as both India and the United States have a massive trade deficit with China and have concerns on on the economic and security rise and some of the steps that China has taken over the years as well.
Okay, Parikshit, thank you so much for that, and thank you so much for joining in with us this morning. But let's move on, and we have Manisha who's waiting by to tell us what's happening in the world of commodities, what's trending this morning. Good morning, Manisha.
Morning, Vinny, and thank you for that. Well, I'm looking at the gold prices because we've seen an all-time high yet again in the early Asian markets right now. Well, the markets are reacting to tweets from the U.S. president where he says the person who has the most gold sets the rules. So clearly some reaction coming in from that, I'm sure. But then apart from that, the concerns on tariffs just about continue. The EU interest rate cut also has enhanced more gold buying into that region. The dollar index is now at a 3-year low below 99, so that has been supportive as well. And if you look at the prices itself, we've seen 12% of gains in last 1 month for prices. And for this year, until now, the gold is up by 29%, clearly outperforming various other asset classes and within commodities as well. The other one that I want to talk about is the crude oil prices, because important developments coming in here. The prices have come off its 3-week highs. Remember, we saw 3% of gains on Thursday. So the US and Iran on Saturday have agreed to draw a nuclear deal framework. So some premium from the prices seems to be going away from that. And then apart from that, it is the US trade deal with Japan and European Union in focus, and the markets will react to that during the day today.
Okay, Manisha, thank you so much for that. Surely keeping an eye out on gold specifically, that continues to shine bright as well. So yes, gold is something that has been trending. Safe haven demand, that's going up as well. But a quick check before we wind down this edition of Power Breakfast in terms of what the GIFT Nifty and Nifty implied open is indicating. A beautiful red start continues. As of now, look at the recovery actually. Bias is still towards the red and negative side, 19 points down as of now. But at one point of time when we started the show, it was down more than 50 points. So, now a slight bit of a muted start is what we're watching out for, not a sharp decline that we're keeping an eye out on. And similarly, like we marked the Taiwan index as well, because that's a bit of a recovery as well from the day's lowest point. So keep an eye out on that. Hang Seng indicating a positive, it started on the positive note as well. So yes, surely keeping an eye out on that. Nifty implied open indicating a 16-point decline. But with that, we'll wind down this edition of Power Breakfast on CNBC-TV18. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
Exponentially, I would say, right, over the past couple of years, and we see the continued growth, carrying on for at least the next few years, as far as we can see, because of the India market, large market, growing at a very fast pace.
Will you also then be applying to the latest PLI when it comes to electronic components? That's something that the government is now pitching for the industry.
Yes, absolutely. So we are following that very closely. The details have also come out, right? And it's structured in a very, very enthusiastic about it. It's a good, encouraging, exciting structure that has come around. It is also finding sync along with the component level incentives that were already finding mention in the PLI 2.0, right, which was already encouraging and also incentivizing, component level activities. Now, this component PLI coming in is perfectly complementing all of that, right, and I feel it is coming at the right time.
Wonderful, Mr. Basu. Mr. Lee, let me come back to you. Help us with a few numbers in terms of what your demand outlook is as far as this fiscal is concerned, and how India is featuring for you as a part of the larger APAC market for ASUS.
Yeah, we expect strong growth in India, but I think now I still cannot tell the exact number. But we have a strong ambition, and I think our year-on-year growth is tremendous.
Wonderful. Any figures for investments that you'd like to share? You said you're looking at India as a much larger hub for not just manufacturing, but also as an R&D hub. Any numbers in terms of what your employee count could look like by the end of a couple of years, or any investment, any numbers in terms of dollar figures that you'd like to share?
It's more than double digit. It's a strong investment, strong growth on all the investment in India.
So holding cards to your chest. But let me then dive into the one big elephant in the room that most industry players have been talking about. That's the tariffs, the US-led tariffs. Let me ask you this decision to expand your portfolio of manufacturing facilities here in India, did the US tariffs have a role to play in you arriving at that decision that perhaps India is a good destination for hedging your bets?
Yeah, I think, we are discussing internally because this just happened recently, right? There are a lot of discussion in our headquarters. Yeah. And we are working on the long term, how we should grow our business in India.
So let me then ask you a follow-up question. There's been so much back and forth. You're telling me that you're discussing this internally. There's been so much back and forth. First, we had the tariffs. Then we had an exemption for electronics. Then there was, of course, the 90-day pause. Now there is talk of the latest interview that Donald Trump gave where he's talking about sectoral tariffs targeted towards the electronics industry. How are you gearing up for this volatility that you're seeing every day back and forth in terms of what the outlook could be?
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Mangalam. Guys, hi, good morning. And I think after 2 weeks of holiday shortened weeks, this is a full one.
Yes, sir. So it's the start
Till
of
the
a
next
new
one.
week and the end of the streak of shortened weeks that we had gotten. And this one's a heavy week. We have a bunch of earnings reactions this morning. Then you have HUL, I remember Tata Consumer, end the week with Reliance earnings on 25th.
And you've got HCL Tech Mahindra. I think about 6-7 Nifty earnings which report, and then you've got the expiry as well, and lots to track. We'll be at the mercy of Trump and tariff announcements and the negotiations.
It's a nice dress, Reema. You're looking
Thank
nice.
you. Thank
And,
you. Green is the color?
Green is the
Green
color.
is the color.
Green is indeed the color.
I mean, I think, it's looking better. It's looking better despite, disappointments from Infosys and maybe, otherwise, generally the environment, apart from Infosys, ex-Infosys, even if you take out some of the other results which came post-market hours on Friday and over the weekend, it's not looking all that bad. So, well, let's just get to it. And of course, we'll take it from the top in terms of global, where we left off, etc. So where we left off was a very good week. So it was a very short week, but it was a punchy one. 3-day week, last one, right? Monday was shut, Friday markets were shut. And look at the change, 4.5 on the Nifty, 6.5 on the Nifty Bank, and the small and the mid-cap indices up 4.5% apiece. So this is, a very, very good way. And by the way, this is the second week that the markets have done recovery in a very strong fashion. So let's take it forward. We have over the weekend data which shows the first estimate of the impact of the US trade war. This is data from an organization which contains container bookings around the world, and they track about 65% of all container which moves on seas across the world. And this is what it shows. This is April first week compared to last week of March. US imports coming into the US are down 64%. US exports are down 30%. Now, just one caveat, because the 2nd April the tariffs were coming in, and that was the pronounced date when Trump would have announced tariffs. A lot of exporters and importers would have sent in and sent out their stuff to beat that deadline. And this data most likely would be marred because of that. But even if you adjust for that, these are very large drops that we're talking about. And we'll look at this closely. Of course, this is the first week of April, and we'll get more as we go along. This week, you get the April flash PMI numbers, which I think will be also a very good first read on global impact of Trump tariffs. Consensus expectation, I looked at some numbers, they're expecting a small down, but nothing very large. But I think markets will be sensitive to this. World Bank, IMF spring meetings. This is only important, it happens every year, but this is important essentially because leaders will gather and, maybe some commentary around the impact of Trump tariffs. So that headline risk is there. G20 finance ministers and central bank governors meeting April 23rd to April 24th. Again, for the same reason. Heavy earnings, 34% of S&P 500 will report in the coming week. This week, basically, macro markets are all steady. The 10-year $4.3 index near 100. Oil has bounced back from about 60 to 68. We're about 68 now. As of Friday's close and over the weekend as well. The one commodity which has done phenomenally well is gold. Gold is up 7% since the 8th of April, which is when the tariffs were paused. And if you look at broker after broker, everybody is basically bumped up their estimates of where they see gold by the end of the year. By the way, this is the best start as of today. This is the best start gold has had in any year going back to the 1970s. Basically, January to April, you go back and this is the best start to any year since the 1970s. So super one there. Just India, and of course, the trade negotiations, I think a lot of focus will be there. So India's trade team led by the chief negotiator, Rajesh Agarwal, will visit the US this week. And they're going to be speaking to their American counterparts for 3 days starting the 23rd of April. Remember, this is not to hammer out a deal straight away. This is to kind of agree to the outlines of, the various things that negotiations will touch upon. So this is kind of, a prelude to the actual negotiations which will happen. The timeline which has been given to us is that we'll probably get to hear something in terms of a bilateral deal. This is not the tariffs per se, which Trump has announced and has paused now. But this is a trade deal between US and India by fall of this year. That essentially has been the guidance. And of course, that FTA between India and UK, we reported source-based information that is moving towards the final stages. So with having said all of that, let me quickly put out the levels. Nifty on Thursday retested the March highs of 23,869, but we did not close above it. So that becomes the first kind of starting point. The next resistance comes in at 23,960 and then 24,551. 24,551 is a number we put out earlier as well. It's the 61.8% retracement of the full fall that we've had. Support for the Nifty, 20-hourly average, 23,460, and then the 40-hourly exponential, which is 23,225. Bank Nifty is almost back to its all-time high, which is 54,467. That's the first level to take out. But then now you got above all-time highs, you got to use extensions. And here, upside levels are 44,474 and 54,474 and then 56,631. So these are the two levels. And support for the Nifty Bank comes in at 53,095. Again, 20-hourly and the 40-hourly exponential, which is 52,369. The mood is generally quite all right. Lots of Asian markets are still shut because of the Easter weekend. But the mood generally is not all that bad at all, despite that infy miss that we had. 18 points lower is what you have on the GIFT Nifty.
Indeed, the bulls have regained control on Dalal Street. We ended higher for the second consecutive week, and we've also recouped all our tariff-related losses by closing above the March swing high. Not closing, but by moving above the March swing high, but not closing above it. But let's straight away get to the cues for the week. In terms of corporate earnings, on the IT side, you've got HCL Tech and Tech Mahindra. In terms of consumer names, it's HUL and Tata Consumer. You've got an Axis Bank and SBI Life in the financials, and Maruti in the auto pack. And globally, all eyes will be on Tesla. Tesla, remember, has down 36% YTD. And globally, Tesla and Alphabet will be on investors' radar. Back home, you've got the monthly April expiry on Thursday. And not to forget, US Vice President J.D. Vance will be visiting with his family India today. It's more of a cultural trip, but it's still the first American vice president to visit India in 12 years. And there is that dinner with Prime Minister Modi. Wall Street on Thursday had a bit of a choppy session. The big story was United Health, which plummeted 22-23%. And that has about a 9-10% weightage on the Dow. So Dow closed down with a cut of more than 1%. US President, by the way, we're not bereft of any drama over the weekend. US President stepped up his attacks on Federal Reserve Jerome Powell. He posted on Truth Social, and that quote is up for you on your screen. Jerome Powell of the Fed, who is always too late and wrong, yesterday issued a report which was another typical complete mess. Powell's termination cannot come fast enough. In terms of flows, the FIs bought in the cash for the third consecutive day on Thursday. They bought about 4,668 crore. Stocks to watch, well, three of them, top of mind, Infosys, HDFC Bank and ICICI Bank. Infosys ADR closed with a gain of about 2.5%, but in after-hours trade, it was up more than about 2%. And, Infosys, through FY25, kept raising their guidance. Thrice they raised it. They started the year with 1 to 3%. They kept raising it, finally made it 4.5 to 5%. But ultimately, given the way the year ended, FY25, they couldn't hold on to it. So that's the story for Infi's guidance.
That's the story for Infi's guidance. Let's see whether, you guys are talking about India doing extremely well. In the times of uncertainty, there's just gold and India, both of them doing extremely well. So if you just take a look at the way the markets are poised right now. On Thursday itself, the Indian indices did extremely well. The Nifty went back to that 23,850 mark. The Nifty bank went within 60 points of a fresh record high. The mid-cap index at an index level was underperforming by gaining just about 0.2%, but by and large has been doing extremely well. The important part is whether this outperformance continues or not, because Nifty is now up 2,100 points from tariff level lows of 21,745 odd itself. And if you look at India versus the world, in the last 1 week versus the last 1 month, India is the only index which has done extremely well. The last 1 month, Nifty is up around 2.15%, an outperformance of anywhere between 6 to 10% versus Nikkei, Hang Seng, Dow Jones and Nasdaq. Last 1 week itself, the Nifty was up 4.5%, as was the Sensex. The Nikkei was the only major global index which was in the green. The others, all of them in the red. So India has clearly been shining, has been doing extremely well, and a large part of that has to do with our domestic-facing names. Now the problem is that the Nifty is around these congestion zones. 23,800 to 23,900 is where the Nifty's high was on Feb 5th, March 25th and April 17th as well. Can we be third time lucky? The answer to that will depend on a couple of things. One, on the way up, we have the 200-day moving average on the Nifty. Do we conquer that? And secondly, can the Nifty Bank lead this rally once again? The Nifty Bank likely to hit a fresh record high today, went within 60 points distance from a record high on Thursday. And the answer to where the Nifty Bank goes on to the result reaction that we will see from both HDFC Bank as well as ICICI Bank. From a flows standpoint, all things are pointing in the up direction. Why is that? Because in the cash market, FIs buy for 3 days in a row. In index futures as well, they've been covering their short positions over the last 5 to 6 trading sessions. If you look at it, we started April 9th with about 22% long exposure. Now that's gone up all the way up to 30%. Shorts coming by lower by almost 40,000 contracts. And levels that we're looking at lower levels, we have strong support at 23,650 thereabouts, because the 23,800 put is very active. 23,850 call tells you that maybe at around that 200-day moving average mark, we might see a little bit of supply. But if that were to hold on, then there are positions for this expiry which are expecting the Nifty to go all the way up to 24,250, 24,300 thereabouts itself. Put call ratio is at 1.16. Remember, nearly 1.2 is where we see the market being a little overbought. Even though we've rallied, we're a slight distance away from being overbought. And a couple of stocks that I'm watching out for today. We have Angel One, which has entered F&O ban after the result-related move. And we have Birlasoft, which is out of F&O ban. So those are a couple of counters I'll be watching out for today.
Thank you very much for that. Let's get to the equity calls then. Sayan Mukherjee of Nomura expects the Nifty to trade in a range of 17 to 20 times 1-year forward earnings multiples. They say they reset the March 2026 Nifty target to 24,970, which is based on a 9.5 times FY27 estimated Nifty EPS of 1280. After factoring in a 5% cut to current consensus estimates, he says they raised the target valuation multiple from 18.5 times to 19.5 times to factor in the drop in yields, assuming no material increase in risk premium. Science says in case of a stable risk environment, they expect FII flows to be supportive after the intense sell-off over the last 6 months. He says their portfolio stance is selective with a preference for domestic businesses.
Ed Yardeni is with us, President Yardeni Research. Ed, good morning. Great to have you with us here. Thank you very much for your time.
Sure.
Ed, I just want to start with something we don't talk about very often, which is gold. A best start to gold since the 1970s, 7% since the tariff pause. Well, that's great news, but gold typically goes up in times of uncertainty. So if gold is doing so well, can everything else do well as well?
The answer is probably no. I think gold has to be in a portfolio as an offset to all the turbulence and uncertainties we have impacting all the other markets, the financial markets. Certainly stocks and bonds have been volatile, and as a result of that, I think owning some gold, maybe a lot of gold, to offset that volatility is an important thing to have in one's portfolio.
Okay, so I mean, this kind of sharp move, not exactly a great thing, right? I mean, in terms of just if you're trying to gauge what kind of sentiment is.
It depends if you own it, it's fine. We've been recommending positioning in gold since it crossed above 2,000 last year, and just looking at kind of the channel that it's in, it could get to 4,000 by the end of this year. And if it gets to 4,000 by the end of this year, I'd say the momentum could carry it up to 5,000 next year. And that's just a bet that if Trump is going to upend the old world order, and now what we have right now is the new world disorder, nobody really knows how this will all play out. And that could be a protracted period of uncertainty that's been unleashed by Trump's tariffs. So I think gold continues to do well. I do believe that there's going to be some resolution of this tariff issue by July 1st. Remember, on April 9th, the president postponed the reciprocal tariffs until July 1st. I think there's going to be some good news along the way, and that should help the stock market. But I think gold will do well because central banks continue to buy it.
Ed, I was talking to somebody on Friday, and we were just chatting about what's going on. He said, well, the failure, it's the inability to make money in the market is now just a failure of imagination, a lack of imagination. Because who knows, right?
Imagination. It's always good to have imagination. But look, it's
no. My question is this: I mean, this entire question of what happens. Trump constantly threatening to fire. Not threatening to fire. He says, "Well, he'll be gone if I want him gone." Now, if something like that were to come to a bit of a head, what happens? I mean, what's the thing to do? Gold? So the conversation was in that context. So I just wanted your thoughts there.
Well, look, right now we have a trade war. That trade war could turn into a currency war. And in addition to that, we have the potential for actual wars. There is a war going on between Russia and Ukraine. The Middle East situation remains on the boil. It's conceivable that there still will be a military choice made by the United States and Israel to neutralize the nuclear facilities of Iran. And of course, China and Taiwan is a major issue. Before the election, Trump was interviewed by the Wall Street Journal about how he would deal with Taiwan. And he said he wouldn't do it militarily. He would just slap a huge tariff on China if they tried to invade Taiwan. Well, the problem is he's already played that card. He's already imposed a huge tariff on China. So China now, from a geopolitical perspective, say, well, what else could he do? What else could he do to hurt us? Let's go and instead of practicing a blockade of Taiwan, let's implement it.
Right. Purely out of curiosity, how much of gold's outperformance would you attribute to its own outperformance, in the sense that a lot of people are buying gold because it's doing well, or how many of them are buying because of the uncertainty in the world? Street is worried about the financialization of gold, so to say. Yeah. They've started looking at it more as a positioning than any sort of protection from the uncertainty that we're seeing. So I want your thoughts on that. And, while everyone's moving towards gold, are there opportunities in any equity markets in the US or the world?
Well, I think what you mentioned before, that sometimes investing could be just simply running out of imagination. Doesn't seem to be any rush to be loading up on stocks here, at least in the United States. It looks like we're going to continue to kind of churn here, maybe be very choppy to the sideways. Bond market looks like it's, despite its volatility, it looks like it's settling in around 4.5%. And meanwhile, as you said, gold is a hedge against all sorts of things like inflation, like political uncertainty, like global chaos. And we have all those things in place right now that continue to favor gold. Clearly, it could kind of feed on itself. And, it's interesting that recently it's gone up faster, almost at a parabolic pace. And that's usually an indication that it's due for some sort of correction, because somebody's getting in at the top, at least on a short-term basis. But I don't think this is a top. I think if there is a correction, it'll be an opportunity. I think there's a potential for gold to go higher. Again, simply because there's a lot of central banks of countries that don't like the United States, don't get along with the United States. They really just don't want to have dollars in their reserves. So they're going for gold, they're going for euro right now.
Ed, we're at the mercy of all the trade negotiations. Last week, it was Japan holding high-level trade talks with the US. This week, it's South Korea. with, visiting the U.S. with trade negotiations in Washington. In the emerging market basket, what is the approach now, and where does India feature?
Well, I think India is right at the top of the list of countries that the United States wants to have a deal with. The thing is, it usually takes a year or 2 years to negotiate trade treaties. There's so much involved. I think in this case, the administration would just like to have a piece of paper that's signed by various countries agreeing in principle to certain things, like reducing their tariffs, like reducing their non-tariff barriers to trade. And I think the United States will get that. I think the president is going to declare victory by July 1st. And with regards to India, I think that'll be the case as well. I think what's happened very helpful for India, certainly in the stock market, is a realization that unlike China, India has a much greater potential for growth domestically, whereas China's got the demographic issue is a negative. In India, the demographic issue is a very big positive.
And this despite the valuations at which India trades at right now?
Well, look, there's a lot of money in the global system that would like to be invested. Not everybody wants to be putting it into gold. Not everybody wants to be putting it into treasury bills. And meanwhile, U.S. stocks are still relatively expensive and volatile. Bond markets become somewhat more unpredictable. The whole concept of U.S. assets as a safe haven is being challenged right here. So, yeah, I think global investors are willing to pay up for India because they perceive that India is maybe has a more stable economic outlook and a more positive economic outlook than maybe many other countries around the world.
That point that you said, right? He just wants to declare victory, but he's put tariffs so high that he's got so many ways he can declare victory, right? He can declare victory at, if the tariff is 150, he can declare victory at 125, 100, 95.
Doesn't really matter.
It doesn't matter. He can do it. Absolutely. So in a way, someone we were speaking with, I think 2 weeks back, said maybe it's hard assets and EMs. And in EMs, India is right at the top in that sense. Make sense, Ed?
Yeah, I think there's a lot of things that don't make sense right now. And I think that the whole tariff issue we're all confused about because we really don't know what the administration's end game is. It's not even clear that the administration has an end game. So in this kind of environment where people are looking for some certainty. For a while there, it looked like they were jumping out of U.S. assets and going into China and into Europe. Now I think there's a realization that, well, wait a second, these are the areas where the trade war is most intense, and less intense is probably going to be the trade war between the United States and various emerging economies, especially India.
All right, Ed, very good conversation and very good primers to start the week with. Thank you very much for joining us and running us through your views and your perspective. Well, let's quickly run you through what's coming up here in the next 2.5 hours or so, what's lined up. So at 8:30, you will hear from Prakash Devan, and he'll be talking individual stocks. Lots to discuss there. 9 o'clock, you'll hear from Bhavin Shah of Samiksha Capital. IT is in focus, and Bhavin is one of the sort of not oldest, but the most veteran kind of IT analyst, of course, runs a fund now. 9:20 a.m., Pankaj Murarka of Renaissance Investment Managers will be with us on markets. 9:30, Angel One reported numbers. We'll, of course, talk with Dinesh Thakkar about what the quarter is looking like. At 9:40, we've got a discussion coming up on the India-US bilateral trade talks. Remember, as we said, the India team is in the US this week. A little later at 9:50, Quarter Se Quarter Tak and Digant Haria of Green Edge Wealth Services will be with us to tell us what to expect from the NBFCs in the quarter. And towards the end, it's the economy with Lata in conversation with Santanu Chakrabarti of BNP Paribas to discuss the quarter gone by for big banks like ICICI and HDFC.
Right, with that, we'll take a short break. But as we do that, on the other side, there is a bunch of stock-specific action to track. We'll get to it in just a bit in our top 10 segment. We'll be looking at HDFC Bank, of course, post results, Infosys, ICICI Bank, HDFC Life, Mastech, a bunch of result reactions. Then we have Adani Ports, Divi's Labs that are on our radar on the back of positive news flow. On the other side, we have Eternal, which is Zomato, Tata Elxsi and Oberoi Realty stocks that are likely to open in the red.
Howard is a joke, teaches hate and stupidity and should no longer receive federal funds. These are the words of America's most powerful man, who's going after America's most prestigious, richest and the oldest university. I'm talking about US President Donald Trump. The US government has now threatened to ban Howard University from enrolling foreign students after the university said it will not surrender its independence. What does it mean? Let's understand the controversy in detail. Now, the US Department of Homeland Security, or DHS, has threatened to revoke Howard University's certification to enroll international students. This comes after the Trump administration decided to freeze over $2 billion in federal funding and cancel $2.7 million in DHS grants. Now, why is Trump going after Howard? Well, he has accused the university of allowing anti-Semitism and promoting ideological bias against Jewish students. Remember those protests that happened across most universities in the US last year in the wake of Israel's attack on Gaza last year. Now, many students
Welcome back. It's a Monday morning. We've got lots of stocks to navigate through, many on the earnings front. Our entire team is standing by for CNBC-TV18's list of top stocks for the day. And first up, it's Abhishek on HDFC Bank. Abhishek, how did the numbers look?
Well, strong operating performance if you see from HDFC Bank, especially the core operating profit. P&L, both the NI and PAT is a beat on our poll. NI beat of about 4.2% and PAT beat of about 3.3%. So the core operating profit, that is operating profit X of Treasury, grew by 20.5% YOY and almost 5% sequentially. The net interest margin on total asset is at 7-quarter high of 3.54% versus 3.43% in the previous quarter. This has a one-off with respect to 5 to 7 basis point on IT refund. However, X of that also at 3.46% versus 3.43 in the previous quarter. The net interest margin trajectory has improved versus the expectation of 2 to 3 basis point decline on net interest margin. Asset quality continues to remain impeccable amongst the large caps, and it has improved in this quarter as well. Both the gross NPA ratio and the net NPA ratio have declined on a sequential basis thanks to lower than estimated slippages coming in from them. Back to you.
Right, Abhishek, thanks a lot for that. We also got Infosys. So it's Nifty Bank and Nifty IT, both of them on our radar. Rima, how did Infosys numbers look?
Well, numbers were disappointing. The guidance was lower than what the street was anticipating, but just take cues from the Infosys ADR. Yes. Infosys ADR was down 2.6%, but in after hours, it was up 2%. And this is the brokerage reaction to the guidance. The guidance for FY26 is 0 to 3% on the top line. Margin guidance is 20 to 22%. As you can see, the guidance is lower than what the street was anticipating. But this is what JP Morgan says. JP Morgan says the FY26 guide of 0 to 3% is below prior expectations set 3 weeks ago. But it's better than the recently feared post the tariffs and the uncertainty impact flagged by Wipro's print. Citi too concurs that FY26 revenue guidance is decent in the current backdrop, though at the higher end, it does look aggressive. So in a nutshell, it does appear that yes, it's weak. The print is weak. The guidance is lower. But compared to the sentiment that was in the market towards tech in the last 1 week, it doesn't appear to be so bad. Now let's get to the Q4 numbers. Revenues sharply lower. Constant currency revenue down 3.5%, lower than expectations and lower than what peers like TCS and Wipro reported. The company also missed achieving its FY25 guidance of 4.2% at 4.2% after the Q4 miss. The positives in the numbers were the margin performance. The EBIT margin performance at 21%, slightly better, and deal wins continue to remain fairly intact at $2.6 billion. Also bear in mind, the stock is down 24% since the start of the year.
Well, so yeah, price damage, a lot of price damage from the beginning of the year. Rima, thanks very much for that. And we'll see what happens as things open up. The backdrop for the market per se is not all that bad, so keep in mind that as well. ICICI Bank is the other one. Stellar numbers once again. Abhishek is here with details. Abhishek, morning.
Morning, Prashant. So on the weaker side was the loan growth for ICICI Bank. However, P&L is healthy and asset quality continues to remain impeccable. Continued improvement trajectory seen over there. So P&L versus our poll, the NI was 1.5% ahead of our poll, and PAT was about 5.5% ahead of our poll. Now, what didn't work in the result? The deposit growth of 14% YOY is perhaps one of the weakest growth that you are seeing in last 8 quarters. But look at the industry as well, growing at 10 to 11%. That augurs well. However, advances disappointed. Advances growth is at just 13.3% YOY and about 2.1% sequentially. Now, YOY, this is the weakest growth that you are seeing in last 17 quarters, and sequentially, that is quarter on quarter, it's the weakest growth that you are seeing in last 5 quarters. ICICI General as well as ICICI Sec, they saw their PAT decline both YOY and quarter on quarter. Now, what's worked in the result? The net interest margin is at 5-quarter high, 4.41% versus 4.25% in the previous quarter. They have given the quarterly highest ROA, that is return on asset, coming in at 2.52% versus 2.36% in the previous quarter. Cost to income ratio is one of the best that you are seeing in last 19 quarters. So 19 quarter low operating efficiency, 37.9% versus 38.5% in the previous quarter. Even the quarterly annualized slippage ratio is at 17 quarter low of 1.53% versus 1.85% in the previous quarter, and that's helped the asset quality improve as well. Gross NP ratio is down to 1.67 versus 1.96% in the previous quarter. So P&L and asset quality auguring really well for them. However, loan growth was weak this time around. Back to you.
Got that. Thank you very much for that. It's over to Yash now for HDFC Life.
Well, Rima, the numbers are broadly in line. In fact, there was a margin improvement which was seen in the 4th quarter for HDFC Life. Total AP saw a slight miss as compared to what the CNBC-TV18 poll estimated. I'll take you through the exact numbers. The total AP grew by about 10% on a year-on-year basis. It came in at about 5186 crore. As I said, it was a slight miss to what the street was anticipating. Value of new business broadly in line. It grew by about 11.5%, came in at about 1376 crore on a year-on-year basis. As I said, there was a margin improvement. The margins were higher, of course, on a year-on-year basis as well as against what the street was anticipating. They were up by about 40 basis points at 26.5% versus 26.1%. I'm going with green on the stock simply because there was a beat which came on the margins, but also the street needs to be cautious. The management has not given exact numbers but guided for the first half of FY26, where they say that the base impact and volatility in equity markets would mean that first half of FY26 could remain soft for the company.
Right, Yash, thanks a lot for that. So the VNB margins may support HDFC Life Insurance stock today. Rima, what can you say about Mastec and weak numbers coming from Tata Elixir?
Indeed, let me start with Mastec. Now, Mastec's revenue performance was not bad, especially compared to what peers have reported, though margins came in lower. The company's top-line growth was 2.9%. This we're seeing in context with larger companies which reported a sequential decline. That said, margins for the company dropped to 15.3%, lower on a quarter-on-quarter and on a year-on-year basis. 12-month order book went up by 7% and the company has cash on its books. But on the whole, top-line performance order book was fairly decent. Tata Elixir was a disappointing quarter. The company's revenues declined by 5.3% on a quarter-on-quarter basis. Their EBITDA margins, profits also sharply lower. EBITDA margins at 22.9% compares with 26.3% a quarter ago, and profits too are the lowest that we've seen in the last many quarters. The company, in its assessment of the quarter, said that the automotive business witnessed challenges in the quarter as some of the OEMs paused new program starts in the face of uncertainty. Media and communication also saw some customer-specific issues, and overall, the industry continues to exercise caution on their R&D and innovation. So we'll watch for Tata Elxsi, but even the other ER&D companies, because if automotive is weak, right, for Tata Elxsi, automotive revenues declined by nearly 10% quarter on quarter. And the company is calling out the new projects were put on hold. That means companies like KPIT Tech could also have a fairly challenging quarter. So we'll watch for the others too.
Watch for Tata Elxsi, watch for KPIT Tech as well. But I'm watching out for erstwhile Zomato, now Eternal. The reason for that is the company has approached shareholders for approval of their foreign shareholding to be capped at 49.5%. Remember, this was expected because from the time the company raised about $1 billion via QIP, increased their domestic shareholding, this is what they wanted to do. Why is it that they want to do that? Because remember, currently the law prevents foreign ownership of multi-brand retail. Is the company in accordance with the law right now? Definitely. But what if in the future quick commerce is deemed multi-brand retail? So this foreign shareholding cap protects the company from potential regulatory risks around foreign ownership in multi-brand retail over the long term. So that's a long-term, medium to long-term positive. But in the near term, this is a negative. Why is that? Because capping the FPI holding results in exclusion from passive indices like the MSCI in the very near term, which means there could be outflows of almost $1 billion as per various quant analysts, and that could be a bit of a dampener on the stock or a bit of an overhang on the stock, the outflows coming in on account of passive flows.
All right, Mangalam, thanks very much for that. Adani Ports is the next one. Sudarshan is here with details. So good morning.
Morning, Prashant. So Adani Ports has announced the updates related to Australian port assets. Company will be acquiring about port holdings from Carmichael Rail and Port Project, and it's a non-cash deal and a related party transaction. Company will be issuing nearly 15 crore shares to Carmichael Rail, and that will help promoters' stake in Adani Ports increasing to around 68% from current holding of 66%. Also, analysts believe that the valuation that this deal is done at the old valuation of around like when it was in 2013, and that will be positive for the company because the valuation has not been taken as the increased valuation that the About Point Holdings has seen over the last 10 years. And this is done at EV to EBITDA of 17 times on FY25 estimated EBITDA of the asset. And what's the rationale of this acquisition? Because this transaction is part of the strategy to handle 1 billion tons of cargo by 2030 that Adani Ports had given. Also, it sees 15% of 2030 cargo to come from the international operation, and the acquisition of About Point Holdings will play an important role in that part as well. And that's the reason I'm going with green for Adani Ports.
Thank you. And it's over to Vinny now for Divi's Laboratory. Vinny, what's the latest?
Good morning. So in terms of Divi's Laboratories, we do have a positive news that's come in where the company has signed a long-term supply deal with a global pharma company. This is mainly for the manufacturing and supplying of advanced intermediaries. This comes under the custom synthesis business. Now, this is expected to meaningfully add to the revenue of the company, as well as they're planning to invest 650 to 700 crore rupees in capacity expansion for this deal that they've signed. This is going to be mainly through internal accruals. As on 31st of December, the net cash that the company had was around 3,659 crores. So there's no problem in terms of cash that they have. The company is looking to expand its custom synthesis business. Last quarter, the growth in this segment was around 44% on a year-on-year basis. Contribution was around 53%. And this is what has been in the last few quarters as well. 40+% growth in this segment, as well as around a 50% revenue contribution that has come in, where they're exceeding and are hoping to expand this furthermore. So margins is something that could furthermore benefit if this expands further as well.
All right, Vinny, thanks a lot for that. With that, we go across to Ria, who is the newest entrant to our research team. Ria joins in to talk us through what's taking place in Oberoi Realty. Ria, welcome.
Well, yes, Oberoi Realty will be in focus today on the back of its Q4 operational update. Now, for FY25, the bookings value has gone up by around 31% over the previous year. But for Q4 specifically, we've seen the bookings value coming in at just about 853 crores in this quarter versus 1,775 crores that we saw in Q4 of last year. And we've seen a decline of almost 52% over the previous year. Even if you look at the number of units sold, we've seen good growth in FY25. But for Q4, we've only seen 78 units being booked versus 228 units booked that we saw in Q4 of FY24. So muted performance for Oberoi Realty in Q4, and we're also expecting some launches to be deferred to FY26. So expecting red on Oberoi Realty.
Thank you very much for that. And a quick recap then of the top stocks. Stocks with positive news flow are HDFC Bank, Infosys, ICICI Bank, HDFC Life, Mastech, Adani Port and Divi's Laboratories. Stocks with negative news flow are Tata Elxsi, Eternal, that's Zomato and Oberoi Realty. Well, nothing is shining brighter than gold over the last couple of days, and Manisha joins in bright and early this morning to tell us all updates on gold, the prices it's at and where it's headed. Manisha.
Well, thank you for that. Absolutely. You know, every 15 minutes we are making a new high since the Asian markets have opened today. So currently we are trading above $33.85 an ounce. It has been one strong run. The year started with $26.50, so we are at $33.85 right now. It has been an $800 of a jump up that we've seen in the gold prices. Well, three things that have been supportive. One, the dollar index continues to decline. The U.S. president statements, whether it comes to negotiations, tariffs, has been keeping the markets uncertain. And the Trump statement on firing U.S. Fed Powell really led to a lot of buying as soon as the markets opened. That is what most of the buyers seem to be stating right now. So the prices are up 29%. Pardon me, in this year, and 45% up in the last 12 months when you look at the markets there. Not just gold, when you look at the metal prices, we've seen some gains here as well. So copper is trading 2.5% on the higher side right now. The markets also have seen stronger gains come back in case of steel and iron ore. What isn't doing so great right now is the crude oil prices. After gaining 3% on Thursday ahead of the long weekend, we're down nearly a percentage point at this point in time as US and Iran will reconvene on conversations and will draw a framework on the nuclear deal. That is something that's led to some premium of those prices.
All right, Manisha, thank you very much for that. So there's gold and there's oil in focus. We'll take a quick commercial break here. Prakash Devan with some fundamental stock conversation on the other side. Stay tuned.
Howard too. Now, what does Trump want? The White House has demanded that the oldest university in the US make changes to hiring, admissions and teaching practices, which it says will help fight anti-Semitism on the campus. The US Department of Homeland Security has demanded detailed records by April 30th, 2025 on visa-holding students' involvement in those protests, disciplinary action taken by the university or any perceived threat to campus safety. Yes, that is the deadline. And what if Howard doesn't listen to the government? Well, then that would result in the loss of Howard University's Student in Exchange Visitor Program certification, which will effectively bar the university from admitting new international students. Howard is the first university in the US to push back against Trump's threat, and the consequences are for everyone to see. The American government has identified 60 universities.
Welcome back. You're watching us here on Bazaar Morning Call. The GIFT Nifty indicating a mildly negative start, but that's really nothing given the sort of outperformance that India has seen. 2,100 points from the lows. The Nifty Bank leading the rally out here as well. Prakash Devan joins in now. Prakash, good morning. It's the start of a fresh new week, but we had a bunch of news flow over the weekend as well. There was Infosys that came out of the numbers. We had HDFC Bank, ICICI Bank, and a bunch of these mid-cap IT names as well. So I'd like you to, weigh in on your opinion with HDFC Bank, point number one. Can the outperformance continue? And secondly is Infosys. Do you think the weakness is in the price?
Good morning, Manglap. So, I think the today's session is going to be dominated by the salience in the private sector banks. That's already evident. And remember, this week you also have Axis announcing its numbers. So there will be a lot of expectations built in. And what these numbers tell you is that look at where the setup, where these banks kind of find themselves in the setup. You have cost of funds likely to come down, NPAs that have probably troughed out. You also have the fact that some of the banks like ICICI had retail loan books growing, which is very helpful because the margins are much better. NIMs have kind of steadied themselves in this band. So from here on, the market will look like, very positively at allocating more money to these banks. And I think that will also benefit some of the largish PSU bank because their cost of funds has always been an advantage. And then I say the largest bank will probably be just the top three, which is SBI, BOB, Can Bank. But you will have a lot of the smaller private sector banks start participating in this reset on the allocation part. So it's just going to be fairly good for financials. And while the BFSI vertical starts attracting attention and capital, remember you have even the geo financial numbers have come in this challenging environment are pretty good, especially the top line growth. They've managed to start flexing. And remember, this is just the beginning. There could be a big scale up going forward. So I'm quite positive on the space as a whole. And my sense is Bank Nifty will probably lead the charge for whatever up move potentially is there on the Nifty. You'll have it because there's a lot of heavyweights that will do well among them. So that's very clear. On Infosys, my sense is it's, most of these largest IT plays will probably go into a time correction, if not a price correction for the next 6 months at least till things ease out. And then they'll probably become better dividend yielding plays. So where 4%, 4.5%, wherever they are, is not a bad deal for people who are looking at the long-term accretion of dividend to portfolios. But I'm not still of the belief that IT will face some issue. Look at how Tata Elxsi got knocked up. It tells you the struggle that some of these otherwise leadership plays were enjoying. That's not available for them to grow. So we will have to be patient with the IT turnaround. But given the way the banks are leading the charge, I think that will become a very, very good play, at least in the next 3-4 months.
Got that. So time correction, maybe some price correction as well for IT. Banks looking good. I mean, ICICI Bank, amazing, right? I mean, I don't think there's been one quarter since Mr. Bakshi has taken over that the bank is disappointed. And he's kind of sort of managed to do that quarter after quarter after quarter. So let's see how this opens up this morning as well. Prakash, so many things to talk about, but let me just pick one from like a carryover from last week. The best performing large name last week was IndusInd Bank. Was up 15% in 3 days. Actually, it was all banks, to be fair. But IndusInd specifically, I mean, it's not so much a banking play, but it's a specific situation there, right? What's your sense on IndusInd?
Good morning, President. So I do agree, the findings were not as disappointing as what was anticipated. And given the fact that the management itself had anticipated the losses to be far bigger, the market already penciled that in. And it came in as a little bit of that relief. And when the entire sector is getting re-rated, it was one of the most damaged, fractured stocks. So there was a little bit of that action. But, for all you know, today the Yes Bank numbers can get a lot of people excited because, everybody has this whole thing saying, what's the next quick up move? And there's a lot of trading mindset that's at play, Prashant. It's not, I don't think IndusInd is being bought for a long-term, reset. It's probably a, quick recovery that everybody was anticipating, and that's played out. I wouldn't really bet on that to continue. You may have the likes of IDFC and all actually get into a little bit of a prominent trade spotlight because of the fundraise that they've done, the kind of numbers that could improve year on. Because this time around, the money is not coming from too many investors who you had to push the equity to. You got the money from just two large investors who would have seen the unit economics, seen the kind of numbers on the ground improving. So I possibly would believe that you'll have other banks feature. IndusInd probably has done its bit last week, and it was quite stellar and quite surprising to my understanding. So I would keep away from those kind of trades. But you will have these other banks which will start kind of getting into the spotlight.
Prakash, you set us up perfectly for the next question. You spoke about people wanting a quick buck, trading mindset, and something not necessarily fundamental. What's really taking place is Gensol, with the kind of price erosion that we've seen on the stock, the kind of worms that have moved, that have come out of the can, the stock down about 5%. The street believes that there are some buyers for the Blue Smart business. After this sort of price damage, after the news that has come by, and after the news that is likely to come by, would you advise anyone to even dabble in names like this?
Oh, absolutely not, Mangalam. See, the potential interest in buying, I don't know whether it was Eversource or somebody that I read over the weekend, would have their own reasons to, buy, and there would be assurances which you and I as retail investors may not be able to enjoy. And in that process, it's extremely skewed, against investors, retail investors to participate. So I think it's going to be largely a structured transaction which will have its own bells and whistles for whoever wants to buy. Because on the other side, the existing investor base is fairly strong and influential, and I'm sure at some point in time that part of the business could be looked very differently. But the overall business doesn't make sense at all. It's a falling knife. Why do you want to kind of even hazard that, especially when there's so much of value available elsewhere?
In fact, let's get to that story because sources revealed to CNBC-TV18 that Eversource Capital is in talks with Blue Smart for a possible acquisition. Parikshit joins us with more on this. Parikshit, what have you picked up?
Well, yes, we believe that Blue Smart has been in talks with Eversource over the last few weeks for a possible stake sale, and we believe that now the talks are at an advanced stage for Eversource to acquire a majority stake in Blue Smart Mobility. Now, this could be a transaction for around 800 to 850 crore rupees. So the discussions are ongoing. We believe it's in a positive direction. But as part of the deal, it's possible that Eversource may want Anmol Jaggi, who is in the board of Blue Smart, to step down as well. Now, he has around a 24% to 25% stake in the company. We need to see what happens to that. But clearly, Eversource wants both Anmol Jaggi and Puneet Jaggi, who were among the co-founders, to distance themselves from the company if this transaction happens finally. Now, a final deal could be announced in the next 2 weeks. So negotiations are happening at a fast pace. This is also coming at a time when Gensol has leased around 5,000 cars to Blue Smart Electric Mobility. Now, Gensol is facing a probe, not just by SEBI, but now by the Ministry of Corporate Affairs as well. So the company, of course, facing heat on multiple counts, but the focus now is on Blue Smart, and we believe that the founders are keen to sell a majority stake in the company at the earliest so that all pending liabilities can be cleared as well.
Looks like this is about saving the business. The business of Blue Smart per se. And Parikshit, thank you very much for that. And we'll see how this transaction goes and get you updates as we go along as well. But with regards to what you should be doing with Gensol, I think you heard that loud and clear from Prakash coming in there, that view. Prakash, just a few other names I wanted your thoughts on. Last week, as the market came up, a lot of mid-caps, small caps also started to recover. I don't know if you have any thoughts on names like Delivery, which was up some 15% last week. Big beaten down names, basically. SW Solar was up some 16%. There was Home First, which came up some 14%. Anything which stood out?
No, so, I would look at what the underlying theme that's emerging from these moves, and not necessarily these moves in absolute terms. The fact that there will be a lot of money coming in, and you've seen FIs turn positive towards India. It's going to be primarily domestic-focused businesses. You have a Delivery which has got nothing to do with external tariffs. You've got SW Solar beaten down. We've seen how the regime is kind of looking more positive than ever before. Though there were doubts in terms of pricing of certain supplies and all of that, but the Wari renewable numbers actually tell you a very strong picture emerging. So I think essentially what's going to happen is all these domestic-facing stocks will actually get re-rated, and some of them are down 40, 50, 60% from their highs. So even if they don't go back to the highs, which I hope they don't, because that was too elevated and risky in that sense, you'll probably have a lot of the earnings catch-up happen faster here, and hence the forward PEs will start giving you that comfort. So a lot of capital will come in there. Simple question, Prashant. If fresh money has to be allocated into the market, where do you put it? And it's going to be these kind of sectors and names. And that's exactly well. So you'll have a smattering of names of the next few weeks that I believe will participate. And the Nifty might not move as quickly to its new highs or closer to the earlier highs. But you'll have the broader market see a lot of this participation. And that's the opportunity.
Is there any particular thing that you like in there?
Maghrib, there are quite a few which we have narrowed down on, but to be fair, we are also kind of looking at the news flow to participate. But yes, I can tell you very simply, a lot of the PSUs are looking positive, especially in the power space. A lot of the domestic-facing consumption names, discretionary consumption names, which will start perking up. Look at some of these FMCGs, look at some of the pharma names, and all this news flow always gives you the opportunity to buy. So that's why it's a bit tactical in terms of when to buy these stocks, even if you identify the names. So that's why I'm refraining from talking specifically about these stocks at this moment. But I think lower levels will give you that comfort in terms of the risk-reward setup.
Prakash, to stay on, need to slip into a short break. On the other side, we'll get chatting about technical. Sudarshan and Mitesh join in. Stay tuned.
Last month, Columbia University agreed to many of the administration's demands in the wake of the protests after the government cut $400 million in funding. Let's look at some numbers here. International students make up more than 27% of Harvard's enrollment this year. Overall, 6,000 students. How will it impact Indian students? Well, Indians constitute a significant portion of Harvard's international cohort. In 2020, approximately 213,062 Indian students studied in the US, with 505 enrolled at Harvard alone. Now, getting an admission is not easy there, but this move could further dent many students' aspirations. And what is happening in present is not good news for many Indian students. Reports indicate that Indian students across US universities are experiencing anxiety over sudden visa cancellations for minor offences such as traffic violations or even social media posts. Foreign students in
Welcome back. There's 7 minutes to go for the pre-open session. Let's welcome in Sudarshan and Mitesh who are with us with what they'd want you to do with regards to the markets and specific stocks as well. Gentlemen, good morning. Mitesh, what's the view and what are the trades? Let's start with indices first. 6 sessions, 2,000 points in the Nifty, and the mood generally remains constructive still.
Morning, Prashant. See, I think, the first index I would like to comment upon is the Bank Nifty. Now, last time when the Bank Nifty was trading around these levels, we got the highest weekly closing at about 53,830, and this week we closed above that. Similarly, the daily highest closing was around 54,375, and we practically closed about only within the 100-point range of that. So maybe around these levels, you might see some pullback, some profitability. Also is the fact that the Bank Nifty has run up a bit away from its short-term averages. The structure is extremely positive, and I think I'll look at much higher levels. But in case there's a pullback which comes in, I think any decline to about levels of 53,800, 750 zones would be a wonderful entry opportunity on the long side. And I eventually expect the markets to get past 54,300, 350 zones and head towards 55,000. So very positive on the Bank Nifty. Similarly, a similar kind of positive outlook on the Nifty. The only thing is that the Nifty will tackle its 200 average at about 24,050. So you might see some supply come in, especially in the light of the fast rally which has happened. So around 24,050 is the first near-term target, but I'm actually looking at 24,200 as the logical target, and in a good case scenario, 24,800. So positive on both the indices.
Take that point, Mitesh. Thanks a lot for that. In fact, we have Sudarshan as well. Sudarshan, you've been recommending a positional long for a fairly long time. For those who wouldn't have acted upon that, would you say that the best of the gains are behind and maybe they should pause before taking any trading action in the very near term?
Yeah, good morning. It's very difficult to say that the best is behind us or in front of us. What we can say is that the trend is up. So if the trend is up, you must be a buyer in this market. Now, it's anybody's guess whether that trend will dissipate today or it will continue. I don't think we can predict that. There is no sign that the trend is getting exhausted. It may pause, as you said. Can it pause? And yes, absolutely. Because after that big run-up, the markets do need some rest. But that pause, if it comes, should be a buying opportunity. Today's dip is a buying opportunity. The rally we have seen and the gaps we have seen tell us that there is very strong upside momentum. So let's go with it. Be a buyer wherever you can.
And what stocks?
Oh, all right, the stocks. This time, it's luckily the Nifty itself will reward more than the stocks. LIC is a buy with a stop under 785. M&M is another buying opportunity with a stop under 2620. HCL Tech is a try, well, it's a buy on dips really, but buy with a stop under 1410. And Auto Pharma is a buy with a stop under 1140. The theme is that this is not a market which we want to challenge. We go only north.
Right. And Mitesh, your stocks?
Yeah, morning, Mungan. I have a buy on ICICI Bank with a stop at 1385 for targets of 1445. Now, this one might open with a gap up, but then Indian Bank is also a buy. Keep a stop at 564, look for targets of 600. A buy on delivery around 278. So if you get a morning kind of a pullback, enter around 278 with a stop at 271 for targets of 295, and a show clearing. That's a buy with a stop at 214 for a target of 228.
All right, gentlemen, thanks a lot for that. Delivery has been a big mover in the previous trading session itself. That's likely to continue as per Mitesh. With that, we'll take a short break, come back. We have the pre-opening, and also we have Bhavin A. Shah of Samiksha Capital to review the fourth quarter IT sector earnings so far. How much of that is in the price? What should one do?
Sudden visa revocations, as I was talking about social media posts and other things, and this comes amid, the immigration crackdown by the government. Moreover, Indian students who often rely on F1 visas and post-graduation work permits, like the H1B visa, fear that their academic and professional aspiration in the US could be jeopardized because of this.
All right, you're watching us here from the CNBC-TV18 Motilal Oswal studio. This is Open Exchange. About 30 seconds to go for pre-open, 15 minutes to go for the market to open. The GIFT Nifty indicating a mild dip at the open itself, which our technical experts are suggesting use as an opportunity to buy itself. We've been speaking to Prakash Diwan. Prakash, you spoke about a bunch of sectors and a lot of stocks as well. I want your thoughts particularly on the pharmaceutical space, because this morning there's news about Divi's Lab inking their drug supply agreement close to around 650 to 700 crores, the capex on that. And then there was Cipla as well. One of their units in Goa has been classified as a voluntary action indicated by the US FDA, which is one of the milder of the classifications, which means it is a positive. In the kind of decline that we've seen in the pharmaceutical stocks and the impending tariffs that may come for the pharmaceutical space as well as promised by Donald Trump, how do you view this space and what would your bets be here?
So, I mentioned this earlier, Mangalam. Pharma as a space, while it offers value, is got this massive overhang that you mentioned about of impending tariff-related announcements. Now, we really don't know whether actually tariffs come, given the way tariffs are losing their, bite in terms of being a tool to negotiate. But my sense is the best way to play pharma at this point in time, and this is a little bit of a global thing. Remember, there are lots of other positive news flow around pharma globally that's also perking up the sector in Europe, particularly. Eli Lilly's got some announcements. Even some of the Ozempic plays getting active. I would play this with the picks and shovels, theme where anybody who's looking at market reset and geographical footprints being reshuffled, will benefit if you look at a company which is called Indegene in India. Again, a very unique business model. I don't think it has a peer. There are a couple of global players, but then they are very niche in that sense. Everybody has their own strengths and niches defined. But Indegene is the one that uses a lot of intelligence, a lot of insights and input empirical data to support which drug you should be launching at what point of time, given the pipeline, given the maturity levels of that cycle. So, it's a very simple business, but very complex to execute. It's simple to communicate. And I think that's the kind of business which will start seeing a lot of salience, irrespective of what happens to tariffs and some of the specific names that you mentioned. So I would play it a bit safe, and I still find a lot of value given the way it's kind of behaved after its IPO, which is just about a couple of years. So it doesn't have a great history, as in a long history. But my sense is, as institutions understand the business and get empirical data or some track record to build on, you'll probably see a lot of interest in this. So keep a watch. Let's hope they deliver the numbers that are being anticipated. My allocation to pharma is probably restricted only this name yet.
Thank you, Prakash, for your thoughts and joining us on this Monday morning. The early rates on some of the IT stocks, Infosys down 3.5% and Tata Elxsi 2 down nearly 4%. Now, Infi's Q4 numbers disappointed the street. The guidance is 0 to 3% for FY26 is lower than estimates. But as some analysts pointed out, that perhaps the street was fearing a lot worse over the last 1 week. But let's talk about Tata Elxsi because their performance has implications for other companies like a KPIT Tech or LTTS. Now, Tata Elxsi has reported the third consecutive quarter of a miss. Their revenue drop of 5.3% is the worst sequential drop in the last 5 years. Their margins have now fallen in 8 out of the last 9 quarters. EBITDA margins now stand at 22.9%. Profits are down 13.5% on a quarter-on-quarter basis. The problem is that transportation, which is about a third of their overall revenues, has seen a drop of 10% sequentially, and therefore you should watch for companies like KPIT Tech. Tata Elxsi management says the automotive business witnessed challenges as some of the OEMs and suppliers have paused on their programs, and media and communication is also another vertical which has been impacted. Now, Tata Elxsi used to command very high valuation multiples of 50, 60 times. But as growth rates for the company slowed down, we should pull up the annual growth rate. In FY22, FY22, the revenue growth rate was 35%. That's when it used to command the peak valuation multiple post-COVID. This came down to 25% in FY23. In FY24, it was about 9.5%, and it's further down to 3.1%. There you have it. This is the annual revenue growth rate for Tata Elxsi, and since then, the stock has been getting derated, but even now, it stands at close to about 30 times forward multiple. Now, is it expensive or is it attractive? So watch for Tata Elxsi and other ER&D companies. Bhavin Shah is now joining in. He's the founder and CIO, CEO of Samiksha Capital, but he's been watching IT for the last so many decades now. Bhavin, thank you very much for joining in. Before we get to Tata Elxsi, first the big one, Infosys, and give us a summary of what we've seen from TCS, Wipro and Infi now.
I think there is increased uncertainty and weaker outlook from these companies. That is what I can see, and I think the commentary guidance is confirming that, and this is perhaps not even fully accounting for the potential weakness that we might see in the sector. And I think we have already seen the growth slowing down last year. I think Gen AI is kind of causing a new equation. Many of the past transitions or technology shifts were positive for Indian IT services, whereas AI is potentially negative. And I think that is where the issue is. And then on top of that, we add the economic uncertainty that has come up because of the tariff war. So I think in summary, it is and I compare current situation to start of COVID because valuations, from my standpoint, at least from a cash flow perspective, are similar to the start of COVID, almost there. But I was very positive and very excited about by owning the stocks going into COVID. I don't think that excitement is there today. There is still a fair bit of question marks on the growth outlook.
So what are you advising clients now? Should one be owning IT at these levels? And if they do have IT, is it time to trim? You want to say something?
No, I was just saying, sorry, Bhavan is his own client. I mean, he's
he's managing money.
He's managing money.
He's managing money. And so what's the call now on?
Yeah, so what I can say is that in our portfolio, we don't really own much of IT stocks. We have very, very small exposure. We have found the sector to, the stocks to be fairly expensive for last some time. And while they are getting attractive, as I say, but the growth is a question mark. So we would continue to sit away, and if people still have it, I think whether or not to trim here or not is a difficult one. But yes, if somebody is overweight, it is worth still going, correcting, especially in the expensive leg of the sector. Some of those mid cap names, which were considered to be high growth, and and both companies and the investors were extrapolating 1 or 2 years of super growth in COVID to sort of 5 and 10 years, and that is, I think, is reversing now. So I think unless you are seeing, and I'll give a simple thumb rule, unless you are seeing an IT stock available at 5 to 6% free cash flow yield, be careful. You probably will see more downside.
And what is it currently at? The free cash flow yield?
I think the likes of Infosys are at that number, but the question mark is growth. And I think, but some of the other ones, the mid cap high growth stocks are not that level yet, so there could be more downside.
So that's like a filter, starting point, right? In that sense, and then you talk about other stuff. Bhavan, good to see you, and it's been a while, and congratulations. I think your portfolios have done very well over a sustained number of years, and we'll talk more about what you are doing. But anything out there in terms of so much technological change, right? And how's any other places it's likely to show up? You track a lot of small mid cap stocks, etc. as well, and there were a few names on the IT hardware side, data center plays, etc. Anything which you like?
I mean, we are very much interested in finding value. We add as well as growth, combination of that. So, we have some exposure to companies that are more in the distribution part of the IT food chain. So not really affected by these technological changes, but, in fact, increase in demand for some of the new hardware might, even be positive for them. And they remain available at very attractive valuations. So we still own them. And I think, the other aspects will be the IT related, you could say, the KPO type of businesses, but they are catering to a very different, let's say, healthcare segment. And I think there, maybe there is still a fair bit of growth opportunity. And so if the valuation is right, we would still own it. But I think overall, the technology is enabler in many ways. For example, I think changing the consumption pattern. Digital music is something we have liked before, and we continue to like. So we have some exposure there. And I think some of the companies that are basically platform plays, they have experienced lower growth. They act as an interface between the users of services and the service providers or goods. And the growth, the slowdown in the economy perhaps has affected the growth, but then they are also available at very attractive valuations. So we own some of them as well. So more domestic play, I would say, in that context, than companies. I mean, I think we have kind of done a scan through our portfolio to see how much is the exposure to for example, the US, and we try to kind of stay very low on that right now.
All right, Bhavan, thank you so much for joining in. I was curious about the digital music plays. There are 2 listed names here. We'll talk to you about that in detail on another occasion. But as of now, thank you so much for your call on the IT sector. Let's get in. It's 9:10. Let's get in Sudarshan and Mitesh back for their pre-open 9:10 calls. Sudarshan, you go first.
Well, M&M is a buy. Consider buying M&M with a stop under 26.20.
Mitesh?
I do the buy on Indian Bank that's a stock which could do well and head towards 595, 600 very fast.
Okay, let's get to some of the stocks you should watch as we await the market opening. Sudarshan is now joining in on GAIL.
So PNGRB, that is the regulatory body, has floated the consultation paper for the tariff review of the pipelines of GAIL. Remember that GAIL has around 10 pipelines, and on that, stakeholder has to reply to GAIL by May 1, and GAIL has to reply to PNGRB by May 15. So what was the GAIL submission? GAIL had submitted the tariff hike to rupees 78 per MMBTU, and after queries from PNGRB, that was revised lower to rupees 77.43. Now, GAIL had spoken to us last month, in which we did ask the same question: what was the tariff quantum hike that GAIL is expecting? And that GAIL had said that it had submitted for the tariff to be hiked to rupees 78, but even if the approval comes for around rupees 70 per MMBTU, GAIL would be happy. And following that, CLSA has written a note on the GAIL, and it has upgraded the stock to outperform from whole, and target is increased to rupees 210 from rupees 175. It said that it's expecting a tariff hike in the June board meeting of PNGRB, and it's expecting a hike in the range of 20 to 25%. Also, it has increased EPS estimates in the range of 9 to 19%, and it believes that it's a start of the review process, which raises its confidence for a tariff hike. So overall, it's positive for GAIL, and we can see an upside in today's trade.
All right, so thank you very much for that. Stocks up 2% at the end of the pre-open session. Now, wind as a space in some focus. Vivek is here to tell us why. Vivek, morning.
Well, good morning. Well, the wind energy sector will be in focus, especially wind turbine generators will be in focus. What has happened over the weekend is that the MNRE, which is the Ministry of New and Renewable Energy, has released a draft notification for RLMM for wind turbine models. RLMM is the revised list of models and manufacturers. What is this particular amendment or the notification all about? It mandates local sourcing of key components as far as wind turbine generation and manufacturing is concerned. What are these components? Some of the components mentioned include blades, gearboxes, generators, as well as towers. What are the key highlights? Number one, the moon mainly aims to increase domestic content usage in WTG generation. Domestic vendors should be used for blade, tower, gearbox, as well as generators, and this is going to be made compulsory. Also, the data centers have to be mandatorily located in India, and also the R&D centers needs to be located within India, and there will be a timeline of 6 months to go ahead and comply with these norms once it comes into effect. What does this particular move do? What is the main aim of this particular process? Number one, it will address concerns regarding competition from Chinese original equipment manufacturers. Remember, a player like Envision from China actually has an order book of close to 10 gigawatt, much higher of combined of Suzlon as well as Inox Wind, both of these players which will be in focus today. Also, there has been worries about potential loss of market share as well as pressure as far as WTG core margins are concerned. So the move will address both of these particular developments. So both watch out for both Suzlon as well as Inox Wind. Expect them to benefit from the domestic content manufacturing draft notification.
Right. Thanks a lot for that, Vivek. Those are a bunch of wind sector stocks on our radar. Less than a minute away from the market opening. The pre-open is actually settled a lot higher. So we have 7 seconds to go. Nifty looks like it will open a lot higher than what the GIFT Nifty indicated. The 97 points is what the pre-open did indicate. Prashant.
All right, well, we've got a decent start, about 1/3% higher on the Nifty. The Nifty Bank, I think, is at a record high.
Yes.
So 54,290 is where we are starting on the Nifty Bank. So that's at a new, the first index, the first big index to get back to its previous high. Of course, I mean, the Bank Nifty did not fall as much as the Nifty did. This entire decline, it's the fastest to come back, and we'll put that alert out in just a bit. Mid-cap index is up about 0.6%, 300 points higher. You've got... We've opened at a record high, so we should change that to not set to open, but opens basically. We got the other indices, the small cap index, which will come up, which is also higher, and it's an all-round good start, which is coming through. Market breadth very early, just out of the gates, but it's 1,000, 1,100 stocks are higher, 400 stocks are lower to begin this week. Prima.
Well, the Nifty is inching towards 24,000 level at open, and now all eyes will be on the 200-day moving average is 24,050. We've extended our rally for the 5th day in a row, and what's helping is positive earnings from the banking names. Perhaps all the bad news is in the price for IT names for now, because the Nifty IT index has also opened up in the green with a gain of about 1.7%. In fact, sectorally, IT is the top gainer. It's Nifty IT 1.7% higher, followed by Nifty Bank with a gain of 1.3%. Very close now to that 24,000 mark level, just 12 points away. The top gainers include in the large cap pack, actually the first three are IT names. So it's Tech Mahindra and HCL Tech. HCL Tech reports numbers tomorrow. Stock is up nearly 2%, and Tech Mahindra towards the end of the week, and that's the top Nifty gainer, 3% up. Infosys is higher. Infosys is open with a gain of about 2.5%, so that's advancing. Remember, the stock had declined 24% since the start of the year, and analysts are pointing out that the guidance of 0 to 3% for FY26 is not as bad as what was feared last week. Following IT, you've got the banking names. It's a stellar performance by ICICI Bank. Brokerages are raising their EPS estimates. Stock is open with a gain of 1.5%. HDFC Bank giving it company, and both HDFC Bank and ICICI Bank are at fresh highs. HDFC Bank inching towards a 2% gain. Axis Bank. In fact, if you look at the top 10 gainers, it's all IT and financials. So you've got, we spoke about some of the others. Some of the others included State Bank of India, Shriram Finance, Wipro, IndusInd Bank. IndusInd Bank continues with its rally from last week. This month now, IndusInd Bank has gained 24%. On the way down, it's Adani Ports. There is that acquisition that's weighing. Stock is down 3%. And then some FMCG names are weighing on the market. Tata Consumer, Asian Paints under pressure, Nestle, ITC down nearly 0.5%.
All right. A lot of markets actually, the market breadth would have you believe that 4 out of 5 stocks in the markets are in the green right now. So for every one stock which is in the red, we have 4 in the green. We have a bunch of stocks which are actually doing well, and a lot of them having news backing them. So Yes Bank up around 6%, reported its numbers. The deposit momentum was strong, as was the advances, close to around 8%, which despite being slightly lower than the provisional update, the street's taking that with both hands, up 6% for that one. GAIL up 4%. Sudarshan had told us that, the PNGRB has, released a consultation paper for revision of tariffs, so that could be a positive. GAIL is up 4%. We have Just Dial as well. Even, the revenue growth was slower, 0.7% quarter on quarter, a 7% move year on year in terms of revenue is has the street excited on Just Dial. Has been a beaten down name, up around 7% as we speak. Devis Labs is the one that is higher from the pharmaceutical pack. This after inking a drug supply agreement for which they will have to invest about 650 to 700 crores in capex. Oberoi Realty is of the 5 stocks, one in the red. Oberoi is one of them. Its fourth quarter bookings were down nearly 52%. FY25 booking value was up 31%, though the fourth quarter being weak has the street worried a little bit. The stock down by about 1.6%. But by and large, a fairly strong looking screen. We have Intellect Design Arena, Oracle Financial Services, Devis Lab, Bandhan Bank, Coforge, financial and IT in the mid-cap end of things doing extremely well as well. And then we have a couple of these names which continue to move in the direction that they've been moving in the past. Senco Gold, for instance, up around 5%. We're seeing some traction on the way up for names like Northern Arc and Kitex Garments as well. But on the way down, we have Gensol, which continues to decline, 5% lower today as well. The stock at 111.
Well, lots happening. Infi is now lost pretty much all of its gains. I mean, not all, but there's about $10 left on it. And I would say rightfully so. I mean, for the stock to open 3% higher, could have started flat and then gone up. But to open 3% higher, I think it would invite, at least traders would want to take a punt that the numbers are bad, the outlook is not all that rosy. I think just some trading action going on here more than anything else. But there is, of course, a lot happening otherwise outside of IT. And I think we mentioned bulk of it. Divi's, of course, 4%. It's got very large volumes. Yes Bank is up 5%. Yes, with 5% is the largest volume-led gainer right now. And there is Axis, which is up 3%, 1,227. Actually, Axis is the number one volume-led gainer as far as the market is concerned. There's Kiri Industries, which is up 5. Inox Wind is up 4. Just Dial, I think we mentioned 8%, big volume gains. Ujjivan Small Finance Bank is up about 4%. Supriya Life Sciences, Senco Gold, and so on and so forth. But things are just picking up as far as volumes are concerned out here. Adani Ports with a 2.25% loss is the number 2 volume-led loser right now. So 1,230 on Adani Ports is what we've got. And the big winner from last week was Goldium. I mean, big 250 to 350 very quickly in about 4-5 days. That's starting with about a 2.5% cut. There's Shelly Engineering. I mean, it's there are institutional investors here. It's down 7%. I'm not sure if there is any specific news flow here. Volumes are very, very thin right now, but 1710 or so is where Shelly is now coming in at. 95 on the Nifty, 23,950 on the index. Pankaj Murarka is with us with what he's making of the market, CEO and CIO at Renaissance Investment Managers. Pankaj, good to have you back here on the program. Prashant this side. Thank you for joining us. So, you know, the Bank Nifty is at a new high. And hopefully this time, last time the 23,800 breakout in the Nifty did not last. Maybe it will now. Mood's pretty constructive out here. What are you doing, Pankaj, at Renaissance? And just tell us your outlook, near to medium term.
Sure. Morning, Prashant. Always a pleasure talking to you. I think, Prashant, we broadly remain constructive on Indian markets. We've held that view. I've held that view that whatever correction or pullback we've seen in the last 5 or 6 months, it's been more of a bull market correction than a change in broader trend on the market. The fact remains that we are coming out of a cyclical slowdown in the economy last year, where last year, if you look back, the March ending FY25, Nifty 50 earnings growth is just about 5%, probably the slowest earnings growth that we've seen in the last 5 years post-COVID. But I think that's in the base. Probably from here on, we'll see gradual improvement in earnings. Obviously, the world has seen that what lies ahead for the world is trade headwinds, significant trade headwinds. But probably in an environment like this, India is a relative winner because India is tariffed much lower than a lot of other competing economies. So that should help India slightly more medium term to long term. So our view overall remains fairly constructive from a broader market perspective. I think probably we should moderate our return expectations, but I still firmly believe that probably before the end of this calendar year, Nifty will make a new all-time high. So in that sense, we continue to remain positive on the markets.
What are your thoughts on IT? That's been the biggest drag since the beginning of the year. Growth is slowing down quite dramatically. But valuations too have corrected. And now some of the stocks like Infosys, for instance, is at its long-term valuation multiple. What's the call on IT, mid-cap and large-cap?
Well, as you rightly said, Rima, valuations have corrected and are pretty much, at least in the large cap companies, are closer to the levels where one would ideally want to invest into these companies. Having said that, we should concede that given the significant amount of uncertainty and these companies have called out that clients are holding back decisions. The biggest damage, I think, apart from everything else, and uncertainty around tariffs and what it does is it shakes CEO confidence globally. And once confidence of the CEO is shaken, obviously all investment decisions and everything is pushed back, and which is what these companies have even called out and they're experiencing where large deals or discretionary spends are pushed back. So I clearly think that the growth in the near term, at least over the next few quarters or probably next year, is impacted for the IT companies in that sense. There's a lot of fog on the windscreen and there's uncertainty. So until the fog is cleared, unlikely that we'll see these stocks performing. Having said that, as we said, in the large cap, at least valuations are far more reasonable or probably have become attractive. Some of the large companies are now quoting out or trading at dividend yields or free cash flow yields or earnings yields, which are as good as 5 or 6%. So probably that's the floor in terms of valuations for these companies. So I think it's time to selectively nibble, but I still think stock price performance probably would be more back-ended towards the second half of the year once fog on the windscreen is cleared.
Same of the consumption space. Valuations are not at long-term averages. They're still slightly elevated. And those long-term averages as well in the consumption space are elevated. A lot on the street believe that maybe the earlier axiom of FMCG stocks trading at a much higher multiple than the other parts of the market needs to be revisited. But on the ground, there have been signs of some recovery, especially on the rural front, and maybe some bit of incremental recovery coming in from the urban front as well, largely on account of all the SOPs that the government has given on the budget, etc. Do you believe that maybe some of these erstwhile companies are now taking charge, also looking a lot better than the D2C competitors which have faced some sort of liquidity crunch?
Absolutely, Nigel. So I'm pretty positive, constructive, bullish, whichever way one way to frame it on the consumer stocks. Meaning, I think it's one sector which has underperformed big time in the last 5 years. If you look at post-COVID stock price performance, this is one of the biggest laggard sector. But I think after 5 years, we are getting to a stage where we are seeing early signs of recovery. And I think we are in for a very significant or meaningful recovery in consumption in the Indian economy over the next 2 or 3 years. Also, in a world where global trade is going to shrink, given that the largest buyer in the world, US, is going to withdraw, I think every economy or every country will have to look inwards towards driving growth. In India, we have stars aligning for a recovery in consumption sector. One, we're coming out of a very low base of consumption in the last 2.5 years, where the PFCE, or as we call the private final consumption expenditure, growth has been about 5%, which is half of the long-term growth of 11.5%. More importantly, the government has done tax cuts in the last budget. That money will flow into the pockets of consumer. I think we're looking forward to a GST rationalization, which will again reduce GST tax on certain category of goods and again benefit consumption. And also, I think the rate cut cycle should also benefit consumption. So all of that, sum total, I think will lead to a meaningful recovery in consumption. So we remain pretty constructive. I think the two big sectors that I really think can outperform the market over the next 2 to 3 years is essentially private sector financials or financials broadly and consumption. So both these sectors have been laggard over the last 2 years, but I think they could be the leaders in this rally going forward as we build on this bull market from here on.
And how do you play consumption? Via traditional FMCG names, rural focused, urban focused, or discretionary names, or maybe entry-level auto names as well?
Well, given our growth bias for us, the natural bias is focus toward discretionary consumption. So we like names, and we own in a portfolio names like United Spirits and Jubilant Foods, to name a few, which we think will benefit as we see an uplift in consumer spending. But I would also say at this point of time, we're also buyers of staples as well, because for the very simple reason that we are coming out of a very low base of consumption over the last 2 years. When I said that, if you look at last 15 years, the aggregate private sector consumption or household consumption in India has grown ahead of nominal GDP growth. In the last 2 years, that growth is like half of nominal GDP. So because of very sharp inflation spike that we saw in the economy 2 years back, consumers have cut back on spending, including on staples. So now that inflation is moderating and there's rise in income levels, I think first thing the consumers will buy into is staples. So I see a very strong volume recovery in staples as well over the next 12 to 18 months. So at this point of time, our natural disposition is to own consumption across both staples and discretionary.
From your published portfolio, Pankaj, if you want to sort of talk about 2 or 3 ideas with full disclosure, what you're most constructive about, Pankaj, across the board. I mean, private, I understand financials and consumption, and we got into some detail there. But if you want to sort of talk about, overall, what you're most convinced about.
Yeah, so in a slowing economy where growth has moderated, I think the natural disposition for a growth bias investor like us is to look for outlier growth, which are the pockets of the economy where the growth can be significantly higher, and probably where can you make outlier returns. So clearly from our point of view, one we clearly see is capital markets or financial services as a sector which has strong drivers supported by savings and money moving into capital markets. So we own HDFC, AMC, and Motilal Oswal Financial Services to play the capital markets play. I continue to remain very constructive on the fintech opportunity in India. I still believe that 10 years out or 15 years out, one of the top 5 financial services company in India will be a fintech. And we've been holding Paytm for a long period of time. So I still continue to remain constructive. I think over the next 5 years, Paytm could do $1 billion of EBITDA. And I think some of these companies can actually lead to some outlier returns over the next, let's say, 1 to 2 year time horizon. As you rightly said, we own all of this in our portfolio, so the disclaimer follows.
No, full disclosure, absolutely. But good to put some names, right, to some of the ideas, as always. Pankaj, thank you very much for joining us. By the way, we have another fintech coming up in the next conversation, so you may want to listen in. I'm talking about Angel One. which is, of course, a capital market play, but of course expanding into many other areas as well within the capital markets and wealth management, etc. as well. Pankaj, thanks very much. So let's get to it. Mangalam, Angel One.
Angel One, the stock's actually done well. In fact, over the last couple of trading sessions, the result was weak as expected, largely because of the weakness that we're seeing in the market itself. The sort of regulatory issues that came by in the F&O space led to their F&O volumes declining by about 26% as well. Overall, there was a decline in their revenues. Let's decode the trends of the future with the company. We do have with us Dinesh Thakkar, who's the chairman and managing director. Remember, the stock from a technical standpoint did come out of the F&O, did enter the F&O ban as well, which explains the sort of up move that we're seeing out there. Thanks a lot, Mr. Thakkar, for joining in. Two things that I want your thoughts on in the very near future. One, you said that things are normalizing. You expect the margin band to return to that 40 to 45% by the fourth quarter. What gives you the belief that it will go there? Secondly, even as there was an impact in the F&O business because of regulations, it seems like you lost market share. So the impact was a little more on Angel One versus the others. What explains this?
Okay, first of all, what I had said, we will return back to kind of like normal financial ratios, that is OPM and all that, by fourth quarter, not first quarter. Fourth quarter of this fourth quarter of the financial year. So we have gone, I would say this industry has gone through a kind of a like perfect storm where whatever should go against this industry has gone. Macros, be it our economic growth, be it FIS not investing, and majority impact is because of regulatory changes, which has now, I would say, absorbed by retail investors. We saw a bottom in terms of number of orders in Feb. We did almost below 50 lakh order per day, which is kind of like minimum. After that, we are seeing slowly kind of like revenue curve is moving up. So March numbers were better in terms of 53, 54 lakh order per day. And we are seeing this trend continuing in the like this month also. So that gives me confidence that, okay, at least revenues are now, revenue come has turned for better. And margin expansion in digital company, what happens when we take a cost to build a platform? There is a cost to build a platform and maintain the platform that we have already taken. So today we have a platform which can serve an order up to 1 crore 40 lakh without much increment in cost. So whatever revenue increment we see in this progressive months, that will straight away contribute to our expansion of margin.
Mr. Thakkar, morning. This is Rima here. Could you give us an indication of what the current orders per day are? February was sub 50. In March, it was averaging 53, 54. What would it stand at? And what was the peak or the average, say, when things were going, all right for the markets?
So average number of orders that we were clocking was around 75, 78 lakh per day. So today, as we speak, last March number, we have already disclosed that it's around 53 lakh plus. So that trend is continuing. So we don't disclose all this number. So maybe by a month end, we'll disclose this. But I can say that trend or positive trend that started in Feb continues.
Okay. What about your F&O market share? Have you lost market share? What does it stand at?
Yeah.
What would you attribute it to? And what steps are you taking to correct it?
Yeah. So what happens when actually we talk about market share? Market share in retail comes from Ultra HNI, retail, prop desk and all that. So when we lose market share, it is that retail is less active. So you will see market share dipping a bit. So it is not a point of concern if you see a graph of like 12 months, 24 months. Few months there would be some dip because retail is not participating as actively as HNIs are participating. So it is not a matter of concern for us. We are seeing overall other parameters in terms of engagement on our platform and all that. We are seeing engagement of these customers is equal or better than what they were a few months back.
Mr. Thakkar, hi, good morning. Prashant this side. On the F&O side, sir, and we asked this, we put this question to exchanges as well when we get the opportunity. Could you give us, again, same kind of comparison? What was the high there in terms of F&Os on a metric that of your choosing? Where are we now? And just to give us a kind of a scale comparison.
So like in terms of number of order, this quarter, we degrew, our growth was like lesser by around 21, 22%. So overall, whatever impact we have seen in terms of F&O order, on month-on-month basis, I am seeing a growth of around 6 to 7% now for this past 2 months. So that gives a broad sense that, okay, retail are coming back. See, for retail, there was no reason for them to come back because markets were depressed. They did not see any opportunity and they were not in a hurry to really jump and decide that what kind of an instrument they had to buy, if at all not options. So what I am saying, after this kind of stabilization in terms of our news that are coming and the FIs inflows that are coming in, it appears that retail is getting back confidence to come back to the market. So what we are saying, if at all this trend continues for few 9 or 10 months, and customer growth rate that we are seeing, we are able to acquire in this bad condition also a customer base of around 5 lakh, 6 lakh per month, that will all contribute to expansion in margin in next 9 to 11 months.
You know, Mr. Thakkar, just to, and we'll sort of summarize this with the overall numbers as well. You've been very aggressive in terms of, by the way, Nifty has hit 24,000, Mr. Thakkar. So, that's talking directly, that's talking directly to your business. I mean, things have got to look up, right? I mean, it's just the way it is. For retail to come back, for optimism to come back, and of course, I mean, that is a direct impact on order flow, order volume, etc. So for now, 150 odd points in the Nifty, by the way, so 24,000, Nifty Bank hitting a new all-time high. So things are looking better, of course, much better. Mr. Thakkar, on wealth management, right? I think you've been, of course, you launched and you're growing rapidly. Could you give us a sense of what are you doing? What should the growth in AUM be? What are your targets for the end of FY26, say?
See, fortunately, we got a good team to manage our wealth business, and we were able to recruit top-class relationship managers and all that. And we just got licensed few months back. And in few months, we were able to get an AUM of around 3,700, of which 3,200 is asset under management. So difficult to set a target for this thing. So usually the way we function is that we are building a base right now. So what is important right now is that all processes are in place, relationship managers, they are aligned to products that we want to sell. So I am seeing a good acceptance of our products in the market. So we are very bullish on that vertical.
Right. Mr. Thakkar, as we speak, well, the Nifty is above that 24,000 mark. The IT pack is coming off lows. The Nifty Bank doing well. Reliance is the one which is powering that index ahead right now. Reliance reports its fourth quarter numbers on Friday. So we have Reliance, which has moved to the high point of trade as well. So that's about the market. Coming back on your customer addition, metric that you spoke about. In this market, you're able to attract around 5 to 6 lakh customers per month. Your customer acquisition costs have increased as well. So from the peak to now, how much do you think your customer acquisition costs have increased? And with retail perhaps likely to come back because the markets are making a comeback as well, how much would they reduce by? If you could give us a comparison on that one. At the same time, the revenues per order. In F&O, it has been coming down to around 21.2, and cash, it's increased to around 11.8 rupees per order. What's your outlook on these?
Yeah, on cost, there was a slight blip in the month of Feb and March. That is usually a seasonal, and even Google has increased the prices. So we have brought that cost back in this month. So now it is again back to normal. And plus, as market were subdued, so definitely to acquire a client, it is becomes bit costly. With market returning back to momentum and all that, we believe we would be able to get to the similar cost of acquisition what we had for past year. And on F&O volume, revenue and all that, again, it is a function of market. Once you see volatility and momentum in the market, lots of retail will come back and you will see that order, revenue per order would almost come back to normal. On cash side, because lots of people who stopped dealing in option because of ticket size increase and all that, they have come back in cash and they're doing margin trading and all that.
All right. And finally, on the commodities front, your business declined 4%. It was explained by a high exposure to oil. But, now gold is doing extremely well. Are you exposed to that? And would we see an improvement in your commodities business?
See, what happens when we talk about market share of overall basket, it contains oil, gold, silver, and all that. But retail tends to be more active when oil is active, and retail tends to be less active when gold is active. In gold, I think mostly HNI, ultra HNI would be taking a big kind of like calls and all that. So whenever this kind of like balance changes favoring precious metal and all that, you will see some dip in our market share.
For the year, Mr. Tucker, for FY26, right? I was looking at some estimates. They are projecting a small single-digit decline in top line and a slightly larger decline, but single-digit decline as far as bottom line is concerned. Should we work with those kind of expectations? A subdued 26? What's your sort of sense?
See, FY26 this year would be a year of consolidation where we would be focusing more on getting back to OPM, and the growth is going to help. So currently we are not working on what kind of top line we will achieve because it's a function of market condition, lots of things. Internally, what we can do is that, okay, how do we bring in AI tool, get more cost efficiency, and how do we bring in more customer on our platform? So result of that, whatever revenue we are going to get, it is very difficult to predict at this point in time. But what we are confident is that we would be able to bounce back to an OPM of 40-45% by Q4 FY26.
Okay. All right, Mr. Tucker, we'll leave it there. Good conversation as always. We wish you all the best of luck, and we'll continue to touch base with you over the next few months and quarters as well. Thank you indeed. I think the market's up 160, holding 24,000. Time for a quick commercial break. We've got a discussion lined up on, of course, the trade negotiations, US-India bilateral trade talks in focus. You also have the US Vice President J.D. Vance arriving in India for a 3-day visit. All of that in focus on the other side. Welcome back. Markets doing well. 24,000 on the board on the Nifty. If you're just joining us, Nifty Bank making a new all-time high. And of course, at the margin, there is everyone keeping an eye on the trade negotiations, which are due to kick off. I mean, at least to finalize the outlines of what final negotiations will look like. I mean, the topics that need to be covered in those negotiations. Well, we also have US Vice President J.D. Vance and his family in India on a 3-day visit. They're going to be in Delhi, they're going to be in Jaipur, they're going to be in Agra.
Okay.
Your mic, Prashant, fix that. So we'll just keep an eye out on that. Those visuals coming in. That's the official airline of the United States of America. They seek to unlock economic opportunities, like it was said, to negotiate a bilateral trade deal. Let's see. We'll get the first visuals of J.D. Vance and Usha Vance off that plane right now. I reckon, it's when it's the vice president who travels. It's called the Air Force 2 and not the Air Force 1. So not sure the nomenclature that one has to use for that airline out there, but shortly enough we'll get the visuals.
By the way, I got my mic back, and kids as well. I mean, I think it's a full family visit.
But it seems like it's more of a cultural trip.
Yeah,
like, of course, there is going to be bilateral trade negotiations. There is a state dinner with Prime Minister Modi, but I think he wants to show.
I'm not sure, but I think this trip was planned before the election. I think because, or maybe now, of course, he travels in his capacity as vice president. But there you go, full, of course, protocol, etc. He's coming in, I think, at the Hindon Air Base, from where I think he'll travel to Delhi and where, of course, I mean, there'll be official meetings, etc. I think there's a meeting with Prime Minister Modi later today, and then I think that's a Palam airport, beg your pardon. And the team coming down, we should have the first pictures, first visuals coming through in just a bit from now. So we'll keep those visuals at the side of the screen, and we'll sort of talk about this and as those pictures start to come in. Well, let me welcome in Ajay Sahai, Director General and CEO at FIEO, and Anup Vadhavan, former Commerce Secretary, Government of India. Gentlemen, good morning. Great to have both of you here. Prashant this side. Mr. Vadhavan, if we can start with you, sir. This visit, of course, is coming at a crucial time. Of course, I'm sure trade talks, etc., will come up, but we don't know in what capacity, how will it happen. But my question to you, Mr. Vadhavan, is that US team is in the US this week and there are going to be discussions. So how will this, in your opinion, work? There are these reciprocal tariffs which have been put on hold for 90 days. There is that, and then there is a trade deal. So when these discussions happen, you're discussing what? Because 8th of July, if nothing happens, these tariffs come into force again. So you've got to avert that. But obviously, you can't get a trade deal by then. That's only by fall. So how will this work out?
That the level of the Vice President, Mr. J.D. Vance, will be at a broad level. As far as the trade agreement is concerned, I think much ground has been covered. Looking at press reports, I think both sides have worked out the broad framework. There is some talk of a 19-chapter agreement. There is talk of a phase 1, which will be completed by September, October, I think covering the goods part, and a phase 2, which is supposed to happen after that, which I think will cover services and other issues. And within the phase 1, the goods part, there is talk of an early harvest within 90 days. So that will happen even before September, October. So I think much ground has been covered, and I think both sides seem to have developed a certain comfort about these negotiations, and I see them happening smoothly. As far as the Vice President's visit is concerned, I think that the discussion will be at a broader level and will go beyond trade. And then we must not forget his India connection. I think his India connection would have been one reason for him to be very keen to make this visit. So I think we have to see the thing in totality.
So this visit aside, as far as negotiations, you're saying that there's, from what you sense and what we read, etc., there seems to be a broad agreement on what all needs to be on the table, which needs to be up for discussion, right? Because we are at that stage here.
Right. So there is always a framework agreement you have when you start a trade negotiation. So I think that framework has been broadly worked out. All the timelines have also been worked out. And I'm sure there'll be an understanding on both sides as to what each side has by way of wants, what each side has by way of sensitivities. So I see a fairly smooth negotiation happening. And I think over the years, we are quite clear as to what are the aspirations the US side has in terms of goods market access. We are quite clear about what aspirations India has in terms of goods access and in terms of our services ambitions, especially our IT businesses, etc. So I feel very hopeful that we'll be able to.
Yeah. According to you, what would be the ask from the US side? 3 or 4 most important things.
Yeah. So clearly. Is it for me, the question?
Yes, it's for you, sir. Mr. Vadhavan, go on.
Clearly, autos, both 4-wheelers, 2-wheelers, including electric vehicles, items like ethanol, items like wines and, bourbon and other alcoholic beverages, dairy and agri products certainly will be on the request list. So I think these will be the basic asks on the US side, and our asks are also quite clear, textiles, gems and jewelry, leather products, our engineering products. Because pharma, they don't face very high duties, but, pharma, there would be requests for facilitation in terms of, regulatory approvals. Those take a lot of time sometimes. So I think both sides have these fairly well understood, asks.
Okay, I think those are pictures coming in. First pictures coming in, JD Vance and Usha Vance coming down the stairs there. And, so first visuals are coming in at this point in time. And by a protocol, you've got, him being welcomed. I think that's Ms. Ashwini Vaishnav welcoming sort of Vice President JD Vance and visuals coming in as we speak. So that's from the Palam Air Base at this point in time. All right. Mr. Vadhavan, I'm going to come back to you in just a bit because I want to ask you whether what you said, right, from the US side, agricultural products are going to be hard to do, and also there are tariffs, but there is also market access, etc., right? There is the issue of VAT, for example, which I don't know if that'll be contentious, etc. So just coming back to you, but let me get in Mr. Sahai into the conversation. Mr. Sahai, I was looking at this data, and I put this data out in the morning as well. This is from a firm which tracks container shipping around the world, about 65% of it. So it's a pretty good data set. And their data shows that US imports in the first week of April as compared to the last week of March, imports into the US fell 64%. Exports out of the US fell 30%. This is week on week. But this is first April data, and there would be that element of, getting shipments through before that 2nd of April deadline. So you'll have to adjust for that. But this is still very large impact in that sense. Could you give us a sense of what the situation is out of and into India? What's the feedback you have?
In fact, so far the imports into India is concerned, that's not much impacted. On the export side, since we have 90 days pause period, companies are trying, and in fact buyers are also insisting that they should ship the goods because there is certainty on the tariff front, at least in the 90 days. Nobody knows within 90 days whether BTA will be concluded, whether there will further deferment or the reciprocal tariff will come into effect. So probably there will be some front loading, which was there earlier also. Probably that may continue, subject to availability of inventory and also the production cycle for number of products. So as of now, both the sides are trying to push within the 90 days. And at the same time, we are hoping that, as told by Mr. Vadhavan, we may have at least first tranche with reference to the tariff negotiation, and we can take other issues subsequently, because as of now, the tariff is the priority.
Mr. Sai, what you're saying is, so anything that you're agreeing to in terms of contracts, etc., exporters and otherwise, July 8th seems to be the outer limit for now, right? That's the 90-day deadline.
No, that's true, because up to 90 days, we know there will be only the MFN plus there will be a baseline tariff of 10%. Nobody knows. So it's not that the Indian exporter, even the foreign buyers, the US buyer, they're also looking from that perspective. Because if the duty goes, let us say, to 26%, they will also require more liquidity, as the duty has to be paid upfront at the time of clearance of shipment. So they have to have the excess liquidity at their disposal also. So to the extent possible, both sides are looking into whether they can push the shipment within 90 days. If it is not possible, and we will see what happens there. We are also hopeful that at least some relief to India will come, as we have the early mover advantage. We are already negotiating the BTA, and we hope that at least the first tranche will relate to tariff, or if not, the early harvest will be in place to take care of the lower duty on the Indian exports.
And in terms of sectors, Mr. Sahai, you heard Mr. Vadhavan, textiles, gems and jewelry. What specifically, according to you, should be in focus as these negotiations go through?
In fact, our focus should be on the product which we are exporting to the US, and also the number of products where shift from the market from China will happen. We did a study and we observed there are 175 tariff lines at 6 digits, where India's export to the US is roughly 50% of the total export in respect to 175 tariff line, and so is the US. So that can also be a priority area. We have to look into our existing product of exports as well as the potential product of export to get the duty relief for them.
Mr. Vadhavan, you briefly mentioned in terms of US's demand, agriculture, horticulture, etc., right? Would that be a problem?
I don't think it will be a problem. There are available these with sensitivity. You typically have staging of duties, so that you can come down immediately to zero, or it comes down to a moderate level over a certain period of time. You have things like tariff rate quotas, where you restrict the quantity which comes in, and you have maybe a moderate duty, not a zero duty. You have things like minimum import prices, only the higher end dairy products, higher end, wines, etc. can come in so that they serve a separate niche and they don't threaten the Indian domestic manufacturers. So I'm sure they'll find a way out. As you mentioned, the main thing will be the SPS protocols, sanitary and phytosanitary protocols for agricultural produce and dairy produce, which are very important in the interest of human health, animal health, plant health. So those are important. American dairy products have this issue of, the cows being fed with sort of animal-based feed. So that is a issue with us. It's a cultural, socio-cultural issue in India. We've been opposed to having dairy products where the animals are fed with animal feed. That sort of undermines the concept of milk, being vegetarian and dairy products being vegetarian. So we'll have to find a way around that problem. And last time we were discussing with the US, some methods were being found, to have ring-fenced production where the animals are not fed animal-based feed. So I'm sure there are mechanisms available for dealing with those problems. We are going to have to deal with them also with EU. We'll have to deal with them when we are negotiating with UK. So these mechanisms are, I think, on the table.
That's a very interesting point, which you bring up, and there'll be so many of these sort of specific things, right, which will come up across various product categories, but very interesting. We'll leave it here for now, Mr. Vadhavan and Mr. Sahai. Appreciate both of you joining us, but we'll invite you back as we get more information in terms of how these negotiations, these talks are proceeding, and continue to get more perspective as well. We'll go across now to our segment, Quarter Se Quarter Tak. We are getting you expectations from one sector every week. And today we have expectations from the NBFC space. Abhishek is standing by, and then we'll get into a discussion. Abhishek, lay it out for us.
Well, Prashant, to begin with, NBFCs could see seasonal tailwinds amid selective stress in Q4 FY25, and they are likely to see peaking of cost of funds for them. So seasonal positives to support the growth. Q4 is seasonally a strong quarter for NBFCs with improved disbursals, recoveries, and collections as well. So tailwinds to asset quality is expected, aided by government project payouts, better winter crop yields, as well as the fact that business team incentives are there in place. So net interest margin is likely to remain comfortable as 15 to 20% of borrowings are repo linked, and they may offer a cushion despite a rise in cost of funds which are nearing the peak right now. Now stress pockets show signs of stabilization as well. Early signs of breather in stress segments such as unsecured loans and microfinance is seen right now. So management commentary will be the key gauging factor to see if the stress has peaked or not, especially in the unsecured and MFI portfolio, that is microfinance portfolio. Selective weakness will persist, like muted disbursals is expected in prime housing loans, vehicle finance loans, and unsecured or personal loans, tightened due to recent regulatory scrutiny that we are seeing. Now, housing loan disbursals is expected to be impacted by registration-related issues in the cities of Bengaluru as well as Hyderabad. Collections and recoveries will set to improve in this quarter, given the fact that seasonal pickup is always seen in Q4 with respect to collections, driven largely by the Rabi or winter crop, realization, government project payments, and target-driven efforts by sales or collection teams. So, credit costs will remain high for the players in the microfinance sector in Q4 of FY25. On your watch list, large H1 FY25 slippages likely to stay sticky for the lenders, with full recovery potentially slipping into H1 FY26. Now, close monitoring of commentary on stress levels in unsecured and microfinance portfolio will be critical to watch out for. Some key estimates that we have from Kotak Securities includes Bajaj Finance reporting a YOY growth in NII by 22% and PAT up 18%. Bajaj Housing Finance NII up 34% YOY and PAT up 61% YOY. Chola Mandalam, they expect NII to grow by 30% YOY and PAT to be up 20% on a YOY basis, while for Muthoot Finance, Kotak Securities estimates NII growth of 35% YOY and PAT growth of 43% YOY. Spanna Spurti, Motilal Oswal estimates NII to decline by 13.4% YOY, while they can report a loss of nearly 414 crore versus a profit of 129 crore in the same quarter last year. Back to you.
Thank you very much for that. Digant Haria is now joining in. He's the founder at Green Edge Wealth Services. By the way, look at the Nifty Bank go. The Nifty Bank is consolidating its hold above 55,000. It's 55,200. It's a new record high for the Nifty Bank, even for ICICI Bank, HDFC Bank. And Hormus points out that in the last 25 trading sessions, from the March 11th low of 47,700, the Nifty Bank has scaled close to about 7,000 points. Digant, it's only getting stronger, especially for names like ICICI Bank and HDFC Bank. Before we get chatting about NBFCs and the expectations, first come in on the numbers that we've seen from these two large private sector financials.
Yeah, morning, Rima. See, ICICI continued its streak of very strong numbers. But if you just see, their loan growth has been a little bit tepid. Everything else is spick and span. And if you look at HDFC, you can actually see something reverse, that, the loan growth has probably not picked up, but margins have started to improve. So I think it is just telling us one thing, that probably ICICI Bank is at the best of its performance and HDFC Bank is at the worst of its performance. So, if I look at next 12 months, I think a switch trade from ICICI to HDFC will do a lot of good to investors. At least that is what we see it.
All right, let's talk about the NBFCs now. At a time when, there are private sector banks which are looking up, the rate cycle is on the lower end and consumer sentiment seems to be improving. Where would you, place your bets in the NBFC space? Do you think they're likely to outperform growth when it comes to their bank counterparts, or do you think NBFCs still have a couple of quarters before they outperform banks?
Morning, Mangalam. See, I think NBFCs also, you can see a very similar pattern. Let's see, all the top quality NBFCs have already made lifetime highs. And, they're pricing in a lot of good things which will come in the next 12 months. So something like a Shriram, Chola, Sundaram, Bajaj Finance. I think a lot of up moves have already been made. It's not very easy to see big up moves because the earnings are not going to surprise in a materially big way. Because, in the previous show also, I said the PSU banks are alive and active and the competition will be very high. What we are seeing is, some bit of easing of the last 12 months. So I would think that in the NBFC space, you should play the other segments, not the very high quality segment, because there a lot of the upsides have been captured. And, I was just watching QSQT, what Abhishek was saying. So this quarter, we should do something different in the sense, the segments which will give very good results are probably the segments which are going to peak out. They will not give great returns or great upside in earnings. So vehicle finance is one where we think we have peaked out in terms of the cycle. And gold finance also, because of the regulatory guideline, both these sectors will report very good numbers. But that very good numbers should not be treated as, what will come in the next 12 months. Next 12 months can be a little softer. Whereas, in sectors like, say, microfinance or personal loans and personal finance, I think the stress will bottom out either in this quarter or the next quarter. So we will actually be very watchful in places where results are bad, because if the commentaries are good, we know that we are probably at the end of the stress cycle.
Any particular picks in the microfinance which are close to bottoming out or may bottom out in Q4?
So I think there is a huge buffet available. Banks like AU Small Finance Bank, or Equitas and an Ujjivan in the bank, small finance bank space. Then in the NBFCs, you have something like an Arman and Credit Access. So it's a huge basket which is available. Even maybe L&D Finance is microfinance heavy. So 5-6 names, I think, that should do well over 12-18 months. That's our take.
All right. Digant, thank you so much for joining us and giving us your view on the way the sector is likely to be. The good quality stocks have already hit a record high. Speaking about record highs, a big move is what we're seeing in the Nifty Bank, which we've been pointing out earlier itself. But today's up move is supported not only by the Nifty bank, but a firm recovery in the IT pack as well. So we have, Tech Mahindra, which is doing well among the top Nifty gainers today. We have Infosys, which has recovered a fair bit from the lows, currently at the high point of trade once again, opened higher, thereafter saw a sell-off. That sell-off had been bought into. Right now, we're back around the higher end of today's trading range so far.
Even Tata LXC, it opened down 2 to 3%, and now it's up 5%. And here the numbers for sure were very disappointing, right?
I take that point. So that's about the IT pack and the Nifty bank. And as we speak, in fact, 24,050. That's an important mark because the 24,050 mark is the 200-day moving average on the Nifty. The Nifty is around the 200-day moving average. Good time to get in the technical picks then. Mitesh, 24,050 was our first target on the Nifty, with the next one being around 24,200. Do you think now that we're close to 2450, there is a trade that may take you another 150 points higher?
I think that's the tricky part of the entire thing. You met one target, it's an important level. You hit the 200 average after a big decline. My idea is that I think, if you're not taking profits, I would still suggest take 30% or 25% off the table. Or even if you're not inclined to take profit because the trend is still strong, at least trade your stop losses to very tight levels. So on the Nifty, I would say now I think a good trading stop would be around 970 or thereabouts, and 5 points below than that. And yes, I think, eventually we will hit 24,200 and possibly even make an attempt towards 24,750, Those targets are still open. But to know if the consolidation will start right now or some profit will happen right now is very difficult to say. So I think that's the way trading should be approached. The buyer should remain on the downside, and only, you might want to lighten up 1/4 or maybe 30% of your positions.
All right. And your trade at 10 would be?
Yeah. I have a buy on Gas Authority with a stop at about 192.5 for targets of 204. And Kotak Bank is another one which I like. That's a buy with a stop below levels of 21.70 for targets of 22.65.
By the way, it'll be interesting to see the FII numbers, right? I mean, it looks like they are piling in big time. I think last week FIIs bought stock worth about 15,000 crores. And of course, I mean, multiples of that went out over the last 7-8 months. So it's a bit of a, I mean, the way the market is going, looks like they're stumping right back in. And of course, I mean, the other thing is this US vice presidential visit. Apart from, there's a fair bit of symbolism with things like this as well, because, you've got practically a bit of a trade war, a very, very antagonistic attitude with the US under the Trump administration to everything else, to all other countries. And in that scenario, the second top person in the US coming for a visit to India, I think a fair bit of symbolism in that sense, for sure. 200 on the Nifty, 24,050. We'll take a quick break here. Manisha will be joining in with commodities in focus, and I'm sure gold will make a mention there. Stay tuned.
Welcome back. Let's turn our attention now to the commodity markets. Manisha is joining us in the studio. Manisha, gold prices, have they hit 1 lakh? If you go to buy now, go to the store?
Oh, well, absolutely, yes, Rima, and I'm going to exactly show you that calculation. Well, let me start with the international prices first, and we are trading at an all-time highs above $33.85 an ounce. I mean, this is an all-time high, and this is the 15th time that you have seen an all-time high above $3,000 an ounce. And my next plate shows you exactly that, the calculation for the Indian markets. So we have seen the gold prices open at an all-time high of 96,745 rupees per 10 grams. Now, this is the price for 24 carats. This is a price which doesn't have anything added to that. But I'm going to add 3% GST to that, because if you go out and buy gold in any form, 3% GST is basic. So with that, it's at 99,650. And if you're buying gold, you will have to give a minimal making charge, even if you're buying a coin or a bar and jewelry especially. So I've taken a minimal 10%. It's much higher at this point in time, but 10% of a making charge on that. And the gold prices are at 1,09,000 rupees per 10 grams. I mean, yes, it is 1 lakh now in the physical markets, and this is a basic price. If you're buying jewelry, anything more than that, you're going to be paying much higher than that. For the Indian markets, for most of the Asian markets, by the way, there are reports that the physical or jewelry buying clearly has been on a decline. I have been speaking to some jewelers, and they tell us that 30 to 40% of a decline in jewelry buying is what they have faced in last couple of months. And the exchange jewelry or the scrap jewelry really seems to be coming into the market. So people are, one, making profits, and second, they are selling their old gold, buying newer gold, or just selling gold because the prices are so lucrative at lakh rupees a 10 grams there. Now, the reasons why you have the gold prices running higher, one is, of course, the dollar index, which is trading at a 3-year lows below 99 now, has been one major absolute recipe for the gold prices to continue to go higher. And then Trump ordering investigation on critical mineral imports has added more uncertainty, and thus that premium. The third thing is about the European Union, where we saw an interest rate cut coming in on Thursday, and that is higher gold yielding. So we have seen gold buying reports coming in from the European Union. And then Trump's statement on firing the US Fed Powell has just added yet another more fuel to this premium that we've seen come in for the gold prices. I want to take you through a report card to show you on what gold prices have done. So on a weekly basis, we are up by 5%, 12% up in last month. And in this year, now we have surpassed on what kind of gains that we saw in previous year. So last year, the gains were 28%. We are up 29% in 2025 already. And the last 12 months have given you 45% returns in case of gold prices there. And the view from here on does look that the momentum will continue higher. Deutsche Bank, Goldman Sachs have talked about $3,700 an ounce and much higher levels if that level also gets broken. Bank of America, well, that level of $3,350 has been taken now, and Citi's talked about $3,500 by the end of May. $35 to $3,700 an ounce is a view that has come in from UBS, De Beers, Swiss Capital, SD Bullion. I was talking to them last week, and they said $3,500 by the month of May, and then for the month of June, July, August, in that quarter, perhaps some profit taking could come. But next couple of months, with the kind of uncertainty, you're not going to short gold.
Well, I think we had Ed Yardini this morning talking about 4,000 by the end of the year. Possibly. I mean, it was not a forecast, but he said, well, it's possible. Thank you very much for joining us. So gold very much at the center of things in terms of what's doing very well. The market here is doing phenomenally well as well, about 1% higher on the benchmark indices, Nifty Bank at a new high. We'll take a break on the other side. It's our special segment. It's the economy. Lata in conversation with Santanu Chakrabarti of BNP Paribas, and they discuss the quarter gone by for big banks like ICICI and HDFC Bank.
The toast of the market today is the Nifty Bank, and it has hit all-time highs. All three banks that reported numbers over the weekend, HDFC Bank, ICICI Bank and Yes Bank, are growing in the right parameters. Higher deposits, higher margins, higher ROAs, return on assets, and correctly showing lower metrics on the appropriate ones, lower costs, cost to income, and lower NPAs. Joining me to discuss the numbers and give us an idea of whether we should be buying back bank stocks at their all-time highs for the Bank Nifty is Shantanu Chakrabarti, the India analyst BFSI at BNP Paribas. Shantanu, good morning. Thank you very much for sparing time for us. I want to start exactly with this question. You know, the margins have risen now, but it is very clear that there are going to be 2 more rate cuts in the very least, given that inflation is expected to be below 4% for all the months of 2025, or almost all the months. So, do you think this lifting of the pressure on margins is temporary? And again, in the current quarter, we are going to see margins dip?
It's interesting you bring that up, Lata. I would invite you to think about this in a slightly different direction. If you look at what is really leading the entire easing that's going on within the space and what has really changed things, more than the first rate cut, it has been the backstopping of liquidity by the RBI that the system has proved the most sensitive to. Now, put yourself in the shoes of the RBI for a moment. Right now, there are external global uncertainties that we are looking at in terms of where tariffs will settle, whether that creates global inflation. Yes, one would expect US rates to come down, but there is an outside chance that it could go the other way as well. Now, if I am RBI and I can achieve my objectives through an instrument which is more flexible like liquidity, my immediate need to go for further rate cuts on an accelerated basis is probably not as high. It's only when the system stops responding to the primary instrument, which is liquidity, do I need to make further monetary realization. So I think probably the rate cut trajectory that is now being talked about, and remember the picture was very different even 2 months back, is now probably a slightly more accelerated timeline that people are talking about. We would expect slight pauses. Secondly, even if rates get cut more, over the next 6 months, you have to keep in mind that the easing factors have already started to kick in. HDFC Bank, for example, have cut FD rates by 50 basis points. Their savings rates is down to 2.75. So as the rate cut cycle progresses, the tailwinds on liability side continue to accelerate. So future rate cuts do not impact margins, point for point at the same level that they do in the beginning of the rate cycle. So both of these things combined, I would say that on margins as well as earnings growth for FY26, we would remain fairly constructive.
Okay. So you're saying that margins have bottomed and that they will inch up or stabilize at current levels?
Yes. Now, if I get 2 rate cuts within the next 6 months, maybe there could be another 5 basis points. I think the probability of that happening is low.
Okay, well, I can tell you a lot of people are on the other camp because obviously the real rate, the difference between inflation, 1-year inflation and current repo rate is more than 200 basis points, and there are a lot of people who will argue that it should be lower. Okay, what about loan growth? Of course, HDFC Bank loan growth is low for a reason. It's by strategy. But ICICI Bank also said that they were very careful with their loan growth. So do you think even if your margin per product is good, the volume is not going to take off so much?
No, Lata, this is where we have to look at what, again, the liquidity infusion by RBI has done. Fundamentally, as we know, liquidity transmission is also a factor on credit growth. So we are already getting much more sound outlook bites from management in the current quarter, and even the pre-quarterly releases, now the releases, we are getting better numbers than we would have probably expected even in February. So something has changed in March. And I would actually call for something like 13% system credit growth for the full year, which we have been calling for, which is not a low number. And it would translate into mid-teens or slightly better credit growth for most of the top banks. I mean, once again, HDFC Bank is a slightly different kettle of fish, but broadly,
But they have
those
said,
are healthy.
no, I'm interrupting for a reason. HDFC Bank said that they will be with system credit growth in FY26 in the con call.
Yes. And that has been their stance for the last 3 con calls, actually. So they would be on system credit growth. But I'm saying for HDFC, for ICICI, for Axis, and all the other large banks, you will be 200 to 50 basis points above credit growth, would be our expectation.
Okay. So you're on a buy side on all these banks?
So HDFC, ICICI, and Axis was my pecking order, as you know. But ICICI, has accelerated a little faster than others, even though HDFC has. So the amount of upside available on ICICI is definitely less than HDFC and Axis, in our opinion. But what you have to keep in mind, Lata, is the vulnerable situation that the global economy is in. If for some reason the flip side of what we believe to be the easing argument plays out, then ICICI is a lot more insulated than the other two. I mean, they are obviously higher beta, HDFC and Axis, as things stand today. And that's why our ordering remains HDFC, ICICI, Axis. And
what you're saying is if rates are cut rapidly, maybe even they go to 5-quarter repo rate, then ICICI is better placed.
No, I'm saying that in case they have to pause rate cuts, if some of the liquidity interventions have to be wound back because there's global inflationary pressures or something like that, and there's more selling in India, if a scenario like that works out, ICICI is better protected than the other two.
Okay. No, actually, the arguments we are getting from economists is that there is a global disinflation. Not global, there is an Asia disinflation already underway. I mean, all Asian central banks are cutting rates, and plus Chinese goods that don't find a home in the US are going to look for home elsewhere. So disinflation is the theme that all economists are running with. Therefore, do banks become stronger buys or weaker buys now in India?
So generally, that should make banks a stronger buy, because the rule of leverage is that inflation decays leverage, and slower inflation or deflation would obviously give you greater value for leverage. And fundamentally, a lending business is just an asset ownership of leverage itself. Okay. So that part is fine. But the little thing that you have to keep in mind, Lata, is that there's also US inflation that you have to keep in mind, which matters in terms of US monetary policy, and therefore the carry trade, and therefore the degrees of freedom that India has on policy interventions.
No, I agree with you. We are entering into uncharted territory where you're going to perhaps see US inflation and Asian disinflation, and maybe uncharted territory in terms of interest rate differential between the two regions. But that discussion for another day. Let me come to the banking sector and how much you can extrapolate this to the other banks. Yes Bank also has reported good numbers. So would you want to bring that in the coverage? And are you therefore upping your forecast for any of the banks that's yet to report, like say Kotak, IndusInd, RBL?
So, in general, we prefer not to intervene into quarterly forecasts so close to the date. But obviously, Lata, one thing I want to make clear, that these margin numbers that have come out for both of these banks were not a surprise for us. We were ahead of consensus on NII on both of these names, and it's come in line with what we were expecting. Because, for example, the classic case is HDFC. You know this very well. I've been making the case for a counter-cyclical and somewhat counterintuitive benefit of easing for HDFC Bank, quite simply because the expiring liabilities, whether they are legacy NCDs or legacy TDs from the parent, at such high cost that it really doesn't matter much what you refinance with. You will always get a positive carry trade on those. So as far as margins are concerned, we have generally been slightly more constructive than the street, and I don't see a need for an intervention right away. We would rather reassess once all the numbers are out.
Well, one of the dramatic developments of the last 2-3 years has been ICICI overtaking HDFC Bank on several parameters, notably, important for investors like ROA. Do you see that continuing, or do you think that as HDFC Bank puts behind these long-term deposits that you're talking about, can it get its mojo back to the same ROAs as the best in business?
I think the same ROAs will come back, but the composition in terms of how much margin and how much cost to income is going to be very different. this is now a lower margin and a lower cost bank and in steady state, and that's what is going to play out. So will you get back to 2% ROA? Absolutely. And that is what our thesis on HDFC Bank has been predicated on. Now, just taking a slightly broader view on this, HDFC Bank is still the #1 liability franchise within privates in the country, right? The way I have put it always is that, yes, HDFC Bank has the more powerful engine vis-a-vis ICICI Bank, but HDFC Bank balance sheet is a truck while ICICI is a car. So pound for pound, ICICI has the cost advantage on borrowings. And even if I load in, appropriate retail scale and operating costs, it is very clear to us that ICICI is the leader as far as fully loaded cost of raw material goes in the sector. And therefore, their re-rating, gain of market share, ability to make enough ROE without taking too much risk is absolutely the sector benchmark right now. In HDFC Bank, I am saying that yes, it is a truck, but the truck's getting leaner every day. So on a relative basis, given where valuations are, once ROE reverts, say 2% and 17% over a few quarters. Now, how fast that happens depends on how fast CASA accelerates. It could happen by early 27. It could happen at exit FY27. It will depend on the liability trajectory. But once it comes back, then multiples will also re-rate back towards that. That has been the thesis.
What are your price targets for both?
I had for the longest time the highest target price on HDFC and ICICI. I still have about 22% as of the last close. I guess it's moved 1-2% today. So but remember that all my target prices currently are set on third quarter of 27, right? So once the numbers are out and we'll review, then by mechanics there's a quarter of compounding that gets added.
Okay. We'll have to leave it at that, Shantanu, but I'll take a rain check from you to invite you after all the major results are out, including Kotak and SBI and the big public sector.
It will be my
banks.
pleasure.
Thank you very much for joining us. We have to wrap up on Bazaar on that note. Markets gung-ho at this point in time, especially Nifty Bank and the mid-caps. Chartbusters will take the action forward after the break.
bulls return on D Street. It opens higher as it's led by the banking index, which scales a fresh record high. The Nifty too above 24,000 for the first time since January this year. Broader market outperforms. Key indices, strong gains.
Banking stocks, HDFC Bank, ICICI Bank and Yes Bank all climb higher as the stocks react to strong Q4 earnings. HDFC Bank as well as ICICI Bank report numbers above estimates. Yes Bank sees deposit rise 6.8% year-on-year basis.
Another stock that's doing extremely well on the back of earnings is Just Dial, up 11%. Revenue rises 7% year-on-year. FY25 revenue grew by nearly double digits.
Divi's Lab is up near 4% after the company signs a long-term supply deal with a global pharma company to manufacture and supply advanced intermediaries.
GAIL climbs nearly 5% after the regulator PNGRB floats a consultation paper for review of natural gas pipeline tariff. Rolling Monday morning with the bulls actually rollicking ahead with gains. A 200-point up move is what you're seeing on the Nifty, but the real gains are on the Nifty, Bank and the broader markets. I'm Mangalam Malu, with me Vinny Motiwala. We're coming to you live from the CNBC-TV18 Motilal Oswal studio, and as you can see at the top of your screens, the Nifty and the Sensex doing extremely well. The Nifty at the 200-day moving average. It's the Nifty Bank, which is breathtakingly higher, 55,200 for that index. And the mid-caps, we have 4 stocks advancing for every stock which is declining. Hi Vinny, good morning.
Hi Mangalam, good morning. An interesting day, right? Where we left on Thursday also last week was a good trading session. Today also we are seeing that run up and momentum continuing, and like you mentioned, the mid and small cap also. Let's look at that because that's clearly outperforming in terms of the benchmark indices as well. So that is something interesting to watch out for. PSU banks and banks, like you said, is leading the way, so that's continuing. What's not doing well today is a bit of a mutinous that we're seeing in FMCG as well as the media side. That's among the top drags coming in on the sector wise. But yes, that's how the performance is looking like. Other than that, everything is trading in the green. So IT also managing to hold on to good gains, and this is also coming in despite Infosys numbers being a bit of a miss, we're seeing IT managing to hold on to some bit of a gain there. But yes, that's how the market setup is looking like as of now. Mangalam,
all right, let's get in. Yes, let's get in Shivangi's data as well. Shivangi, from a technical standpoint, 24,050 is where the Nifty is, where the 200-day moving average is as well. The Bank Nifty doing well. They're welcoming you back. What do you make of the way the markets are right now?
Very good morning, Mangalam and Vinny. Thank you for having me. So we've seen that there has been a strong comeback of the bulls, and how we've seen that last week was truncated. Even, then we've seen a good run up of more than 650 points in the market. So overall texture of the market is quite positive, and we've seen that the put call ratio is above 1.15 levels, which indicates that put writers are comfortable at this levels and creating a base. Now, of course, Bank Nifty is heading towards a new lifetime high, but Nifty has been, also gaining strength, and we're looking at 24,200 and 24,350 as the next marks for Nifty, with a support of 23,850 levels as a crucial stop loss. So overall, buy on decline to continue over here. Now, of course, there have been a lot of pockets which are witnessing good buying interest, but banking and financial space has been the star performers. And Bank Nifty per se, we've seen that the run-up can be seen from the last 7 trading sessions with very strong follow-up action over here. A good short covering trigger was led, and now it is followed by long build-up, thanks to the heavyweight banking private counters actually, which have contributed to this run. Of course, the PSUs have started moving today, but overall strength is dominating in the private banking names, and we would recommend to be with the heavyweights. Now, the next levels that we're looking at is 56,000 for Bank Nifty with a support of 54,950 levels.
Right, Shivangi, surely keeping an eye out on those levels over there for the banking side as well. Anything specific that you're looking at today in terms of trades as well?
Of course, the first pick that I am looking at is from the financial space. I'm looking at Bajaj Finserv today. This has been one of the stocks which has outperformed and held on resiliently at the higher zones. Of course, both the twins are quite well placed, but Bajaj Finserv is witnessing a good open interest addition from the last 2 trading sessions. It has surpassed its previous hurdle zones of 2020 levels as well. Now, RSI has shown a positive divergence here, and it is consistently holding on to its 50 daily exponential moving averages as well. Even on the monthly basis, we've seen a range breakout and good follow-up over here. So recommending a buy here in Bajaj Finserv. Now the next targets that we're looking at is 2170 for this stock with a support of 2040 levels. The second pick on my radar is HAL. We have seen that there has been a comeback of the bulls in the last 2 months over here after good 10 months of lackluster move over here. So, of course, there has been good momentum in action, a little bit of a softness, which we saw last week, but it was well covered by the bulls. Now, trading, at the higher zones of the day and witnessing good amount of open interest activity. So, recommending a buy here with a target of 4,500 levels with a support of 4,235 levels.
Okay, Shivangi, thank you so much for that, and thank you so much for joining in with us on the show as well. But let's shift focus now to our special segment where we will get you a few ideas for profit from Money Control Pro. Anand Chaudhary of moneycontrol.com is joining in with us to talk to us about a stock that he has been tracking closely. Anand?
Following the tariff announcement by President Trump, textile stocks witnessed a sharp correction due to high exposure to exports. With Pearl Global Industries, one of the India's leading garment exporter, declined by 34% since April 2nd. However, the recent 90-day deferment of proposed tariff has raised near-term concerns for Indian exporters, prompting a strong rebound in the stock price. The company faces two key risks from the tariff issue: a high exposure to US, which is 50% of revenue, and having higher manufacturing facilities in Bangladesh and Vietnam, both of which are subjected to higher tariffs. However, we believe a stock price has been factoring in worst of the tariff-related uncertainty. Pearl Global is also gradually shifting its facilities from Bangladesh and Vietnam to India. Additionally, the US continues to maintain a tough stance on China, including higher tariffs, while the ongoing turmoil in Bangladesh further strengthens the competitive advantage of Indian textile companies. Overall, the optimistic outlook for the company is supported by strong demand momentum, addition of new customers, and an increasing wallet share from existing clients, all of which are expected to drive sustained growth over the coming quarters. Moreover, with a valuation of 15 times on FY27 earnings, the stock offers a reasonable margin of safety and scope for re-rating.
All right, that's about Pearl Global. Just keep an eye out on Angel One. We had the management, Dinesh Thakkar, join us an hour ago, said that maybe things are looking a lot better. In fact, there was a revenue turn that took place in the month of March and that sustained into April as well. Going forward, he remains confident of reaching the 40-45% sort of margin band by the fourth quarter of this financial year. That is FY26, though this remains a year of consolidation. The street takes note of that. Mind you, the stock's also in F&O band, so no fresh short positions or long positions can be taken to be carried overnight. So that explains the exaggerated nature of moves that we're seeing on Angel One as well. The stock continues to do well this morning. Take a short break, come back, tell you about a bunch of other stocks which are moving around. And mind you, there are a lot in this market.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform?
Welcome back. You're watching us here on Chartbusters. IndusInd Bank doing extremely well. Bajaj Finserv, JSW Steel, that's the frontline indices. The Nifty Bank is the one which is at a record high after strong results coming in from HDFC Bank and ICICI Bank. They've been doing extremely well earlier as well, which is why the gains on those two counters are relatively muted as compared to the other stocks which are doing well. But be that as it may, how the numbers were and what the outlook is, Abhishek joins in with more. Abhishek, start with HDFC Bank and then ICICI Bank.
Well, strong core operating profit was seen with respect to HDFC Bank. The P&L with respect to ANA and PAT is a beat on our poll. Now, core operating profit grew by 20.5% YOY and about 4.9% quarter-on-quarter. Remember that by core operating profit, I mean operating profit without treasury gains. So, 7-quarter high net interest margin on total assets, which came in at 3.54% versus 3.43%. Even if you remove the one-off that they have over here with respect to 700 crore of one-time income, the 3.45-3.46% that you have looks pretty good with respect to 3.43% in the previous quarter, as analysts were anticipating a decline in net interest margin, but it has actually improved for them. Cost to income ratio or operating efficiency is one of the best that you are seeing in the last 4 quarters. Annualized slippage ratio is at 5-quarter low of 1.15% versus 1.4% in the previous quarter. Overall, the slippages have declined by nearly 15% quarter-on-quarter. Asset quality continues to remain impeccable for them. Gross NPA ratio and net NPA ratio have improved and are one of the best in the industry. With respect to ICICI Bank, the loan growth momentum is weak. However, the P&L is very strong for them. Versus our poll, the ANA and PAT is a beat on our poll. Deposit growth came in at 14% YOY and about 6% sequentially. YOY, it's one of the weakest growth that you are seeing in last 8 quarters. Now, advances growth were on the lower side at just 13.3% YOY and 2.1% quarter-on-quarter. So YOY, it's the weakest growth that you are seeing in last 17 quarters, and sequentially, that is quarter-on-quarter, you are seeing one of the weakest growth that is coming in 15 quarters. Net interest margin is at 5-quarter high of 4.41%. Core operating profit growth is at 5-quarter high of 13.7%. Now, quarterly annualized slippage ratio is at 17-quarter low of 1.5% versus 1.85% in the previous quarter. Their asset quality continues to show robust decline and is one of the best in last 10 years or even more for them. Gross NPA ratio and net NPA ratio have improved, with ROA or return on asset being the highest ever that they have recorded, north of 2.5% in this quarter. Back to you.
Okay, Abhishek, thank you so much for the roundup coming in for HDFC Bank as well as ICICI Bank in Q4. But let's listen into the management of both these banks as well, what they had to say in terms of the growth, outlook, what are they watching out for there? Listen in.
We've already seen 2 rate cuts, and the change in stance from neutral to accommodative is a welcome relief to all of us. RBI intends to increase durable liquidity, which is followed by concrete actions, which along with rate cuts will help supporting the GDP growth. For FY26, we expect the GDP to be supported by a pickup in rural spending, discretionary consumer demand, and investment activity. Of course, the goods exports may be impacted until the global trade and tariff situation becomes far more clearer. We acknowledge that the global macroeconomic outlook has become more uncertain due to the recent trade tariff-related measures and the volatility surrounding them. This may potentially impact global inflation, leading to lower growth across economies. Corporates have adopted a wait-and-watch stance, and we are waiting for more clarity. We remain watchful. Our credit deposit ratio has been brought down from the highs at the time of merger, which was at about 110%, to around 96% as of March 2025. Our deposits have grown faster than the system, and so has it grown faster than our loans as well. Next year, in line with what we had committed, the adjustment in CD ratio will not be so steep, supporting the loan growth for the bank, but it will be on a downward path. Asset quality, one of our USPs, remains pristine. As liquidity and growth improve, we are well placed to grow in both assets and deposits.
So as far as the loan growth is concerned, I don't think anything specific incrementally in terms of caution on the credit side. I think we are pretty comfortable with what we are underwriting. Of course, on personal loans and cards, as you know, we had tightened, a few quarters ago, and that is showing up in the volumes over the last couple of quarters and the loan growth. But other than that, no specific caution on the credit side. I would say it's largely a function of what is happening in the system. And also, I guess, on the pricing side, some consciousness given that, during this quarter, we were at the sort of cusp of the, downward movement in benchmark rates. We have seen liquidity improve substantially over the last couple of months with all the measures that the central bank has taken. And deposit growth for us has continued to be quite strong. You would have seen the numbers for the fourth quarter have also been pretty strong for us. So, and as the rate, now, of course, if you look at it, the repo rate has fallen by 50 bips. So that will start to see a transmission into deposit rates, which is what has started. So I think that's, in the natural course of things.
Okay, that's all about HDFC Bank as well as ICICI Bank. But Abhishek is here to tell us what is happening with Yes Bank as well and how are the Q4 numbers. Abhishek?
Well, surprisingly, the control over cost of funds has actually aided the PNL beating our poll. So, with respect to NII, it's a beat of 4.5% or 4.3% to be precise. But with respect to the profitability, it's a beat of nearly 23.5%. Net interest margin is at 8-quarter high of 2.5% versus 2.4% in the previous quarter. However, it remains one of the lowest in the industry. Loan growth is at weakest in last 7 quarters, coming in at 8% YOY and 0.55% sequentially. They have now removed all the security receipts from their balance sheet. Other income has actually aided the top line growth this time around. Other income is up 15% quarter on quarter, thanks to the fee income, which is up 21.5% quarter on quarter. So weak loan growth, but the fee income is robustly grown by 21.5% quarter on quarter. Cost to income ratio remains one of the highest in the industry, but it is the lowest for them in last 15 quarters, coming in at 67.3% versus 71.1% in the previous quarter. Now, annual slippage ratio, that's heartening to see. It's at 10-quarter low of 1.99% versus 2.2% in the previous quarter. And net NPA ratio is one of the lowest that you are seeing in last 8 or 9 years. At least 33-quarter low of 0.3% versus 0.5% in the previous quarter. Quarterly annualized credit cost is at 4-quarter high, given the fact that there might have been a write-off which aided the net NPA this time around. Return ratios for the bank, it's one of the best in last 25 quarters, but the weakest in the industry with respect to private sector bank. ROA at 0.7% and ROE at about 6.2%. Back to you.
Abhishek, thanks a lot for that. So that's about banking stocks, and the Nifty bank, understandably, 55,250 as we speak. The Nifty moving towards that 24,070 mark as well. 24,100 is what the street is eyeing. But as we slip into a short break, there's some good news for all you viewers. We have the CNBC-TV18 all-new app, which gives you instant access to breaking news, in-depth articles, all the financial world updates at your fingertips. You can download the app from either the App Store or the Google Play Store, or just scan that QR code which comes up for you on the screen.
Starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube. With me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Howard is a joke.
Well, welcome back to Chat Masters on CNBC TV18. But a quick look at what the market has been doing as well. We're managing to hold on to these gains for the Nifty 24,087. So we've picked up some bit, and the day's highest point is what the Nifty is trading at. A few of the names coming in from the broader end of the market that you should watch out for. Just Dial, keep an eye out on that one, buzzing in trade after numbers. Small Finance Bank, Adani Power, Aavas Financiers are some of the names that are managing to hold on to good and strong traction at on that Tata Elxsi. That's the one that I'll keep an eye out on as well. 5-6% of gain on that front is what we are watching out for as well. But let's move on wind power stocks. They are in focus after the Ministry of Renewable Energy releases a draft notification for a revised list of models and manufacturers. Sourcing guidelines for certain components have also been changed. Vivek is joining in with us to give us more details on this one. Vivek?
Well, that's right. So wind turbine makers, two listed entities over here, the ones in focus, Suzlon as well as Inox Wind, they are in focus and the stocks are doing quite well. Like you mentioned, MNRE had released a draft notification. Now, this is for the revised list of models and manufacturers for wind turbine models, and most likely this draft notification should come into should fructify a few months down the line. So what are the key amendments? Amendments mandate a local sourcing of key components as far as wind turbine generation is concerned. Components include blades, gearboxes, generators, as well as towers. What are the key highlights of the draft notification? The move mainly looks to go ahead and increase domestic content usage as far as wind turbine generation is concerned. Along with that, domestic vendors for blade, tower, gearbox and generator will likely be made compulsory. Along with that, it is expected that they will mandatorily locate data centers as well as R&D centers in India. What is the main reason for such a move? Analysts expect that this particular move is likely to be made, number one, regarding competition from Chinese OEMs. This is something that State believes is actually hurting domestic manufacturers. And secondly, there is worry of potential loss of market share as well as pressure on WTG manufacturing margins, given the fact that Chinese players are more competitive. On the back of that, this likely relief both Suzlon as well as Inox Wind doing very well in the session.
Vivek, thank you so much for that. So Suzlon and Inox Wind doing extremely well. Both stocks up around 4%. Meanwhile, just keep an eye out on JSW Energy as well. It's set to start its largest greenfield thermal power plant with a capacity of 1,600 megawatts in West Bengal. This, even as the time Vivek speak to us about wind energy, thermal power not going out of fashion. In fact, CNBC TV18's Abhimanyu Sharma also caught up with Sharad Mahindra, who's the joint MD of the company, to understand what the scope of the project is and the company's plans to set up a green hydrogen plant in Karnataka. So we have thermal, we have green hydrogen, we have wind. Quite a power-packed segment. So let's hear out what the management of JSW Energy had to say.
We are at a very advanced stage of commissioning the first such project, though not very big in size, but still largest in the country, and which is which is a part of the PLI scheme, where we qualified also, which is the 3,800 tons of green hydrogen coupled with 30,000 tons of green oxygen. We are going to commission this project in the current quarter, which is Q1 of FY26, and which we are supplying to our captive requirement to JSW Steel. And it's a co-located plant in Vijayanagar in the state of Karnataka.
Also about renewable energy targets, about expansion in the renewable energy sector, there are several issues which still exist as concerns, be it pump storage, be it the foray of the private sector into nuclear energy, and also with respect to a replacement of the base load with renewable energy. Now, these continue to be big concerns, big elephants in the room, as not just your company, many others in the ecosystem are also driving the foray. What are the deliverables you are looking at while you try to solve these issues?
Yeah, this is very pertinent question, I'll say, because as I said, the demand growth, the way the demand growth is happening, even a conservative demand growth of 5.5%, 6% growth, the amount of energy every year which is required, like last year approximately, country consumed 1,700 billion units of power. And even if we take a conservative 5.5%, 6%, which is going to be a number of almost maybe 125 to 130 billion units incremental will be required. which when converted into capacities will be about 25 to 30 gigawatt of fresh capacity. Assuming that maybe 7, 8 gigawatt or even 10 gigawatt on a very higher thermal capacity gets added. So balance 15 to 20 gigawatt through renewable energy, where the PLFs are 30% if you say wind or solar combination, the capacity addition in RE space which is required for wind solar is close to about 40-45 gigawatt. This is the size of opportunity which country is India exists. So we are cautious in terms of where to go. As I said that our some of the basic principles are that my returns to my stakeholders, my shareholders is protected, financial prudence is maintained, the benchmark ratios which define my ratings, which give me an advantage in terms of the interest rates which the banks and financial institutions offer, all those things are paramount for us. Keeping all those things in mind, we have made the plan, but of course round the clock storage power and other things, that is evolving now. Initially it was battery energy storage. Now Government of India in last budget announced pump storage policy, and a lot of pump storage bids have come. We have also won. We have signed the power purchase agreement. So a mix of solar, wind storage either through battery or pump storage is going to be the future.
Two aspects you spoke on, be it PPAs or a transmission system, both are important cogs in the wheel, important linchpins for energy security moving ahead. What are your plans for PPAs in other states? And also a comment on the transmission system. Of course, the government has been working overtime. Several states have also been making efforts in this direction. What are the kind of deliverables, the kind of targets you're looking at in the transmission system, and also with respect to PPAs?
Yeah. See, PP, as I said, that operational 12.2 gigawatt today and another 18 gigawatt capacity for which either the PPAs have been signed or we have received the letter of award, wherein some portion of the PPAs are to be signed. So we are definitely focusing as and when the states keep on coming with their requirements. We have the letter of award awarded through either SECI or SJVN or NTPC bids. So states as and when come, we are ready with the solution. It is only the question when the state comes for signing the PP. So our teams are engaged with them, but we have enough signed PPAs to take care for next few years on which we are working.
That's about JSW Energy, but what's powering the market ahead are the usual suspects this morning. We have the banks doing well, the IT pack has come back from the lows, and when we started the show, the Nifty was about 200 points higher, and we leave the Nifty a lot higher as well. 24,100 is where the frontline index is. With that, we wrap up on this edition of Chartbusters. Stay tuned. From Vinny, me, the entire team, Trading Hour comes up next.
And stupidity and should no longer receive federal funds. These are the words of America's most powerful man, who's going after America's most prestigious, richest and the oldest university. I'm talking about US President Donald Trump. The US government has now threatened to ban Howard University from enrolling foreign students after the university said it will not surrender its independence. What does it mean? Let's understand the controversy in detail. Now, the US Department of Homeland Security, or DHS, has threatened to revoke Howard University's certification to enroll international students. This comes after the Trump administration decided to freeze over $2 billion in federal funding and cancel $2.7 million in DHS grants. Now, why is Trump going after Howard? Well, he has accused the university of allowing anti-Semitism and promoting ideological bias against Jewish students. Remember those protests that happened across most universities in the US last year in the wake of Israel's attack on Gaza last year? Now, many students protested at Howard too. Now, what does Trump want? The White House has demanded that the oldest university in the US make changes to hiring, admissions and teaching practices, which it says will help fight anti-Semitism on the campus. The US Department of Homeland Security has demanded detailed records by April 30th, 2025 on visa-holding students' involvement in those protests, disciplinary action taken by the university or any perceived threat to campus safety. Yes, that is the deadline. And what if Howard doesn't listen to the government? Well, then
Good morning. Welcome to Trading Hour. It's a Monday morning. It's 11 o'clock. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer. And what a powerful start to the week. Straight away off to the races. Benchmark indices up 1%. The Nifty is closer to 24,100. And now it's crossed the 200-day moving average, which was 24,050. Technical analysts were looking at it as an important resistance level, and now that we've conquered it, perhaps the bulls will draw some more comfort for upside. Broader markets have participated, in fact, doing even better. The mid-cap index is up nearly 2%. The advanced decline ratio has 2,000 stocks advancing for about 500 stocks declining, and it's good to see both banks and IT. These are the two leadership sectors in terms of weightage. They contribute a lot, more than 50% of the overall index, and both banks and IT are on the way up. Banks, because the numbers from HDFC Bank, ICICI Bank have been fairly robust, particularly ICICI Bank, and IT, just going by the reaction to numbers like in Infosys or Tata Elxsi, where the numbers were muted. But the stock price reaction is telling you that perhaps incrementally there is no bad news, right? Whatever bad news was there was known over the last couple of days in terms of growth slowing down, margins being under pressure, FY26 being a tough year, challenging year. All that was known when TCS and Wipro came out with their numbers. Incrementally, there is no, bad news that we've heard, which should drive the stocks further down. Whatever pain was there is now perhaps in the price.
Good morning, Reema. What a wonderful start as far as Monday is concerned. And like you mentioned, the Nifty IT probably digesting most of the negative news flow like you've mentioned. Well, the other set of stocks doing very well is the banking pack, record highs. All three of the stocks, HDFC, ICICI and Yes Bank, all of them that delivered results over the weekend, doing very well in the session. ICICI Bank cooling off a little bit from the day's highest point. A couple of other stocks, from the broad end of the markets that are doing very well. Have a look at the wind turbine listed companies, so the generators like Inox Wind and Suzlon, draft norms coming in, and both of these stocks, both Suzlon as well as Inox Wind, today doing very well in the session. Also, the pharma pack, there have been a few stocks that have outperformed, Divi's Labs being one of them. Incremental positive news flow coming in over there. The company has gone ahead and signed a long-term supply deal with a global pharma company, and Citi actually guesses that this could be a GLP-1 opportunity with Eli Lilly that Divi's has probably gone ahead and signed an agreement with, which is an incremental and material opportunity for Divi's. Well, the other stock on focus, something that our colleague Sudarshan pointed out at 9 a.m. today, that is GAIL, and a tariff hike consultation paper is something that is being deliberated. GAIL doing very well in the session, and HDFC Life, one of the few stocks that are reacting a little negatively to earnings. H1 is expected to be slightly tough for the company on a high base. No wonder then the stock is lower by 1.5%.
This week, we have SBI Life also reporting numbers amongst many others. So we'll see if SBI Life also has a tough Q4 and a guidance. But let's talk about Just Dial, because that's one of the big movers today. 9% up on Just Dial, and 12% up now. Let me tell you three quick reasons why the stock is up despite a muted Q4. One, collections, which is basically cash collections, is improving. Collections in Q4 was up 11.3%, better than what we've seen in the prior quarters. Secondly, the cash on the books is 60% of its market capitalization at more than 5,000 crore rupees. And three, even as the company's growth is a bit challenging to come by, the company is improving its margins. In FY25, the company's margins went up by 860 basis points. So from 20.8%, EBITDA margins in FY25 were closer to 30%. That's a big improvement. Now, as I said, Q4 is a slow growth, In fact, growth has been slow for Just Dial. In Q4, the top line growth was 7%, lower than what we've seen in the last 2 or 3 quarters. Margins, though, the company's held steady, closer to the 30% mark, and profits aided by higher other income is up 20% on a quarter-on-quarter basis. There is a conference call later today at 6 o'clock, so we will get more clarity. But 3 reasons: collections, the cash, which provides downside support, and the fact that margins of the company are very healthy at 30%.
Deepa, were you surprised by the stock reaction at Tata Elxsi?
Absolutely.
Tough quarter, maybe auto vertical not doing so well. So Tata Elxsi, have you had a chance to look at the internals?
Yes, so Tata Elxsi has completely reversed its morning losses. Stock had opened with a cut of about 2 to 3%, but now it's higher. As I said, the Q4 was disappointing. There is no doubt about it. It was a third quarter of a miss. The top line declined by 5.3% on a quarter-on-quarter basis. EBITDA margins sharply lower at 22.9%. Lower quarter-on-quarter and on a year-on-year basis. In fact, in the last 9 quarters, in 8 quarters, margins for the company have actually declined, and profits too are down 13%, both quarter-on-quarter and on a year-on-year basis. So the question is, what could be driving the stock price higher? Now, in the conference call, the company said they expect growth to return in Q1 of FY26. They also said that FY26 growth rate could be better than FY25. Analysts are saying this is challenging. It's going to be difficult for them to achieve that, but the company is saying FY26 ought to be better than FY25, and what's giving them confidence is the large deal wins that they have. In fact, even in Q4, and that was a silver lining in the quarter, the company announced large deal wins, a $100 million deal in media and communications and a €50 million deal in the transportation vertical, and that will help. Also remember, the stock for the last 3 years has done absolutely nothing. It re-rated after COVID when growth rates were 20, 30, 35%. But in the last 3 years, that's 28% down in FY25. But in 3 years, the stock is down 35%. Now, the question is, valuations is still at 30, 32 times. Is it attractive enough because it's fallen from the previous peak levels, or is it still too high? Brokerages that I've looked at so far, and I'm sure there are many who are bullish also, but the ones which I could glance through, Kotak as well as Ambit, both of them have a sell call on the stock.
A cautious view, but the stock today doing quite well. Well, moving on to the oil and gas space, the natural gas regulator, PNGRB, has floated a consultation paper for a review of natural gas pipeline tariffs. Sudarshan joins in to tell us more and also what brokerages are making of the same. Sudarshan, you highlighted this earlier in the day at 9 a.m. Take us through the internals if you've had a chance to look at what exactly this means for GAIL.
So the first, if I can say why the stock is positive, because the tariff hike has been long pending, and now after PNGRB coming out with the paper expecting a consultation from stakeholders as well as GAIL, it implies that tariff hike can come very soon. In the month of June, PNGRB will have the board meeting and tariff hike can be approved. So what was the GAIL submission? GAIL had asked for tariff to be increased to rupees 78 per MMBTU, and after certain queries from PNGRB, it was settled at rupees 77.43. Now, we had a conversation with GAIL last month in which GAIL did say that it has proposed for tariff to be increased to rupees 78, but even if PNGRB approves up to rupees 70, it would be taken positively. What does CLSA say on that? CLSA has first upgraded the stock to outperform from hold rating. Also, it has increased target price to rupees 210 from rupees 175 per share. Now, CLSA believes that there can be a tariff increase in the range of 20 to 25%, and it has even lifts EPS estimates in the range of 9 to 19%. And it says it's a start of the review process, which raises its confidence that tariff hike will come in the next PNGRB board meeting. So the biggest positive is that tariff hike has been long pending for its pipeline. There are 10 gas pipelines of GAIL, and if there is a tariff hike and if it's increased up to rupees 770, it would be taken positively, and that's the reason you are seeing a big move in the stock.
Thank you very much for that. Get into a break. On the other side, we'll get chatting with Devan Jain from Inox GFL Group. He'll talk about the latest deal wins and the FY26 outlook.
Result in the loss of Harvard University's Student in Exchange Visitor Program certification, which will effectively bar the university from admitting new international students. Harvard is the first university in the US to push back against Trump's threat, and the consequences are for everyone to see. The American government has identified 60 universities for review. Last month, Columbia University agreed to many of the administration's demands in the wake of the protests after the government cut $400 million in funding. Let's look at some numbers here. International students make up more than 27% of Harvard's enrollment this year, overall 6,000 students. How will it impact Indian students? Well, Indians constitute a significant portion of Harvard's international cohort. In 2020, approximately 2,13,062 Indian students studied in the US, with 505 enrolled at Harvard alone. Now, getting an admission is not easy there, but this move could further dent many students' aspirations. And what is happening in present is not good news for many Indian students. Reports indicate that Indian students across US universities are experiencing anxiety over sudden visa cancellations for minor offences such as traffic violations or even social media posts. Foreign students in the US have faced sudden visa revocations, as I was talking about social media posts and other things, and this comes amid, the immigration crackdown by the government. Moreover, Indian students who often rely on F1 visas and post-graduation work permits like the H1B visa fear.
Welcome back. Let's talk commodities. Manisha is here joining in, and she's focusing on crude prices and gold. Manisha.
Oh, well, yes, one a gainer and another a loser. I'll start with the gainer first, and an all-time highs in case of gold prices, $33.85 an ounce as the last count. We have seen prices gain up by 29% in this year now, and it is up 45% in last 1 year. It's not just the international markets. Gold has made all-time highs in various currencies, starting from Japanese yen to euro, and the Indian rupee as well, where when you look at the prices, add a GST and a minimum making charges to that, we are trading at above lakh rupees a 10 grams right now. And the markets are seeing support from the decline in dollar index, which is below 99, a new 3-year lows, and all the kind of statements that have been coming in from US President, whether it is about investigating on critical minerals or about firing the US Fed Chair Powell, or of course talking about higher tariffs going forward if the countries retaliate. All of that has been adding premium to the gold prices, with banks and brokerages telling us that the prices can move much higher from here. The next targets after $33.85 are $3,500, $3,700 an ounce as well. And of course, there are some banks and individuals talking about $4,000 an ounce in this year if the situation continues the way it is or gets even extreme from here. So that's about gold. But what is not doing so well today is the crude oil prices. The decline is coming on the back of US and Iran going back onto the framing table. The understanding is that the nuclear deal framework could be happening in this week itself, and that has taken some premium off the prices. The markets also are looking at higher production from OPEC, from US and non-OPEC countries as well. And the demand on the other side has been cut as in sense of revision for this year, and that has been weighing onto the prices. So 1.5% of decline in the Asian markets right now for crude prices.
Thank you so much, Manisha, for joining in and telling us about what exactly is transpiring as far as crude oil is concerned. But moving on, it's a good time to get in Soni Patnaik from JM Financial Services for a quick technical check of the market. Thank you so much, Soni, for joining us. 24,100 is what Nifty has managed to scale. Bank Nifty at record highs. Where do you see markets headed from here on?
Hi, good morning, Vivek. Rima, thank you so much for having me on your show. I think Nifty still continues to show that strength, and anyway towards 24,200 to 24,300. I think that range is going to get tested first before seeing any sort of profit booking. One may continue to hold on to the longs. The put writers are definitely trying to increase or raise their base from 23,500 to 23,800 as of now. So I think that 23,800 support gets defended. Nifty test 24,200 to 24,300. Maybe some profit booking gets to be seen from those levels, but as of now, the uptrend is yet to continue from here. Similarly, if we talk about Bank Nifty also looks quite strong with its all-time highs today, and it may head towards a 55,700 to 56,000 range before seeing any sort of profit booking. Both the indices as of now remains as a buy on declines, and any profit booking that we may see ahead in the next 1 to 2 days may only be a good strategy to initiate longs on those declines.
Okay, and Soni, any individual stocks that you're looking at?
Right. So Vivek, the first buy would be an official recommendation that is in Theta Curd, which is seen above its shorter moving averages crossing today. It is also giving a good option chain breakout above a 805 level. So one can buy Theta Curd at current levels, keeping a stop loss of 785 and a target towards 830 to 850 can be seen. The second official recommendation for us today is in the banking space, which is PNB, looking for quite a strong breakout. The stock is heading towards a target of 107 to 113. So one can accumulate PNB at current levels and on small declines up to 100. Keep a stop loss of 95 and targets of 107 to 113 can be seen.
Thank you for joining in. We will slip into a break. As promised, on the other side, we'll get chatting with Devan Jain from Inox GFL Group. Stay tuned.
Academic and professional aspiration in the US could be jeopardized because of this.
Welcome back to Trading Hour. Well, an important development as far as wind turbine manufacturers is concerned. The Ministry of New and Renewable Energy released a draft notification mandating local sourcing of key components like blades, gearboxes, generator towers. To discuss this in detail, we are now joined by Devan Jain, who's the Executive Director at Inox GFL Group. Thank you so much, Devansh, for joining us today. First up, have you had a chance to look at the draft notifications that have been put up by the MNRE? What are the earlier notifications? What are the current notifications? And how does it benefit Indian domestic manufacturers?
Hi, good morning, Vivek. Pleasure to be back on CNBC. No, certainly. So, I mean, we've been working with the Government of India and MNRE and the related agencies on getting a regulation to the extent which has come out in the public domain now for the past 2.5 years. As many of you may be aware, there is something called ALMM and ALCM, which is now coming forth for the solar industry, which basically mandates domestic manufacturing. And I think what has been happening in the wind sector in the the post-COVID era, you've suddenly seen a couple of Chinese guys come into India with, I would say, C-grade products. You have more expected to come in, given that we never had any domestic content requirement notifications in place. And I think what this does is a big positive for the domestic industry, where the current policy was that you simply need to have something called RLMM, where turbine manufacturer needs to enlist his model and his plant with the Government of India. Under the new regulation, you now need to domestically procure blades, towers, generators, and gearboxes. Now, if you put these four things together, that would constitute almost 75% of the turbine cost, barring the EPC, which anyways is a domestic play. So this is a huge positive for the domestic wind industry. And clearly, Inox Wind is going to be a huge beneficiary of this.
Of the 4 items now, are you importing any? What percentage of your components is imported right now?
So basically, all our blades and towers are domestically manufactured by us. With respect to the generators and gearboxes, partly we have imports. But we have a large enough domestic supply chain, which is already available for us to leverage upon. So currently, if I may not be mistaken, broadly, I think 70 to 75% of the entire turbine cost is domestically made by Inox Wind. So we are well positioned to meet these norms.
Devansh, we want to understand what exactly is happening on ground. Number one, out of the total projects that are currently being executed, what is the proportion that the Chinese players are enjoying? We understand that Envision has almost a 10 gigawatt order book currently. So now, in the current execution cycle, will they be forced to go ahead and meet these norms that are likely to come into effect soon? Or will this only be for incremental bidding? And incremental bidding, what will be the win percentage that you will enjoy?
No, so first and foremost, with respect to the regulation, as soon as the draft becomes law, it goes into operation. So whether they give us 6 months or 200 megawatts, there are two criteria. It goes into force as soon as it becomes law within 6 months. And then no matter what the bidding criteria is, everybody needs to follow the rule of the law. With respect to, I won't comment specifically on any specific manufacturer, but having said that, I think a lot of people make a lot of announcements, noise, and I keep reading about, historically at least, a lot of order wins by one or two of these Chinese guys. But if you look at what's been executed on the ground, is virtually 1,000 megawatts. So in some cases, it's 10 to 15% of the so-called order book over the past 2-3 years. I wouldn't read much into it. I think the two key domestic players, which is us and Suzlon, I think frankly speaking, I think the two of us are the ones fundamentally executing maximum number of projects on the ground. We possibly are the largest turnkey solutions provider in the country at this point in time. And I think with respect to ongoing bids or bids which will come in as we move forward, I think it's going to be increasingly more and more difficult for some of our Chinese colleagues to take in orders, given the fact that you had a lot of C-grade component dumping happening in India. And now with this notification and law going into force, that entire so-called cost arbitrage is completely gone.
But just for you, are there any cost implications? You said part of the gearboxes and generators are imported by you. And about, I think, 25 to 30% is imported of the overall turbine because the balance is made domestically. So now, as you look to replace that, will there be any cost increases? And how would you assess the overall financial impact of this development?
Again, I think that's absolutely insignificant for us. As I mentioned, a big chunk of our procurement, 70-75% of the entire turbine cost, is anyways domestically manufactured. With respect to some of the components which we are partly importing, we already have a large enough domestic supply chain in place. We'll simply shift the entire volume to these guys. Given the fact that there is been 2 years that this policy has been in the work, and again, the policy is not abrupt where it goes into force tomorrow. So there is a period of 6 to 8 months. So I think that's more than comfortable for us. Again, with respect to the remaining 20-25%, look, it's not just China. You've got some components, for example, balsa, which is used in bids coming from Ecuador. Everybody gets it from Ecuador because that's 90% of the global market. Various other components come from different parts of the world. So it's not as if everything is only coming in from China. Certain components, the quality is better. They're far more competitive. So, again, I think for us to possibly be 80-85% local is not rocket science. But I think we've got a mix and match in our supply chain. We've de-risked countries in our supply chain. So everything is also not just focused on India. God forbid something was to go wrong with a vendor in India. We had various vendors globally as well. So for us, our supply chain is very, very integral to our success. And that's also the reason why we enjoy one of the highest EBITDA margins in the industry.
Right. Devansh, couple of quick points. On-ground execution, are you still facing land delays, something that players have highlighted in the last couple of quarters? Number two, can Chinese players actually find a way around this particular notification? Could they go ahead and form JVs with existing Indian players?
Look, let me answer the second point first and then come to the first point. Now, whether it's JVs or majority, it's absolutely, frankly, irrelevant because the product has to be domestically manufactured. Now, you may get into a JV with a large corporate or whatever it may be, makes no difference because effectively, whoever you are, the blade, the tower, the generator, and the gearbox has to be domestically manufactured. Full stop. So it really doesn't matter whether you're on your own or whether you do a JV or a minority or whatever with somebody else. Coming to your second question with respect to execution on the ground, I think, what's very important, which people, Vivek, I would like to talk about is the fact that, these are long gestation projects. Wind infrastructure is not something which any Tom, Dick and Harry can do, or, we are in solar as well, but solar is probably 1/10 the complexity of wind. Having said that, you need to plan a couple of years in advance, and then you need to get your connectivity and land in place. At Inox, we control over 5 gigawatts of plug-and-play common infrastructure across the country. And I think that's a huge moat for us, which is what we continue to leverage and build upon as we move forward. With respect to a lot of other players in the market, they suddenly win a tender and then they come and say, oh, our connectivity is delayed. Oh, the land is not in place. My friend, it's not going to get in place in 1 or 2 quarters. This requires years of planning. And other than that, I would say, the routine land-related issues or routine delays sometimes in evacuation infrastructure is part and parcel of the business. Nothing which requires a special mention. I think the government has done a phenomenal job over the past 2 years in easing out a lot of the operational difficulties. In fact, even this domestic content requirement notification which has come out is a huge step forward to ensure a resilient domestic supply chain.
Devansh, I know you're in the silent period. You may not be able to talk numbers. Today, you've given an update to the exchanges on the 1,500 megawatt framework agreement that you have with a subsidiary of CESC. What is the development on that front? How much of it is in operation? And that particular project, what can be the incremental EBITDA contribution once it comes on stream?
Look, I'll simply talk about what's in the public domain, given we are in the silent period in real estate, right? So we've taken out an update where we signed an agreement of about 1,500 megawatts with CESC's subsidiary, Purva Green. We currently have received advances for the roughly 1,000 megawatts of turnkey development across 3 different states. All these projects are now have gone into execution. And yes, there's a period over which commissioning starts, kickstarting from this financial year. This was, if you recall, an agreement where we were to build out 1,500 megawatts for them in the next 3 to 4 years. Happy to say that the turnkey should happen prior to that period. With respect to the remaining 500, it's expected to move forward in the near future. And of course, we'll keep the markets updated as we move forward on that. No specific comment on EBITDA, but as you know, we've upgraded EBITDA a couple of times over the past 3 quarters. We currently, I think, have guided for about 18% EBITDA margins, if I'm not mistaken. We have historically been doing better than that. So I wouldn't be able to, lay more emphasis or talk more about that at this point in time.
Devansh, always a pleasure chatting with you. Thank you very much for joining in. Let's get on to the big story then. US Vice President J.D. Vance has arrived in India. Parikshit is now joining in to tell us more on what's on the agenda. Parikshit.
Well, J.D. Vance has arrived in India for his first official visit. We got those pictures of him getting down from the aircraft with his wife, Usha Vance. Their 3 children were dressed in Indian attire. They are at Akshardham Temple right now. They have strong Indian roots. Usha Vance is of Indian origin. She has family here, friends here. So this is an important official plus personal visit for them. They will be staying at the famous ITC Maurya in New Delhi. And ITC Maurya is a place where many US presidents and their families have stayed when they visit New Delhi. In the evening, J.D. Vance will be calling on Prime Minister Narendra Modi at his residence for an official meeting. That will be a 30 to 40-minute meeting, and we believe that trade could figure prominently on the agenda. We hear from sources that the Indian government is willing to give concessions as low as 10% all across the board as the average tariff to the United States, but US wants a zero tariff regime. So somewhere India and the US will have to come to a compromise as far as the tariffs are concerned. While the PM and J.D. Vance are likely not to go into nitty-gritties of the tariff negotiations, they may show an intent to resolve all the outstanding issues as soon as possible. Issues related to security to defense acquisitions, energy are going to come up for discussions. Manufacturing, startups, space cooperation will be very important. Discussions on the Russia-Ukraine war, on the Middle East, in Gaza, will be important in those discussions. And both India and US may share their view on the economic and security challenges arising from China as well, considering both countries have high trade deficits with China and they are concerned about China's role in the Indo-Pacific as well. From here on, J.D. Vance and family will leave for Jaipur, where they'll visit the Amer Fort. They will have an address at the Rajasthan International Centre, and finally they go to Agra, and following which they leave for the United States.
Thank you so much, Parikshit, for joining us and giving us an update on this very important.
This is the first time that a US Vice President is visiting in the last 12 years.
Wow.
So while there is cultural and personal significance to this trip, it's always going to be a diplomatic mission as well. So all eyes will be on this one.
Let's wait for the outcome, whether there are any material developments from this particular visit. We'll take a quick break. Post the break, we'll put the spotlight on HDFC Bank and ICICI Bank on the other side.
Welcome back. Tata Elxsi is climbing higher and higher, and another stock which deserves mention is BHEL. Came out with a muted set of numbers, BHEL, but the stock is now inching up. It's moved back into the green after opening up. It was a bit of a, I think, subdued set of numbers for BHEL, but the stock is seeing some recovery. So it's that kind of
top line muted. So execution FY25 along expected lines has been muted. There's been quite a lot of worries in terms of execution, but the order book, something given the fact that it's almost the sole player when it comes to thermal power EPC in India. Order book has been very strong, and that is something that has led to a bit of a recovery.
I think 92,500 crore of order inflows in FY25. So that's a fairly sizable number. But let's now go across to Abhishek. He's going to tell us how ICICI Bank fared in the fourth quarter. It's a bank which has been delivering stellar numbers in the face of heightened competition, irrespective of the macro challenges and the asset quality issues that peers have had. ICICI Bank's numbers quarter after quarter have been very resilient and strong. Abhishek is now here with more.
With respect to ICICI Bank, the loan growth momentum is weak. However, the P&L is very strong for them. Versus our poll, the NI and PAT is a beat on our poll. Deposit growth came in at 14% YOY and about 6% sequentially. YOY, it's one of the weakest growth that you are seeing in last 8 quarters. Now, advances growth were on the lower side at just 13.3% YOY and 2.1% quarter on quarter. So YOY, it's the weakest growth that you are seeing in last 17 quarters, and sequentially, that is quarter on quarter, you are seeing one of the weakest growth that is coming in 15 quarters. Net interest margin is at 5-quarter high of 4.41%. Core operating profit growth is at 5-quarter high of 13.7%. Now, quarterly annualized slippage ratio is at 17-quarter low of 1.5% versus 1.85% in the previous quarter. Their asset quality continues to show robust decline and is one of the best in last 10 years or even more for them. Gross NPA ratio and net NPA ratio have improved, with ROA or return on asset being the highest ever that they have recorded, north of 2.5% in this quarter. Back to you.
Thank you so much, Abhishek, for joining in and taking us through the internals of ICICI Bank as far as the results were concerned. But remember, the management also held a post-earnings conference call over the weekend. Let's listen in to key excerpts from that call.
So as far as the loan growth is concerned, I don't think anything specific incrementally in terms of caution on the credit side. I think we are pretty comfortable with what we are underwriting. Of course, on personal loans and cards, as you know, we had tightened, a few quarters ago, and that is showing up in the volumes over the last couple of quarters and the loan growth. But other than that, no specific caution on the credit side. I would say it's largely a function of what is happening in the system. And also, I guess, on the pricing side, some consciousness given that, during this quarter, we were at the sort of cusp of the, downward movement in benchmark rates. We have seen liquidity improve substantially over the last couple of months with all the measures that the central bank has taken. And deposit growth for us has continued to be quite strong. You would have seen the numbers for the fourth quarter have also been pretty strong for us. So, as the rate, now, of course, if you look at it, the repo rate has fallen by 50 bips. So that will start to see a transmission into deposit rates, which is what has started. So I think that's, in the natural course of things.
Okay, the other big one is HDFC Bank, and that too is sitting at a record high today post the numbers. The stock is up nearly 1.5%. And HDFC Bank and ICICI Bank have done well last week as the FI buying has returned to the market. We know the FIs have a preference and a bias towards these private sector financials. Now, HDFC Bank's numbers were also strong. In the conference call, CEO Shashidhar Jagdishan commented on how the bank will place itself amongst the will position itself given the global macro uncertainty and plans with its key ratios in the coming fiscal year.
We've already seen 2 rate cuts, and the change in stance from neutral to accommodative is a welcome relief to all of us. RBI intends to increase durable liquidity, which is followed by concrete actions, which along with rate cuts will help supporting the GDP growth. For FY26, we expect the GDP to be supported by a pickup in rural spending, discretionary consumer demand, and investment activity. Of course, the goods exports may be impacted until the global trade and tariff situation becomes far more clearer. We acknowledge that the global macroeconomic outlook has become more uncertain due to the recent trade tariff-related measures and the volatility surrounding them. This may potentially impact global inflation, leading to lower growth across economies. Corporates have adopted a wait-and-watch stance, and we are waiting for more clarity. We remain watchful. Our credit deposit ratio has been brought down from the highs at the time of merger, which was at about 110%, to around 96% as of March 2025. Our deposits have grown faster than the system, and so has it grown faster than our loans as well. Next year, in line with what we had committed, the adjustment in CD ratio will not be so steep, supporting the loan growth for the bank, but it will be on a downward path. Asset quality, one of our USPs, remains pristine. As liquidity and growth improve, we are well placed to grow in both assets and deposits.
Well, that was the CEO of HDFC Bank in the post-results conference call. But moving on, in the latest episode of Market Cafe, Surabhi Upadhyay caught up with White Oak Capital founder Prashant Khemka to discuss what the post-COVID investing landscape looks like. Khemka says investors do need to temper their return expectations as the easy money era of the stock market is probably over. Let's listen in.
Post-COVID 5-year fantasy run is over. Yeah. A dream run, I would call, is much longer term. I would say the last 40 years have been a dream run.
So the fantasy run is over.
The fantasy, last 5 years were pure fantasy.
From the market doubled. I mean, from the March 2020 bottom to, I was looking at the charts again, September, the market had just doubled.
Absolutely. See, from 2020 bottom, March 23rd, 2020, the market still, over the last 5 years, small caps, if I'm not mistaken, have quintupled. gone up 5-fold if I'm not mistaken. The larger caps included, I think like BSE 500 has given compounded 20% return or something. Some pockets within small caps and mid caps, certain segments which did build some excess. And the last 6 to 12 months, that froth has been to a great extent fizzled out.
It's fizzled out. But, you know, again, I ask this in a very broad way. And I ask this from the point of view of investors who had more time during COVID and decided to come in, and they were either buying stocks directly or, you know, buying in and out of mutual funds. And making money from the market seemed really easy. Is that time over?
Yeah, I think that time is going forward. It's not going to be so easy. So just on that one, you know, retail investors during such time handily beat fund managers, by the way. Yeah. And they feel that fund managers are useless because all the fund managers.
20% मेरे stock पे मिल रहा है.
My son, who's 13 years old, he's managing his younger brother's money already, outperforming over the last just 9 months by 25 percentage points.
Your elder son is managing your younger son's money.
And elder sister's money.
Okay.
And outperforming by 25%.
He's outperforming you also.
Our team is hardly, I mean, our team, compared to him, our team might be outperforming by 3 to 4 percentage points over this time period. So
and how old is he?
He is now going to turn 14. He's 13 and a half or so.
Imagine
So
that.
to him, his God's gift to mankind. Outperforming by such huge. Now, he'll obviously over time come to learn that markets aren't so favorable to small caps, because that's the area where he would typically, retail investors in general tend to invest in smaller caps, which have done phenomenally well. So that, I think, should at least normalize.
Most mutual fund managers will tell you that compounding over long periods of time, if you're getting 12% to 13, 14% kind of returns from equities, you're well off.
Absolutely.
But then we got greedy. We've gotten used to, at least 20%, 25%. If you're in a great mid-cap or a small-cap fund or individual stocks, then, sky's the limit. So what is the new reset that we have to go back?
So if you see over the last 40 years, markets delivered close to around 14% return, but it includes the 80s and 90s where inflation was higher. Over the last 30 years, 20 years, it's been around 12% return. Going forward, assuming an inflation regime which is more in the 4 to 5% range rather than 5 to 7% range, I think a 10 to 11% return from equity markets over the next 5, 10, 15 years is a reasonable base case expectation.
10 to 11%. When people hear you say that, half of them will be pulling their hair out saying,
Pre-tax.
What is Prashant saying?
Pre-tax. Nowadays, we have to, unlike in the past,
Exactly,
now we have to pay
12.5% tax. Assuming it remains 12.5%.
Post-tax, if you earn 10% going forward, it will be a very good outcome. In an inflation environment of 4 to 5%, 10% is very good, meaning you can double your money in 7 years.
Now that we've understood that this is a real reasonable expectation to have, I want to come to now how to go about investing in this environment. And before that, let's understand earnings. IT and FMCG are two large parts of our large cap universe. And they seem to be stuck in a rut, a low growth rut. Isn't that an overall problem for Indian equities?
See, it remains to be seen how much of it is truly structural and how much could it be on top of. There is some structural element to it, but on top, what is the cyclical element? For many years, we had double-digit growth in consumption. Consumer discretionary was, growing at mid-teens for many years during the 14 to 18 time period for several years. So I think when it settles down, I do think consumption overall can still grow high single digits.
So overall, staples, you're expecting the earnings to recover to what level?
Let's say top line growth of 7 to 10, somewhere in the 7 to 10% range, call it 8 to 9.
And by when? This year?
Oh, very hard to say. This is more like trend line.
And then IT services?
IT services, you're right. I think longer term, over the last 5 to 10 years, it has shown a tendency to be around 5% dollar terms, which is about 8% rupee terms.
Yeah.
So lower end of the staples range, I would say. But 8% is not that bad. You have to obviously marry all this with valuations.
Welcome back. You should just keep your eye out on Hyundai Motor because today the 6-month lock-in of its IPO, shareholder lock-in, will come to an end and a fairly large amount of shares will get released. So according to Nuvama, nearly 50 crore shares of the company, which is worth about $9.5 billion, will become eligible to trade. The 6-month and beyond lock-in will come to an end today, and that's about 60% of the company's outstanding. So that's Hyundai Motor, which you should keep on your radar. But let's welcome Nitin Raheja on the show now. He joins us from Julius Baer, India. Thank you very much for joining in. Nitin, your call for a while has been bullish on financials. You've been positive, particularly on private sector financials, and now they're the first to get to their record high levels. Where from here? Do you think we've already seen a bulk of the gains, or do you think they are in a structural uptrend, and even at these levels, one can go long and accumulate banks?
So, thank you for having me on the show. But just to, when we talk about financials, I'll just sort of enumerate why we like this sector so much. It's very simple. The sector has been going through a lot of regulatory overhang on the part of RBI. Then you had this whole not structural, I would say, a whole tightening of liquidity in the economy, which came and sort of, hit these companies pretty well. And we've seen deposit growth being tepid. Now, what we are seeing is there is ample liquidity in the economy. We've seen that the regulatory overhang is lessening. And in fact, all the curbs that were coming on unsecured loans, personal loans, we've seen that the net impact, at least when we've seen the two big banks declare their results, we haven't seen a worsening of credit quality. And because of that, we've also seen the RBI roll back some of those measures. So I think with all of that in place, you have these banks sitting very well placed. They've been able to even pass on the cut of repo rates by lowering the deposit rates. We saw that from 1st April onwards. So, and that coupled with the fact that the valuations that these companies in this sector trade at are at probably their lows over the last 10 years. So we've just, in my own view, if there is one place where you can find valuation comfort, at the same time, the upside of growth, that is financials. Now, we are seeing that discretionary consumption is struggling, and the government put in measures as far as in the budget in terms of, increasing the tax threshold, plus a good monsoon and rural. I think you should see consumption come back in the second half. CapEx spending should also start seeing an uptick as we go ahead. So I think they're very well placed for growth as far as the balance sheet is concerned, as far as the regulatory framework is concerned. And hence we think that, that space has yet, long legs or a long way to go.
Nitin, take your point completely on board. Banks clearly cheering, especially as far as the last couple of weeks are concerned. You did mention about significant avenues for growth going forward, but in the quarter gone by, especially for a bank like ICICI Bank, were you a little worried about the loan growth, around 13%, slightly lower than what the street was anticipating? And also your view on NBFCs. Do you feel that they would benefit quicker as far as rate cuts are concerned?
Well, to take your second part of the question first, clearly, I think the NBFCs should be the first beneficiaries of rate cuts because they ultimately, are, they borrow, a huge chunk of the borrowing comes from the banks. So I think the NBFC pack should do well. But however, within the NBFC pack, you have to sort of be very, very selective because what we have seen is in each segment, there are a few NBFCs which have excellent underwriting norms. When we look at NBFCs more than growth, the first thing that I look at is how strong is their underwriting norms and culture. I think that is what clearly, because when you have sources of fund which are higher than banks, and you are actually borrowing from the banks as one of the large source of fund, the spreads that you typically enjoy are leveraged by the fact that you take 5 or 6x leverage and your credit cost being low. So if any NBFC has high credit costs, it invariably lands into trouble. And that's why you've seen since 2018 till now, very few NBFCs generate sustainable wealth. So I think when you look at the NBFC pack, looking at those which have very strong underwriting norms is very important. And I think I agree with you that they will be the first beneficiaries of this. In terms of credit growth, I think we are coming to a realistic level. The fact that the economy is slowing, and those 17, 18% growth numbers are going to come down to 13, 14% sort of numbers. In a particular quarter, if a bank does less than expectations, that's fine. Because I think the larger banks will primarily land up doing maybe 1.1 or 1.2 times nominal GDP growth. And if nominal GDP growth is going to average anywhere between 10.5%, 11%, so you're probably going to see a 12 to or a 13 to 14% sort of growth number payout as far as credit growth is concerned.
Nitin, with the appropriate disclosure, and you could just say that, could you share some of the top bets that you have in your portfolio that you're recommending?
Well, I'm afraid we are not allowed to talk about stock specific in such forums.
Okay. Any new themes which have emerged?
No, I think the big what we are seeing today is across the board, a lot of sectors are seeing a slowdown. At least we're going to see a trend emerge in the first half. But within each of those sectors, you will see stocks do better. So I think it's very difficult to call a sectoral theme play out. But if I have to take a little longer term view of the next 1 year, I probably see in the second half consumer coming back. And I think the bottom K, which is, we've seen this K-shaped recovery where premium discretionary has done well. I think the bottom K should start coming back because there are a number of levers that are driving. A, inflation has come down. B, you're going to see, the pay commission wage hikes come into play in the next 1 year. So you should see that happening. And with monsoons being there, I think rural should start doing better. So all of these come together should see in the second half a good festival season. And as far as consumption on the lower K is concerned. So I think that is one other area that we see. But otherwise, we believe that this is going to be a more bottom-up market, even among sectors, whether you take pharmaceuticals, whether you take automobiles, you will see one or two companies doing far, far better. And I think that's the way you'll have to play this market.
Right. Nitin, you've spoken about 3 export-oriented sectors, auto ancillaries, textiles, as well as EMS plays. Given the kind of uncertainty we have around tariffs, how are you approaching this space now? Would you wait for a better opportunity or are you constructive on them now?
So clearly, the era that we are living in is an era which is going to be driven by bilateralism. So we're going to see very soon in the next couple of months, probably the first of these few bilateral trade agreements fall in place with the US. And when that were to happen, you will clearly see some sectors emerging as winners. So if you look at it from an India perspective, right, I do believe that autos is going to be, and auto anchs is going to be a clear, a lot of auto anchs, in fact, have now set up facilities in Mexico, where the US has a more favorable sort of tax agreement. So you will see a lot of auto anchs doing that. Pharma, I think, is going to be around. We are going to see a new deal that will come through. So I think if you're looking at the next 2-3 months, clearly there is a slowdown you will see as far as exports is concerned. In fact, what you might also see as a reverse, that before any of these tax treaties come in, you could actually see the pipeline getting filled. Okay. So you could more aggressive this thing. So you could actually see a good few quarters. And then once the news come, actually the market start discounting what the news is, the bilateral trade deal is already this thing. So I don't really see too much of a impact on export-oriented sectors over a long period of time.
What's the best way to play the broadening out of the consumption theme? As you said earlier, it was all about premiumization, and we did see, luxury apartments, for instance, like flying off the shelves. But now you expect that with the monsoon, with just better sentiment, the consumption will now broaden out. Would you play it with the staples, the regular HULs and the Britannias, Nestle's of the world, the Daburs, or would you also look at some other themes, for instance, shoes? Right, they've also been impacted at the lower end. What's the best way to play this consumption theme at the lower end?
So I would probably play it through like you said, footwear, apparels, even, for example, two-wheelers. I would probably play it, and affordable housing, and within that, look at affordable housing finance companies, which is actually a great proxy play for that.
Thank you so much, Nitin, for joining us, giving us your view on a whole range of sectors and the fact that you continue to like a few export-oriented sectoral themes. Thanks so much for joining us once again. Well, we now slip into a short break. More stock-specific action on the other side.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies.
Welcome back to Trading Hour. Well, a very important story is what we are picking up from our sources. Sources revealed to CNBC-TV18 that Eversource Capital is in talks with ride-hailing firm BlueSmart for a possible acquisition. Parikshit joins in with more details.
Well, yes, we believe that these talks between Eversource and BlueSmart have been on for the last few months. They've gathered pace and gathered momentum in the last few weeks, ever since the irregularities surfaced in Gensol, and they had an impact on BlueSmart as well, considering that Anmol Jaggi and Puneet Jaggi, the co-founders of BlueSmart, own about 25 to 30% stake together in that company. Now, what's been happening is that there is a discussion to buy a majority stake in BlueSmart for around 800 to 850 crore rupees. This is likely to be finalized over the next 2 weeks or so. A final decision is still awaited, but we believe that talks have gained positive momentum. But one of the conditions for taking over BlueSmart would be that Anmol Jaggi and Puneet Jaggi have to step aside and have to distance themselves from the company, and Anmol Jaggi would have to step down from the board as well. So let's see how things pan out. Eversource did not comment on our story, but if Eversource does buy a majority stake, there will also be a question mark on unpaid salaries, the liabilities of BlueSmart over the last 45 to 60 days, and all the pending bills at the company as well. So let's see what happens now.
Okay, that's a big story that we will be tracking. Parisha, thank you for that. That brings us to a close on Trading Hour. From the entire team, thank you for watching.
Expert opinion on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community.
Stocks gain with the benchmark Nifty stamping 24,000 after foreign investor buying last week. Energy and power stocks are the biggest gainers, even as FMCG is a big drag. The Nifty Bank has hit a record high and continues to build on that. The mid caps are outperforming as well.
Private heavyweights, HDFC Bank, ICICI Bank, power up banking stocks after beating profit estimates in the fourth quarter. Good deposit growth, pristine asset quality and healthy margins underscore a strong show.
Infosys misses Q4 expectations but guides for revenue to grow at 0 to 3% ahead of most analysts' expectations, powering up IT stocks. Valuation comfort adds fuel to the up move.
Eversource Capital may be in advanced talks to buy beleaguered ride-hailing player Blue Smart, a deal that will likely involve the promoters Jaggi brothers stepping down.
US Vice President J.D. Vance arrives in India even as bilateral trade talks are expected to have made good progress. Experts believe talks between Vance and PM Modi will extend beyond trade to other strategic issues. You're watching Halftime Report live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia, with me is Manglam Malu, and it's a very good halftime report that we are bringing to you from the market's perspective. The Nifty back above 24,000, in fact above 24,100 now. The Nifty Bank making new highs. The Sensex is up 1,000 points. Well, what more could you ask for after coming back from a long weekend?
What more could you ask for from a long weekend? You know what's interesting is that the way Mumbai played against CSK yesterday, the single-handed win that our boys gave us is exactly what's taking place in the markets today, and the Bulls are concerned. Because what is it that Mumbai did to CSK? You had the top two players do extremely well. We had the erstwhile giants like Rohit Sharma as well as Surya Kumar Yadav powering Mumbai ahead in a win which was 9 wickets more than, or it was a win which was with 9 wickets. So thumping victory is what we saw there. That's exactly what's taking place in the markets right now. We've been talking about how the Nifty Bank will do a lot better in today's trading session, hit a fresh record high. Well, come the second player, we have the IT index as well. After so much disappointment, maybe the street believes that we have a bit of a value zone in space and in place, as a result of which we've seen the index move ahead. So the Nifty Bank was always expected to support. The IT pack is the one which is leading or lending that additional push to the frontline index, and as a result of which the Bulls are thumping ahead right now, near 300 points on the Nifty. Speaking about IT, we have to go to Rima. Rima, it has all started with the performance that Infosys made this morning in terms of the stock price, even though the company missed the fourth quarter performance. What do you make of this?
Well, as you rightly pointed out, Q4 was a miss. The FY23 guidance at first look at 0 to 3%, you would say is lower than consensus expectation. But what the street was fearing perhaps was a lot worse. So look at what JP Morgan has to say about the FY26 guidance. They say it's below prior expectations, which was set 3 weeks ago. But it's better than the recently feared post-tariffs and the uncertainty impact flagged off by Wipro's print. Remember what Wipro guided for Q1. Citi too says the guidance looks decent in the current backdrop, though the higher end does look a little aggressive to achieve. But don't forget, the Q4 was a miss. The company's top line declined by a sharp 3.5%, though margin performance was a saving grace. But many brokerages, in fact, 70 to 80% of the brokerages have a bullish view on Infosys. Many of them have it as a top pick. So Kotak says they expect a muted performance in FY26 on account of the uncertainty. And considering that Infosys has a higher exposure to discretionary spending, it makes Infosys more vulnerable than the other peers. But given the company's strong positioning in cost takeout deals, basically cost optimization in the face, vendor consolidation and AI, they believe the company will be able to weather the storm. They have a buy target price 1700, lower compared to the 1800 that they had before. Jefferies buy call 1660, JP Morgan overweight call target price 1800, HSBC target price cut, but it still stands at 1700, and similarly for Nuvama too.
Well, if HDFC Bank and ICICI Bank could be categorized as boys played well, Infosys has joined the party as well. But what's also on the list is Tata Elxsi has reversed not only all of its morning losses, but it's now up almost 9%. Rima, what has the quarter gone by for Elxsi?
Well, you know, the quarter undoubtedly was weak. It was lower than street expectations. It was the third consecutive quarter of a miss. Revenues for the company declined by 5.3% quarter on quarter. EBITDA margins sharply lower at 22.9%. Profits declined by 13.5%. So what could be driving the stock higher? Well, it could be the management commentary, because what the management said in the conference call is that they expect growth stability to return in Q1. FY26 should be better than FY25. Analysts say, well, this looks difficult to achieve. But the company is calling that out, and they're expressing their confidence based on the deal wins that they have. Remember, the company also in Q4 announced large deal wins, a $100 million deal win in media and communication, and about a €50 million deal in the transportation vertical. Also, the stock has seen a big derating. In fact, in the last 3 years, it's a negative return of 35%. So the stock has been under pressure. So these could be some of the factors that maybe tactically there is, just going by what the management has to say, maybe the worst is in the price. The stock is looking attractive at these levels, but brokerages are still a bit cautious. Kotak and Ambit have a sell call with a target price at about 4,000, 4,500, which is lower than the current market price.
All right, we take that point. Rima, thanks a lot for that. We have the IT pack covered. Now let's talk about some of the city gas distribution companies. The government is taking measures for sustained allocation of affordable gas to them. Sudarshan joins in with more details on this development. Sudarshan, this was largely on expected lines, but this is still nevertheless a positive.
It's a minor positive because over the weekend we have seen that government has announced some changes to the domestic gas allocation, and this time domestic gas would not only include APM but would also include new well gas. So what does government say? It says that from Q1 of FY26, domestic gas allocations will be done on a 2-quarter advance basis. So currently it's done per quarter, but now from Q1 of FY26 it will be done in the advance of 2 quarters. And second, apart from APM, new well gas will also be part of the allocations. Now, for new well gas, as of now, it used to be done via auction, but now it would be done via pro rata. What does pro rata mean? It would be done as per the demand. Suppose that if, for example, the MGL and IGL, if IGL has more demand, so IGL would get more new well gas than MGL. Now, third, as per the government, allocation as of Q3 FY26 was 54.7% of total demand. And even in Q1, it's around 55.7%, and Q2 FY26 also government expects to be around 54.74%. But this 54.74% includes both APM and new well gas, because as per the communication we received from IGL and MGL, APM is around 37 to 38%, and new well gas will form around 17 to 18%. What do analysts say? Analysts believe that it's not sure if there will be further decline in the affordable gas, even from current levels as well. But what is positive is we are saying crude is soft, even this LNG prices are soft. These soft prices will help companies to maintain the margin, not only in the near term, even because there are expectations that even going forward over 12 to 18 months, these prices are going to remain soft. So that would aid the margin for most of the city gas companies. And today's trade, on the back of announcement from the government, you are seeing positive move in these names.
Positive moves indeed. Sudarshan, thanks a lot for that. By the way, the Nifty is still up 280 points, 24,130 on the index. Some of the top movers then, Just Dial, also another earnings reaction, is now up 11%. Suzlon has also extended its gains after that notification that came in from the Renewable Energies Ministry. That stock too is up over 7%, now 6.5% higher for Suzlon. We'll talk about all of these buzzing names on the other side of this short break. Stay tuned. We'll be right back.
Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Welcome back. On to some buzzing stocks in today's trading session, one of which is Eternal. That is also trading with gains of around 2.5%. And that is after the company made an announcement last week that it will cap its foreign shareholding at 49.5%. Now, what does that mean for the stock? How a brokerage is looking at it? Manglam will tell us about all of that. Manglam.
Well, you know, Eternal, erstwhile Zomato, has approached shareholders for an approval to cap foreign shareholding to 49.5%. What this means is that domestic holding of the company would be 50.5%. Is this new? Not necessarily, because the board approval has come by. Remember, the company has already raised funds, via a QIP itself from domestic investors. So the shareholding is more domestic than foreign. The management has indicated that as well. The shareholder vote is via remote e-voting between 28th April to 19th May. And this will maintain Indian ownership classification for the company. Why is this important? Because in the long term, there could be potential regulatory risks around foreign ownership in multi-brand retail. There are, foreign investors who are, or foreign companies who are not allowed to do a lot of things in the retail business in India itself when it comes to multi-brand. One of that is stocking your own inventory. So you're allowed a marketplace, not allowed to stock your own inventory itself. So this protects the company from any long-term risks around that. But in the near term, because it is a domestically owned company, there could be a risk of outflow from passive indices, exclusion from passive indices like the MSCI in the near term. Analysts expect a near $1 billion outflow as well whenever that happens, either in the current the current renovation or the next check of the MSCI index itself. What is it that brokers are saying? ICICI Securities says that foreign shareholding cap supports the shift to owned inventory model. It will add about 100 to 150 basis points EBITDA margin in the quick commerce segment, for which they will have to deploy around 1,000 to 2,000 crore in terms of working capital because they will have their own inventory right now. But can they do that? Of course, yes, because they have cash of nearly 19,000 crores, which the company had said that they're raising for QIP for that very reason. Morgan Stanley has an overweight call as well. They're saying that, this will enhance their moat of quick commerce, but increase capital intensity, which may be offset by margin expansion itself. Jefferies as well as CLSA, both of them positive on the stock. Jefferies has a target price of 255. CLSA has an high conviction outperform call with a target price at 375. But the near-term headwind still remains, which is that of nearly $1 billion worth outflows whenever the index reconstitution happens for the MSCI.
Interesting. And even after the stock corrected significantly from its peak, which was around 304 rupees, the stock managed to defend that mark of 200 on the downside and has seen a rebound from those levels. Now at 232 is eternal. Well, focusing on Angel One now, as the fourth quarter was a weak one for the company, a sequential decline across the board, across all parameters. The management also told CNBC-TV18 earlier that FY26 will be a year of consolidation. Now, Mangalam, you will tell us more on our special segment, Insight Edge, as to what were some of the key takeaways that you had with the management.
Well, you know, the reason why the stock has moved higher is because now the management, by virtue of its conversation on CNBC-TV18 and in the conference call as well, did indicate that the worst was definitely behind the capital market players. Why do they say that? Because one, it was a perfect storm. There was a fair amount of volatility in the stock market. There were also a lot of regulatory changes, which now the street believes that is gone and done with. There are signs of recovery. The impact of regulatory changes have been absorbed by retail investors. The revenue curve is moving up slowly. They said February was the trough. Thereafter, there was some recovery in March, and that continues into April as well. And this revenue increase will contribute directly to margin improvement. There were a couple of one-offs in the fourth quarter as well. If you take note of that, going forward, margins are likely to improve. They saw 6 to 7% month-on-month growth in F&O orders in the last 2 months as well. F&O was largely hit by the regulatory segment. And they say that while FY26 will be a year of consolidation, some of their products like Wealth doing well, seasonal market share changes that they saw in the commodities and F&O business as well. And they said that they are able to bounce back to their 44 to 45% operating margin guidance by the fourth quarter of FY26 itself. So were that to happen, then maybe you know a lot of the estimates that the street was making of a large single-digit decline in EPS for FY26 may not come by, because if the margins are improving, even if the revenue stays stable and the worst is behind, then maybe the performance would be slightly better than what the street is fearing. Add to all of this, the stock is in F&O ban. So no fresh positions can be taken to be carried overnight. Though, can the stock get out of F&O ban or not? For that, you'll have to take that break, come back, talk about the F&O segment, and that's when I tell you whether Angel One comes out of F&O ban or not. But as of now, from a business standpoint, the management says perhaps the worst is behind. So let's listen in to what Dinesh Thakkar, who's the CMD of the company, who had to say about the business.
Macros, be it our economic growth, be it FIS not investing, and majority impact is because of regulatory changes, which has now, I would say, absorbed by retail investors. We saw a bottom in terms of number of orders in Feb. We did almost below 50 lakh order per day, which is kind of like minimum. After that, we are seeing slowly kind of like revenue curve is moving up. So March numbers were better in terms of 53, 54 lakh order per day. And we are seeing this trend continuing in the like this month also. So that gives me confidence that, okay, at least revenues are now, revenue come has turned for better. So whatever revenue increment we see in this progressive months, that will straight away contribute to our expansion of margin. Whatever impact we have seen in terms of F&O order, on month-on-month basis, I am seeing a growth of around 6 to 7% now for this past 2 months. So that gives a broad sense that, okay, retail are coming back. See, for retail, there was no reason for them to come back because markets were depressed. They did not see any opportunity, and they were not in a hurry to really jump and decide that what kind of an instrument they had to buy, if at all not options. So what I am saying, after this kind of like stabilization in terms of our kind of like news that are coming and the FIS inflows that are coming in, it appears that retail is getting back confidence to come back to the market. FY26 this year would be a year of consolidation where we would be focusing more on getting back to OPM, and the growth is going to help. So currently we are not working on what kind of top line we will achieve because it's a function of market condition, lots of things. Internally, what we can do is that, okay, how do we bring in AI tool, get more cost efficiency, and how do we bring in more customer on our platform? So result of that, whatever revenue we are going to get, it is very difficult to predict at this point in time. But what we are confident is that we would be able to bounce back to an OPM of 40-45% by Q4 FY26.
Well, the worst is over, is what Dinesh Thakkar of Angel One says, and it's showing up on the stock as well. 6% higher now for the stock at the highest point of the day is Angel One, but of course significantly away from its all-time high, which is close to around 4,000 rupees. We take a short break. The Nifty is now up 320 points, up at 24,160. The Sensex is now up almost 1,000. We'll get you more with a chart check with Sudeep Shah of SBI Securities, and of course, Mangalam tells us whether Angel One comes out of the F&O ban or not. Stay tuned.
Howard is a joke, teaches hate and stupidity and should no longer receive federal funds. These are the words of America's most powerful man, who's going after America's most prestigious, richest and the oldest university. I'm talking about US President Donald.
Welcome back. You're watching us here on Halftime Report. Perfect time to get you up to speed with what's taking place in the F&O space. First things first, no questions about it. Bulls have charged ahead. The Nifty up 311 points. When we started the show, it was 280 points. When we started the previous show, it was up 200 points. So at any point in today's trading session, had you bought, you would be in the money. That's the kind of trend day that we've seen. Nifty Bank continues to do well. The mid-cap index a shade better at around 2.5% in gains. The Nifty accelerated its up move once it crossed past the 200-day moving average of 24,050. Now the level to watch would be the 2025 high of 24,227, from which we are just about 50-60 points away. So were the Nifty to cross that 24,227 mark, it would make the Nifty, at the highest level of this calendar year itself. What's interesting is the tug of war that took place between the Nifty Bank and the Nifty IT over the last 1 month. Over the last 1 month, the Nifty Bank is up 7.5%. The IT index is down 8%. So the outperformance of the Nifty Bank is nearly 15%. Now that is coming undone. Can it go past, a lot more from here on itself or not? Because the Nifty Bank is at a record high. The Nifty is still 8% away. The Nifty IT is 26% away and Reliance is 19% away. Nifty IT and Reliance, if they make a move towards that 52-week high from current levels, if these stocks or sectors have bottomed out, then who's to say that the Nifty may not cross a record high, which is about 8% away. Quite a lot, but still a marker to keep in mind. What's also important is this week, the momentum is firmly with the bulls. And this week is important from a momentum standpoint because it's April series expiry. Nifty is up 2% in April series this week, but from April series low itself, we're up around 11 to 12%. Where do we go from here? For this expiry, the 24,000 mark seems like a foregone conclusion because the put writers are fairly active there. 24,000 now an important psychological support, as is the 200-day moving average, which is at 2450 itself. 23,900 put writers also making a lot of money right now by writing that. On the way up, the 24,200 call writers and the 24,300 call writers are taking their chances, believing that maybe around 24,350 and 24,300, there could be some sort of supply that may come by. If that were to happen, then these call writers would make money. But if that weren't to happen, then these call writers will have to cover their positions. That may cause another melt up towards that 24,500 mark. A couple of stocks that I'm keeping on my radar. Nalco may exit F&O ban in today's trading session. And Angel One, we spoke about how it entered the F&O ban in the previous trading session. But with the kind of up move that we've seen in the stock and the concomitant pace at which the open interest has declined, it stands at around 83-84% of market-wide position limits. If it falls below 80%, the stock exits F&O ban. Remember, in the previous trading session, it was at around that 97% mark. So in the first half of trade itself, it's come down by about 11 percentage points. Who's to say, again, in the next 3 hours, if it goes beyond, goes lower by another 300-400 basis points, then it may actually come out of F&O ban. Chances are that it may well come out of F&O ban today.
We're hoping for that, a lot of those bulls. But yes, 6% higher on Angel One, and Nalco 2 may exit the F&O ban in today's session. But Sudeep Shah of SBI Securities is joining in now on the show. Sudeep, good afternoon. Thank you for joining in. We have had 3 consecutive days now of very, very strong moves on the index. From defending levels of 23,000, we are now well above 24,000. Where do we go from here? And does Nifty Bank have more upside in store after the kind of moves you've seen today? And couple that up with your stock recommendations as well.
Afternoon, Hormaz and Mangalam. See, I very well agree with Mangalam that every passing hour we are seeing the rally getting strengthened, and what we feel is that with the indices crossing the 200 DMA today and with such a force, we are more likely to head towards 24,400, 24,500 on Nifty in the next couple of days, probably ahead of expiry. On the downside now, the way the recent resistances have been taken out, which is closer to 23,800, 24,000 now. So we feel on the downside, 23,900 now becomes all the more important support. So till the time 23,900, 23,950 holds, this rally could extend up to 24,500 and above. And from the Bank Nifty standpoint, kind of rally that has already happened ahead of the results of ICICI Bank and this in the last weekend, and the strength which is being visible today, we feel that now it's in an uncharted territory, and till the time 54,800, 55,000 holds, Bank Nifty is poised to go towards 56,300, 56,700. And it's just gaining strength by strength. And now with the large caps, even the mid-sized bank as well as the PSU banks are participating. That gives all the more strength to the banking space.
What about specific stocks, Sudeep?
Hormaz, there are 2 stocks on my radar. One is the first one is MCX. Now, in case of MCX and all these platform stocks as well as the financials stocks which are related to the financial market intermediaries, here there is a decent pullback on that has been witnessed in the last couple of weeks. And we feel MCX, which has now crossed above its February and March swing highs, is poised towards 6,200, 6,300 in the coming few weeks. And this can be bought with a stop loss of 5,700 on the downside. The second stock which is on our radar is CDSL. Now, similarly, CDSL also has a similar pattern. It is reversing from lower levels, strong pullback which has been witnessed in the last several sessions. So this could be bought with a stop loss of 1,260 on the downside and a target of 1,360 and 1,400 on the upside.
All right, we take that point, Sudeep. Thank you so much for joining in and giving us your view on the market. Nifty gaining with accelerating volumes and a lot more gusto. Take a short break, come back on the focus on banks once again on the back of their fourth quarter earnings and what this means for all the others which are buzzing around as well. On the top of the list are HDFC Bank and ICICI Bank.
The US government has now threatened to ban Howard University from enrolling foreign students after the university said it will not surrender its independence. What does it mean? Let's understand the controversy in detail. Now, the US Department of Homeland Security, or DHS, has threatened to revoke Howard University's certification to enroll international students. This comes after the Trump administration decided to freeze over $2 billion in federal funding and cancel $2.7 million in DHS grants. Now, why is Trump going after Howard? Well, he has accused the university of allowing anti-Semitism and promoting ideological bias against Jewish students. Remember those protests that happened across most universities in the US last year in the wake of Israel's attack on Gaza last year. Now, many students protested at Howard too. Now, what does Trump want? The White House has demanded that the oldest university in the US make changes to hiring, admissions and teaching practices, which it says will help fight anti-Semitism on the campus. The US Department of Homeland Security has demanded detailed records by April 30th, 2025 on visa holding students' involvement in those protests, disciplinary action taken by the university or any perceived threat to campus safety. Yes,
Welcome back. 1,120 points higher now on the Nifty Bank, well above the 55,400 mark, a new record high today for the index, and of course led by the heavyweights HDFC Bank and ICICI Bank, which are powering along, both of them at record highs as well, and these after reporting their fourth quarter results. Abhishek is here to decode how they fared in the fourth quarter.
With respect to ICICI Bank, the loan growth momentum is weak. However, the PNL is very strong for them. Versus our poll, the NIN part is a beat on our poll. Deposit growth came in at 14% YOY and about 6% sequentially. YOY, it's one of the weakest growth that you are seeing in last 8 quarters. Now, advances growth were on the lower side at just 13.3% YOY and 2.1% quarter on quarter. So YOY, it's the weakest growth that you are seeing in last 17 quarters, and sequentially, that is quarter on quarter, you are seeing one of the weakest growth that is coming in 15 quarters. Net interest margin is at 5-quarter high of 4.41%. Core operating profit growth is at 5-quarter high of 13.7%. Now, quarterly annualized slippage ratio is at 17-quarter low of 1.5% versus 1.85% in the previous quarter. Their asset quality continues to show robust decline and is one of the best in last 10 years or even more for them. Gross NPA ratio and net NPA ratio have improved, with ROA or return on asset being the highest ever that they have recorded, north of 2.5% in this quarter. Back to you.
All right, we take that point, Abhishek. Thanks a lot for that. Let's hear out what the management had to say in their post-earnings conference call over the weekend.
So as far as the loan growth is concerned, I don't think anything specific incrementally in terms of caution on the credit side. I think we are pretty comfortable with what we are underwriting. Of course, on personal loans and cards, as you know, we had tightened, a few quarters ago, and that is showing up in the volumes over the last couple of quarters and the loan growth. But other than that, no specific caution on the credit side. I would say it's largely a function of what is happening in the system. And also, I guess, on the pricing side, some consciousness given that during this quarter, we were at the sort of cusp of the, downward movement in benchmark rates. We have seen liquidity improve substantially over the last couple of months with all the measures that the central bank has taken. And deposit growth for us has continued to be quite strong. You would have seen the numbers for the fourth quarter have also been pretty strong for us. So, as the rate, now, of course, if you look at it, the repo rate has fallen by 50 bips. So that will start to see a transmission into deposit rates, which is what has started. So I think that's, in the natural course of things.
It was a strong quarter for HDFC Bank as well, and CEO Shashidhar Jagdishan also commented about how the bank will place itself among global macro uncertainty and its plans with the key ratios in the upcoming financial cycle. Listening.
We've already seen 2 rate cuts, and the change in stance from neutral to accommodative is a welcome relief to all of us. RBI intends to increase durable liquidity, which is followed by concrete actions, which along with rate cuts will help supporting the GDP growth. For FY26, we expect the GDP to be supported by a pickup in rural spending, discretionary consumer demand, and investment activity. Of course, the goods exports may be impacted until the global trade and tariff situation becomes far more clearer. We acknowledge that the global macroeconomic outlook has become more uncertain due to the recent trade tariff-related measures and the volatility surrounding them. This may potentially impact global inflation, leading to lower growth across economies. Corporates have adopted a wait-and-watch stance, and we are waiting for more clarity. We remain watchful. Our credit deposit ratio has been brought down from the highs at the time of merger, which was at about 110%, to around 96% as of March 2025. Our deposits have grown faster than the system, and so has it grown faster than our loans as well. Next year, in line with what we had committed, the adjustment in CD ratio will not be so steep, supporting the loan growth for the bank, but it will be on a downward path. Asset quality, one of our USPs, remains pristine. As liquidity and growth improve, we are well placed to grow in both assets and deposits.
Right, the stock which is doing well right now is Power Grid, moved to the high point of trade, and we're also seeing some traction in names like Titan, which has recovered from the lows even as gold continues to shine. We have Muthoot Finance at the bottom of your screen announcing an interim dividend of close to 26 rupees per share for FY25, which currently implies about 1% in terms of dividend yield. Stock doing a lot better because of the rise in gold prices and perhaps the recovery from the lows that we've seen in the stock already, which has seen a decline of almost 7.5% in 1 month. Take a short break, come back, focus on a bunch of stocks which are in the news.
And what if Howard doesn't listen to the government? Well, then that would result in the loss of Howard University's Student in Exchange Visitor Program certification, which will effectively bar the university from admitting new international students. Howard is the first university in the US to push back against Trump's threat, and the consequences are for everyone to see. The American government has identified 60 universities for review. Last month, Columbia University agreed to many of the administration's demands in the wake of the protests after the government cut $400 million in funding. Let's look at some numbers here. International students make up more than 27% of Howard's enrollment this year, overall 6,000 students. How will it impact Indian students? Well, Indians constitute a significant portion of Howard's international cohort. In 2020, approximately 213,062 Indian students studied in the US, with 505 enrolled at Howard alone. Now, getting an admission is not easy there, but this move could further dent many students' aspirations. And what is happening at present is not good news for many Indian students. Reports indicate that Indian students across US universities are experiencing anxiety over sudden visa cancellations for minor offenses such as traffic violations or even social media posts. Foreign students in the US have faced sudden visa revocations, as I was talking about social media posts and other things, and this comes amid, the immigration crackdown by the government. Moreover, Indian students who often rely on F1 visas and post-graduation work permits like the H-1B visa fear that their academic and professional aspiration in the US could be jeopardized because of this.
Welcome back. Just to put a look at some of the other movers on the Nifty 500 in today's trading session. We did speak of Suzlon earlier on the show, but Aavas Financiers has made a move in the last few minutes, 7.5% higher there as well. Anant Raj is one of them as well. Anant Raj will be reporting results today, so 7% higher on that stock as well. KFin Tech is up another 6.5%. Nippon AMC. So most of these capital market plays, be it Nippon AMC, HDFC AMC, all of them doing well in today's trading session. What's also doing well is Divi's Laboratories, and as that's because the company has signed a long-term supply agreement with a global pharma firm. Vinny is joining in with more details on that. Vinny.
Yes, good afternoon. So you're keeping an eye out on Divi's Laboratories. like you mentioned, long-term supply agreement is what they've signed with the global pharma company. This agreement is mainly on going to be focusing on manufacturing as well as supply of advanced intermediaries, and this is in the custom synthesis side of the business. Now, custom synthesis, when you look at it in Q3, accounted to around 53% of their revenue contribution, saw growth of around 44% as well on a year-on-year basis, and that is why we're expecting this to support the growth of the company going forward as well. This is expanding their portfolio on the custom synthesis side. The company is planning to invest around 650 to 700 crore rupees for capacity expansion because of this new client that they've added as well. Net cash on the books as of 31st December was around 3,600 crores, so not much of a worry on that front. The company will be increasing their capex plans or focusing on capex plans through internal accruals as well. And a good deal that is coming in for the company in terms of revenue contribution, that will see an improvement as well, and significant meaningful revenue is what is expected from this company going forward.
Ronnie, thank you so much for that. Let's talk about the oil and gas space now, more specifically the city gas distributors. The oil and gas regulator, PNGRB, has floated a consultation paper for review of the natural gas pipeline tariffs. Sudarshan joins in to tell us more on this, the stocks that get impacted and what brokerages are making of this. Sudarshan.
So this is especially for GAIL pipelines. GAIL currently has 10 pipelines. So over the weekend, we have seen that PNGRB, that is the regulatory body, has released the consultation paper related to the tariff hike that has been long pending. Now all the stakeholders have to reply to GAIL by May 1st, and GAIL has to reply by May 15th to PNGRB. And following that, PNGRB will have the open discussion and the board meeting to approve the tariff hike if there is any that we can see, and that can come in the month of June. So what was the GAIL's submission? GAIL had proposed the tariff to increase from current level of rupees 58 per MMBTU to rupees 78 or more than rupees 78. But after the certain queries from PNGRB, the proposed increase was seen at rupees 77.43. Last month, we had a conversation with GAIL, and which GAIL had confirmed that it had proposed a hike to rupees 78. But even if the increase comes around rupees 70, that can also be taken positively. Now today CLSA has written on that it has upgraded the stock to outperform from whole, and target is increased to rupees 210 from rupees 175 per share. It has even increased EPS estimates in the range of 9 to 19% because it believes that tariff hike can come, and that can be in the range of 20 to 25%. That will be positive for GAIL because this tariff hike has been long pending and GAIL has been demanding for the last few months, or say basically last 1 or 2 years. And GAIL had also said that if the tariff hike can come, it can be implemented retrospectively, because once it's done, that would be effective January 1 to 25 to 2049, because economic life cycle of a pipeline is seen as 30 years. That's the reason it will be implemented for 30 years. So overall, it's very positive for GAIL.
Very positive for GAIL, showing up on the screen as well, 4.5% higher. Sudarshan, thanks a lot for that. Well, JSW Energy will be setting up its largest greenfield thermal power plant with a capacity of 1,600 megawatts in West Bengal. CNBC-TV18's Abhimanyu Sharma caught up with Sharad Mahindra, who is the joint managing director and CEO of the company, to understand the scope of the project, and also asked him about the company's plans to set up a green hydrogen plant in Karnataka. Listen to what he had to say.
We are at a very advanced stage of commissioning the first such project, though not very big in size, but still largest in the country, and which is which is a part of the PLI scheme, where we qualified also, which is the 3,800 tons of green hydrogen coupled with 30,000 tons of green oxygen. We are going to commission this project in the current quarter, which is Q1 of FY26, and which we are supplying to our captive requirement to JSW Steel. And it's a co-located plant in the state of Vijayanagar, in the state of Karnataka.
Also about renewable energy targets, about expansion in the renewable energy sector, there are several issues which still exist as concerns, be it pump storage, be it the foray of the private sector into nuclear energy, and also with respect to a replacement of the base load with renewable energy. Now, these continue to be big concerns, big elephants in the room, as not just your company, many others in the ecosystem are also driving the foray. What are the deliverables you are looking at while you try to solve these issues?
Yeah, this is very pertinent question, I'll say, because as I said, the demand growth, the way the demand growth is happening, even a conservative demand growth of 5.5%, 6% growth, the amount of energy every year which is required, like last year approximately, country consumed 1700 billion units of power. And even if we take a conservative 5.5–6%, which is going to be a number of almost maybe 125 to 130 billion units incremental will be required, which when converted into capacities will be about 25 to 30 gigawatt of fresh capacity. Assuming that maybe 7–8 gigawatt or even 10 gigawatt on a very higher thermal capacity gets added. So balance 15 to 20 gigawatt through renewable energy, where the PLFs are 30% if you say wind or solar combination, the capacity addition in RE space which is required for wind solar is close to about 40–45 gigawatt. This is the size of opportunity which country is India exists. So we are cautious in terms of where to go. As I said that our some of the basic principles are that my returns to my stakeholders, my shareholders is protected, financial prudence is maintained, the benchmark ratios which define my ratings, which give me an advantage in terms of the interest rates which the banks and financial institutions offer, all those things are paramount for us. Keeping all those things in mind, we have made the plan. But of course, round the clock storage power and other things, that is evolving now. Initially it was battery energy storage. Now Government of India in last budget announced pump storage policy, and a lot of pump storage bids have come. We have also won. We have signed the power purchase agreement. So a mix of solar, wind storage either through battery or pump storage is going to be the future.
Two aspects you spoke on, be it PPAs or a transmission system, both are important cogs in the wheel, important linchpins for energy security moving ahead. What are your plans for PPAs in other states? And also a comment on the transmission system. Of course, the government has been working overtime. Several states have also been making efforts in this direction. What are the kind of deliverables, the kind of targets you're looking at in the transmission system, and also with respect to PPAs?
Yeah. See, PP, as I said, that operational 12.2 gigawatt today and another 18 gigawatt capacity for which either the PPAs have been signed or we have received the letter of award, wherein some portion the PPAs are to be signed. So we are definitely focusing as and when the states keep on coming with their requirements. We have the letter of award awarded through either SECI or SJVN or NTPC bids. So states as and when come, we are ready with the solution. It is only the question when the state comes for signing the PP. So our teams are engaged with them, but we have enough signed PPAs to take care for next few years on which we are working.
The management of JSW Energy there. But moving on, cash flows are important, but not everything. That's the view from emerging market investing expert Prashant Khemka. Now, in the latest episode of Market Cafe, Khemka shares his investing lessons from the 90s .com era with Surabhi Upadhyay and explains why he chose to invest in new age stocks like Zomato, even when they were making losses. Listen in.
Today, I often get asked, because we are very cash flow centric and there are loss making companies in our portfolio as well. So how do you talk about superior returns on capital for a loss-making company? Yeah. Some of the new age companies that our team very much likes and owns for several years. So it is superior returns on incremental capital. Looking forward many years, people take this lightly, but value of any business is present value of future cash flows. It's not necessary you have to make cash flows in year 1, year 2, or even year 3. Whether the cash flows that you are expecting over time.
I remember this categorically because I remember doing a show when Zomato was listing with some of your team members, and there was a massive debate there about whether this whole price to sales, there's no earnings, how can you value a company like that? And of course, White Oak took early calls, big believers early on.
Absolutely, and we've owned, its parent company since much longer, ascribing value to these investments that the parent company has made. This is one of the lessons I learned, I would say, early in the TMT bubble, .com bubble, when in my US portfolio, I never could buy Amazon.
Okay.
Thinking that it's not making money. And at that time, it was also an assessment that it can never make money. I did own telecom companies or wireless companies which weren't making money. But I guess in wireless companies, it was very well accepted that for several years, they would make cash losses at least.
Yeah.
And then later on, they'll generate cash flow. But new age companies, because there isn't an established business model to look back onto, people often just ignore them or write them off as something they won't look at. And that's the opportunity for investors like us who are willing to take a closer look.
We've reached that point again for these new age internet stocks where the debate is back on. They're investing a lot in dark stores, they're expanding in tier 2, tier 3. So suddenly some of them are saying that they reached profitability, but maybe, at least in quick commerce, it can get delayed because of this expansion.
Yes.
What do you think about these businesses as of now?
See, the same way we've looked at this business, there'll be winners and losers. Not everyone's going to be, the next whatever of India. See, we do benefit having invested during the dot-com bubble through the late 90s and 2000s in US, where these kind of companies first came to market. Having made mistakes there, both of commission and omission. Amazon is a mistake of omission, if you will.
Missed
right?
opportunity. So
Missed opportunity. Then as on the EM, while in India, a lot of these businesses might be developing for the first time. That's not true globally. In China, this story has played out a decade ago, right? The Alibabas, the Meituans, the Tencents, those all also have had the opportunity to participate in several of them in the IPO. Just like Google in US was an IPO company invested in my portfolio. Similarly, Alibaba and others were IPO companies. In Korea, you have similar companies who are leaders. They're just further along in the journey to profitability than some of the Indian companies are.
Right.
And if you study the US, the developed markets, the emerging market companies in similar businesses, how they've progressed, how they now have come to a stage where they are throwing up tens of billions of dollars of cash flow. The Mag 7, there's a cult-like following amongst Indian investors for the FANG. FANG was very widely followed 2 years ago.
Absolutely.
Majority of those FANG companies weren't making money or cash flows
when they started
when they were $100 billion in market cap or more. Obviously Microsoft was making money and some others might have been making money. Google was making money early on. But others, Amazon wasn't making money, Netflix wasn't making money, yet they were so loved.
So you have to be a patient investor if you're going to be on
patient and selective. You can't have a spray and pray approach across all. Not everything would become a Amazon or a Facebook or something.
Absolutely.
Interesting conversation there. What we'll do is take short breaks and come back. This time around, we'll have Manisha joining in with Sanjay Kumar, who's the MD and CEO of Sensex, to talk about all things commodities.
Welcome back, and joining us on the show now is Sanjay Kumar. He's MD and CEO at Sensex. Sanjay, hi, thank you so much for joining in. And it's been a volatile market for across sector, across companies and segments as well. When it comes to food, really, we're looking at very volatile prices in the global markets. India, of course, has seen slightly easing off inflation here. But what has been your sense, whether it's about weather, Indian production or the global cues? What is it that you're watching at?
Hi, Manisha. Thank you for this call. The way I see it, we have to look at both the supply side and the demand side. So the good news is that this year, the FCI expects to hold almost 30% more stocks than it did previous year. So about 32 million tons is what we expect. We also expect that retail inflation will be moderate, driven by lower oil prices. But what we need to watch is, and which is a very interesting trend, is that domestic food consumption has been increasing, particularly in the rural areas. Over the last 12 months, it's up from almost 3,700 per capita to 4,200. So even as we produce more food, stock more food in the warehouses, which helps stabilize inflation, we must make sure that we are able to meet demand. And if demand grows at a faster pace than what we see in terms of the reserve buildup, we could see a spike in inflation.
And what are your concern areas within here? Because when you look at rice, there's record production. Wheat as well, after 2 or 3 years of concerning situation, we've seen some stability come there. Edible oil, well, yes, that can be a bit of an issue. And where do you see major concerns coming from?
So you rightly mentioned wheat, I think, is going to be pretty stable. There's 12 million tons additional this year that we expect in the reserves. So that will have a moderating impact. Where we still see a concern is pulses, actually, because, given what we are seeing in Canada and the unstable global environment, we'll need to watch that. We'll also need to watch oil, particularly, in the backdrop of the recent deal that we've seen between Malaysia and US with regard to palm oil. So overall, we maintain and we believe that this year will be less inflationary than last year was. As you remember, last year was one of the worst we've seen for food inflation. So to that extent, it's definitely good that we have 105% above average monsoon forecast. So food production is going to be stable. On the back of good infrastructure, we expect that movement of food within India will be less expensive, which will enable to pass on some of the surplus production which happens across different regions to harvest the benefit from that. So our view, coming back to your question, remains that this year will definitely be better than last year in terms of overall food inflation as well as retail inflation. And that's good news.
Oh, it is. Sanjay, so how good is this time to be in food business as you are? You said rural consumption seems to be increasing. What about urban and the changing trends, etc.? What does it mean for you?
Yeah, so from a business standpoint, we maintain that the food services business will grow at about 16%, which makes India one of the fastest growing market. It also provides a great opportunity for Indian companies to now start investing for the future, because Indian companies have largely shied away from this sector, even though it's almost $20 billion. We're still waiting that moment in history when the first Indian food service company will list on the Indian stock market. We are the only country in the world which doesn't have a listed food service company. So our expectation is that on the back of manufacturing growth, our business per se will see between 14 to 16% growth in revenue. Margins, we believe, will remain depressed, largely because of the fact that input tax credit is still not available to the food services business. Should that get restored, we will see some margin enhancement. But in the near term, I expect that revenue growth will be quite robust, far outstripping what you would see anywhere else in the world.
At that point, thank you so much, Manisha, for taking us with this conversation. A big up move is what you're seeing in the market. Once again, the Nifty closing in on the 24,200 mark with a 330-point gain, 1150 points on the Nifty Bank now. Take a short break, come back on the other side. Business Lunch takes all the market action ahead.
Stocks gain with the benchmark Nifty index stamping 24,000 after foreign investors buying last week. Energy and power stocks are the biggest gainers even as FMCG drags. Nifty Bank hits a record high, mid-caps outperform. Private heavyweights HDFC Bank and ICICI Bank power up banking stocks after beating profit estimates in Q4. Good deposit growth, pristine asset quality and healthy margins underscore a strong show. Eversource Capital may be in advanced talks to buy a beloved ride-hailing player Blue Smart. A deal will likely involve the promoters Jaggi brothers as well as stepping down as well. US Vice President J.D. Vance arrives in India even as bilateral trade talks are expected to have made good progress. Experts believe talks between Vance and PM Modi will extend beyond trade to other strategic issues. China warns trade partners it will undertake countermeasures in a resolute and reciprocal manner if they strike trade agreements with the United States at the expense of China. Hello, good afternoon. You've tuned into Business Lunch coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala and thank you so much for tuning in as always. It's a good Monday that's shaping up for the markets, right? We're seeing that momentum in terms of the gain continuing that we saw last week. Today, as of now, also the Nifty is up almost 330 points in the trading session. Day's highest point, 1.4% uptick is what the Nifty is managing to hold on to. Nifty Bank, obviously among the top gainers coming in there, 2% gain there. PSU banks are also doing well. Do not forget we had those earnings that came in for the private banks, whether you look at HDFC Bank, ICICI Bank. Good set of numbers coming in from both these big banks, and that is something that is supporting the overall momentum in terms of the move coming in as well. Broader end of the market, let's look at that. What is that doing? Nifty mid cap as well as a small cap managing to hold on to good gains as well. Outperformance coming in on that front. 2.4% gains for the Nifty mid cap, small cap holding on to gains of 2% as well. Energy stocks, those are the ones that are buzzing in trade as well. So keep an eye out on Nifty Energy overall as well. That's among the top sectoral gainers. FMCG, that's a bit subdued on today's trading session. A bit of a decline that we're seeing on that front. But yes, all in all, that's how the market shape setup as of now is looking like. Not a bad day coming in, building up in terms of the momentum that we're seeing for the markets, and some of the broader end of the names on the back of earnings are also seeing some focus. So Just Dial is one of them. Then we have Tata Elxsi in other news flows, as well as Aavas Financiers also in other news flows, which is managing to keep up with some of the gains there. But like I was talking about the Nifty Bank, right? That's what we should start with because the index has hit record highs, and this is after the strong results that were reported by HDFC as well as ICICI Bank. Now, let's begin with HDFC Bank, which reported a strong beat in terms of estimates. Abhishek will take us through the numbers. What are the key highlights on that front as well?
Well, strong core operating profit was seen with respect to HDFC Bank. The P&L with respect to NI and PAT is a beat on our poll. Now, core operating profit grew by 20.5% YOY and about 4.9% quarter on quarter. Remember that by core operating profit, I mean operating profit without treasury gains. So, 7-quarter high net interest margin on total assets, which came in at 3.54% versus 3.43%. Even if you remove the one-off that they have over here with respect to 700 crore of one-time income, the 3.45, 3.46% that you have looks pretty good with respect to 3.43% in the previous quarter, as analysts were anticipating a decline in net interest margin, but it has actually improved for them. Cost to income ratio or operating efficiency is one of the best that you are seeing in the last 4 quarters. Annualized slippage ratio is at 5-quarter low of 1.15% versus 1.4% in the previous quarter. Overall, the slippages have declined by nearly 15% quarter on quarter. Asset quality continues to remain impeccable for them. Gross NP ratio and net NP ratio have improved and are one of the best in the industry.
Thank you so much for that, Abhishek. But HDFC Bank CEO Sashidhar Jagdishan commented about how the bank will pace itself amongst the global macro uncertainty and plan with its key ratios in the upcoming financial cycle. Let's listen in.
We've already seen 2 rate cuts, and the change in stance from neutral to accommodative is a welcome relief to all of us. RBI intends to increase durable liquidity, which is followed by concrete actions, which along with rate cuts will help supporting the GDP growth. For FY26, we expect the GDP to be supported by a pickup in rural spending, discretionary consumer demand, and investment activity. Of course, the goods exports may be impacted until the global trade and tariff situation becomes far more clearer. We acknowledge that the global macroeconomic outlook has become more uncertain due to the recent trade tariff-related measures and the volatility surrounding them. This may potentially impact global inflation, leading to lower growth across economies. Corporates have adopted a wait-and-watch stance, and we are waiting for more clarity. We remain watchful. Our credit deposit ratio has been brought down from the highs at the time of merger, which was at about 110%, to around 96% as of March 2025. Our deposits have grown faster than the system, and so has it grown faster than our loans as well. Next year, in line with what we had committed, the adjustment in CD ratio will not be so steep, supporting the loan growth for the bank, but it will be on a downward path. Asset quality, one of our USPs, remains pristine. As liquidity and growth improve, we are well placed to grow in both assets and deposits.
Okay, now let's focus and talk about ICICI Bank, because that fared well in the fourth quarter as well. With more details, we have Abhishek here. Abhishek?
With respect to ICICI Bank, the loan growth momentum is weak. However, the PNL is very strong for them. Versus our poll, the NIN part is a beat on our poll. Deposit growth came in at 14% YOY and about 6% sequentially. YOY, it's one of the weakest growth that you are seeing in last 8 quarters. Now, advances growth were on the lower side at just 13.3% YOY and 2.1% quarter on quarter. So YOY, it's the weakest growth that you are seeing in last 17 quarters, and sequentially, that is quarter on quarter, you are seeing one of the weakest growth that is coming in 15 quarters. Net interest margin is at 5-quarter high of 4.41%. Core operating profit growth is at 5-quarter high of 13.7%. Now, quarterly annualized slippage ratio is at 17-quarter low of 1.5% versus 1.85% in the previous quarter. Their asset quality continues to show robust decline and is one of the best in last 10 years or even more for them. Gross NPA ratio and net NPA ratio have improved, with ROA or return on asset being the highest ever that they have recorded, north of 2.5% in this quarter. Back to you.
Okay, let's also listen out to the management of ICICI Bank on what they had to say post earnings at their conference call over the weekend.
So as far as the loan growth is concerned, I don't think anything specific incrementally in terms of caution on the credit side. I think we are pretty comfortable with what we are underwriting. Of course, on personal loans and cards, as you know, we had tightened, a few quarters ago, and that is showing up in the volumes over the last couple of quarters and the loan growth. But other than that, no specific caution on the credit side. I would say it's largely a function of what is happening in the system. And also, I guess, on the pricing side, some consciousness, given that, during this quarter, we were at the sort of cusp of the, downward movement in benchmark rates. We have seen liquidity improve substantially over the last couple of months with all the measures that the central bank has taken. And deposit growth for us has continued to be quite strong. You would have seen the numbers for the fourth quarter have also been pretty strong for us. So, and as the rate, now, of course, if you look at it, the repo rate has fallen by 50 bips. So that will start to see a transmission into deposit rates, which is what has started. So I think that's, in the natural course of things.
And moving on, with the fixed deposits and floats disappearing, banks need to cut their cost to income to 1/4 their current levels. Veteran banker KV Kamath tells Lata Venkatesh. She adds that hereafter banks must finance only retail loans given their short-term funds. Infrastructure and corporate capex should be funded by market instruments outside the banking system. Listen in.
Challenge that banks will face, are facing and will face, is cost-to-income ratio. So unless you disrupt that cost-to-income ratio to 1/4 of what it is today, you won't survive. 1/4. I'm saying if you cannot operate, you will have to be well below the 35-40% people are.
No, ICICI and HDFC
And some people are, are higher than that. Banks, I think, as they evolve, the larger and larger part will be to the retail sector, because they are, as of now, best equipped, unless they're disrupted by a fintech. The corporates, large part of the corporate universe today, are cash positive. The cash flows are positive and can meet most of their growth needs. At the margin, they may have to borrow. Large part of infrastructure funding will come through a market process, which is outside the banking system. It's already happening. Banking money is really, short-term saving deposits and some fixed deposits. And the average tenure of a bank deposit, banking system is about a year and a half. Yeah. And you expect to fund the infrastructure over 7 years or a corporate loan over 5 years. You are sitting on a mismatch, whatever you say. So it will have to evolve.
To corporate CPs and bonds.
And really, if you look at the lay borrower, the retail borrower, his or her need is to repay every month. And that's what you are collecting. And then you are in sync and you're repricing the loan maybe on a quarterly basis or half-yearly basis. So that is appropriate financing.
Okay, now let's shift focus and talk about gold prices, because the rally is continuing for this yellow metal. It's hit another record high level, and that is about the $3,390 an ounce. Manisha is here to tell us more on gold. What are we expecting going forward as well? Manisha.
Well, thank you for that. Those numbers on your screens are absolutely all-time highs for the global and the Indian markets as well. So we've done an all-time high of $3,395 an ounce in the international markets. For the Indian markets, until now, it has been $96,850. So rupees per 10 grams. So, well, absolutely running, making newer highs in every time zone. Asia started higher, Europe has followed in, and if US were to follow the same suit, you could be looking at much higher prices beyond $3,400 an ounce as well. Well, the support in gold prices comes in from the fact that you are looking at uncertainty in the global markets. Well, that actually is a calculation on what really you would be paying in sense of gold prices in India. These are the prices which are not inclusive of GST and making charges. Once you start adding all of that, we are almost at 1,10,000 rupees per 10 grams for the Indian markets. If you were stepping out to buy gold today per 10 grams, whether it was a coin or jewelry, you'll be paying much higher than 1,00,000 rupees per 10 grams already. And the expectation is that with the kind of scenario that we are working with in the international markets, whether it is about the dollar index, which is trading at a 3-year lows at or below 99 right now, is a supportive factor. And then apart from that, Trump ordering investigations on critical mineral imports, or whether it has been about a statement of not being very happy with the US Fed Chairman Powell and a statement also of firing him. So these uncertainties clearly are adding premium, and a safe haven buying is happening only in gold, and none of the other asset classes has been supportive for the gold prices as well. So $3,400 an ounce, almost done. The banks and brokerages are keeping on and reiterating their higher targets in sense of gold there. Deutsche Bank has talked about $3,700. Goldman Sachs upped their forecast to $3,700 and $4,000 an ounce as well in this year, if the current situation persists or there is more extremities coming in there. And then you have Bank of America, Citi, UBS also talking at levels of 3,350 to 3,500 on the higher side. Swiss Capital has talked about 3,500. SD Bullion has spoken about 3,500 in the month of April to May itself. So, well, very, very bullish cues continuing even now.
Absolutely. So that's something we are watching out for in terms of gold, bullish cues going forward as well. But let's move on. And sources revealed to CNBC-TV18 that Eversource Capital is in talks with the ride-hailing firm Blue Smart for a possible acquisition. Parikshit is joining with us to give us more details on this front.
Well, yes, there have been talks between Eversource Capital, a private equity firm, and also BlueSmart for a few months now. But considering the situation where BlueSmart is in right now, with operations coming to a halt because of legal and financial irregularities at Gensol, Eversource believes, and many investors believe, that this may be the right time for the company to be acquired. So we believe that talks are on for acquiring a majority stake, and discussions are on to have a stake sale at around 850 crore rupees. No decision has been taken as yet, but we believe a final word will be taken, a final decision will be taken about 2 weeks from now. If indeed the sale goes through at around 800 or 850 crores, this would be 60 to 70% lower than the last known valuation of BlueSmart a few years ago. The company has many key investors such as BP Ventures, Stride Ventures, Mahinder Singh Dhoni, Deepika Padukone, Suman Sinha. All of them have been key investors of BlueSmart over the years. Let's see where things go, but Eversource is likely to put a condition about the key founder and board member Anmol Jaggi to step down and step aside from the day-to-day functioning of the company. And Anmol Jaggi has a 24% stake in BlueSmart. Let's see what happens.
Okay, surely we'll be keeping an eye out on what happens to that stake, which Anmol Jaggi is holding as well in BlueSmart. On that note, we're going to slip into a very short break, viewers. And after the break, we'll bring you the latest updates coming in. As US Vice President J.D. Vance arrives in India, we'll tell you what's on the agenda after the short break. Welcome back to Business Lunch on CNBC-TV18. Now let's move on. And US Vice President J.D. Vance has arrived in India, and this is for a 3-day visit. Parikshit is now joining in with us to give us what's on his list of agenda, what can we be expecting as well. Parikshit, afternoon.
Well, the hope would be that both India and the US will iron out any differences that remain over the trade negotiations. Highly placed sources tell CNBC-TV18 that while the US government is seeking zero tariffs all across the board, India is willing to offer a concessional tariff of 10% all across the board. So let's see where things eventually fall. While Prime Minister Modi and J.D. Vance are not likely to get into the nitty-gritties, there could be an intention expressed by both sides to resolve the outstanding issues as quickly as possible and perhaps get an interim trade deal done. Having said that, issues such as immigration, defense, security, energy partnership are likely to figure prominently in the talks between the two leaders. We also believe there will be a discussion on the Russia-Ukraine war, the war in the Middle East, in Gaza, and the China situation. Both the US and India have massive trade deficits with China. There are concerns around China's approach to the world economy, Chinese approach to security, China's coercive and expansionist tendencies in the region, also in the Indo-Pacific and South China Sea. So all of that could come up for discussion. So it's going to be an important
meeting whereby the entire comprehensive strategic partnership is going to come up for discussion. But of course, the big takeaways will only happen when Prime Minister Modi and Donald Trump speak. Prime Minister Modi is our leader, and J.D. Vance is the number 2 leader in the United States. But of course, J.D. Vance will be coming with a very important message on trade and also aligning our approach due to competition from China.
Okay, Parikshit, thank you so much for that. Surely we'll be keeping an eye out on the more updates that come in from his visit here as well. But meanwhile, Indian officials will head to the United States this week to sort out issues which will enable both countries to negotiate a trade deal. Abhimanyu is here to give us more details on that front.
India's negotiating team is set to visit the United States this week to sort out pending issues before launching negotiations for a bilateral trade agreement between both the countries. Led by Chief Negotiator Rajesh Agrawal, who's an additional secretary with the Department of Commerce, the team will speak to its American counterparts for 3 days starting 23rd April. Sources have told CNBC-TV18 that India and the US have finalized terms of reference covering 19 chapters for a proposed BTA covering issues of tariffs, goods, non-tariff barriers, customs facilitation, rules of origin and regulations. For a proposed FTA between India and the UK, the talks are moving towards final stages, with the sticking point being the issue of resolution of disputes between both the countries. Another full round of negotiations is unlikely as discussions are progressing at a fast pace between India and the UK. With the EU, India is discussing an early harvest agreement. The 11th round of India-EU FTA talks are slated to take place in New Delhi from the 12th to 16th of May. It remains to be seen how all these talks are going to pan out, even as the pause on reciprocal tariffs by the United States continues.
Thank you so much for that, Abhimanyu. Now, staying with the trade news that we have coming in related to China as well. China's Commerce Ministry has cautioned countries against making economic deals with the United States that could come at an expense of China, and this is escalating the trade war between the two global economic powers. Beijing vows to strongly oppose and retaliate against any country that makes such a deal. The ministry criticized the United States for misusing tariffs and pushing for reciprocal tariff negotiations, putting countries like those in the ASEAN, including India, in a difficult position due to their existing trade agreements with both the United States and China. And moving to the world of diplomacy, Prime Minister Narendra Modi is set to embark on a 2-day visit to Saudi Arabia from April 22nd. He will be in the kingdom on the invitation of the Crown Prince. Trade, investment, energy and defense corporations are expected to figure in the Modi's meeting with the Saudi delegations. The two countries are expected to finalize several agreements to bolster cooperation. Prime Minister Narendra Modi and the Crown Prince of Saudi Arabia are also going to co-chair a bilateral strategic partnership council meeting. Okay, on that note, we are going to slip into a very short break. When we return, we'll bring you more news and updates, so stay tuned in.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards. Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a
Welcome back to Business Lunch on CNBC TV18. Now, in some international news update that we have coming in for you all, reports say that the US Defense Secretary Pete shared details of the Houthi attack in another group chat that included his wife, brother and dozens of other people. Remember, this comes after the existence of the first Signal group chat that was later made public by the chief editor of The Atlantic. Other than that, also he was accused and allegedly shared some details of the attack to the second group chat, including details scheduled of the airstrikes. Some news from the World Economic Forum. World Economic Forum founder has decided to step down from the position of the chair and as a member of the board of trustees. The board has unanimously appointed Vice Chairman Peter Barback as the interim chairman. Now, it has also established a search committee for the selection of a future chair. And on to some other sports and news updates that we have coming in here. The BCCI has announced its annual player contracts. Rohit Sharma, Virat Kohli, Jasprit Bumrah and Ravindra Jadeja have been given a A+ contract, while Shreyas Iyer and Ishan Kishan have returned to the central contract list. Shreyas Iyer featured in the B category and Ishan Kishan is in the C category. And moving on to some bit of a somber news that we have. Now, news agencies are reporting that Pope Francis, the head of Catholic Church, has passed away. We'll wait out for more details, but as of now, this is according to news agency reports that's flashing at the bottom of the screen as well, and this is according to AFP and what is coming in from the Vatican as of now. So in somber news is what we have, that Pope Francis has passed away, says the Vatican, according to agencies. And with that, we'll wind down this edition of Business Lunch at CNBC TV18. Thank you so much for tuning in. Up next, your Mid-Cap Radar.
Itself as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Good afternoon. You're watching Midcap Radar live from the CNBC-TV18 Motilal Oswal studios. I am Harmas Fatakia and with me.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Vivek Iyer and with me today is Harmas Fatakia. Harmas, we are coming out of what is essentially very truncated week. Today globally, we have what is again a truncated week. Remember, Easter holiday is going on as far as US markets and a whole host of other markets are concerned. We have quite a lot lined up in today's edition of Midcap Radar. Let's start off with the top headlines. Stocks gain with the benchmark Nifty index stamping 24,000 after foreign investor buying since last week. IT and PSU banks are the biggest gainers. Nifty Bank hits a record high. Midcaps outperform. Tata Elxsi reverses early losses despite reporting a decline in profit after tax in Q4 FY25, with contraction in margins in 8 out of the last 9 quarters. The management says they expect growth to return from Q1 FY26. Wind power stocks like Inox Wind, Suzlon Energy surge in trade after the Ministry of Renewable Energy releases a draft notification for a revised list of models and manufacturers. Management of Inox GFL Group tells CNBC-TV18 that the draft policy for localization is a big positive for the domestic industry. Just Dial rallies over 11% on the back of its Q4 results. Revenue rises 7% year-on-year. FY25 growth grows 9.5%. And Yes Bank rallies on the back of its fourth quarter numbers. Net profit beats estimates, while net interest margin comes in at an 8-quarter high. Welcome to Midcap Radar. Well, it's a screen that's completely green. As you can see, the mid-cap index is up over 2.2%. The small-cap index is up over 1.8%. As far as the advanced decline ratio is concerned, or the market breadth, as you can imagine, it is firmly in favor of the advances. And the IT pack, especially the mid-cap IT pack, is what is keeping the markets higher, especially when it comes to the broader end of the markets. Just as we speak, a name like Birlasoft, that particular stock, now near the day's highest point. But a whole host of other stocks is what Harmas has on his radar. Harmas just stepped across to this wall. This is the special segment, Midcap Movers. Harmas will take us through the midcaps that are moving around in the session.
All green today on the screen, be it the broader markets, be it the benchmark indices. It's difficult to find losers, so we will stick to the gainers in today's trading session from the broader markets. 1,200 points higher now on the mid-cap index, and there are names like Aavas Financiers, TBO Tech that are doing well for themselves in today's trading session. Among the top gainers in the broader markets, Techno Electric also seeing gains of around 7%. Of course, there are a lot of stocks that are reacting to their results predominantly from the mid-cap IT space, be it Tata Elxsi after some optimistic management commentary is up 9%, Just Dial 2 up 11%, the top gainer on the Nifty 500, and Angel One after the management saying that the worst is over is up 6%, and that has had a rub-off on a lot of the capital marketplace as well. Now, some of the other movers then within the broader markets, the newsmakers in today's session, be it GAIL after the announcement of a potential tariff revision, Suzlon, of course, on the wind ministry notification is up 7%, and Coforge after Motilal Oswal Mutual Fund bought some stake on Thursday is also seeing healthy gains in today's trade. And as I mentioned about the capital marketplace, a lot of the moves on Angel One have rubbed off on names like Nippon Life, HDFC AMC, BSC, KFintech, all of them seeing gains of anywhere between 6 to 7%. And lastly, stocks that are doing well on the back of strong volumes, and they include the likes of Cochin Shipyard off the highs of the day, still holding on to gains of around 3%. Anantraj is up 6% reporting results today. L&T Finance is up 5.5%, and Aptus Value 2 is up 3% on very strong volumes, Vivek.
Thank you so much, Harmas, for joining in, telling us about all of the movers as far as the broad end of markets are concerned. Get back to your seats so that we can take the show forward as well. Well, you did speak about some of the stocks from the capital markets doing very well. Well, one stock that's seen a very sharp up move, especially in the last couple of hours, is MCX. Again, option trading volume over there is very strong. And when you look at MCX, this particular stock too is a strong mover in today's session. But it's now a good time to welcome Chandan Taparia from Motilal Oswal Financial Services for a technical check on the market. Chandan, well, the Nifty Bank at a record high, Nifty firmly about 24,100. Do you see markets surging from this level on as well?
Good afternoon. Thanks for having me, Vivek. So really, we have seen a decent run-up of more than 2,400 points in Nifty index in last almost 8 trading session, we have seen a V-shaped recovery and market managed to reclaim the 24,000 marks back. The good part is that index has been making higher highs, higher lows, and the base of the market is gradually shifting higher. So I believe till it holds above 22,850 zone, ongoing momentum could continue. Apply buy on decline strategy with support of 23,850, and Nifty index has potential to rally towards 24,444 to 24,750 marks. Talking about Bank Nifty index, here we are clearly witnessing this strength. The index has outperformed, has been making higher tops, higher bottom, surpassed the previous lifetime high of 54,467, heading towards 55,500 marks. We have seen a rally of almost 5,500 points or 6,000 points in last 8 days. So I believe this momentum could continue, and entire BFSI segment could do well. So till it holds above 54,750, Bank Nifty has potential to rally towards 56,000 to 56,500. So positive stance in both the indices, and Bank Nifty and entire banking and financial space is likely to outperform the market. If I add about the seasonality index, we have noticed that in the month of May, June, July, usually market remains positive. July has 90% track record of the index to be in positive, and June has 80% track. So I believe the ongoing momentum could continue for a next 2.5, 3 months. And if this speed continues, then I believe the Nifty can head towards 25,000 and Bank Nifty can head towards 57,000 on positional point of view as well.
Chandan, good afternoon. Thank you for joining in. What's on your stock specific list? Are there the large cap private names that are making new highs within the banking names, or is it the IT names, or is it something else?
So I think better to focus on the relative strength. We have noticed that banking and financial sectors are doing well, and most of the private PSU and the financial names are heading to the new high zone, and I believe one should continue to remain bullish here. So Bajaj Finserv could be the first name. We have seen a rally of around 3.5-4% for the day. Longs are being added, and after the 4.5 years, the stock is heading towards the new lifetime high. So a multiple years breakout is visible on the daily, weekly, monthly chart. So with support of 2065, Bajaj Finance can be bought for an upside target towards 20 kind of level. Apart from Bajaj Finserv, one can also look at the consumption theme. Crude is falling down, and Indigo is one of the strongest name in this market. Already this stock is up by around 20% on YTD basis and has been doing well from last couple of weeks. Recently, it gave a breakout from the triangle, and after that, it retested and turned higher. So with support of 5350, Indigo can head towards 5650 kind of level. So Bajaj Finserv, Indigo, these are the name which could do well even at current scenario, and we believe that BFSI segment can do well, and Nifty can also see the buy on decline stance to commence the next leg of rally.
New highs for Bajaj Finserv as well in today's session as well for Indigo. Chandan, thank you so much for joining in with your views on the index and on specific stocks as well. But as we slip into a short break, here's some good news for our viewers, and that is of course the CNBC TV18 app for getting India's business news leader in just a click away. You can get all the financial news updates, in-depth articles, and of course breaking news on just your fingertips. And you can download the app from the App Store or the Google Play Store. And of course, you can also scan the QR code that comes up on your screen to download the app. Take a short break, back on the other side.
Welcome back to Mid-Cap Radar. Well, have a look at some of the two-wheeler stocks. The entire market is buzzing and we're seeing a green screen, but the two-wheeler stocks, especially in the last half hour, have seen renewed buying. So look at a name like Hero Motor, that particular stock higher by almost 2.5%. Bajaj Auto almost 3% higher today. Hero Motor too is doing quite well. TVS Motors is the other name that we're looking at. All of these stocks are doing very well. But moving on, one stock from the broad end of the market that's doing very well is Just Dial. The stock is surging after the company reported its Q4 numbers. Rima joins in with more details.
Thanks so much for that. So for Just Dial, let me give you 3 reasons why the stock is higher. For starters, the company's collections have improved. In Q4, the collection growth was 11.3% higher than what we've seen in the prior 2 quarters. Secondly, the cash in the books is in excess of 5,000 crore rupees, and that is 60% of the company's market capitalization. And the third reason is the company has been improving margins. In FY25, that's the year gone by, they managed to improve their margins by 860 basis points, 8.6%, and margins are nearly at 30%. That said, Q4 revenue growth has been a bit slow for the company. Revenues for the company have just gone up by close to about 6%. So growth has been slow. But as I said, 3 reasons why the stock is higher in trade.
Indeed, and it's doing well as well, right? The top gainer on the Nifty 500 index is Just Dial. 3 important reasons. And of course, Rima, Tata Elxsi as well. What a sharp reversal that has seen. Some optimistic management commentary behind that.
Indeed, it's taken a lot of people by surprise, the price action today. So, Q4 was a disappointing quarter. The company's top line declined by more than 5%. This was the 3rd consecutive quarter of a miss. Margins have come under pressure. EBITDA margins at 22.9%, sharply lower compared to the 26.3% prior quarter ago. Profits are down close to about 12-13%. But what could be driving the stock higher could be the management commentary. So management in the conference call spoke about growth stabilizing in Q1. They spoke about FY26 perhaps being better than FY25, given the deal wins that they've had. In Q4 itself, there were some strong deal wins. In media and communications, there was a $100 million deal in the automotive vertical, which saw a decline of 10% in Q4. There was a deal win of €50 million. So all that could be aiding sentiment, and the management at least seems to be confident about things stabilizing after a rough Q4. Also bear in mind, the stock has fallen a lot. In the last 3 years, the stock price is corrected by nearly 35%. That said, brokerages still remain a bit circumspect. Kotak, Ambit have a sell call. Their target price ranges from 4,000 to 4,500 crore, lower than the current market price.
Thank you so much, Rima, for joining us, talking us about a couple of stocks today that are seeing the big moves, both Just Dial as well as Tata Elxsi. But we'll now shift focus to the city gas distribution companies. The government is taking measures for sustained allocation of affordable gas. Sudarshan joins in with more details on this particular development.
So over the weekend, we have heard that government has announced some changes to the domestic gas allocation, and it includes both APM, that is Administered Price Mechanism, and NWG, that is New Well Gas. Now, what does it say? So first, related to the domestic gas allocation, now it would be done in the advance, basically 2 quarter advance, the allocation would be done, and allocation would include both New Well Gas and APM gas. Now, second is the NWG, that is New Well Gas allocation, now will be done on pro rata basis. So as of now, it used to be done via auction. Now government is saying it will be done on the basis of pro rata. What does exactly pro rata mean? It will be done as per the demand. If a company has more demand than another company, then the previous company will get the higher allocation as far as New Well Gas is concerned. Regarding the allocation ratios, government has said as of Q3 FY25, total allocation was around 54.7%. Mind it includes both APM as well as New Well Gas. And in Q1 FY26, government is saying it would be around 55.7%. And also for Q2 FY26, government is projecting around 54.74%. But it includes both. Now, as per the communication that we had received from 2 major city gas companies, those are IGL and MGL, total allocation as far as APM is concerned, it was in the range of 37 to 38%. And as far as New Well Gas is concerned, it's around 17 to 18%. Analysts believe that going forward, the range of allocation for affordable gas is only expected to go down. But they are positive on city gas companies because of two major reasons. Now, both crude and LNG prices are soft. Now, they believe that not only in the near term, also going forward, that basically in 12 to 18 months, these prices are expected to remain soft, and that could help company to maintain margin. Will company be required to take the price hike? It depends what exactly the allocation would be in going forward. But now government is saying that, basically confirming that now it's going to be done for 2 quarters in advance. So we can expect the continued or sustained momentum of allocation as far as city gas companies are concerned. And you are seeing big move in all the major names on the back of these announcements.
Sudarshan, thanks a lot for that update. A lot of these city gas players and gas companies doing well for themselves. By the way, is a slight cool off from the highs of the day now. 24,120 is where the index stands, around about a 60 to 70 point cool off from the highs of the day. And the IT index earlier in the show, as Vivek was highlighting, has also cooled off from the day's high, and that is also leading to a bit of a cool off on the benchmark index as well. And a lot of the FMCG names have seen a bit of a cool off today. Marico is down 2.5%. Varun Beverages is also down 2% in today's session, as is Godrej Consumer Products. So a lot of these FMCG names not doing very well for themselves in today's session, falling to the lows of the day as well.
Almost very interestingly, ICICI Bank, that had a very good quarter. Very strong NIMs. Loan growth slightly soft. It's now at the day's lowest point. So that's one key reason why the Bank Nifty as well as the Nifty have cooled off from the day's highest point. But like you're mentioning, we'll slip into a short break. We'll get you more on the markets and stock specific action on the other side. Stay tuned.
Howard is a joke. Teachers hate and stupidity and should no longer receive federal funds. These are the words of America's most powerful man, who's going after America's most prestigious, richest and the oldest university. I'm talking about US President Donald Trump. The US government has now threatened to ban Howard University from enrolling foreign students after the university said it will not surrender its independence. What does it mean? Let's understand the controversy in detail. Now, the US Department of Homeland Security, or DHS, has threatened to revoke Howard University's certification to enroll international students. This comes after the Trump administration decided to freeze over $2 billion in federal funding and cancel $2.7 million in DHS grants. Now, why is Trump going after Howard? Well, he has accused the university of allowing anti-Semitism and promoting ideological bias against Jewish students. Remember those protests that happened across most universities in the US last year in the wake of Israel's attack on Gaza last year? Now, many students protested at Howard too. Now, what does Trump want? The White House has demanded that the oldest university in the US make changes to hiring, admissions and teaching practices, which it says will help fight anti-Semitism on the campus. The US Department of Homeland Security has demanded detailed records by April 30th, 2025 on visa-holding students' involvement in those protests, disciplinary action taken by the university or any perceived threat to campus safety. Yes, that is the deadline. And what if Howard doesn't listen to the government?
Welcome back to Midcap Radar. Well, two stocks from the renewable energy space and pertaining to the wind energy space. Both of these companies, remember, are wind turbine generator manufacturers, and both Inox as well as Suzlon today are doing very well in the session. So what is the reason for that? Over the weekend, MNRE, which is the Ministry of New and Renewable Energy, released draft notifications which is for revised list of models as well as manufacturers, and this is for wind turbine models. What is this particular proposed amendment? The proposed amendment says that there will now be a minimum content of domestic manufacturing required as far as wind turbine generators are concerned. Amendment mandates local sourcing of key components like blades, gearboxes, generators as well as towers. And what is the key highlights of this particular move? Number one, looks to increase domestic content. Domestic vendors now necessary for key components as far as the turbines are concerned. Mandatorily locating data centers in India, mandatorily locating R&D centers in India within 6 months of this particular notification coming into effect. What does this particular move mean as far as the renewable energy space, especially wind space, is concerned? Number one, it addresses key concerns regarding competition, much lower price competition from Chinese OEMs. Remember, a name like Envision from China actually is sitting pretty on an order book of close to 10 gigawatt. Along with it, there has also been potential loss of market share and pressure on wind turbine generation manufacturing margins, which again players like Inox Wind and Suzlon have been talking to the regulators about. So this is an important development. The final notifications are awaited. But remember, earlier today, we spoke to Inox GFL Group Management. In fact, Devansh Jain spoke to us, and this is what he had to say as far as these draft notifications are concerned.
What has been happening in the wind sector in the the post-COVID era, you've suddenly seen a couple of Chinese guys come into India with, I would say, C-grade products. You have more expected to come in, given that we never had any domestic content requirement notifications in place. And I think what this does is a big positive for the domestic industry, where the current policy was that you simply need to have something called RLMM, where turbine manufacturer needs to enlist his model and his plant with the government of India. Under the new regulation, you now need to domestically procure blades, towers, generators, and gearboxes. Now, if you put these four things together, that would constitute almost 75% of the turbine cost, barring the EPC, which anyways is a domestic play. Big chunk of our procurement, 70-75% of the entire turbine cost is anyways domestically manufactured. With respect to some of the components which we are partly importing, we already have a large enough domestic supply chain in place. We'll simply shift the entire volume to these guys. Again, with respect to the remaining 20-25%, look, it's not just China. You've got some components, for example, balsa, which is used in bridges, coming from Ecuador. Everybody gets it from Ecuador because that's 90% of the global market. Various other components come from different parts of the world. So it's not as if everything is only coming in from China. Certain components, the quality is better. They're far more competitive. So, again, I think for us to possibly be 80-85% local is not rocket science. But I think we've got a mix and match in our supply chain. We've de-risked countries in our supply chain. So everything is also not just focused on India. God forbid something was to go wrong with a vendor in India. We had various vendors globally as well. So for us, our supply chain is very, very integral to our success.
Another stock that's making new highs in today's session is Indigo, and the company is now aiming to increase its international capacity to 40% this year, according to CEO Peter Elbers. Now, he spoke to Shireen Bhan and he mentioned that he welcomed the grievance redressal body for customers on airfares, but also called for correlation between costs of doing business and airfares. Now, the Indigo CEO also warned about rising airport fees, saying that it runs the risk of tipping over.
The Indigo International Network, Shireen, is started some years back, very traditional, if you wish, between India and the Gulf and the Middle East countries. We've been slowly expanding that. So in 23, we started flights into Central Asia. We started flights into Nairobi. We have moved, and I had a meeting earlier this week with the CEO of Changi Airport. We moved from moving into Singapore from 3 Indian cities to 9 today. But that's still within that 5 to 6 hour radius. I think the next step for Indigo is to make sure that even Europe and further parts of Asia would be accessible, directly operated by Indigo. And, if India is going to be the third largest economy in the world by 27, the country needs and deserves actually an airline of the size and scale and potential of the nation.
We've once again seen the parliamentary panel recommend the possibility of looking at intervening in the market as far as prices are concerned. We've now got the government setting up a special cell where customers can actually talk about their complaints as far as pricing is concerned. Would you worry about the possibility of government intervention on pricing at this point in time?
Well, when there's a body where customers can complain about certain things, I think that's a good thing. There's always good for companies to have a body which keeps sort of things in balance and things. So I think in general to have a body like that is a good thing. Having said that, looking at the Indian market, it's one of the most, if not the most competitive market in the world. The average price levels are extremely competitive. There has been some recent reports which made a comparison. How did inflation go over the years and how did airfares go? And actually you could see that the inflation has gone much faster than the airfare. So we need to catch up in that in efficiency and sort of in order to keep the margins. Because in the long run, there must be a correlation between the cost of doing business and the price of airfares, right? Otherwise you'll be out of business. Looking at the price sensitivity, a few hundred of rupees sometimes is enough to have people flying or not flying. So we should be mindful of looking how these user fees will eventually find their way into ticket prices. Because at the end of the day, there's a correlation between what is the price and the cost price of a product and what is the price for the consumer eventually. So full support for all the changes. I think it's important that it's being done, but we should be mindful that, at the end of the day, the price of the ticket is based on different elements, and this aspect is an important part of that, and that should be in line with it.
Is it in line with what you believe is the kind of threshold, or do you believe it's tipped over?
I think at some points it runs the risk of tipping over. If you take the price of a ticket, the price of some of the UDFs should, in terms of percentage and correlation, should be not too much as the total price of the ticket, right? There's going to be fuel and flying and this and that and the other. So I think, again, full support for all the changes we're making, but we should be mindful of what would it do eventually for the total ticket prices.
New highs for Indigo, and also despite ICICI Bank giving up all of its gains, the Nifty Bank too is still holding on to gains of around 1,050 points, still 2% higher. The Nifty holding on to gains of around about 300 points. But with that, we call time on this edition of Midcap Radar. From Vivek, me and the team that put this show together, thank you so much for watching. News and updates continue on the other side.
That would result in the loss of Harvard University's Student and Exchange Visitor Program certification, which will effectively bar the university from admitting new international students. Harvard is the first university in the US to push back against Trump's threat, and the consequences are for everyone to see. The American government has identified 60 universities for review. Last month, Columbia University agreed to many of the administration's demands in the wake of the protests after the government cut $400 million in funding. Let's look at some numbers here. International students make up more than 27% of Harvard's enrollment this year. Overall, 6,000 students. How will it impact Indian students? Well, Indians constitute a significant portion of Harvard's international cohort. In 2020, approximately 2,13,062 Indian students studied in the US, with 505 enrolled at Harvard alone. Now, getting an admission is not easy there, but this move could further dent many students' aspirations. And what is happening in present is not good news for many Indian students. Reports indicate that Indian students across US universities are experiencing anxiety over sudden visa cancellations for minor offences such as traffic violations or even social media posts. Foreign students in the US have faced sudden visa revocations, as I was talking about social media posts and other things, and this comes amid, the immigration crackdown by the government. Moreover, Indian students who often rely on F1 visas and post-graduation work permits like the H-1B visa fear that their academic and professional aspiration in the US could be jeopardized because of this.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in, as always. A quick look at what the market is doing, because Nifty managing to hold on to the 300-point gain that we saw in the last hour as well. And as of now, also almost near the day's highest point is what the Nifty is trading at, 24,145, 146 levels, just around the 300-point uptick for today's trading session. Some of the names that we should keep an eye out on in today's trading session, specifically coming in from the broader end of the market. Let's look at Just Dial. We have Tata Elxsi, we have Suzlon Energy, Sterling and Wilson, as well as Nippon Life AMC among some of these names that are buzzing in trade as well. So surely interesting to watch out for, where we'll be seeing the next half and next couple of hours of the trading session, where that's going to be headed. It's going to be interesting to watch out for if we still sustain the gain. But today, as of now, so far so good coming in for the markets. But let's move on and get started with the show for today. This is the show where we solve all your stock related queries, and to solve all those queries today, we have our experts joining in with us. Ashish Kayal, CMT author and founder at Wave Strategy Advisors, as well as Gaurang Shah, Senior Vice President at Geojit Financial Services, to talk to us about the markets as well as solve all your stock-related doubts. Good afternoon, gentlemen. Thank you so much for joining in with us. Ashish, we have come past the 24,000 level. What are we watching out for in terms of levels now for the Nifty as well as the Bank Nifty?
Hi, afternoon to you and all the viewers. See, in this kind of a market where it's just one side rally, I think giving a level is going to be futile, because it's not stopping anywhere else. The only simple thing that one can do is follow the trend. Unless we see a close below the prior day low, continue to be in the market and keep riding it on the upside. Having said that, over short term, yes, the indicators are overbought, but that does not mean that you have to sell. You have to keep looking for any dip that you can get around 24,000, enter into the market. On the upside, maybe 24,300 is the level that we can look at. And on the downside, the support is going to be around 23,900 level. That's the level that you can look at right now. Nifty Bank has been leading the way all the way on the upside. Now at lifetime high levels, there is a very strong outperformance. And I think if you look at the weekly time cycles kind of a study, the overall trend has reversed on the upside for the next 6 months to 8 months time frame. So the overall perspective for Nifty Bank is also positive, as long as the gap on the downside over short term is not filled. The support is going to be around today's low for Nifty Bank, which is 54,700. And on the upside, there is no hurdle because it's at the lifetime high level. So having said that, maybe the psychological 56,000 mark is the next level that one can aim for.
Okay, keep an eye out on those levels over there for the Nifty as well as the Bank Nifty. But on that note, starting with the first query for today, we have Kirti Shah, who's writing to us from Gujarat. She's holding 50 shares of HDFC Bank, and this is at a price of 1,800 rupees per share. Wants to know whether she should continue to hold or sell at the current levels. Gaurang, coming to you, good set of numbers that have come in from HDFC Bank over the weekend as well. Not only HDFC Bank, even ICICI Bank. So private banks seem to be doing well. Should she continue to hold?
Thank you so much for having me on the show. Very good afternoon to you and to all the viewers, and to my good friend Ashish Kayal. Well, the numbers, if I have to compare ICICI Bank and HDFC Bank, I think ICICI did a much better job. That doesn't mean that HDFC's numbers were ugly. They were more or less in line with what we had penciled down. And our estimates, Vinny, at Geojit Investments Limited, is that the entire banking pack, be it private, public, or as a matter of fact, strong NBFCs, they would possibly report good numbers, not only for this fourth quarter, but also for some quarters to come by, even in this and the next financial year. And one should have a dedicated allocation towards banking and finance if you do have a portfolio in the stock market. So we have a positive coverage. Long term, continue to hold on HDFC Bank.
Okay, continue to hold on HDFC Bank. Ashish, your view on the charts and technicals, any different?
No, absolutely. This is the first sector. So how do we identify the leaders that are going to be there? The first sector, after a strong correction that outperforms, can be the leader for the next bull trend that might come up. So looking at that, I think HDFC Bank can also continue to outperform. We are seeing some kind of a short-term profit booking in today's session after the uptick that it showed at near 1950, but the overall tone remains bullish. I think the stock can touch 2,000 levels over the near term. On the downside, the support for the stock is the previous peak, which was 1882. So 1882 can be the support and 2,000 is the target.
Okay. Keep an eye out on those levels over there for HDFC Bank. Let's move on to the next query, and this is coming in from S. Jaykumar, writing to us from Tamil Nadu, holding 1,000 shares of Swiggy. This is at a price of 343 rupees. I beg your pardon, 352 rupees per share. Stock is currently trading at 343 rupees per share, making some bit of a loss. And he's a short-term investor. So, Gaurang, what should they be doing with Swiggy? Might as well just book that little bit of loss they're making or continue to hold Swiggy?
Very honestly, I'll leave it to my good friend Ashish Kayal to answer this because it's a short-term comments. But then let me give a broad view about the quick commerce universe. You know, we are going to see a couple of more names coming into this quick commerce. But let us not forget one thing, that Zomato and Swiggy are the two oldest and the largest player in the quick commerce segment. New competition coming in can create certain discount-related issues from a short to medium-term point of view. But if you have to ask me the survival of the fittest, then our view at Geojit is that both Swiggy and Zomato will continue to perform well. Maybe there will be 1 or 2 quarters wherein numbers may not come in what has been anticipated, but long-term growth story remains intact. As a disclosure, on Swiggy's IPO, we had a subscribe recommendation from a long-term point of view. And on Zomato, even in the IPO and currently, that is eternal as of now, we remain positive from a long-term growth story.
Okay. Surely keeping an eye out on that for Swiggy and Zomato, the perspective that we've gotten from Gaurang. But on the charts and technicals, Ashish, what are you looking out for in Swiggy? And it's a short-term query, so should the viewer just book out their profits right now?
No, I think he bought at around 352 and the stock is at 343. So he's incurring some kind of a loss. 352 is the hurdle from where the stock has reversed 2 or 3 times. So I think he can hold on for now. And if 352 is taken out, we can expect the stock to go even towards the level of 380 on the upside. So the overall consolidation is going on in this stock. Zomato has outperformed Swiggy to some extent, but Swiggy is yet to catch up. I'm optimistic that it can go to the levels of 380, hold on to the stock here, but maintain a stop loss on the downside at around 329. Since he's a short-term trader, it's important to use the stop loss of 329 and 380 is the target.
Okay, keep an eye out on those levels over there. 380 is a target over there, so something interesting to watch out for from Swiggy. Next query for today, Hindalco, that's the stock we'll talk about. Himanshu is writing to us from Noida with an investment query. He's asking if he can buy Hindalco at current levels, and this is for the long term. And what is your view coming in on this, Gaurang? Hindalco, is it a good bet, or would you be picking up something else from the sector?
No, so as a brokerage house, we remain positive on both ferrous as well as non-ferrous. As a play in copper, aluminium, steel, we believe copper would do much better in terms of commodity prices in the international commodity market. And on Hindalco, we do have a positive coverage. That's a disclosure from my side from a long-term point of view, provided you have your investment time horizon. When it comes to metal related, you need to have at least 1.5, 2 year plus. 2 year plus would be a more comfortable time zone because it'll take that much of time for the headwinds in terms of global events which are unfolding to settle down and for domestic consumption to look much more strong.
Okay, and your view coming in for Hindalco, is it attractive at current levels, Ashish?
See, from the long-term perspective, I think there is some kind of a shift in the overall economic cycle where we have started seeing interest-sensitive sector as a whole to do much better and can do much better. So I would be focusing if I have to put money from a next 1 year perspective, I'll be focusing more on the banks, financials, real estate is where I think it's much better. Hindalco on the charts, there is no sign that it's going to go down. But overall, I think it's better to be staying with those interest-sensitive sectors and maybe stocks.
Okay. Keep an eye out over there for what Ashish was mentioning as well, and Hindalco specifically. Let's move on to the next query for today. We have, this one is coming in from Shashi Rathod, who's writing to us from Bangalore, holding 40 shares of Tube Investments. This is at a price of 620 rupees per share that bought it some years ago. And he's asking if he can hold the shares for further 2 more years, or does it make sense to book out of the profit that he's making? Gaurang, your view coming in for Tube Investments, right? Good amount of profit. Should they book out some of this profit, or make sense to hold on for a longer period of time of 2-3 years more?
Well, first of all, the investment is at a very decent level. Let me admit this. And 2 more things. If you are concerned about the rally, and if you are worried about your capital, though let me give a disclosure, we do have a positive coverage on buy side on Tube Investments and auto ancillary company. But in case if the investor is worried about his capital, since he is getting this kind of a phenomenal return, at least bring home your capital or maybe some percentage of your profit, and that much quantity he can sell. If not, if he or she has a relatively higher risk appetite, we believe there is still more headroom left in tube investments. Our targets, Vinny, from a long-term point of view, is 3,000 plus. So if you're not in a hurry, stay invested. If you are concerned, then maybe you can bring home your capital, but stay invested.
Okay, bring home your capital, but stay invested if you're worried. But otherwise, it makes sense to stay invested as well, as what Gaurang is highlighting. Your view coming in on this, Ashish, levels, anything attractive? Are you expecting a further run-up in the near term?
See, if you look at the entry has been excellent. I think it's at around 620 levels, and the stock is now at 2575 odd. So the overall tone over short term, there has been a correction that we saw, but there is a very, very important support which is placed for the stock at 2,400. There has been multiple bounce back from that zone. It came very close to that again, and it's bouncing back. So my suggestion will be hold on with 2,400 as a strict stop loss. On the upside, there is a possibility the stock can again move towards 2,920. So that's where he can look out to book some of the profits.
Okay, that's a word coming in there for tube investments. Let's move on to the next query. This one is Samvardhana Motherson is the stock that we'll talk about. Raghav Jain is writing to us from Mumbai. He's holding 80 shares of Samvardhana Motherson. Price is 80 rupees per share. Wants to know whether he can buy more of the shares, or what should he be doing this with this one? Samvardhana Motherson, your view coming in on this, Gaurang. Given that so much of these geopolitical tensions, trade wars that we keep hearing, what should one be doing with Samvardhana Motherson on that uncertainty front?
Well, it has a decent exposure to overseas market, Samvardhana Motherson, Vinny, and US is a decent part of that export market that this company provides to. Don't know what is going to happen in terms of the 90-day window post that, what is going to happen, whether there's going to be rethinking, whether Indian government is going to be having a dialogue. We already know Vice President Vance has landed in Delhi, and there will be some dialogue between Indian and the counterpart. If there is going to be a mid-road that can be paved out to have the impact to the minimal as possible. Having said that, from a long-term point of view, point number one, hold on. Point number two, if whether you want to add to it, well, you got it at 80. If you're going to add at 130 plus, it's going to bring up your cost of investment. If you are able to digest that, and if you have a elevated risk appetite, remember one thing, there are uncertainties for the next 3 to 6 months in terms of tariff clarity impact. But beyond that, we think there is a lot of positivity for auto ancillary sector as far as export market is concerned.
Okay. And your view, Ashish, on the charts and technicals, what would you suggest the viewer do?
See, I would recommend to hold on over here, not to add up right now. Like Gaurangji rightly said, there can be headwinds over next 3 months, 6 months. It can be a little tricky. So do not average or do not pyramid right now. But short-term pullback is possible for the stock towards 150. That's the retracement that we are looking at on the upside. The fall has been sharp and wild. We can expect a pullback to come towards 150. So hold on for as of now. And on the downside, the support for the stock is at around 125, which is the gap area.
Okay, keep an eye out. Hold on, don't add more. That's a word coming in from Ashish as of now. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll be back with more of your stock-related queries after the break. Welcome back to Your Stocks on CNBC TV18. We still have our experts with us, Ashish Kyal, as well as Gaurang Shah, to solve all your stock-related doubts. Gentlemen, let's move on to the next query. Now, this one is coming in more from the railway side. We have two stocks that the viewer wants to know on. Wesley is writing to us from Goa. Investment query. So one is Titagar Wagons, others Jupiter Wagons. What does it make sense to invest in this one, long-term as well as short-term view? So Gaurang, let me take it to you first. Titagar Wagons as well as Jupiter Wagons. What's your view on this one? Because so far in Q3, they've spoken about delays in those orders that were coming in, especially from the Indian Railway side. But now does that seem that we'll be seeing that change, and your view on both these stocks?
Well, Suvini, I'll restrict my comment on the sector and maybe not so directly in terms of buy, sell and hold. Now, let me give you a perspective. We've seen major rehaul happen in terms of Indian Railways, whether it is to do with the bullet train that is on track, Mumbai, Ahmedabad, Mumbai, or whether it is to do with Vande Bharat, or increasing the speed of express trains, or introduction of new trains, improving the last mile connectivity, upgradation of tracks, upgradation of railway station, so on and so forth. So there is a lot that is happening with respect to Indian Railways. Now, which are those companies which will get benefited over a longer period of time? Definitely with the kind of upgrade of coaches, I think names like Titagar Rail, Titagar Wagon, Jupiter Wagons would be the straight out beneficiaries from a long-term point of view. There has been a slow space because of the kind of work that was supposed to have undergone. That run rate was not happening, but in the future it is likely to complete. So these companies, along with the IRFCs and the IRCTCs and the RVNL and Railtel of the world, would be the direct beneficiaries of the modernization stroke change that is happening in Indian Railways. What I'm trying to say is that things will not happen overnight. For things to materialize and improvement to come through and for earnings to improve will take time. But Indian Railway sectorially and the companies which are associated with Indian Railways, they are a long-term play in terms of earnings improvement on fallback of order intake.
Okay, that's a view coming in on the sector. More stock specific, Ashish. Titagar Wagons as well as Jupiter Wagons. What would you look at? Which one is better? Any other railway stock?
See, if you look at both of these stocks, the chart structure is very similar. I mean, both of them are showing a very similar kind of an up move, then a correction that has happened, and both have them bounced back from an important support. So having said that, the overall trend for this, I would prefer Jupiter Wagon over Titagar because it shows little outperformance, bounce back sharply from the 300 levels, now around at 388. So the overall tone for Jupiter Wagon looks to be little much better. But I would prefer IRCTC over these stocks. That looks to be showing a much better structure and relative outperformance, relative ratio outperformance. So my pick is going to be IRCTC, which can now move towards the level on the upside at around 840, 850. And on the downside, the support for that stock is around 740 or 744. So my suggestion would be if you can invest into IRCTC, that is a much better pick.
Okay. IRCTC is a better pick is what Ashish is highlighting. But if you want to still buy from Titagar Rail or Jupiter Wagons, then Ashish prefers Jupiter Wagons. That's the word coming in there. But let's move on to the next query. We have Mohit Khanna who's writing to us from Mumbai. And he's holding 500 shares of Morpin Labs. This is at a price of 26 rupees per share. He's asking if he can continue to hold the shares for another 2 years time period. Morpin Labs, any view coming in on this one, Gaurang?
Vinny, I'm sorry, I'll give it a pass because we don't have coverage on this.
And your view, Ashish, Morpin Labs, I don't think everyone tracks it too closely always, but Morpin Labs, anything on that one?
Yes, we can see there has been decent enough correction. It went all the way to 100, corrected to the lows of around 42, which is more than 50% correction from the top that we can see in the stock. But right now, there is some kind of base formation and it's trying to recover back some of the losses. So my suggestion would be hold on if you have the investment right now. On the downside, the stop loss has to be maintained at around 49.50. And on the upside, look at the levels of around 64 where you can book out from the stock.
Okay, surely keeping an eye out on those levels over there, 64 on the upside, downside. Also, the stop loss is what Ashish has mentioned as well, around 49. So keep an eye out on that. Let's move on to the next query. This is an investment query that we have coming in from Rashi Jain from New Delhi. Gaurang, she's looking at the auto ancillary names and she wants to know, is there anything attractive that you're finding that one could look to buy for the long term right now?
Well, there is definitely, but remember one thing, like we discussed, for auto ancillary names earlier, something like a Motherson, Samarthan Motherson. There is going to be headwinds in the near term, but notwithstanding that, if you're long term and a little bit of elevated risk appetite, then we do like auto. Look, if auto does well, winning auto ancillary tire battery manufacturing will do well. And for these companies, replacement market is also a big opportunity other than the new auto market. So we like Uno Minda, CIE Automotive, and Bosch. These are the three names in the equipment related. In the tire side, we like Apollo Tires and JK Tires. In the battery universe, we are positive on Amara Raja Mobility as well as Exide Industries. So the auto ancillary sector is positive, provided you are capable of going through the difficult times immediately from a short to medium term point of view in terms of the tariffs and issues related to that.
Okay. A lot of stock names that Gaurang has mentioned as well, specifically for each different kind of auto ancillary that you are interested in. You have the names coming in there. Ashish, your view on the charts and technicals, you are finding any interesting in that sector?
Yes, if you look at Apollo Tires, I think it has done very well, formed a double bottom, showed sharp recovery from 375, now at 460. So if you can get some kind of a dip in Apollo Tires, use that as an opportunity to buy. The targets can be at around 500 and possibly higher. The next stock is Exide Industries. We can clearly see it is also breaking out of the downward sloping channel, managing to move above its 20 DMA. So the overall tone for Exide Industries also reversing on the upside can be a good entry at this level. Risk look a little less. On the downside, the support for the stock is at around 354, and we can expect it to touch the levels of around 440 over near term.
Okay. Surely keeping an eye out on those stocks over there and the auto ancillary names. Let's move on to the next query. This is coming from K. Sachin, who's writing to us from Chennai. He's holding 270 shares of Bandhan Bank. It is at a price of 301 rupees per share. Obviously, from the buy price, his stock is currently trading at half of that level, 167. He's asking whether to book the losses or continue to stay invested in this one. Gaurang, your view coming in for Bandhan Bank, given that bank side is doing well now, does it make sense to continue to hold Bandhan Bank or just book your losses and invest your money somewhere else?
Well, so Vinny, if you have elevated risk appetite, I would advise hold on, possibly accumulate since you got in at higher level. The stock is trading at about 167, 168. Improvement in terms of earnings visibility, let me be very, very clear without mincing words, it's going to take pretty long. But it is not like the turnaround is not going to happen. It will happen. It is a matter of time, and possibly the changes that have been happening in the top management would possibly bring in the improvement in earnings sooner rather than later. But to go on to the level where the investor has invested, I think it's going to be pretty long. He can do one thing, he can average, not at current levels, but maybe you get Bandhan Bank at maybe 150 or sub 150. You can average, bring down your cost, and then possibly think about a reasonable exit in terms of your investment. But it's going to be a long wait.
Okay, it's going to be a long wait is what Gaurang is highlighting. On the technicals, anything different, Ashish?
No, I concur with the view of what Gaurangji is saying. I think the overall, there are a series of hurdles on the upside for the stock. I think right now, the immediate hurdle is going to be around 184, 185 levels. And then if it manages to cross that, because it has been forming lower high and lower low, which is the overall trend of the stock. Having said that, if he wants to invest, I think Axis Bank or ICICI Bank can be a much better pick as well, because ICICI Bank touched the 52-week high, and we can clearly see a very strong outperformance that has come over here. So it has been emerging as a leader in the space. So private banking space looks attractive as of now, and I think ICICI or Axis Bank can be a diversification if he wants to invest more.
Okay, Ashish, thank you so much for that view coming in. But that was the last query for today, gentlemen. So thank you so much, Ashish, as well as Gaurang, for joining in with us on the show as always and helping our viewers solve all their stock-related queries. And viewers, thank you so much for tuning in and sending us your queries. Keep sending us your queries and email us your queries. The address is flashing on the bottom of your screens as well. The top of your screens, I beg your pardon. So do send us your queries. But that's all the time we have on this edition of Your Stocks on CNBC TV18. Thank you so much for tuning in. Up next, your closing bell.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Asian markets as of now have opened up a bit mixed. Look at the Taiwan index, that's down almost 1%.
The next resistance comes in at 23,960 and then 24,551.
This is also coming at a time when Gensol has leased around 5,000 cars to Blue Smart Electric Mobility.
Decent start, about 1/3% higher on the Nifty. The Nifty Bank, I think, is at a record high.
Yes.
Valuations have corrected and are pretty much, at least in the large cap companies, are closer to the levels where one would ideally want to invest into these companies.
A number of almost maybe 125 to 130 billion units incremental will be required, which when converted into capacities will be about 25 to 30 gigawatt of fresh capacity.
Both banks and IT are on the way up. Banks, because the numbers from HDFC Bank, ICICI Bank have been fairly robust.
These uncertainties clearly are adding premium, and a safe haven buying is happening only in gold.
Completely green, as you can see. The mid-cap index is up over 2.2%.
Well, it's an absolutely stunning day once again, starting the week in style, and the market is breaking records. At least the Nifty Bank has, and the Nifty, in a way, sort of also has. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, and it's all green. Rima, hi.
Hi, we've just taken off from where we left off, right, on Thursday. Last week we rallied, 4.5%, 6.5% on mid-caps. And markets like a rocket last 4 days.
Like a rocket, and it's continuing.
It's continuing.
And, I think the flows are going to be strong once again. It looks like it because the momentum suggests that it's not, the covering bid, etc., got over the week before last, towards the end of the week before last. Last week, of course, there was massive FII buying which happened. And I think today's number should also be pretty solid, all told. So, this is looking good. We were talking about in the morning that it looks like the breakout from the 23,800 levels, which failed last time, will sustain. Well, it's sustaining, and how? We are past 24,100 now, and the level to target from here is 24,551. That's essentially extension targets based off what we've seen. And for the Nifty Bank, the next level is about 56,000. I think 500 or so, 400 something. With the levels we put out in the morning, it's just that it's all sort of happening so fast now. And the banks, the first big index to come back to new highs. And, the mid and small caps are also participating equally. So last week, they kind of lagged the large caps a little bit. But today, they're kind of making up 2.5 on the mid cap index. And I think they've got the small cap index, which is also up, strong fashion. So about 1.95 odd percent. Rima.
Yeah, it's a very powerful start to the week. Look at the advanced decline ratio. 4 stocks gaining for 1 stock declining. And both banks and IT are outperforming today. The Nifty banking index up nearly 2%, while the IT index has a gain of about 2.5%. And this is despite disappointing numbers coming in from many of the IT majors. Markets in Europe today are shut on account of Easter Monday. The global markets, the ones which are trading, even in Asia, a bit subdued. So the Taiwanese market and the Japanese markets closed with a cut of more than 1%. And right now, the Dow futures is down close to about 1%. Running you through some of the big large cap gainers on the way up. Peppered with IT and financial. So Tech Mahindra is the top gainer, 5% up. Trent is giving it company a good 4.5% up move. IndusInd Bank, a stock which gained 15% last week, has added on another 4%. And then you've got strength in Power Grid, HCL Tech, Bajaj Finserv. On the way down, Adani Ports is struggling, HDFC Life. These are the only 2 Nifty companies with a cut of more than 1%. And then some FMCG staples under pressure are not participating in the up move. ITC, HUL, Britannia, Asian Paints. These are stocks with cuts anywhere between 0.5% to 1%. So how should you position yourself in the last hour of trade? Mitesh is now with us with a few closing strategies. Mitesh, a long call would have worked beautifully. The Nifty is now well above that 200-day moving average of 24,050. 24,150 now, 300 points up. What should one do? Is there opportunity to add to fresh long positions now, or just close and wait it out?
Good afternoon. I'm not really keen to add on to long positions for two reasons. While I believe that there's still more upside left, the entry point doesn't offer you a very good risk-reward equation. We have run up too far away from the 10-day, 20-day averages. There could be a pullback any point in time. We are slightly getting close to overbought levels as well. So what take fresh longs on the index? A good way would be to look at stocks which have been sideways in the last 1-2 days, start trying to give some kind of a reversal today and trying to move up. So that could be a good way. But the bias and the directional view preference is on the upside. So I have a buy on Bosch Limited with a stop at 27,500 for targets of 28,500. And also a buy on Birlasoft. Keep a stop at about levels of 380, just below 380 here, and look for a target of 402 to about 405.
Okay, lots of IT stocks are higher, even in the mid-cap IT space. Birlasoft is one of them, but Emphasis 5% up. You've got a Tata Tech, Cyient, Coforge, Emphasis, all up between 4.5% to 5%. In fact, the up move in IT would have surprised many because the news was negative. So Infosys, for instance, disappointed the street with the Q4 print. The guidance for 0 to 3% was also lower than street expectations. But the street is happy that at least one, they've given a guidance, and two, it seems to be slightly better than the worst case scenario, what was feared in the market. So that's what JP Morgan says. The guidance is below the guidance set, the prior expectations 3 weeks ago, but it's better than the recently feared one after Wipro's print. Citi says that the guidance is decent in the current backdrop, though the higher end appears to be a little aggressive. Brokerages are fairly bullish on IT. So Kotak, for instance, says that Infi will have a muted FY26. Infi in particular is more vulnerable compared to others on account of its discretionary exposure. But its strong positioning in vendor consolidation, cost optimization deals will help company weather the storm. So they have a buy rating, target price 1,700. In fact, I think about 70 to 75% of the IT analysts who track Infosys have a bullish call on them, on it, and these are some of the ratings. The other one which catches your attention is Just Dial, a powerful move on that. 3 quick reasons why the stock is doing well. 1, improvement in the collections now in double digits for Q4. 2, cash in the books above 5,000 crore rupees is 60% of its market capitalization. And 3, the company, despite slow revenue growth, is improving its margin. So in FY25, margins improved by 8.6%, 860 basis points, and now at 30%. Conference call today is at 6 p.m. And Tata Elxsi has been the big mover. Again, this is one that's taken everyone by surprise because numbers were very disappointing. Top line degrew by close to about 5%. Maybe the company's guidance, what they spoke in the conference call has infused some support because they spoke about stability in Q1, FY26 being better than FY25, and then the strong deal wins that they've announced in Q4. All that will aid. And plus, the stock has been an underperformer. In the last 3 years, the stock has lost close to about 35%. Dipan Mehta is now joining in. Dipan, first come in on all these 3 IT names. The question is it just like a dead cat bounce from oversold regions levels because the Nifty IT index was down 25% from the start of the year? Is this just a tactical or a dead cat bounce, or do you think all the bad news, at least for FY26 or the first half, appears to be in the price?
Yeah, good afternoon, Rima, and thank you for having me on your show. I think it's more of short covering taking place over there, and maybe investors are taking a longer term view that beyond the slowdown which may come or the uncertainty post Trump tariffs, once it's over and done with, maybe you could see a slight revival in the earnings. But I'm not convinced, and I think investors need to be extremely selective in IT shares, and there'll be only a very, very few winners in the entire space, according to me. Coming specifically to Tata Elxsi, you're right. I think the numbers are disappointing, but the deal wins have been exceptional. That too across all the 3 verticals of Tata Elxsi. And I think that maybe a quarter or 2 down the line, growth may return to Tata Elxsi in a pretty strong way because base effect also will benefit, and a lot of these deals also will start getting into implementation stage. And of course, the stock has nearly halved. So therefore, from valuation point of view, there is a some amount of comfort. But you have to try and be very selective when it comes to YT. That's my summary.
Very selective as far as IT is concerned. Dipan, hi. Good afternoon. You know, the top gaining sector is the capital markets index, flying 4-5%. Just coming off oversold levels, of course, it's a function of the market getting a little better as well, isn't it?
Yeah, actually, Prashant, good afternoon. The Sensex, Nifty and the capital market stocks are going to move completely in tandem, and they're dependent upon higher volumes and more interest coming in from investors. And so it's natural that these stocks should do well. These companies also have seen a steep correction. Maybe this quarter numbers may not be that impressive, but investors seeing beyond this quarter, maybe in the next quarter, the June quarter, you may have better numbers coming through. If we are convinced that the bottom has been made, and from this point on this foundation, stocks will gain momentum and volumes also will pick up. So yeah, but I think the real story is in banks, and we saw what happened with HDFC, ICICI. I think it's going to make the best alpha is going to come from banks and NBFCs, especially small mid-cap banks and NBFCs.
Okay, you know, in terms of constituents, look at Nippon India. If you can put these stocks up, we showed the index. Nippon is up 6%. This is the capital market constituents. That's Nippon India. The mutual fund BSC will come up next, 6% there. HDFC AMC is up 6%. K Fintech, and you, by the way, you'll hear from the K Fintech management in just a bit from now. That's flying. Angel One is up 4.5%. We spoke with the management this morning. Angel. They're expecting FY26 to be a year of consolidation. And of course, 26 then 26 will be a year of consolidation. 27 will then look better. That's the word coming in from Dinesh Thakkar. Motilal Oswal is up 4.5%. Aditya Birla mutual fund is up, asset management is up 4.5%. MCX is up 4%. UTI AMC is up 4%. So there is a fair bit of activity and action coming through in this particular space. You think action will move to outside of banks as well, Deepan? To what segments? I mean, IT, you said one has to be careful. Banks and financials, I mean, you know, because we're back to highs here in this space. Where else do you think? Because FIs are coming back, I mean, stomping back into the market. Looks like it at least. Last week was big, the big numbers, and this is going to continue. Where else do you think?
See, Prashant, if we are convinced that the next phase of the bull market, the multi-year bull market, which we've seen for the last several years or so, if that is to continue, and it seems to be so, then the leadership sector has to be the banks and the NBFCs. So from that point of view, very positive over there. Of course, there are other India-centric sectors like engineering, construction, retail as well, even cement, aviation, all of these should do well. But I think the leadership is going to come back into banks. The bank Nifty has underperformed on a 5 out of 10 year basis also. But now I think it's going to come back very strongly with the large companies, ICICI, Axis, SBI, all of them reporting good numbers according to me. And with interest rates coming down, it's going to be beneficial for the entire sector. So investors need to have a very close look at what their exposure to banks and BFCs are and be adequate or maybe overweight in that segment.
In the past, you've said you like Bajaj Finance. At these levels, which bank or NBFC would you like to add?
See, I think that within the banks, also these smaller banks, like first the disclosure, we and our clients are invested. I thought IDFC First Bank is at an interesting level. It has also underperformed big time. But now with the deal which has taken place and the overall improvement in the environment, I think that company can do exceptionally well going forward. Within the NBFC space, we still remain very, very positive on Bajaj Finance. And this is one company which will show, I would say, very good outperformance compared to its peer group also. Within the NBFC space, against Chola Investment also looking very interesting to us. And then there's, of course, L&T Finance. So what we're trying to do here is go for multi-product NBFCs rather than focused on one particular segment, be it gold or microfinance or vehicle finance. So that's our strategy as far as NBFCs are concerned. And within the banks, as I said, I think one is, of course, IDFC First. I thought even AU Small Finance Bank may do exceptionally well. It's on the expensive side, but its performance has been quite decent. So, and of course, there are the PSU banks as well. I think across the board, a lot of choices, but this is one segment investors should be overweight in.
And these are all stocks that you own: IDFC First, AU, Chola Investment, L&T Finance.
Yes, as I said, we are following what we say. And we are getting overweight on the banks and BFCs.
Okay.
All right.
Yeah. Go ahead.
All right, Deepan, thank you very much for joining us. Maybe actually, if you want to listen in to the next conversation, we were talking about capital marketplace. We have K Fintech Management now joining us. The company has announced that it will buy a 51% stake in Ascent Fund Services. We have Srikanth Nadella, the MD and CEO of the company, now joining in. Srikanth, thank you very much for your time. Good afternoon, and congratulations on the acquisition. Could you tell us a little bit about the company that you're acquiring this 51% in, and what do you hope to do with it? What are the synergies, and how will this add to the business at K Fintech?
Very good afternoon, and happy to be here. K Fintech has entered into a definitive agreement to buy Ascent Fund Services. It's a Singapore-based fund administrator. As you could be aware, K Fintech is in the capital market infrastructure space. We are the largest registrar and transfer agent. We manage about 60% of the mutual fund houses in India. We're on the share transfer side as well, managing the IPOs in the secondary markets, also managing alternatives. That's broadly the role that K Fintech plays in the capital market ecosystem. It had been our stated goal over the last 5 years to create the country's first and largest global fund administrator at scale. Today, if you see the capital markets ecosystem beyond India, you have several large fund administrators. Many of them are bank-based administrators. Some of them are pure play fund administrators. They combined manage close to about $90 trillion worth of wealth globally. And in that context, they offer services such as transfer agency, which is everything to do with investor servicing, and fund accounting, which is basically net asset value computation, so on and so forth. Given our plan to grow globally, over the past 5 years, K Fintech had started organically growing itself, right, in Malaysia, Philippines, Hong Kong, Singapore, and Thailand. We have about 80 clientele, but we constantly look at opportunities to expand the international space as frequently as we could. And given it is a highly regulated space, sometimes acquisitions make more sense than organically growing. In that context, we've been evaluating several assets, and one such asset, is Ascent Fund Services. It's based in Singapore. It's a reasonably young organization, started in 2019 by 3 young entrepreneurs who have scaled up the organization quite well. Today, they manage about $24 billion worth of assets under administration. The company has, grown its revenue profile from nil to near about, $15 to $16 million in a very short period of time, and has scaled to be present and manage clients across 18 different countries, regulated by 6 different administrators, whether it is the Singapore administrator, Dubai, Abu Dhabi, Cayman Islands, so on and so forth. So it is a hugely complementary asset acquisition by K Fintech. We intend the deal to be closed over the next 5-year period. And as such, it is, first big step for K Fintech towards being a global fund administrator.
Srikanth, so the first step, you're acquiring a 51% stake for nearly $35 million. But you will be acquiring the balance 49% in FY 28, 29, 30, based on certain, if you achieve certain EBITDA, certain EBITDA requirements. If those are achieved, what is expected to be the total payout?
So should they be, so we are looking at a range anyway between about $110 to $170 million with the total payout, entirely dependent on the margins that the organization will deliver in those 3 years.
And the current revenues of the acquired company, you said, I think is 50-60 million, right?
That's right.
Okay.
So for the period ending, Ascent, year is between July and June, and for the first half year ending January, they ended about $13.5 million. The current run rate is about $1.5 million a month.
And by say 2030, if they are to achieve the EBITDA targets that you've set out and will entail a maximum payout of 170, what is the expected revenue and EBITDA that you're looking at?
The base case submitted was close to about $85 million.
So, sorry, what's the business growing at, Srikanth? The Ascent?
Prashant, so we're looking at the metrics in terms of 3 broad metrics. One is the number of fund houses and fund managers itself. That growth had been close to about 57% over the past 4 years. Assets under administration has been growing up north of 45-46%. Revenue profile itself has been growing at about 36% over the past 3 years.
So they essentially cater to all global funds, essentially, right?
Correct. So these are the funds that have been structured in Singapore or Dubai or Abu Dhabi, any of these offshore locations, or direct in-house, geographies such as Hong Kong. Yeah.
Okay, because I mean, I'm assuming it's a big financial center, but it's used as a base to invest around the world, not so much in Singapore, but around the world in that sense, right? So this is, and you said 47% is 57% is the growth over the last 4 years.
Fund managers, yes.
And 40 something in terms of AUM. That's the CAGR.
That's the CAGR, correct.
Okay, and what are margins here, Srikanth?
So it's a relatively young organization, as I said. They just turned the corner for the previous quarter. They turned EBITDA positive, and I guess depending as the scale increases, the margin profile will. Our plan is for it to trend to track towards that of KFintech's margins over the next 3 to 5 years.
Just in the immediate term, will there be any earnings cut on account of lower other income and higher non-mutual fund revenues? Some of the analysts we spoke to seem to indicate that at least upfront in the first year, there would be an earnings cut of 2 to 4%.
I do not anticipate that. We are, funding this entire acquisition entirely through internal accruals, right? That's about roughly 300 crores of cash. We believe it will be EPS accretive even in this year, albeit marginally so, given it's already EBITDA positive. I guess so long as our treasury income, we get about 4 to 5% return beyond the treasury income, we should be, EPS accretive this year too.
And what will be the contribution of your international revenues that you anticipate, say, 5 years down the line, given the inorganic aspirations and the organic growth?
So we started the international journey for 2 broad reasons. One, over-dependency on one country and on one asset class, which is mutual funds. And we believe it just makes prudent financial decision to diversify your risks. And the diversification was one across business processes instead of just doing RTA, do also fund accounting, digital technology, data. Instead of just one country, India, be across multiple geographies. Instead of just mutual funds, be across multiple asset classes. So from that context, we believe that, we wanted to get to close to 50% of the total revenue book to come from international in the near term or medium term, if I may, right? That's anywhere between 5 to 7 years. With this acquisition, once the acquisition is completed over the next 3 to 4 month period, the total share of international revenue to overall KFintech's revenue would be up north of 25% already. Over the next 5 years, should we execute to our plans, well, we should get anywhere between 40 to 50% of the total book to come from international.
More acquisitions in the pipeline, Srikanth? Or you think this one, at least till you get this done?
No, we continually, evaluate potential targets, Prashant. I know, and we look at acquisitions, from the lens of 3 different angles. One is, to drive certain amount of consolidation, which is basically in the same business, buy out smaller entities, which can help us drive both the, top line and bottom line. Second, new geography expansion, which is where I suppose Ascent acquisition will come into picture. The third one would be a completely new product line or a business line, where we haven't been. For example, our past acquisition of Hexagram is in that regard. We have a very active M&A, and a board orchestrated committee. So we continually look at it. At any point in time, we have 10 different assets we are looking at, and it could fall into any of those categories. Yes, it is possible that we can have more. But first and foremost, of course, we need to complete this transaction. As you know, it's a highly regulated business. We need a whole lot of regulators to clear this, and about at least a couple of quarters for integration and cultural alignment, so on and so forth. But along the way, we'll continue to evaluate more.
But it should get done, right? You have assurances. I mean, it'll be, the regulatory part of it, because it's a highly, very, very regulated industry and it's a foreign entity, but it'll get done. It's just a matter of time, right?
Yeah, we are very confident. There are no reasons why it should not.
Okay, all right. Srikanth, thank you very much. Good speaking with you. Appreciate you joining us here on CNBC-TV18. Good luck with that business. We'll take a quick commercial break here. Markets, of course, up about 300, 24,150 is where we read. Vikas Khemani with us on the other side. Stay tuned.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses?
Welcome back. Markets up 300 and it's good going all across. Banks, of course, leading. Vikas Khemani is with us, founder of Carnelian Asset Management and Advisors. Vikas, good afternoon. Welcome back. It's been a while and good block of time has passed since we chatted and so much has happened. But it's looking good after everything which has happened. Looking very, very constructive out there, at least in terms of price action. What's your view, Vikas? And what have we been doing over the last many months?
Good to always chat with you. So I think, we've been throughout this whole, chaotic period. We have said that continuously to our investors and reiterated again and again that India story is far from over. India is the least country, India is least impacted with what's happening globally. In fact, as the noise settles down, India will be neutral to positive. So net India will be beneficiary of this. The only thing is that when there is a chaotic news flow all around the globe, it's very natural to have that India might also fall. And which we saw, though India relatively fell lesser than most of the world, but it is impossible to not get impacted when there's so much noises around the world. And as I think more and more clarity is coming that India will negotiate out of this in a much better position, and US is also kind of retracting from that situation of making it very aggressive situation, which we've said always that there are rhetorics and there are realities. The reality is that US can't manufacture overnight, US can't stop consuming overnight. So where would they get it from? And if you have 140% tariffs, it's only going to be inflationary for you. So I think it's not sustainable. So if you just take the noise around and just think logically, this is how it had to pan out. But at the time of extreme volatility, obviously everybody gets spooked, and rightfully. I'm not, it's always kind of unnerving when this kind of environment is there. But investing is all about keeping your nerves and, cutting through the noise and, buying or investing, based on your long-term vision, conviction, and thought process. So we think that, the interest rate cut has just, in fact, much before this 2nd April move, RBI had pivoted towards, very easy monetary policy, growth-oriented policy, which was, a 3.5 lakh crore deficit got converted into 1,40,000 crore surplus. That itself was a very big move. That earlier deficit actually had an impact on the corporate earnings 2 quarters with 2 quarters lag. Obviously going to change the same situation back, with 2 quarters lag in the corporate earnings, and that's what we've been saying. That Indian corporate earnings will do well. I have no doubt in my mind, even in the current financial year. So if that's the case, then obviously you have to navigate. Nothing is going to impact the entire banking sector, whatever is happening in the US or anywhere else, right? So if that's the case, then why should one get worried and stay away? So that's been our thought process for quite some time, and we've remained invested through thick and thin. We've added weights to the sectors where we have kind of more bullish, such as banking and pharma and some manufacturing bit. So wherever you think that there's no long-term damage or long-term potential damage, we don't know. People wrote of IT. We never got worried about IT because it's only potential, worry. We don't know the real situation, what will pan out. So I think all these things have kind of played out well back.
So you're not worried about IT? Because companies are talking about projects which are being put on hold, paused, delayed, which will hurt growth.
I think we've remained, invested into IT. We've been of course, we've not been overweight. We've been kind of slightly underweight, not even majorly underweight. So we've had our names which we bought. And I think in IT last 2-3 years, people have been calling out for slowdown. It's not the recent phenomena. And despite that, most of our IT portfolio companies have done well. So I think, again, and secondly, if you see, if US Fed rate cut starts happening, with whether that will happen 6 months later, 12 months later, I don't know. But that will be again a great thing for IT. But in general, in my opinion, when economies struggle for efficiency, they can't cut down significantly on IT. So IT will grow between 5 to 10% of earning growth, but the valuations are also very attractive. And within that, you can look for companies which will grow faster. So again, it's not about painting the whole sector with the same brush. You've got to identify companies within that sector and which are kind of still growing well.
No, absolutely. Point taken. I mean, by the way, you have pretty sort of interesting holdings, right? I was looking at one of the funds, the fact sheet that you've sent across, Vikas. You got an interesting hospital company, but that's not there's Paytm you own. This is publicly sort of available information. You've got Interarc Building Products, a pretty diversified, varied kind of list. Anything you bought recently in the fall, or these are all long-term holdings which you've been sort of which you've had for a number of months now?
For now, and I must tell you that we haven't made any, except tweaking one or two changes, we have not made any change in our portfolio through this fall. Of course, when this kind of fall happens, you take a knock along with the market, no doubt about it. But we've also recovered back and much more than markets in the recovery as well. So, but all the names which you mentioned, their business model did not change at all because of the US situation. Their model is not going to change. Whatever is happening globally right now, right? All of them are domestically focused, either on the healthcare cycle of the country or on the capex cycle of the country or on the banking cycle of the country. So they're all India focused stories. Nothing changes around that. And if those companies were available at a better price, it was a great opportunity according to me, which we kept on communicating to our investors through our calls and to media.
After BFSI, the second biggest weight is pharma as a space, pharma, API, etc. So pretty bullish there, Vikas. And this, from what I see, you've got exposure to companies like Loris, Biocon, and a few others as well. Want to run us through the sort of logic, the rationale?
Sure, we've been very for long. Not now, almost a year and a half. For long, but even more so specifically in the last 1.5 years, since the early part of 2024, we've been very bullish on pharma and CDMO as a space. I remember buying Loris at around 300 rupees when I think most people were writing off that company, and we had conviction in that capability of the company, on the potential of the company, potential of the sector. And today, I think we have seen that stock, has done well and numbers are coming through. So I think, when you understand a company, when you believe in a management, you can take those opportunities as a entering points. And every company go through that up and down. So, and pharma, CDMO is structurally very, very long. We have said multiple times in our interaction as well with you that, it's 5-10 year opportunity. And, it's like where in some sense IT was in, mid 90s. I won't be surprised if many of these companies will be 5x, 10x from in fullness of time, because that's the kind of, tailwind you have in the sector. And so we've always positioned ourselves in that space very well. And so far we've done well on that. And we think that it's here to stay. And then, of course, like with everything else, it boils down to the company specific and specific management. It's not that every company and everything will do well in the sector as well.
The other domestic theme is consumption. So far, it's the premium luxury consumption which has done well. But now increasingly, there is a view that given the normal monsoon, this K-shaped recovery will broaden out. And some of the low-value consumption, whether it's in footwear, apparel, maybe two-wheelers, will also start seeing a recovery as the year progresses. Not just staples, but even some of the other low-value consumption stocks in areas. Would you concur with that view? And where do you stand on the consumption at the lower end?
Always believe that, see, we've never bought consumption much in last 5-7 years, except last 6-8 months, we bought some companies, but, again, there we don't have a lot of weight. We think that there's a lot of, overvaluation in the sector, given the kind of growth it offers. Of course, it boils down to the companies which are interesting, which can essentially, sort of capturing the premiumization space. and can grow 15-20%. But most companies are growing single digit and commanding at 50, 60, 10 price to earning multiple, which in my opinion doesn't make sense unless you get a feeling of or sense of accelerated growth in a particular company or sector. Then you kind of play. So we have had some small companies playing out, but in that. But there are also interesting companies we are monitoring. If we find risk reward is there, we'll buy that. But generally speaking, consumer discretionary still looks better than consumer staples. Given the fact that most staples are, not growing, and more importantly, we have said, Rima, that companies, I mean, it's not the consumption which has been slowing down. It is more, I think, that consumption patterns are changing. It's more that, newer incumbent players are getting challenged by the smaller, nimble, agile, innovative players sitting in different parts of the country in small towns are giving challenge to the larger incumbents. So it's not only demand in slowing down, it's probably, democratization of the market or large to small shift is happening in the space. And that, I think, is, in my opinion, market is ignoring, and it is assigning to the slowdown in the consumption. I don't think it's as much a slowdown in the consumption story. It is the changing industry pattern, changing consumer, consumption pattern. That is a lot more relevant, and hence one has to be very mindful of this fact while investing into the consumer stories.
Absolutely, and point taken, Vikas. Good conversation, good chat, and continue with the performance there. Thank you very much for joining us. It's a pleasure here on CNBC TV 18. Well, I think we're going to take a quick commercial break here. We'll come back, a quick check with Dealing Room. Nimesh joins us for that, and we'll get you some short-term ideas as well on the other side.
Honchos before putting your money on the line. How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV 18 and CNBC-TV18.com. CNBC TV 18's most comprehensive.
Welcome back. Holding on to pretty much all its gains. It's up more than 1% as we count down to the last 30 minutes of today's trading session. It's been a strong Monday. Nimesh is now joining in to get us all the D Street chatter. Nimesh, should we expect another strong FI buy figure?
Well, it looks like, Rima, that's the overall feedback that there is buying, and there is buying in banks, OMCs, as well as the MFI space as well. So that's from a flow perspective. But it's clearly the momentum from last week, which continues in today's market as well. The Nifty is about 24,000. The bank Nifty is at record high, up to what percent, another 2% gain. And now it is spreading into the broader market stocks as well. The broader market, the mid-cap index is up 2.5%, but a lot of individual names have started reacting and buzzing in the last couple of days, and today is clearly a day for the broader markets to outperform. So a lot of MFI stocks are doing good today. The small private banks are buzzing in trade, and a lot of buying as well from larger institutions. The three space, as I spoke about, private banks, especially the smaller private bank stocks now, MFIs and OMCs. These are the three pockets where there is buying from larger institutions. We've been talking about 23,800 as a big resistance. Now that will turn out to be a big support on the downside. So watch out for that levels on the downside. But looks like, given that about 24,000, 24,100, you could see a further short squeeze and a rally in the Nifty. So that's the overall feedback. But clearly, flow seems to be positive again in private bank stocks.
Okay, all right. Flow seems to be positive in private bank stocks. Nimesh, what are you picking up in terms of specific stocks?
Also, in terms of individual names, the first stock on my list is Shami Hotels. That's been buzzing in the last couple of days. You know, in the last 1 month itself, I guess the stock has rallied all the way from low of 140, 150 to 180 now, and the volumes have also picked up. In Shami, the buzz is that maybe you'll hear a corporate development very soon. A potential fundraising at an SPV level from a global sovereign funds. That's the buzz as far as Shami Hotel is concerned. So that's the first stock to watch out for. The second stock is IDFC First Bank. I've been covering for the last few weeks. It's come into my charter list few times. And even after the fundraise, you know, the stock has been outperforming largely on back of aggressive HNI buying. I understand one large HNI investor has been aggressively buying in the last couple of days, and hence a big up move with that name. So that's the second stock. The third couple of stocks where there is delivery-based buying today, Aditya Birla Capital and as well as ABB India. Both are unusual names to figure out in the list of large FI buying in today's markets. Expect high delivery volumes on both the stocks today. And on the flip side, while Bandhan Bank is up today 5%, there is selling is what I understand. So delivery-based selling in Bandhan Bank, and also there is delivery-based selling happening in Max Health for the last few days. So especially in Max Health, the feedback is one large FI long-only fund is an aggressive seller, hence you'll see delivery-based selling in those two names today.
Well, interesting list of names as always, and Sami, we'll keep an eye out, Nimesh, as you pointed out. Stocks up about 25% over the last 1 month or so. And actually, it's come up very, very quickly. And as Nimesh points out, maybe a corporate development soon here. Mitesh is now joining in with what to buy or sell today for a reverse trade tomorrow. Mitesh, what do you have?
Yeah. Prashant, the BTST on its side with a stop at 380 for targets of 388, and Federal Bank, that's the BTST with a stop at 200.5 and a target of 205.
Thank you. So let's now go across to Abhishek, and he's here with a snapshot of how the large banks so far have performed in Q4. Abhishek.
Well, the banking sector, which saw some numbers coming in for Q4 FY25 over the weekend, actually surprised positively given the fact that deposit growth was seen over there. And despite that, you saw net interest margin improve. The interest rate have started to decline from Feb of 25 onwards, wherein we saw RBI cut rates, and hence the interest rates started coming down a bit. However, the surprise has come in from growth in deposits, which has come in at a lower cost in Q4 FY25. So all lenders who reported numbers over the weekend have seen interest expenses growth on a sequential basis being lower than that of the deposit growth. Take a look at SDFC Bank, 5.9%, ICICI Bank, 5.9% growth, Yes Bank, 2.6% deposit growth, but their interest expense growth is very low, which is a heartening factor to see. In fact, Yes Bank saw interest expense decline by 4.7% on a sequential basis. Now, some part of it has to do with low-cost deposit accretion. Over the last few years, what we have been seeing is that the banks have actually lost out on CASA ratio, and this is perhaps the first time that we are seeing momentum coming back in the CASA ratio for the banking sector. So sequentially, you saw improvement in CASA ratio of all these banks despite strong deposit growth. So this has actually helped the NIM of the lenders to improve on a sequential basis, while expectations were there that, high cost of funds will actually result in NIM decline on a sequential basis. Even if you remove one-offs in SDFC Bank or ICICI Bank, the net interest margin has actually remained healthy or improved on a sequential basis. Now, NIM were also led by the fact that quarterly annualized slippage ratio declined for most of the lenders on a sequential basis. Hence, their asset quality saw massive improvement on a sequential basis, with the likes of, best in 10 years or even more reported by ICICI Bank on their asset quality front. As a result of improvement in NIM as well as lower credit costs, the return ratios of the lenders saw improvement. ICICI Bank, for example, a 2.5% plus quarterly annualized, ROA is one of the highest that they have ever reported. Take a look at the valuation picture. Valuation is always driven by return ratios improvement, and we are seeing that large private banks like SDFC Bank, ICICI Bank and Axis Bank are trading at a price to book value anywhere between 2.6 to 2.8 times. SBI is trading at a price to book value of 1.5 times. X of SBI, PSU banks are largely trading in the price to book value range of 0.8 to 0.9 times. IndusInd Bank, amongst the private counterparts, is the cheapest bank trading on bourses today. Back to you.
Thank you very much for that. So far, the picture is pretty. NIM's improvement, asset quality looking better. By the way, the street seems to have liked the KFin Tech management speak. The stock has moved up close to about 8.5%. It was higher since morning, but it's seen a spike after the management said that the total payout would be at max $170 million. It will be EPS accretive from year one. And with this acquisition, the contribution of overseas revenues will rise to 25%, but they want to further increase it to 50% in the next 5 to 7 years. KFin Tech up 8%, 9% now. Let's focus on the City Gas Distribution Company. The government is taking measures for sustained allocation of affordable gas. Sudarshan is here with the details.
So government over the weekend has made some changes to domestic gas allocation for city gas companies, and it includes both APM, that is administered price mechanism gas, as well as new well gas. So in the first, it says that now the allocation would be done in advance, basically in 2 quarter advance. These city gas companies would know exactly how much gas, both APM as well as new well gas, they will be getting. And second, this domestic gas would include both APM and new NWG, and new well gas now would be done or allocated on pro rata basis. So as of now, it used to be allocated as per auction. Now it would be allocated as per pro rata. Pro rata means it would be allocated as per the demand. If IGL has more demand than MGL, then IGL would be getting more gas than MGL. And in third, it has given the allocation ratios of the last few quarters. Government says in Q3 FY25, the allocation ratio was 54.7%. In Q1 FY26, also it says it's 55.7%. And Q2 FY26, it projects that ratio would be around 54.74%. So basically, giving the allocation ratio, government is saying that there has not been much change in the allocation in the last few quarters. But mind it, this includes both APM as well as new well gas, and that's the reason you are not seeing major changes in the allocation ratio. As per the communication that we have received from major city gas companies like IGL and MGL, APM gas allocation has reduced, and now currently it's in the range of 37 to 38%. And as far as new well gas is concerned, its allocation is in the range of 17 to 18%. And the price of new well gas is at least 20% higher than APM. That was the reason when government had decided to reduce the allocation of APM gas to city gas companies. It had raised certain concerns among city gas companies, and also even all these brokerages had raised concerns. Now, this what exactly analysts believe? They believe that apart from this detail that government has given about the allocation, this softer crude and LNG prices that they are going to, they expect that it will remain soft, not only in the near term, but even in the medium term, say over 12 to 18 months. And this is going to aid the margin of all the city gas companies. And as far as the government action is done, now the announcement of like in 2 quarter advance, all these city gas companies would know exactly how much volumes they will get. At least it will help them knowing that, okay, these are the volumes they are going to get for the next 2 quarters, and they can plan the volume accordingly. So overall, it's positive for city gas company, and that's the reason you are seeing big move.
Absolutely. So thank you very much for that. Very, very interesting story there. We're going to welcome in Anand Tandon now, who's... Okay, I think let's just focus on GAIL as well, which we're going to sort of talk about. So the natural gas regulator, PNGRB, has floated a consultation paper for review of natural gas pipeline tariffs. Sudarshan is here with details on this one and what the street is making of the development. So back to you.
So over the weekend, this regulatory body, that is PNGRB, has floated draft paper for the review of the tariff, and this would be for the pipelines of GAIL. So overall, GAIL has 10 pipelines, and on the draft paper, stakeholder has to reply to GAIL by 1st of May, and GAIL has to reply back to PNGRB by 15th of May, and post that PNGRB will hold open market open house discussion, and after that, in the board meeting, it will decide that if tariff has to be increased. As far as GAIL's proposal is concerned, it had proposed an increase up to rupees 78 per MMBTU, and after certain queries from PNGRB, that price was reduced to rupees 77.43. Last month, we had a conversation with GAIL in which company had said that, yes, it had proposed for increase up to rupees 78, but even if PNGRB approves hike up to rupees 70 per MMBTU, it should be taken positive by the investor as well as brokerages. And also today, CLSA has come out with a note. It has upgraded GAIL to outperform from whole, and target is increased to rupees 210 from rupees 175 per share, because it believes that tariff hike can come in the range of 20 to 25%. Also, it has increased EPS estimates in the range of 9 to 19%, because it believes that it's the start of the review process, which raises the confidence that in the next or upcoming board meeting that PNGRB will have in June, there is a likelihood that the range of 20 to 25% tariff hike can be seen.
All right. So thank you very much for that. Anand Tandon is now with us with what he's making of things. Anand, good afternoon. Good-looking screen. Can't argue with price action, can we?
No, absolutely. It's been a stellar rally, and the fact that it's gone up beyond where the whole thing started before Mr. Trump announced his tariffs, it just shows that the market is more sanguine than one had expected, actually.
More coming, you think?
Well, right now there is no sign of nervousness here. So obviously, you have to play with the trend. But frankly speaking, you're back to having concerns about valuations, isn't it? Because whatever correction you had seen, which had kind of moderated the valuations a little bit, had also dropped down earnings estimates. And now those earning estimates remain low, because if you look at all the numbers that are coming through, and the ones that are likely to come, the advanced tax figures for the last quarter have not been good. The economic cycle is clearly on the way down. You cannot have a situation, even assuming that the tariffs were to be rescinded for the most part. It is very unlikely that it will go back to zero on China. And if the two largest economies in the world were to slow down because of mutual tariffs, it cannot but affect the rest of the economies as well. So you are still looking at a market which has again gone back to slightly higher pricing than you would be comfortable with. The only caveat is that maybe the interest rates will come down a little bit more, and therefore, there may be a bit more sustenance in terms of a slightly higher P.
Yeah, absolutely. Let's just listen on to the financial space is doing very, very well. My colleague Lata spoke with veteran banker KV Kamath, listening to a slice of the conversation. We'll take a quick commercial break here. Back with Anand on the other side.
Challenge that banks will face, are facing and will face, is cost-to-income ratio. So unless you disrupt that cost-to-income ratio to 1/4 of what it is today, you won't survive. 1/4. I'm saying if you cannot operate, you will have to be well below the 35-40% people are.
No, ICICI and HDFC
And some people are higher than that. Banks, I think, as they evolve, the larger and larger part will be to the retail sector, because they are, as of now, best equipped, unless they're disrupted by a fintech. The corporates, large part of the corporate universe today, are cash positive. The cash flows are positive and can meet most of their growth needs. At the margin, they may have to borrow. Large part of infrastructure funding will come through a market process, which is outside the banking system. It's already happening.
Award-winning news show India Business Hour drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
whatever impact we have seen in terms of F&O order. On month-on-month basis, I am seeing a growth of around 6 to 7% now for this past 2 months. So that gives a broad sense that, okay, retail are coming back. See, for retail, there was no reason for them to come back because markets were depressed. They did not see any opportunity and they were not in a hurry to really jump and decide that what kind of an instrument they had to buy, if at all not options. So what I am saying, after this kind of stabilization in terms of our news that are coming and the FIs inflows that are coming in, it appears that retail is getting back confidence to come.
Welcome back. All gains intact as we wind down to today's trading session. Anand Tandon is now with us for the last leg. Anand, thank you for joining in. First, coming on Tata Elxsi, it was a disappointing set of numbers. Stock is up 9-10%. What explains that?
Yes, the management has talked up the stock price by being very bullish. The reality is, of course, that so far the numbers for the last quarter have been a bit of a disappointment. And it is quite likely that given some of the exposure that the company has, the areas it operates in, especially autos and so on, and media, those are both sectors which are likely to be disturbed quite a bit for a while because of a suspension of discretionary spend in their target markets. So I would be very surprised to see a huge pickup from there. And I think most analysts are not really buying up the whole story. But clearly, at this time, the market is a little more bullish than most analysts are.
You were surprised with the Infi stock reaction today? Or you think, day on day, it's very hard to tell, of course, which way things will go. But the numbers were subpar, right?
Well, see, the industry is growing at 4-5%. It's not likely to do more than that for the next year. The stocks are trading at 20%, 20 times plus. So, if you're willing to buy stocks which grow at 4% at a PEG of 4 times, well, good luck, because, the likelihood that you'll get a positive surprise from here is somewhat remote to my mind, even if you assume a kind of back to normal kind of situation. The reality is that the innovations in the technology sector have been such that services themselves will be under some pressure going forward, especially in terms of the lower-end coding jobs, which many of the companies continue to do.
There's a rub-off impact on many of the banks after what ICICI Bank and HDFC Bank delivered, and it just... the tide seems to be turning now on the regulatory front. There's abundant liquidity, rate cuts are coming. Would you be buying any of the banking names, mid, small caps, microfinance lenders, any NBFCs on your radar to buy at these levels?
So I still think, we've been bullish on banks, especially for a long time now, especially when it was not so popular in the market. And I think overall one continues to be, though a large part of that action has already happened. There is no doubt that, the companies have, especially HDFC, for example, has now turned the corner and probably from the next year onwards will start to show an increased growth rate on the top line. One of the concerns has been the slow loan growth, largely because of the fact that they are constrained for capital and the deposit. So now their CDR is now less than 100%, and therefore they are in a position to grow. And I would imagine at least a 10% growth for them next year. Many of the stocks have already gone up quite a bit, but even then, on a historic basis, they are still trading at, around between 1.9 to 2.5 times price to book, which for a company which can potentially generate somewhere around 17-18% or maybe even 20% if your fee income is good, kind of figures for ROE is kind of justifiable. So I think there is still some space to go in terms of the frontline banks, especially those where the deposit franchise is strong. And not so much for the NBFCs. I think NBFCs, I think the likelihood of severe interest rate cut is being overplayed again. There are limits to how much we can cut. Liquidity is good only because of the fact that, your demand has come down again. Loan growth has fallen from 16% to 11% now. So you're again back to having a slower loan growth. And I don't see any reason why you should expect to see a sharp increase in the consumer side lending. If it will, then it will actually lead to greater NPAs as well. So net, I think a good private sector bank in the front line or an SBI kind of large public sector bank is still the best way to play the sector.
Stay with us, Anand. Just wrapping up things and we'll come back to you. So, of course, I mean, good day. Nifty Bank making a new all-time high. And the Nifty, of course, past 24,100. Mid-caps and small-caps starting the week with a bang, 2.5% each. And IT was, of course, I mean, in a way, one of the sectors of the day. And the other one was capital markets, but much smaller space, of course, compared to what IT did. Tech Mahindra, HCL Tech were the two large IT names in the Nifty which stood out. Trent did well. IndusInd Bank, another 4% after last 3 days, 15%. But there were a few others as well. Nothing very much. Adani Ports was down a little bit. HDFC Life and Lever, maybe. That's it. The three stocks which were down. And of course, I mean, we've been talking about capital marketplace, Nippon India, BSC, HDFC, AMC, K Fintech, Angel One. So lots of action in that part of the market.
Well, the Nifty is closing above 24,100. The bell is gone and the final tick on the Nifty is 24,120, a gain of about 270 points. Sensex advancing by 800 points. The mid-cap index has soared nearly 1,400 points, a 2.5% up move, so outperforming with a very strong advance decline ratio. The only sector in the red is the FMCG index, with Britannia, ITC, HUL, Asian Paints down close to 1%. Adani Ports, HDFC Life post numbers also a bit subdued. Well, that brings us to a close on Closing Bell. Thank you for watching, but don't go anywhere. On the other side is Markets Forward.
FY26 this year would be a year of consolidation where we would be focusing more on getting back to OPM, and the growth is going to help. So currently we are not working on what kind of top line we will achieve because it's a function of market condition, lots of things. Internally, what we can do is that, okay, how do we bring in AI tool, get more cost efficiency, and how do we bring in more customer on our platform? So result of that, whatever revenue we are going to get, it is very difficult to predict at this point in time. But what we are confident is that we would be able to bounce back to an OPM of 40-45% by Q4 FY26.
Howard is a joke, teaches hate and stupidity and should no longer receive federal funds. These are the words of America's most powerful man, who's going after America's most prestigious, richest and the oldest university. I'm talking...
Markets extend gains for the fourth consecutive session. Sensex traded over 79,300 levels. Nifty holds on to 24,100. Nifty Bank makes an all-time high. Small cap, mid cap stocks charge ahead. FMCG stocks were the only laggards.
Bank Nifty hits a new milestone after it crosses 55,000. This is after stocks of private heavyweights HDFC Bank, ICICI Bank powered up in trade after beating profit estimates in Q4.
Nifty IT index powers up in trade. This after Infosys raised their FY26 guidance in addition to valuation comfort provided by analysts. Coforge, Emphasis, Tech Mahindra were the top IT gainers after surging over 4% in trade.
US Vice President J.D. Vance is in India for a 4-day visit. This is his first official visit to India since assuming office. He's set to meet Prime Minister Narendra Modi and other top officials before heading to Jaipur and Agra.
Okay, well, super start once again to the market. I mean, we left off on a high last Thursday, went into the weekend, and we've come back and picked up exactly where things left off. So, super day. Can't complain. I think mid caps, small caps, everything really doing very well. Reema, even IT.
Even IT and all advancing now for the 5th day in a row. So very strong momentum seen in our market. But how would you classify today's trading session?
I think new highs for the Nifty Bank. And the Nifty, of course, is still far away. So that's still got some work to do. Remember, I mean, to be fair, the Bank Nifty fell far less as compared to the Nifty. When you see this correction, from the highs late September last year to the lows that we had in March. And of course, I mean, the Nifty fell more. So a little bit more work to do for the Nifty. But the Nifty Bank is right there in terms of where it came off from. And of course, I mean, I think today's FI number perhaps also important because last 3-4 days, we've seen some 15,000 crores worth of buying from FII. So it's a chunky, large number. Looks like FPIs, FIs are stomping back in a hurry, rebuilding positions which they sold out of. And of course, I mean, what's coming is only a fraction of what they sold over the last 7-8 months now. So it's just a function of that. We'll have to see. Of course, local flows, etc., remain pretty steady as well. Mid and small caps, they kind of lagged a little bit last week, what Frontlines did, but 2.5% each on those two indices today to start the week. I think cannot complain at all. IT was a bit of a surprise, but I guess what was playing out here is sell the rumor and buy the news. The news was bad, but I guess, it happens. And the other smaller space was the entire capital market space. So just completely abuzz with activity. Exchanges, brokers, wealth management firms, and so on and so forth. Reema.
The market cap of all BSE-listed companies has now crossed the $5 trillion mark with today's advance. Let's tell our viewers what we've lined up for you on our show today. We start with the top movers and shakers with Vivek. Several stocks in focus today. So banks, names like HDFC Bank, ICICI Bank, Yes Bank, all posting the Q4 numbers and looking good. IT stocks higher despite subdued numbers. We'll get you more on that. And finally, we'll delve into the key market events to watch tomorrow. But top of the show, let's get an update on all the stock movers. Vivek is now joining in. He's at the wall. Vivek.
Well, thank you so much for that. Well, another session where you actually struggle to find losers. Advanced decline ratio very, very strong. Very good set of, especially as far as the broad end of the market, the advanced decline ratio, the market breadth was very, very good. What did very well? Of course, like you mentioned at the start of the show, the entire IT pack, especially some of the mid-cap IT names, some of the beaten down names, they were the ones that saw the maximum amount of buying today. Infosys rebounded quite sharply after a muted set of numbers. But have a look at the mid-cap names, Tata Elxsi, Emphasis, TechMahindra, all of these stocks doing very well in this session. The other stock that did quite well, in fact, one of the top gainers today was Divi's Labs. Well, a very large contract that the company has gone ahead and signed with a global pharma major. Citi estimates that this could be be the GLP-1 opportunity that the company has tied up with Eli Lilly, and Divi's Labs is the stock that we're talking about, one of the top gainers today. The other stock that did quite well was GAIL India. Remember, PNGRB has gone ahead and floated a consultation paper for tariff review for natural gas pipelines. Analysts estimate significant upside in case the revised tariff, which is a significant revision and an upward revision of almost 32% is what GAIL has gone ahead and asked for. The other set of stocks that did quite well was the entire banking pack. You alluded to some of the large cap names, but have a look at some of the smaller banking names. AU Small Finance Bank 7% higher today. IDFC First Bank built onto the gains of Friday post the news. IndusInd, Axis Federal, all of these stocks doing very well in the session today. From the broad end of the markets, one stock that reacted very positively to its results was Just Dial. Better collections this time around. Stock ended higher by over 11%. On the other side, very few laggards today, but HDFC Life, the company at the conference call, alluded to a softer H1 FY26. Stocks saw a bit of selling pressure, 1% lower today. And FMCG pack today, especially in the last hour of the session, saw intensified selling pressure. Marico, Godrej Consumer, all of these stocks ended lower by around 2% today.
Okay, thank you very much for that. Let's invite our guest on the show. Anand Tandon is still with us, and Jay Thakkar of ICICI Securities now joins in. Jay, after this kind of an up move, swift and powerful over the last 5 trading sessions, how do you expect the near term, the next few days to pan out? Do you think there is more in store for us in terms of gains?
Hi, good afternoon to you, Rima and Prashant. Well, see, we have seen a very smart recovery in the index, and what's really important to see is that Nifty today has surpasses 200 DMA as well. I mean, we had seen Nifty, providing a death crossover, a few months back, which means that the overall trend in the market is negative. But then, the kind of recovery which we have seen, one by one, Nifty has managed to take off its crucial resistance level, maybe even 22,800, followed by 23,800, and now even 24,000 and above. I mean, that's 200 DMA. So I think that going forward, yes, 23,000 now is a very crucial support. I mean, that is where we have this VWAP level as well. And, that's the positional reversal level for Nifty, and positionally till 23,000 levels are healthy, trend is positive. In the immediate basis, I think that 24,200 to 50 range on the upside may act as a resistance at least until the monthly expiry. I mean, if Nifty manages to surpass 24,250, then yes, we might even see the rally extending till 24,500. Otherwise, more or less, we have seen this rally coming on account of, great support from the BFSI segment, which contributes more than 40-45% in the index. So we have seen that happening already. Now, the 3 sectors are pending, 3 to 4 sectors, Rima. I would say one is auto, second is IT, FMCG and metals. I mean, these are the 4 sectors which contribute to almost like 30-35% of the Nifty are underperforming the market. So if at all there is a pause in the BFSI, and if we see a bounce back coming in these 4 sectors, then Nifty might stabilize and bounce back. Otherwise, we might see some consolidation from here on, because Bank Nifty has already extended its gains and gone up to 55,000 plus levels. And I think that monthly expiry 56,000 should be the max, wherein Bank Nifty can stretch. I'm not looking beyond 56,000. So, but then the trend is positive, definitely, and the broader markets, the breadth is very positive. So the broader markets are also likely to perform. I mean, they've just provided a breakout today. So any dips won't be sustained at the lower levels, is what I mean to say. So buying on dips should be the good strategy going forward.
Broader market, which index has seen a breakout, Jay?
I mean, see, the mid and small cap indices have already given a breakout today only. I mean, technically, if we see, Prashant, then the kind of lower tops and lower bottom which were forming, the previous high has just been taken off in today's session. So that has confirmed the final reversal from down to up today. Hence, broader markets and capital market segment, I mean, which you also mentioned right at the start of the show, I mean, that's performed really well today, and I think that is likely to perform going ahead as well. I mean, the BSE, where we had seen maximum shorts getting built up due to a couple of negative news in the sector, which got thereafter rolled back, and we have seen good short covering happening there. And above 6,000, I mean, there has been massive call unwinding. So BSE is one stock, and along with that, CAM, CDSL, all of these stocks are looking at, even for that matter, MCX are seeing or witnessing good short covering. So I think that is one sector from the broader markets which I think is likely to perform going forward.
Okay, all right. Got that. So broader market also seeing a breakout. I mean, if there's a breakout, there's a long way to go here in this part of the market, the broader markets, that is. Let's just address BFSI, right, which Jay was also talking about. Banks continue to power higher. Abhishek is here with just, the big earnings that we got over the weekend. Abhishek.
Well, to begin with, the surprising factor in banking results over the weekend was the movement in net interest margin, which was expected to come down, but it has actually improved despite the fact that we have seen a robust deposit momentum for some of the lenders. So interest rates have started to decline from Feb of 25 onwards by RBI. However, the surprise factor has come in from growth in deposits, which has come in at lower cost for the banks. So if you take a look, all the lenders who have reported numbers, that is SDFC Bank, ICICI Bank, as well as Yes Bank, they have seen their interest expense grow way lower than the overall deposit growth in their banks, respectively, on a sequential basis, that is quarter on quarter. Take a look, SDFC Bank and ICICI Bank having grown their deposit base by 5.9% and Yes Bank by 2.6%. However, the interest expense has grown at a very marginal rate for SDFC Bank at 0.1%, ICICI Bank at 1.5%. In fact, Yes Bank has seen a decline in their interest expenses by 4.7%. So some part of it has to do with the fact that after a long time, low-cost deposit share or the CASA ratio for these banks have actually improved. So SDFC Bank, ICICI Bank and Yes Bank, all of them have seen improvement in their CASA ratio, which has actually aided in controlling their cost of funds. So this has also helped the net interest margin of the lenders to improve on a sequential basis, while the expectation was that, high interest rate, high cost deposits will actually, impact their net interest margin on negative side. So if you remove the one-offs also from SDFC Bank as well as ICICI Bank, the net interest margin has actually held up really well for them on a sequential basis. Now, net interest margin was also led by the fact that quarterly annualized slippage ratio has improved for all the lenders. Hence, their asset quality also saw an improvement on a sequential basis, which has actually helped the yield to remain at better levels than expectations. As a result, there was improvement in net interest margin, and in fact the impact was a lower credit cost on a sequential basis. These two factors help the return ratios improve for all these lenders on a sequential basis. ICICI Bank, if you take a look, the 2.5% ROA quarterly that you are seeing for them in Q4 FY25 is the highest ever quarterly ROA that they have recorded. So for banking sector, the valuations do come in from return ratios improvement. So large banks like SDFC Bank, ICICI Bank and Kotak Mahindra Bank are trading at a price to book value 1 year forward basis between 2.6 to 2.8 times. SBI is trading at a price to book value of 1.5 times. X of SBI, the PSU banks are largely trading at a book value, price to book value of 0.8 to 0.9 times. IndusInd Bank is the cheapest private sector bank amongst the large caps. Back to you.
Thank you very much for that. We should just continue to keep that valuation played. Anand, in the large private sector banks, Abhishek was just pointing out that how Axis Bank is the cheapest. Would you have a preference for Axis Bank? And between ICICI and HDFC Bank, one of the analysts we were chatting with earlier said that HDFC Bank might start outperforming given its recent underperformance compared to ICICI Bank.
Axis has been delivering good numbers. ICICI has actually performed in a sterling manner. Their quality of asset has increased. Their loan book is growing probably almost close to 3 times what HDFC is able to do because of their lack of deposit catch-up. But, as I mentioned a while back, in HDFC, you should expect to see the loan book now increasing in double digits. And going forward, given the fact that their credit to deposit ratio has now come down to more manageable levels, you should be able to see at least them being able to maintain over the next 2 or 3 years growth rate, which is at par with the industry, if not slightly higher. And therefore, I wouldn't be so very surprised if we actually were to see on an incremental basis the stock price, which has not done that much, actually catch up and perhaps outperform the peers in the near term.
The IT space, of course, also saw action today. Infy started higher, stayed up, actually. Came off a little bit from the day's high into the close, but Tata Elxsi, big move today. Rima, this is the rumor was that it was going to be bad. It was bad, and
it's very bad.
Stocks moved up.
Indeed, it was bad, 5% plus in terms of a revenue decline. Margins fell sharply from 26% plus, it came down to sub 23%, yet the stock closed up well. Okay, before we get to Tata Elxsi, let's talk about Infosys. Now, again, Infosys also, Q4 was a miss, especially on the top line, revenues contracted. The margin guidance at 0 to 3% was lower than expectations. Yet, analysts believe that the fact that one, they gave a guidance, and two, the guidance was not as bad as the worst case scenario. This 1 to 4% that the analysts had put out was towards the end of March, early part of April. But since then, the macro uncertainty increased. Then you had TCS miss, then Wipro come out with a muted guidance for Q1. And therefore, the street started fearing that what if Infi doesn't give you a guidance? Or if they do, what if it's a negative guidance? So compared to that, it's not as bad as what analysts are pointing out, both JP Morgan and Citi. And broadly, still amongst the large cap large IT heavyweights, many brokerages believe Infi is your top pick. So that's on Infosys, and the stock closed up with a gain of more than 2.5%. Tata Elxsi was a surprise up, gainer today, because here the numbers were sharply lower on revenues and margins. Profits were down 13-14% quarter on quarter. But the management in the conference call sounded positive. They thought things will they believe things will stabilize in Q1. The deal wins are strong even in Q4. They won a large deal win in media and communication and in the automotive vertical, and that will help the company grow in FY26 and perhaps better than FY25. So this commentary supported the stock. And finally, the third big mover was Just Dial, and the stock ended with a gain of more than 10%. And here, let me quickly tell you three reasons. One, collections were strong, an improvement in collections to more than 11%. Two, cash in the books at 60% of the market capitalization provides a downside support. And three, the company has managed to improve their margins significantly in FY25 by 860 basis points. So all the three numbers that came out, stocks closed up in the green.
Well, it's a good day to be in that space. But of course, this comes after a fair bit of pain. Will the gains last is the question. The other area, city gas distribution companies, stocks were buzzing. But again, they've been up and down and all over the place, actually. MGL, IGL, etc. Sustained allocation of affordable gas. So it is here with details on what went on.
So government has made certain allocations of domestic gas to these city gas companies, and the first one is that the allocation of domestic gas that would include both APM, that is administered price mechanism, and new well gas. Now it would be done 2 quarters in advance so that all the city gas companies would know exactly how much volumes they would have for the next 2 quarters. And the second is the allocation of NWG or new well gas will be done on pro rata basis. As of now, it used to be done via auction. Now the pro rata basis will help basically these companies would know that exactly it would get the gas as per the demand. If IGL has more demand, it would get more gas than other companies. And last is company has given the allocation ratios of last few quarters. In Q3 FY25, government says the allocation ratio was 54.7%. In Q1 of FY26, it's saying it's around 55.7%. And in Q2 FY26, it's expecting that it would be around 54.74%. But it includes both APM as well as new well gas, because the communication we received from major gas companies like IGL and MGL, APM gas allocation has reduced to around 37 to 38%, while for new well gas, the allocation is around 17 to 18%. So going forward, analysts believe that the allocation of affordable gas, basically APM, that's only going to go decline. But what is the one positive thing? Recently, we have seen that crude oil has fallen. So crude oil and LNG prices, analysts believe that not only in the near term, even on the longer term, say for 12 to 18 months, these prices are going to remain soft, and that is going to help or aid the margin of these city gas companies. So factoring both the announcements, you have seen major uptick in all the city gas companies. Those stocks were up in the range of 3 to 4%.
Sudarshan, what about GAIL? Closed up with a gain of 4.5%.
That's correct. So over the weekend, we have seen that regulatory body, that is PNGRB, has floated the draft paper related to tariff review for the 10 gas pipelines. GAIL has 10 pipelines. So now tariff is going to be reviewed, and in all probability, the tariff is going to be increased. Now on the draft paper, all the concerned stakeholders have to reply to GAIL by 1st of May, and GAIL has to reply to PNGRB by May 15th. So what was GAIL's submission? In the first, when GAIL had written to PNGRB, it had sought for tariff to be increased to rupees 78 per MMBTU, but after certain queries from PNGRB, that was reduced a bit to rupees 77.43 or 0.45 per MMBTU. And last month, we had a conversation with GAIL in which management had said, even if the hike is approved up to rupees 70 per MMBTU, it should be taken positively. And today, CLSA also has come out with a note on GAIL. It has upgraded the stock to outperform from whole, and target is increased to rupees 210 from 175 per share, because it believes that tariff hike is going to come, and it's likely to be in the range of 20 to 25%. Also, it has increased EPS estimates in the range of 9 to 19%. So if tariff hike comes, it's going to be positive for GAIL because it has been long pending.
Absolutely. So thank you very much for that. Anand, any interest? The city gas companies or GAIL?
Well, city gas is right now not in a great place. I mean, clearly, the government imperative is to increase gas availability for things like urea. And therefore, despite the fact that gas prices are probably at a multi-decade low, you are actually having to reallocate how much is available for city gas and how much for other things so that your subsidy bill can come down. Basically, you also have to incentivize the new well generation. Otherwise, that's not going to be particularly viable. So it's a kind of balancing act that the government is playing. I think if you are looking at this area, then GAIL is clearly going to be a winner, because whatever kind of increase happens, at least that increases their net revenue. For the others, it's a pass-through, but the pass-through will make the growth a little slower if the price increases are fairly high.
Jay, quickly, you want to just highlight, your top trades? Doesn't have to be from whatever you like.
Sure, Prashant. I mean, I think that, as I said, the capital market segment looks positive, but along with that, the PSU banking pack has just, provided a fresh breakout. I mean, earlier it started all with the private sector banks, but since past two trading sessions, I would say, Prashant, has been the PSU banking pack that's contributing quite a lot. So among which I think, Canara Bank from here on has seen a good derivatives build up on the long side. And I think that can be focused for the remaining part of the series, or maybe, into the coming series of May. It's trading around the levels of 99, and I think it's heading towards the levels of 110. So at least 10% move from here on can't be ruled out. And definitely I've got a buy recommendation on Bombay Stock Exchange BSE on back of short covering, and I'm expecting 6,500 to 6,700 levels going forward. I think 6,100 to 6,150 range should act as a very crucial support. So although it was up by 6%, but still I believe there's got some more room still pending on the upside.
Gentlemen, thank you for joining in. We'll slip into a break and come back.
Donald Trump. The US government has now threatened to ban Howard University from enrolling foreign students after the university said it will not surrender its independence. What does it mean? Let's understand the controversy in detail. Now, the US Department of Homeland Security, or DHS, has threatened to revoke Howard University's certification to enroll international students. This comes after the Trump administration decided to freeze over $2 billion in federal funding and cancel $2.7 million in DHS grants. Now, why is Trump going after Howard? Well, he has accused the university of allowing anti-Semitism and promoting ideological bias against Jewish students. Remember those protests that happened across most universities in the US last year in the wake of
Welcome back. Let's now get to the voices that we heard during the day. First up, shares of Angel One surged in trade despite a weak set of fourth quarter numbers. The management told us that FY26 is going to be a year of consolidation, and they're confident that the operating profit margin or the operating margins for the company will bounce back to levels of 44-45% by Q4 of FY26. Okay, next up, it's JSW Energy. The power company is currently operating at a capacity of 12.2 gigawatts, and there is an order pipeline of 18 gigawatts. The management revealed it will soon reveal its capex plan. That's not all. It's in advanced stages of commissioning India's largest green hydrogen project in Q1 of FY26, which will generate 3,800 tons of green hydrogen.
Okay, we also had the management of Inox GFL Group. The management basically blamed the Chinese players of dumping C-grade products in the wind category in the country. The draft policy for localization of wind turbines in India, according to them, is a big positive for the local sector. They went on to add that since all components don't come from India, it's not difficult to keep 80 to 85% of supply chain local for the company. K Fintech was another management we spoke with. They've guided to get about 50% of their overall revenues from the international side, from outside of India in the next 5 to 7 years. Remember, they just announced an acquisition of Ascent Fund Management. They've bought 51%. They're going to buy the rest of the 49% by 2030.
And before we wrap, let's get you the key market events to watch out for. Vinny is now joining in.
Hi, so important events to watch out for on the global front. Not much in terms of macro data point, but in the Eurozone, we'll be keeping an eye out on the consumer confidence data. Global earnings, Tesla will be reporting their numbers, SAP as well as General Electric will report their numbers tomorrow. Domestic cues, earnings that we're keeping an eye out in terms of Q4. Nifty, we'll watch out for HCL Tech. Other than that, M&M Financials, signed DLM, Havells, Tata Communications, I beg your pardon. Delta Corp, AU Small Finance are some of the companies that will be reporting their numbers tomorrow. Corporate action, keep an eye out on 361 WAM. Fundraising plans, they'll be considering a proposal for issuing some equity shares or warrants. So that is something to watch out for. Other events, RBI is conducting that OMO that has been going on. Now, this is the third tranche of that OMO of 80,000 crores. So 20,000 crores is what they're looking to raise as well. IMF meeting tomorrow. World Economic Outlook is what they'll be giving as well as a press meeting. And US Vice President is here. So any updates on that front is something that we'll watch out for.
All right, Vinny, thank you very much for that. It's a wrap on this edition of Markets Forward. We'll be back with more news and updates after a quick break.
Gaza last year. Now, many students protested at Howard too. Now, what does Trump want? The White House has demanded that the oldest university in the US make changes to hiring, admissions and teaching practices, which it says will help fight anti-Semitism on the campus. The US Department of Homeland Security has demanded detailed records by April 30th, 2025 on visa-holding students' involvement in those protests, disciplinary action taken by the university or any perceived threat to campus safety. Yes, that is the deadline. And what if Howard doesn't listen to the government? Well, then that would result in the loss of Howard University's Student in Exchange Visitor Program certification, which will effectively bar the university from admitting new international students. Howard is the first university in the US to push back against Trump's threat, and the consequences are for everyone to see. The American government has identified 60 universities for review. Last month, Columbia University agreed to many of the administration's demands in the wake of the protests after the government cut $400 million in funding. Let's look at some numbers here. International students make up more than 27% of Howard's enrollment this year. Overall, 6,000 students. How will it impact Indian students? Well, Indians constitute a significant portion of Howard's international cohort. In 2020, approximately 213,062 Indian students studied in the US, with 505 enrolled at Howard alone. Now, getting an admission is not easy there, but this move could further dent many students' aspirations. And what is happening in present is not good news for many Indian students. Reports indicate that Indian students across US universities are experiencing anxiety over sudden visa cancellations for minor offences such as traffic violations or even social media posts. Foreign students in the US have faced sudden visa revocations, as I was talking about social media posts and other things, and this comes amid, the immigration crackdown by the government. Moreover, Indian students who often rely on F1 visas and post-graduation work permits like the H-1B visa fear that their academic and professional aspiration in the US could be jeopardized because of this.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty gained for the fifth straight session, the longest winning streak in a month. The Nifty reclaims 24,000. The Nifty Bank hits a record high. Gold continues to rally as prices hit another record. Weak dollar, ECB's rate cut and President Trump ordering a probe on all critical mineral imports spark more safe haven buying. The price of 10 grams of gold in India now above 1 lakh rupees, including GST and making charges. US Vice President J.D. Vance and his family begin a 3-day India visit at the Akshardham Temple in Delhi. Prime Minister Modi will host a dinner later this evening. Vance will make an address in Jaipur tomorrow, where he's likely to make policy statements on the Indo-US ties. Finance Minister Nirmala Sitharaman is hopeful of a trade deal with the US in the incoming months as she begins her 5-day visit to the US. India's team, led by the new chief trade negotiator Rajesh Agrawal, will hold talks with US counterparts to sort out pending issues. Both sides have finalized the terms of reference, covering 19 chapters of the proposed bilateral trade agreement. China warns countries against striking a trade deal with the US at the expense of Beijing. Chinese Commerce Ministry threatens countermeasures in a resolute and reciprocal manner. A bureaucratic reshuffle at the Finance Ministry amidst hectic trade negotiations. Arvind Srivastava, who was working with the Prime Minister's office, is appointed the new Revenue Secretary. Wum Lun Mangwal Nam moves from Civil Aviation to become the new Expenditure Secretary. Pope Francis dies at the age of 88 after a prolonged illness, the first person from Latin America to be anointed as the head of the Catholic Church. Pope Francis was known for his social justice advocacy, his calls for reforms within the Church and his environmental activism. Finance veteran KV Kamath says banks need to cut their operational cost to 1/4 of current levels just to survive. Kamath predicts banks will end up providing only retail loans in the long run, with the market providing corporate and infra financing. That's a money control exclusive. Rohit Sharma, Virat Kohli, Jasprit Bumrah and Ravindra Jadeja get contracts from the BCCI. Rishabh Pant promoted Shreyas Iyer and Ishan Kishan make a comeback as 34 players get new retainers. Well, let's start with the day's trading action. After a long weekend, Dalal Street came back to trading day with a bang, gaining for the fifth straight day. It's the longest winning streak in a month. The Nifty reclaiming the 24,000 marks, and banks led from the front, with the Nifty Bank hitting a record high. It's almost a 2% rally there on the Nifty Bank, a new record for that. 1% higher on the Nifty, reclaiming 24,000, and the Sensex up by about 855 points. Mid-caps did also outperform. Prashant standing by to wrap up the day's trading action. Prashant, looking strong as we start the trading session.
Well, a strong day once again as we start a full week of trading. I mean, last 2 weeks we've seen massive gains from the lows, of course. Nifty's added about 2,000 points. And today, if there's any indication, there's no signs of stopping. Bulls are back and back strongly, especially large caps. And of course, I mean, foreign buying at the margin is back as well, which has been very evident over the last 4-5 trading sessions now. So the Nifty past 24,100, the Nifty Bank making a new all-time high. mid caps and small caps, which lagged a little bit last week, participating very strongly today. I'll start with what was up in terms of the Nifty. Tech Mahindra was a big one, went up. And by the way, Infi was not a great number, but the Infosys stock itself was... it closed higher, but other IT stocks did much better. Of course, I mean, the Nifty IT index is down 25%, maybe a little less now after today's gains for the year so far. IndusInd Bank continues its journey. I mean, 15% last week, another 4% today. Trent was up 4%, Hero MotoCorp 4%, Power Grid 3.5%, Bajaj Finserv, Mahindra and Bajaj Auto were some of the other names which were up and about. Only three noticeable losers: Adani Ports, HDFC Life, and HUL, which were down about 1% plus. In terms of broader market, lots of winners, and I'll just outline some. BSE was the big one, 6%, but the capital markets play. BSE, K Fintech, Novama, 361, Angel One. I mean, that entire pack was a buzz today, top performing sector. Tata Elxsi, 9% numbers again were poor, but I mean, of course, there was, I guess, a lot of covering and some buying as well. Just Dial, big one, 12% backed by volume. Suzlon was up 10%. Atul Limited, about 4.5%. Sterling Wilson Solar continues its gains off the lows from last week. You had Vijaya Bank, Aavas Financiers, J&K Bank, Spandana Spurti, All Cargo Logistics up 6%, and many more. So, decent day, very decent day for the broader markets as well. In terms of what was down, Kirin Industries down 4%, Marico was down about 3%, and a name like Avanti Feed was down about 5% as well. But can't complain because, the repair and recovery over the last 2 weeks has continued as we begin, as I said, this new week. Back to you.
Thanks very much, Prashant. Repair and recovery there as far as the stock markets are concerned, but it continues to be a frenetic rally for gold. Gold rallying with the yellow metal hitting another record high. A faltering dollar and worries of a global economic slowdown have kept safe haven bullion in demand. Manisha standing by. Manisha, the gold gallop continues clearly.
Well, thank you for that. Those numbers on your screens are absolutely all-time highs for the global and the Indian markets as well. So we've done an all-time high of $3,395 an ounce in the international markets. For the Indian markets, until now, it has been $96,850. So rupees per 10 grams. So, well, absolutely running, making newer highs in every time zone. Asia started higher, Europe has followed in. And if the US were to follow the same suit, you could be looking at much higher prices beyond $3,400 an ounce as well. Well, the support in gold prices comes in from the fact that you are looking at uncertainty in the global markets. Well, that actually is a calculation on what really you would be paying in sense of gold prices in India. These are the prices which are not inclusive of GST and making charges. Once you start adding all of that, we are almost at 1,10,000 rupees per 10 grams for the Indian markets. If you were stepping out to buy gold today per 10 grams, whether it was a coin or jewelry, you'll be paying much higher than 1,00,000 rupees per 10 grams already. And the expectation is that with the kind of scenario that we are working with in the international markets, whether it is about the dollar index, which is trading at a 3-year lows at or below 99 right now, is a supportive factor. And then apart from that, Trump ordering investigations on critical mineral imports, or whether it has been about a statement of not being very happy with the US Fed Chairman Powell and a statement also of firing him. So these uncertainties clearly are adding premium, and a safe haven buying is happening only in gold, and none of the other asset classes has been supportive for the gold prices as well. So $3,400 an ounce, almost done. The banks and brokerages are keeping on and reiterating their higher targets in sense of gold there. Deutsche Bank has talked about $3,700. Goldman Sachs upped their forecast to $37,000 and $4,000 an ounce as well in this year, if the current situation persists or there is more extremities coming in there. And then you have Bank of America, Citi, UBS also talking at levels of 3,350 to 3,500 on the higher side. Swiss Capital has talked about 3,500. SD Bullion has spoken about 3,500 in the month of April to May itself. So, well, very, very bullish cues continuing.
Yes, clearly the rally there continuing. Manisha, many thanks. And speaking of Trump, his deputy J.D. Vance, the Vice President of the United States, in Delhi for a 3-day India visit. Well, U.S. Vice President J.D. Vance starting his trip to India. He is the senior-most leader from the U.S. government to fly down to India since Donald Trump took oath as president this January. Now, Vance's visit comes on the backdrop of the tariff war and negotiations between both countries to seal a bilateral trade deal. Prime Minister Modi will host a dinner for the Vice President later this evening. Now, Vance will make an address in Jaipur tomorrow, where he's likely to make policy statements on current Indo-U.S. ties. The U.S. Vice President has been accompanied by his wife Usha and their 3 children, who were seen in traditional Indian attire. They were received by Union Minister Ashwini Vaishnav at the Palam Air Base in New Delhi. Later, J.D. Vance and family will have visited the Akshardham temple in the capital and spent nearly an hour there. Parikshit is standing by to take us through what is on the itinerary. Parikshit, J.D. Vance will call on the Prime Minister later this evening. What are some of the issues that are likely to be up for discussion?
Well, trade and tariffs could take centre stage when Prime Minister Modi meets J.D. Vance at his residence. This is going to be an official meeting, possibly will last for about 30 to 35 minutes. And we do believe that somewhere both sides will express an intent or a request to resolve all outstanding issues at the earliest. At this level, you don't expect the leaders to go into nitty-gritties, but somehow there would be discussions on how we can move beyond the differences on the trade front and have an interim trade deal at the earliest. Our understanding is, and we learn from sources privy to the trade talks, that the Indian side has agreed to reduce the average tariff rate from somewhere around 13.5% to 10%, all across the product lines, but US is seeking 0 tariffs. So will there be a compromise? That remains to be seen. Will India reduce barriers on agriculture and dairy? That remains to be seen as well. But both sides are expected to express their sensitivities and somehow say that let's move on and have a trade deal soon that can mutually benefit both nations. Having said that, discussions on immigration, discussions on defense acquisitions, energy, startups, space, these are some of the issues that are going to crop up in discussions. Russia-Ukraine war, the war in Gaza, definitely up for discussion, and India will also give its view on these subjects. China will be a big point of discussion. The US has imposed an almost 245% tariff on certain Chinese products, and Vance is expected to give his rationale on reciprocal tariffs to Prime Minister Narendra Modi, and both sides are likely to align foreign policy views on China as well. Thereafter, he will be going to Jaipur, where he'll visit Amer Fort. That's a personal visit with his family. In the afternoon, he gives a speech at the Rajasthan International Centre and goes to the Taj Mahal in Agra on day 3, following which he heads back to the United States. So it's an official trip in one sense, but there is a lot of personal element to the visit as well.
Well, Parikshit, many thanks for joining us. And let's stick with the official, because Finance Minister Nirmala Sitharaman is in the US on a 5-day visit. The Finance Minister addressed the Indian diaspora in San Francisco, where she expressed hope in being able to achieve a bilateral trade deal with the US in the coming months. Both sides have finalized the terms of reference, covering 19 chapters of the proposed bilateral trade agreement. Here's the Finance Minister in San Francisco.
Keenness with which we are engaging with the US administration, even as I talk, I think the Vice President of the United States of America is in India. He will be engaging with the Prime Minister hopefully this evening or tomorrow. In between all this, the additional USTR had visited India to see the progress or to engage with the negotiating team who's dealing with the tariff-related negotiation and with the bilateral trade agreement that we want to sign. In fact, the progress of the agreement or the trade agreement that we are working on, at least a first tranche, is something which we hope to conclude by the fall this year.
Well, that is the Finance Minister in the US. As trade talks between India and the US progress, India has announced that IAS officer Rajesh Agarwal will take over as the next Commerce Secretary in October. He's currently the Additional Secretary in the Department of Commerce. A team led by Agarwal will hold negotiations in Washington this week to iron out differences in striking a bilateral trade agreement. Abhimanyu joins us now with more. Abhimanyu, what can we expect this week as talks restart?
India's negotiating team is set to visit the United States this week to sort out pending issues before launching negotiations for a bilateral trade agreement between both the countries. Led by Chief Negotiator Rajesh Agrawal, who's an additional secretary with the Department of Commerce, the team will speak to its American counterparts for 3 days starting 23rd April. Sources have told CNBC-TV18 that India and the US have finalized terms of reference covering 19 chapters for a proposed BTA covering issues of tariffs, goods, non-tariff barriers, customs facilitation, rules of origin and regulations. For a proposed FTA between India and the UK, the talks are moving towards final stages, with the sticking point being the issue of resolution of disputes between both the countries. Another full round of negotiations is unlikely as discussions are progressing at a fast pace between India and the UK. With the EU, India is discussing an early harvest agreement. The 11th round of India-EU FTA talks are slated to take place in New Delhi from the 12th to 16th of May. It remains to be seen how all these talks are going to pan out, even as the pause on reciprocal tariffs by the United States continues.
All right, Abhimanyu, many thanks for joining us. Amidst all the trade negotiations and tariff tensions, we now have a new team in North Block, which is the Finance Ministry, after a major bureaucratic reshuffle over the weekend. Timsy standing by to give us the details. Timsy, take us through what has changed in the Finance Ministry. Take us through the new team that Nirmala Sitharaman is going to work with.
Well, these changes have been awaited for a while. The Finance Ministry has a slew of new faces who will take charge of the government's many economic and developmental policies. Arvind Srivastava, a senior IAS officer from Karnataka cadre, has been named Revenue Secretary. He's an officer from 1994 batch and was serving in the PMO as Additional Secretary. V. Wolnam, who has been serving as Civil Aviation Secretary, is new Expenditure Secretary. This 1992 batch Manipur cadre officer will take over from Manoj Govil, who will assume charge as Secretary Coordination at the Cabinet Secretariat. After a long gap, we now have a female secretary in the Finance Ministry too. Anuradha Thakur, an IAS officer from again 94 batch of Himachal Pradesh cadre, will move from the Ministry of Corporate Affairs, where she was serving as an officer in the additional secretary rank, and now she'll take over immediately as officer on special duty in Department of Economic Affairs. She will take over as DA Secretary from current DA Secretary Ajay Seth upon his superannuation on the 30th of June 2025. Department of Public Enterprises, that is DPE, will also get a new face. Moises Chailai, presently Secretary of Interstate Council Secretariat in the Ministry of Home Affairs, will take over from Arunish Chawla. Secretary Deepam Chawla was also holding additional charge in the Ministry of Culture and DPE. The Ministry of Commerce and Industry will also see a new bureaucrat later this year. Rajesh Agarwal, a Manipur cadre officer from 1994 batch, who is currently serving as Additional Secretary again in the Commerce Ministry, has been elevated to Special Secretary, and he will become the next Commerce Secretary when Sunil Barthwal, the current Secretary, superannuates on 30th September 2025. Important to note that Agarwal is also the chief negotiator for the ongoing India-US trade deal talks. The Central Board of Direct Taxes also has 4 new faces: Pankaj Kumar Mishra, Sanjay Bahadur, L. Rajashekar Reddy and G. Aparna Rao. All revenue service officers of the IT cadre from 1989 batch will join the board.
Timsy, many thanks. Now, President Trump is registering the worst economic approval numbers of his presidential career. According to a CNBC economic survey, 43% people polled approved of his handling of the economy, 55% disapproved. This is the first time in any CNBC poll that Trump's rating has been net negative on the economy, while President overall, 44% of the respondents approved of Trump's handling of the presidency so far, 51% disapproved. This is slightly better than the final reading of the CNBC survey when Trump left office in 2020. Now, China has warned it will retaliate against countries that negotiate trade deals with the U.S. at its expense. The Chinese Commerce Ministry, in a statement, has threatened countermeasures in a resolute and reciprocal manner. China has also accused the U.S. of abusing tariffs and bullying countries around the world. It promised to defend international fairness in trade and promised to strengthen solidarity with all parties. Pope Francis, the head of the Roman Catholic Church, passed away at the age of 88 after battling a severe respiratory illness. The first person from Latin America to be elected the head of the Catholic Church, Pope Francis was known for his social justice advocacy, his calls for reforms within the Church, and his environmental activism. Born as Jorge Mario Bergoglio, he was a hope of many firsts. The first from the Jesuit order, the first to take the name Francis, and the first in almost 6 centuries to become the Pope, following the resignation of his predecessor, Pope Benedict. Crowds gathered at the Vatican Square to pay tribute to the Pope. Leaders from across the world have hailed Pope Francis's legacy. Prime Minister Modi, in a tweet, said that Pope Francis will always be remembered as a beacon of courage, humility and spiritual courage by millions across the world. The papal conclave to elect the next Pope should be convened in the next 2 to 3 weeks. And other international news, Israeli forces have killed at least 39 people in Gaza over the last 24 hours, taking the death toll from 18 months of war to over 51,000. That's as per the Gaza Health Ministry. Meanwhile, the Israeli military has said that professional failures led to the killing of 15 Palestinian medics in Gaza last month. An inquiry into the incident by the Israeli Defense Forces found a series of failings, including an operational misunderstanding and breach of orders. The deputy commander of the unit involved has now been dismissed. Russia launched an attack in Ukraine just hours after President Vladimir Putin's one-day ceasefire came into an end. That was a ceasefire for Easter. As per the Ukrainian Air Force, Russia launched as many as 96 missiles and 3 drones in overnight attacks targeting 3 regions in Ukraine, including Kharkiv. Ukraine claimed its air defense unit shot down 42 Russian drones, while another 47 drones were redirected by electronic warfare. We will head into a break, but up next, finance veteran KV Kamath says banks need to cut their operational cost to 1/4 of the current levels just to be able to survive. An exclusive coming up. Eversource Capital is set to be in advanced talks to acquire ride-hailing startup BlueSmart. Sources tell CNBC-TV18 the company has made a non-binding offer to acquire BlueSmart for 850 crore rupees. Sources add that BlueSmart's co-founders Anmol Jaggi and Puneet Singh Jaggi may be asked to step down from their role on the company's board as part of any potential deal. A final announcement could be made within the next 2 weeks. Remember, BlueSmart has already suspended operations in several cities. This comes at a time when the Jaggi brothers, who are promoters of Gensol Engineering, face a SEBI probe over alleged fund diversion. As per sources, the Ministry of Corporate Affairs has also launched a suo motu investigation into alleged irregularities at Gensol. It will examine the company's regulatory filings and accounts. On to a money control exclusive. Finance veteran KV Kamath says banks need to cut their operational cost to 1/4 of the current levels just to be able to survive. In a conversation with CNBC-TV18's Lata Venkatesh, Kamath predicted that banks would end up providing only retail loans in the long run, with the market providing corporate and infra financing.
Challenge that banks will face, are facing and will face, is cost-to-income ratio. So unless you disrupt that cost-to-income ratio to 1/4 of what it is today, you won't survive. 1/4. I'm saying if you cannot operate, you will have to be well below the 35-40% people are.
No, ICICI and HDFC
and some people are higher than that. Banks, I think, as they evolve, larger and larger part will be to the retail sector, because they are, as of now, best equipped, unless they're disrupted by a fintech. The corporates, large part of the corporate universe today, are cash positive. The cash flows are positive and can meet most of their growth needs. At the margin, they may have to borrow. Large part of infrastructure funding will come through a market process, which is outside the banking system. It's already happening.
That's KV Kama. Now, the government has remained silent on MTNL's rising defaults, which now stand at 8,346 crore rupees. In fact, the firm's operations are being managed now by BSNL under a service arrangement. Sapna standing by with more. Sapna, take us through the details and where MTNL finds itself today.
Well, definitely it has been a very long road, especially also for all those banks, because MTNL continues to be, pardon me, continues to be an NPA account, so to speak. So if you look at the latest regulatory filing, well, the default amount has actually gone up by around 69 crores. So it's around 8,346 crores is what MTNL basically owes to banks. And having said that, despite queries across the board, we have not got any suitable response from government officials as to what needs to be done regarding the NPA status of MTNL. However, what we have been given to understand, and this is through also conversations that we have had in the past with government officials, is the fact that there is no fiscal package as such that we can talk about in terms of rescuing MTNL, so to say. Sorry, pardon me. That's one. However, asset monetization is what the government has agreed upon. That's the second element. And third, very importantly, which you have pointed out, is basically BSNL taking over day-to-day operations of MTNL. I think that has already happened from Jan 1 onwards. So that is basically going to help the company stay afloat, so to speak. But the fact also remains that 8,346 crores worth of bad loans are still sticking out, and we have to wait and watch and see the space for more on MTNL.
All right, Sapna, appreciate you joining us. That's the latest there as far as MTNL is concerned. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment with more.
I think all of us who were in any form or fashion related to the markets in 2008, that would be a firm imprint on our minds for the rest of our lives.
It changed us forever.
Forever, yeah. It's a ghost of 2008, which gives us all that.
It
would never leave you. We have this, meeting of investors, and one of the investors mentioned this is worse than GFC because of XYZ reason. Everything, something props up, it becomes worse than GFC. Obviously, COVID one could have legitimately said it's worse than than GFC. So far, it's been moving along as Trump had planned. And I think the worst is behind as far as the markets are concerned. There were some pockets within small caps and mid caps, certain segments which did build some excess. And the last 6 to 12 months, that froth has been to a great extent fizzled out. Post-COVID 5-year fantasy run is over. I'm not calling that we would have an environment like 18 or 19. If you'll very well recollect, January 2018, small caps peaked and there was a 40% drawdown in small caps. And that was a time when most retail investors lost a ton of money. I think a 10 to 11% return from equity markets over the next 5, 10, 15 years is a reasonable base case expectation.
10 to 11%. When people hear you say that, half of them will be pulling their hair out saying,
Pre-tax.
Prashant, what is Prashant saying?
10% is very good, meaning you can double your money in 7 years.
Okay, so now let's come down to the brass tacks questions as to what we should be doing as investors, where we should be looking. My first question, starting point, is going to be on the leaders of the run up until now, whether we need to reset, their prominence in the portfolios. And I'm talking about industrial stocks, defense, PSUs, railways, capex, capital goods, etc. Do you think their best is over, and should investors be lightening up on that side if they've not done it already?
Certainly. So I assume by investors, you are talking about not professional investors, but those who are investing retail.
Who are managing their portfolios either through direct stocks or maybe overexposure through funds in this part of the market.
Excellent. So I would say those who have time to do research, they should spend time managing their portfolios in individual stocks. Those who don't get time to research are better off hiring a financial advisor and then go that way. But now we'll talk about, and the financial advisor, based on your risk profile and whatnot, would recommend
what. You can be in a PMS, you can be in a, you can leave it to an expert. Correct.
Now for someone who's doing on their own and are able to spare the time and effort to do the research, obviously can only suggest the way we do things. So the way we do things is we don't take thematic bets or sectoral bets or forget big, even small macro calls from a making money perspective. Macro sectors, themes, these are all from a risk management perspective. Going back to the experience I talked about at State Street Global Advisor, I used to go home after setting a few quant models to work through the night, crunch the data to provide results next morning, what macro or sector or other fundamental bets, high ROE, low volatility, high sales growth, high margin, what can work and predict returns. Believe me, nothing works on a forward-looking basis. So no point in taking such big risks or big bets in your portfolio. Have a broadly diversified portfolio across sectors. Try and identify winners in each sector. Money is made, I often say, money is made in diamonds business as well as in coal business. One might be more flashy and glittering, but actually more money has been made in coal business than in diamond business. Nowadays, more particularly so with all the lab-grown diamonds in fashion. So you have to identify the best of the diamond companies and the best of the coal companies, if you will. Meaning across sectors, you identify companies that can deliver superior performance both on business front as well as then over time from the market.
Okay. So that actually brings me to the question on your own personal investing style and how it's evolved over the years. When you decide to pick a stock for the portfolio, where do you start? Is it you look at a broad top-down theme that you're convinced about, and then you look at companies there? Do you look at management, valuations? How does it work?
No, excellent. So our team's approach is very stock selection driven, as I've repeatedly said. We aren't of the kind that will ignore macro. And then macro are of several kinds. There's one is structural macro, like Indian demographics, per capita incomes, urbanization. These are all structural macro that you have to factor in your bottom-up thinking and analysis and valuation of individual stocks. But then there is conventional macro, like interest rates, inflation, these, that, and the other. There we don't see any opportunity to make money or, necessarily differentiate ourselves from what the consensus is and make money. And then there is this tactical or sporadic macro, like Trump tariffs.
Renewables is a theme, or exports is a theme.
So all those themes you have to be very careful, because themes are not, by the time something becomes a theme, it's very well known and well followed. There's cult following in the market. A lot of themes have had very bad endings in the market. If you look back during our own experience, infrastructure was a big theme during 03 to 07, and so was real estate. Both had very bad ending. So I'd say one needs to be very diversified across sectors. Each sector in a way is a theme on its own. Some may be more in favor, other times they might be out of favor. So broadly diversified from a risk management perspective. From a stock picking perspective, what we as a team focus on, I would say the organizational culture as it pertains to execution and governance. Then, superior returns on capital. Not necessarily today. I often get asked, because we are very cash flow centric and there are loss making companies in our portfolio as well. So how do you talk about superior returns on capital for a loss making company? Some of the new age companies that our team very much likes and owns for several years. So it is superior returns on incremental capital. Looking forward many years, value of oftentimes, people take this lightly, but value of any business is present value of future cash flows. It's not necessary you have to make cash flows in year 1, year 2, or even year 3. Whether the cash flows that you are expecting over time.
I remember this categorically because I remember doing a show when Zomato was listing with some of your team members. And there was a massive debate there about whether this whole price to sales, there's no earnings, how can you value a company like that? And of course, White Oak took early calls, big believers early on.
Absolutely, and we've owned, its parent company since much longer, ascribing value to these investments that the parent company has made. This is one of the lessons I learned, I would say, early in the TMT bubble, .com bubble, when in my US portfolio, I never could buy Amazon.
Okay.
Thinking that it's not making money, and at that time it was also an assessment that it can never make money. I did own telecom companies or wireless companies which weren't making money, but I guess in wireless companies it was very well accepted that for several years they would make cash losses at least, and then in later on, they'll generate cash flow. But new age companies, because there isn't an established business model to look back onto, people often just ignore them or write them off as something they won't look at. And that's the opportunity for investors like us who are willing to take a closer look.
This is a bit of a deviation, but a great one. Since we're on the subject, I have to ask you this, because we've reached that point again for these new age internet stocks where the debate is back on. They're investing a lot in dark stores, they're expanding in tier 2, tier 3. So suddenly some of them are saying that they've reached profitability, but maybe, at least in quick commerce, it can get delayed. Because of this expansion.
Yes.
What do you think about these businesses as of now?
See, the same way we've looked at these businesses, there'll be winners and losers. Not everyone's going to be, the next whatever of India. See, we do benefit having invested during the .com bubble through the late 90s and 2000s in US, where these kind of companies first came to market. Having made mistakes there, both of commission and omission. Amazon is a mistake of omission, if you will.
Missed opportunity.
Missed opportunity. Then as on the EM, while in India, a lot of these businesses might be developing for the first time. That's not true globally. In China, this story has played out a decade ago, right? The Alibabas, the Meituans, the Tencents, those all also have had the opportunity to participate in several of them in the IPO. Just like Google in US was an IPO company invested in my portfolio. Similarly, Alibaba and others were IPO companies. In Korea, you have similar companies who are leaders. They're just further along in the journey to profitability than some of the Indian companies are.
Right.
And if you study the US, the developed markets, the emerging market companies in similar businesses, how they've progressed, how they now have come to a stage where they are throwing up tens of billions of dollars of cash flow. The Mag 7, there's a cult-like following amongst Indian investors for the FANG. FANG was very widely followed 2 years ago.
Absolutely.
Majority of those FANG companies weren't making money or cash flows
when they started
when they were $100 billion in market cap or more. Obviously Microsoft was making money and some others might have been making money. Google was making money early on. But others, Amazon wasn't making money, Netflix wasn't making money, yet they were so loved.
So you have to be a patient investor if you're going to be on
patient and selective. You can't have a spray and pray approach across all those. Not everything would become a Amazon or a Facebook or something.
Absolutely.
But you can't write off. Otherwise, you'll end up investing if you absolutely you come in much later.
What about renewables? Similar. I mean, before this market correction set in, any company that was talking EV or renewable stocks were shooting through the roof.
Certainly.
Right? What is your take on the Indian RE renewable/EV space?
Certainly. So again, here also there'll be winners and losers, and you have to identify, work, and it's a similar job to any other sector. I would say the froth in this segment has considerably come off. This was one of those segments of the market where valuations had gotten way ahead. For a renewable utility,
sure,
there is a certain IRR and ROE. Let's call it mid-teens, maybe a point lower or a point higher. That has to be valued commensurate with that level of profitability. That level of profitability is very good, pretty decent for that kind of business and predictability. But it can't have the kind of valuations it got, say 6 to 12 months ago. And now I think the valuations are more in a reasonable zone.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits?
Let's talk about what excites you the most. Right now, I've been throwing some sectors and themes at you. And when I say excite, it means where you see growth visibility, you see valuation comfort, where you're convinced that next 3 to 5 years there's serious money to be made.
So see, what excites us the most always will be is mismatch of fundamentals and valuations. So we're looking for the undervalued companies relative to the fundamentals.
Sure.
Now that is there across market cap segments, large, mid, small, and across sectors. Yeah? Having said that, inefficiencies are higher in small caps and mid caps. So even for a fairly valued small cap or overvalued small cap sector of the market, the inefficiencies being higher, you're likely to find more opportunities where there's a bigger mismatch of fundamentals and valuation in smaller caps than it would be in larger caps. So think of the largest of financial sector companies. and the smaller NBFCs or banks or whatever, there is likely to be greater inefficiency in the valuations of the smaller, and there are some beautifully run small cap NBFCs just as there are beautifully run large cap banks and NBFCs.
When you say inefficiencies in valuation, you think the price has not fully captured the potential?
Yes, very true. So across sectors those exist. So we tend to have always higher allocation in small and mid cap. Now in certain sectors, there's just a greater availability of small and mid cap names than other sectors. So energy as a sector tends to have only the largest cap companies.
Big companies,
Yeah. Think of how many companies in small cap energy can you would not run out of your fingers counting small cap companies. Whereas in consumer discretionary or healthcare, in healthcare there are dozens and dozens of small and mid cap companies, be it in pharmaceuticals, be it in diagnostics or hospitals and whatnot. So it's an alpha rich segment of the market.
And you've liked pharma earlier as well. Does that view still hold, irrespective of tariffs are there, not there, and whatever's happening in the US?
I think again the view is because you are able to, it's a very rich hunting ground, fertile hunting ground, or it's part of the pond where there are a lot of fishes to fish. And that's why it's likely to be higher allocation in our portfolio, not because from a top-down view perspective we believe pharma is going to outperform. Even if pharma over shorter time periods underperform or whatnot, we believe over time, over the cycle, because it's so alpha-rich segment of the market, our portfolio or our component of the portfolio that's pharma or healthcare should be able to outperform the overall market, even if pharma underperforms in the market, if that makes sense. So right now, if you see in the portfolio, besides small and mid-cap pharma or healthcare more broadly, we have mid-cap IT services, something that we discussed. We have in consumer, across small and mid-caps, a lot of opportunities. In financials, we've tended to find a lot of large-cap opportunities as well. When we compare large-cap Indian lending institutions to anywhere else in the world, be it emerging markets or developed world, they seem to be very well priced for the, very attractively priced for the quality of balance sheet and the growth prospects that they have. So these would be the few categories besides chemicals, industrials and other segments where we selectively find a lot of opportunities.
Just to round up this part of the conversation, you said selective industrials. And I started with asking you this question.
Yes.
Do we need to, change our approach towards industrials? So which parts of industrial / capex, economy facing stocks, which part of that are you still happy
So within
holding?
Industrials, if I look at, obviously there are many, industrials is a catch-all sector.
It's a
just like
massive word.
Yes. So if the benchmark makers don't understand where to put a company, it neatly doesn't fit in any sector. If it is consumer oriented, they throw it in consumer discretionary. And if it is B2B oriented, they throw it in industrials. So within industrials, where we have a big chunk of our team has big chunk of allocation is in equipment makers, intellectual property products. So the industrial equipment makers more so than infrastructure developers or EPC players or so on.
PSUs?
We do have some PSUs more so from a risk management perspective. Their operational performance certainly has improved over the last several years. Question still that we have, and we are not convinced of whether it is sustainable through different governments.
Yeah. This government had a very clear approach of sort of pushing forward.
Absolutely. And if you go by, you are from the school where you believe value of any business is present value of future cash flows. Those future cash flows are accrued over decades. So present government may be doing, or PSUs might be doing a fine job under the present government, but can the same be extrapolated or expected over many decades? So that's where some of the concerns are, but we do own some PSUs as well.
Okay, fantastic. I think that's been really exhaustive and very comprehensive. So I have to start coming down to some final thoughts. I want to ask you, what would be, since we're talking about a new market and a post-COVID, getting over the hangover, getting ready for a new phase, what should be the, let's say, top 3 mistakes that investors need to avoid?
Certainly. I think at any time, and this has been true over the last 40 years and true, I think, over the next 40 years as well. 2 of these 3 mistakes I've made repeatedly. 1 mistake I've never made, which is trying to time the market. There's a most important mistake that, or the biggest mistake that investors make, they try to time the market.
Yeah.
Yeah, going into cash, going back into market, and so on and so forth. And not every time, but you'd be fortunate to get it 50% of the time right. So if you got worried from media headlines about Trump tariffs and whatnot, and you get out, or worried about COVID headlines and you get out, that's not going to pay off. So this, fortunately, I've never fallen in the trap of. So timing the market is a big mistake. Second, leveraging is a huge mistake.
Okay.
Never important for investors to not lever up and invest in the market. We've seen or heard anecdotally several instances of people leveraging. It is a mistake I've made because when you have less money and you want to make more money, it seems very easy to lever up.
Borrow and then
invest because you're always confident that equity markets would, in this, as you were saying earlier, people have become confident of earning 20 to 30% return.
Yeah.
And they can borrow money in 10 to 15%, and they feel, that's the easy way of multiplying the wealth. And third big mistake is getting too concentrated in your portfolio. As an individual investor, you're often prone to, and I've heard just very recently, one of the coaches of my student, my son, the coach said, I've always been 100% invested in biotech companies in the US.
Okay.
He's just big fan. He has very little. He's not from the field, has no specific expertise in biotech. He's an individual investor. He coaches sports, is a sports coach, but just has a fancy for biotech. But that's like, in a way, buying lottery.
Really risky.
You're waiting for lightning to strike in the spot that you've picked. Typically doesn't work that way, right? So having excessive concentration in very few stocks or in a theme or two, like a lot of people during 03 to 07, and again maybe in the recent years, had high concentration in deep cyclicals or industrials and infrastructure, defense, PSUs and whatnot. Again, it's a recipe for disaster sooner or later.
If you're very concentrated.
Very concentrated. So avoid market timing, avoid leverage, avoid heavy concentration.
Over-concentration. Got it. I think that those are great 3 nuggets to keep in mind. Finally, when you're not picking stocks and forever studying balance sheets and companies, how do you keep yourself sane in this very noisy and very volatile market?
So I'm certainly a fan of cricket, as most of us are, and watch that with my kids. And second is of chess, so play quite a bit of chess with kids. And after Gukesh's win, World Championship a few months ago, 4 or 5 months ago, I've really taken to watching chess as well.
Okay.
Obviously the fast version, rapid fast forward version, these matches can last 5 hours. But on YouTube, there are certain websites where you can watch a whole match in 22 minutes and you can play double the speed.
Wow.
So in 10 minutes, you can watch. And if Gukesh and Ding played some 14 games, you can within 2 hours complete the whole championship.
Wow,
and it's great fun to watch.
The benefits of technology, right?
Absolutely.
So as we get ready to sign off, I have just 3 simple rapid fire questions, rapid fire off the cuff.
Bring them on.
The highest moment of your career so far?
Oh boy. It's yet to come.
Wow, yet to come. Nice one. The one thing that you would have done differently in your career?
You would have taken the risk earlier on.
The Amazon call.
Or I was saying more the entrepreneurial risk.
Oh, okay, okay. Would have started entrepreneurship early, got it. The biggest lesson that the market has taught you?
Don't have too much confidence in subject matters which don't lend themselves to any degree of predictability. To give an analogy, a coin flip, let's say. There's no, and I might be carrying one, there's no point in having strong confidence in when I flip a coin that it's going to be heads or tails.
True.
Yeah.
It's
the nature of the beast is such that you can't have confidence. So that's a very important lesson that I've learned over time, where I've had confidence in hindsight when it turned out that these were clearly subjects where I shouldn't have had confidence in.
Very interesting thought, and something for us to take home, think about, chew over, ponder over, and then take the benefit from. It's been such a pleasure listening into you. It's been a very, very insightful conversation. Thank you so much for taking out the time and doing this. Thank you very much.
Thank you, Survi. My
Look
pleasure.
forward to more of this in perhaps the months and years ahead.
Same here.
Well, viewers, it's a wrap then on this edition of Market Cafe. Remember, this is season 2, episode 2, and you can find all the seasons, even the previous ones, on our YouTube handle. See you with another conversation, another guest very soon.
Wizards. Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Hello and welcome to this special broadcast. I'm Parikshit Luthra. United States Vice President J.D. Vance with family in Tao is in India for a 3-day visit. The visit is crucial as it comes in the backdrop of Trump's tariffs and talks of a bilateral trade deal. Vance is the senior-most leader from the U.S. government to fly down to India since Donald Trump took oath as the president this January. He will be meeting Prime Minister later this evening. We learned from our sources that both leaders shall be stressing on the importance of resolving outstanding issues in the bilateral negotiations. China and the economic and security challenges emerging out of it would be on the agenda as well. The Indian government is hopeful that the first tranche of the bilateral trade pact would be ready in the next few months. I'm now joined by former Foreign Secretary Kanwal Sibal. He's also the Chancellor of the Jawaharlal Nehru University. Also on the program are Arun Kumar Singh, former Indian Ambassador to the US, with me on the program, and Richard Rosso, Senior Advisor and Chair on India and Emerging Asia Economics at the Center for Strategic and International Studies. Gentlemen, thank you very much for joining us on the show. Richard Rosso, how do you see this visit by J.D. Vance? More personal, more private than official?
Yeah, I mean, we've seen the itinerary, more personal, but still, the fact the vice president's going out, the drumbeat towards the president's trip later this year, some very critical issues on the table, not just the trade agreement, as you mentioned, but renewing our 10-year defense framework and some potential other areas of defense cooperation. So even though the official meetings may be relatively brief, the fact that he's one of the few people that's got the president's ear and we got big issues on the agenda couldn't come at a better time as we try to keep momentum when the United States is really fighting a trade war against a lot of our partners and friends. So hopefully they can get some decent outcomes out of the visit.
Right. Ambassador Sybil, coming to you, what's going to be J.D. Vance's message to Prime Minister Narendra Modi, considering that we're at a very critical time with trade negotiations? This week, the official who's set to be India's Commerce Secretary in a few months, Rajesh Agrawal, the top trade negotiator, is traveling to the United States for talks with the US counterparts. We're hoping for an early trade deal. Do you think at the level of leaders between Prime Minister Modi and J.D. Vance, there could be some discussion on quickly resolving the outstanding issues?
In principle, yes. I mean, his visit itself is a very powerful message that the United States wants to deepen, expand ties with India. Now, he's fully aware of the tariff issues and the pressure on India to open up our markets. And he's also au fait with the visit of our Prime Minister and the joint statement that was issued and the content of the joint statement and what the two sides plan to do together ahead in a variety of areas, defense, technology, this and that. So the fact that he has come very early during his tenure, and I'm glad that this visit has been made official, because once you make it official, then the protocol part of it gets elevated, and he's got a guard of honor and everything else, and the foreign minister will call on him, and our national security advisor will call on him, and of course there'll be proper discussions across the table with the Prime Minister. But also remember that he's not come with a full-fledged delegation to engage in full-fledged talks on the issues that are there, number one. Number two, when it comes to trade and tariff issues, he's not directly in charge, but he's a very powerful voice in the new government, and he's taking a lot of interest in foreign policy. Therefore, to have him come here is important for both sides. That's one aspect of it. The other is that in a general way, the two sides will obviously discuss what are the issues on the table and how both sides should address them in a kind of win-win situation. Now, focusing only on the tariffs and pushing India much harder than is necessary in terms of opening up markets, especially in the agricultural area and all, are very sensitive issues, and they have to be treated with that kind of sensitivity. And at the end of the day, there are other very important strategic underpinnings of the India-US relationship, which J.D. Vance would be very sensitive to. As you know, he's pretty much of a China hawk. and the fact is that today, the direct confrontation in this trade tariff war between United States and China, the stakes are very high for both sides. And therefore, United States would, at a strategic level, would like India to remain on its side, rather than pushing India so hard that we then begin to pursue even more hedging strategies, not knowing that where all this could end in terms of damaging our own interests. So all in all, I think the backdrop is very good. The fact that he has also been very open about his India connection, visiting the Akshardham temple and everything else, sends a very, very good message in terms of cultural affinity and openness on the part of an administration which is seen to be racist, MAGA, and stuff like that. I'm rather glad that this visit has occurred, and the manner in which we are dealing with it.
Right. Let me also get an Ambassador Arun Singh at this stage. Ambassador Singh, clearly he is a very important person in the Trump administration, somebody who could be the next Republican candidate for president as well. How important do you think this meeting with Prime Minister would be in terms of getting an early conclusion on the trade deal?
No, I think as Ambassador Sybil mentioned, the trade negotiations are happening elsewhere. The Indian, following the joint statement that was issued after our Prime Minister's visit to the US in February, where it was declared that the two would work towards a multi-sectoral free trade agreement and that the first tranche would be completed by the fall of this year. They also set the target that by 2030, trade would be taken to a level of $500 billion, and right now it's about $200 billion. Now, following that, the Indian Commerce Minister had made a visit to the US. After that, the US Assistant US Trade Representative had come to India. And now, as you mentioned, a senior official from the Commerce Ministry is going to the US to continue the discussion. It has been reported that the negotiators have finalized the terms of reference for a trade agreement between them. So clearly, there is sustained and very serious engagement from both sides to try and complete the trade agreement. And that's where the discussions are taking place. I think where we should look at the J.D. Vance visit, aside from the personal angle, is that it signals continued high-level engagement between the two countries. And all that helps in creating an atmosphere in which the difficult issues can be addressed. Now, if you recall, the Indian Prime Minister was the fourth foreign leader to be invited by the US President. He had invited the Prime Minister of Israel, King of Jordan, Prime Minister of Japan, and the Prime Minister of India. So there was a signaling there. And the Indian Foreign Minister was one of the Quad foreign ministers invited to the inauguration of US President in January. And that the first multilateral meeting that the new US Secretary of State did soon after his confirmation was of the Quad foreign ministers. And the first bilateral meeting he had was with the Indian foreign minister. So all this is part of the signaling that while there are differences on trade issues, which the two are trying to negotiate, they see the broader relationship as very important. And after the Prime Minister's visit, it was framed as US-India Compact for the 21st century. And Compact was elaborated as catalyzing opportunity for military partnership, accelerated commerce, and technology. So I would see the Vance visit not just as signaling an effort to get the trade agreement through, but also continuing discussions related to military partnerships, technology partnership, and the overall relationship given the challenges we face. Some of the common challenges, for example, China's unilateral and assertive behavior. So we should frame it like that.
All right. Very important points there by both Ambassador Kamal Sibal and also Ambassador Arun Singh. Let me go back to Rick Rosso. Rick, on the optics of the visit, considering his family is accompanying him, they visited the Akshardham temple in New Delhi. They spent about an hour there. Tomorrow they head to Jaipur. They'll be staying at the Rambagh Palace. They will be visiting the Amer Fort. He has a speech at the Rajasthan International Centre. Thereafter, he goes to Agra for the Taj Mahal visit. How do you see the optics of his all? And not to miss, when his children got down from the aircraft, all of them were dressed in the Indian attire. So, as someone who is an observer of foreign policy, how do you see this?
Well, having traveled to India extensively over the last 30 years, I know our friends in India definitely want to make sure that we're imbibing not just defense ties, not just economic ties, but the culture as well. And it certainly is an easy thing to do. I do agree, the previous speaker had mentioned that, foreign travel and embracing foreign culture may not be considered necessarily the line of sight of the party, the Republican Party these days. So this is significant for another reason. I mean, to imagine the president or vice president having their kids dress up in local attire, things like that, traveling to other countries and such. There's so many ways where I think this visit is underscoring the fact that India has been given a priority place for this administration and embracing it in a way that full scope, of course. You've got some trade tensions, but also some great opportunities. But the cultural affinity and connectivity there is extremely important, and we're seeing that really play out. I will say there's one other element on the trade bit, though, Parikshit, that hadn't come out yet that I think is important. The fact that Vance had been on the Hill. There is one question that hangs overhead on the trade agreement. If ultimately the U.S. has commitments that we have to undertake that require legislative change, we will have to move legislation on the Hill either sooner rather than later, or maybe when the deal is negotiated. And we want to make sure that Congress won't be amending the trade agreement, So I do think there is one specific area where the vice president actually may be able to offer some inclination to the Indian government. What is the Hill strategy as well, if the deal ultimately is going to require the U.S. to change our own laws, which some types of deals may not need that. But if this agreement has U.S. commitments, they'll have to look at that as well. So the cultural significance is huge. On trade, there may be even one angle the vice president can carry heavy water for.
Right. You know, when you say talk about the message on trade, what's going to be the message from Washington? Because the feeling is that India wants to bring down the average tariffs, Rick, from, say, 13.5% to 10%. Now, this has been an offer from the Indian side, as per sources. And the US government wants 0 for 0 tariffs all across the board, including agriculture and dairy. They don't want anything to be left out. So what's going to be the middle path or the message that J.D. Vance would be carrying on the trade and tariff front?
I mean, you did see during the joint statement when Prime Minister Modi was here that the two sides had agreed that when we talk about manufacturing integration, that the United States would focus on capital-intensive industries, India would focus on labor-intensive, so that if they do have to split some hairs, maybe that would give us some inclination about where there would be some variation there, where the United States might be a little bit more open to giving customs access in areas that are labor-intensive, which favor, what India has, this massive demographic and such. I do think, again, agriculture is the area where it's going to get the most difficult. The United States has a lot of concerns about market access, but I think from India's view, I mean, a lot of Indian farmers that grow potatoes would never have a chance of getting Indian-grown potato on an American plate, whereas American agriculture system, with its deep integration with logistics and trade, it's a lot easier for the opposite to happen there. So I think that's the area that it's going to be the most difficult. But if there's other areas of split hairs, maybe this capital-intensive versus labor-intensive that the two leaders laid out in the joint statement might give us some kind of a guide on where they're willing to give and take.
Right. Let me go back to Ambassador Sibal at this stage. Ambassador Sibal, when it comes to greater acquisitions of defense equipment, acquiring more energy, we've already seen greater energy contracts being signed between India and US companies. Do you expect this visit of J.D. Vance to focus a lot on defense and energy partnership as well?
Well, when you say focus a lot, you're assuming that there will be very detailed, intensive discussions on these matters between the two sides. That could happen.
Maybe not intensive discussions, but a policy intent.
Yes, in general terms. Already, the Indian side is very open to the idea of buying more energy from the United States. After all, we are hugely dependent on imported energy, well over 80, God knows, 80-some percent. There are various sources for energy procurement, and we can switch to the United States. The United States has actually been selling oil and natural gas to us. So we can step up those purchases, especially of LNG. And in the case of oil, yes, some additional oil can be bought from the United States. But the oil is a very well-controlled international market, and pricing would become very important in this regard. There is also the nuclear part of it, where India is now wanting to step up enormously the production of nuclear energy in India. And there is talk about small modular reactors on which there could be cooperation between India and the United States. So this could help in better balancing the trade deficit between India and the United States. With regard to defense, yes, in principle, already India is now very open to acquiring defense material from the United States. The total volume has gone up to 2022 or $25 billion, whatever the figure is. And there could be more purchases of PY-8 aircraft, which are very important for maritime surveillance and underwater sea technologies and all that. There is scope of purchasing things from the United States, which we need for our defense, but there are constraints. There are budgetary constraints. And of course, there is this issue of seeing what is best for us in terms of managing the already hugely diverse, systems that we have from various countries. Now, this F-35, which has been offered, to my mind, I don't think this is going to fly. There are various reasons for this, and it should not become the touchstone of India wanting to expand defense ties with the United States.
Right. I'm going to take a short break, but we will be discussing a lot more on the sensitivities on trade between the two countries. I'll be going back to Ambassador Arun Singh, but we'll be taking a break. Right back with this discussion on the optics, the importance of J.D. Vance's visit to India.
Whatever impact we have seen in terms of F&O order. On month basis, I am seeing a growth of around 6 to 7% now for this past 2 months. So that gives a broad sense that, okay, retail are coming back. See, for retail, there was no reason for them to come back because markets were depressed. They did not see any opportunity and they were not in a hurry to really jump and decide that what kind of an instrument they had to buy, if at all not options. So what I am saying after this kind of stabilization in terms of our news that are coming and FIs inflows that are coming in, it appears that retail is getting back confidence to come back to the market. FY26 this year would be a year of consolidation.
Welcome back to our special broadcast. We still have with us former diplomats Kawal Sibal and Arun Singh. We also have with us Richard Rosso of CSIS. Ambassador Arun Singh, when it comes to import of dairy and agriculture products, India has certain sensitivities. This is to do with animal feeds in the US, use of animal fat for making certain dairy products. How do we cross that line?
We shouldn't look at the Vance visit in the context of just trade issues, as I said earlier. The second thing I'd like to point out is that for India, this is also a moment of opportunity. There is a major reordering of global supply chains that is happening. Now, in the setting of supply chains after China joined the WTO, India gained in services, but China sucked away global manufacturing. They have 18% of global GDP, but have 32% of global manufacturing through subsidies, through forced technology transfer, through building excess capacity. Now, a major reordering of supply chains is happening. So I think this is how, as I see it, Indian leaders and negotiators are looking at the opportunity. How do you plug into this reordered supply chain so in that India gains not just in services, but also in manufacturing? Now, as you look at negotiating this, there will certainly be some areas where we may need to make some concessions. But so long as we can get enhanced market access to the US, so long as both sides are not just looking at existing pattern of trade and production, but looking at taking the relationship to a $500 billion trade agreement. And one of the ways to do it is through this partnership on critical and emerging technologies that they have worked out, which is now being called Trust, transforming the relationship using strategic technologies. So you look at doing co-development of technology. Based on that, you look at doing production sharing. And based on that, you see how you can benefit from a multi-sectoral free trade agreement. So that is the approach. Now, there will be certain sectors where there will be disagreements. And the two sides are both, be mindful of each other's sensitivities and look at the new opportunities. That will be the way to address this issue.
Right. Ambassador Sibal, returning to you at this point, when you speak about reordering of supply chains, when the US is imposing a 245% tariff on certain Chinese products such as syringes and electric vehicles, there is an opportunity for India. How do you see India and US deepening the relationship going forward?
Look, a couple of things. The last word has not yet been said about these tariff wars and this and that. A lot of countries have been targeted. China, of course, is specifically targeted, but there are other countries like Vietnam, Bangladesh, and others on which tariffs are much higher, and that could open up opportunities for us. And then, of course, from on the U.S. side, there is no real clarity about what lies in the future, because you get contradictory decisions. You have there's a change in direction. There's a willingness to find a solution. President Trump is even now saying that he's very hopeful that he'll find a solution to the problem with China. I mean, he keeps being very optimistic about it. So therefore, one shouldn't assume that the situation will continue in the direction in which we are thinking. And therefore, we should base our strategy on what could be opportunities for us. Opportunities would be there, but then there's the other thing, which the US side has announced, that they're also going to actually impose tariffs on pharmaceuticals as well as semiconductors. Now, as part of a different set of tariffs. Now, if that happens, that creates other issues for us. Fortunately, on the side of services, since we don't impose any tariffs, therefore the tariff issue for the moment is not there. But you never know what could happen on this front. So to come back to your specific question, even with the Biden administration, there was been a lot of talk about trustworthy, resilient supply chains. And the whole idea was to reduce dependence on China, which is monopolizing very critical supply chains and critical raw materials. And now, of course, they have, as you know, imposed a ban on export of some very critical raw materials, which are necessary for the EV industry. So this is a clear warning that the impulsion to create alternative supply chains and reliable supply chains is going to become stronger. And India, fortunately, gives a sense of confidence. Our democratic system, we are not in competition with the United States in terms of replacing the United States as the principal power in the global system. We have no large strategic differences with the United States today. I mean, the issue of trade is there. But beyond that, unlike in the case of China, there are no large strategic differences. On the contrary, there are actually strategic points of convergence between the two countries. So that gives us a basis of moving forward. And finally, although that's not your question, I think we have a lot of friends in this new administration. Of course, the tariff guys are pretty strong, pretty demanding when it comes to us. But on the political side, we have a lot of people who are very favorably inclined to India, includes the vice president, and therefore we'll be able to manage this reasonably well.
Okay, finally, Rick, a final word from you. What's the word on the Hill in Washington when it comes to the trade deal? Do you think there will be an early trade deal, early harvest deal, even before Trump's visit in fall? Could this happen in the next 90 days?
I think it certainly could. In fact, I would lean towards at least negotiating the deal and having it ready to cook well ahead of the visit. I think India's strategic imperative to get this agreement done, not just for the fact that the United States is India's most important economic partner, so they want to keep that alive. But if India is the first one to get the deal done too, the ability for India to land other countries' investments as well that want to get good access to the U.S. market, could be tremendous. So I think negotiations, I suspect both sides have a drive to get it done sooner rather than later. Although the actual inking of the deal, they may wait till the president, since it's something that he's kind of put the stamp on. But I do think that there's a really high chance that they actually get this done on time or even ahead of time.
Right. Thank you very much, Rick Rosso, Ambassador Arun Singh and Ambassador Sybil for joining us for those very interesting details on the importance of J.D. Vance's India visit with his family, clearly showing a very strong degree of trust between India and US. But remember, when it comes to China, the different pieces of the puzzle are constantly revolving. Things may not remain the same, as Ambassador Sybil is pointing out. But let's see how this translates into a strong trade deal, a mutually beneficial trade deal between the two sides. That's all we have time for. Goodbye.
Focusing more on getting back to OPM, and the growth is going to help. So currently we are not working on what kind of top line we will achieve, because it's a function of market condition, lots of things. Internally, what we can do is that, okay, how do we bring in AI tool, get more cost efficiency, and how do we bring in more customer on our platform? So result of that, whatever revenue we are going to get, it is very difficult to predict at this point in time. But what we are confident is that we would be able to bounce back to an OPM of 40-45% by Q4 FY26.
The travel and tourism industry has been on a good run, and the hope is that things will continue. The momentum, of course, has been built up. And as we look at the new financial year, which has started, we are already seeing signs of the domestic move strengthening further. Of course, international at this point in time a bit uncertain given the escalation of the trade war. Back home, the big story, of course, emerging is Indigo. It has become the world's most valuable airline, with its market cap crossing $23 billion. To talk to us about Indigo's aspiration of being India's first global airline is Peter Elbers. Peter, always a pleasure. Many thanks for joining us here on CNBC-TV18. It's great to have you back on the program. Let's start with India, and let's start with domestic travel at this point in time, still looking very, very strong. As we start this new financial year, I know you can't give us specific numbers because you are in your silent period, but what's the mood in the market at this point in time?
Yeah, thank you. Thanks for having me here today. And it's a pleasure to speak to you always. If we look about the development of the domestic market and we take the most recent published official numbers, and as you said, I cannot give any speculation about today's numbers since we're in that silent period. But for both the month of January and February, the DTCA data was released, and both of them actually had an 11% increase, which basically are very, very good numbers. So there was some slowdown at the beginning of 24. Around the election time, there was some slowing down, but actually ever since we can see a very solid demand and a very positive development of that demand.
Well, speaking of demand and speaking of positive developments, I'm just taking a look at the numbers for your summer schedule, 14,158 weekly flights. That's much higher than the 13,050 flights last summer.
Yeah, we keep adding and we keep growing, and for the financial year, which is past, we announced a early double-digit growth. We have actually the same outlook for the next year. And for an airline of our size, today we operate a little short of 2,300 flights a day. You know, if you think about that, take a step back, we're welcoming every 3 days 1 million customers. You know, by the time this interview is over, we've welcomed another 7,000. So it just shows that the numbers are there and the numbers continue to grow. So our ambition really is to double towards the end of the decade. That's a long-term projection. But in the meantime, we keep adding these numbers.
Well, speaking of adding numbers, it's what, a plane a week at this point in time? That's the run rate that you're working with?
Yeah, that is still the runway. I mean, the last year, 24, we received 58 aircraft. And, you know, I think it gives a lot of pride to everyone at Indigo and probably India also. You know, the single largest taker of planes on the world, not the region, but the world, was Indigo. So here we are, an 18-year young Indian airline taking the highest number of plane deliveries from anywhere in the world, 58 planes. That means more than one a week we had last year. And our ambition is actually to continue that growth path well into the next decade.
Well, I know it doesn't directly impact Indigo, but let me ask you about what you make of China's decision not to order Boeing jets any longer. We don't know whether that will eventually happen or not, but how do you see that development?
You know, that entire discussion today around the tariffs and that US China development, especially when it comes to aircraft. I think the world today is in need of having multiple suppliers when it comes to aircraft, and clearly Boeing and Airbus being the two largest. So I would assume that the resolution is found one way or the other at that point in time.
Well, speaking of finding a resolution for the capacity constraints that you're faced with, you are continuing to lease aircraft. You've just leased 4 more from Norseal. What's the plan on that front, especially as you have these big global ambitions?
Well, the Indian market is growing at a great rate. Despite our large order book, still some of the global supply chain challenges are really affecting us when it comes to delivering the capacity. So ever since this started to occur 3 years ago, we have taken a whole range of mitigating measures in terms of extending leases, getting temporary planes, doing some damp leases. All these things have really helped us to live up to our capacity guidance. Now we have ordered the wide bodies, so we have 27. The first wide bodies are coming in, and actually we don't want to wait for that. So as a bridging until that time, we started to damp lease 787s from Norseal.
So does this give me a sense that the decision to not wait for the wide bodies and actually go in for leases is a way for you to accelerate and speed up your international expansion plans?
It surely is. The market is there. A lot of Indian travelers today don't have the opportunity to travel either direct or travel on an Indian operator. I think by us providing that capacity, there's an opportunity for people to start flying direct, or to, you know, we have announced Manchester is going to be the first direct connection from Delhi into Manchester. That's great, both for the people in Delhi and actually India, and the people in Manchester. Amsterdam is the other destination we'll be starting adding, and there's more to come. And
so what more can we expect, at least as far as this financial year is concerned? How many more destinations do you intend to add?
Well, we will have the number of Norseal planes going up from 1 to 4 in this year. We will start with the XLR. That's a very important development for Indigo. That will allow us to further stretch the range. We haven't disclosed yet which destination, which number, but let me share the following number with you to get a bit of an indication. When I joined Indigo 3 years back, we had like 25-ish international destinations. Today we're 40. And Fujairah has been announced as number 41. So that is in a time span of less than 3 years.
You've doubled.
We pretty much doubled.
Yeah.
And of course, there's an end to, you cannot endlessly double it. But India was so largely underserved, and the demand for the Indian consumers, ranging it from Karabi in Thailand to the Middle East to Europe, is just massive.
So, coming back to specifics now, in terms of your international ambitions, because when we last spoke, you said you want to make Indigo India's global airline. So in the near term, what does that mean in terms of the number of people that you will fly on your international operations? What does that also mean in terms of your margins and change of margin profile?
The Indigo International Network, Shireen, is started some years back, very traditional, if you wish, between India and the Gulf and the Middle East countries. We've been slowly expanding that. So in 23, we started flights into Central Asia. We started flights into Nairobi. We have moved, and I had a meeting earlier this week with the CEO of Changi Airport. We moved from moving into Singapore from 3 Indian cities to 9 today. But that's still within that 5 to 6 hour radius. I think the next step for Indigo is to make sure that even Europe and further parts of Asia would be accessible directly operated by Indigo. And, you know, if India is going to be the third largest economy in the world by 27, the country needs and deserves actually an airline of the size and scale and potential of the nation.
So what is the indication and the timeline that you're working with in terms of the wide-body deliveries because of the backlog that we're dealing with?
You know, just some numbers here. Today, we have ordered 30 wide bodies. The delivery start from 27. We don't want to wait for that. That's why we have the temporary bridging. We used to have around 25% of our available seat kilometers international. This year, we're reaching 30, and we've put a projection out there to move that percentage up to 40%. So the foundation of who we are as Indigo will remain strongly and deeply rooted in India. We operate a little short of 500 routes in India itself, direct city pairs. That's the foundation of who we are, and that continue to be. Out of that 500, pretty much half of them are unique. So that provides suddenly air connectivity, connecting the nation, giving wings to the nation. But on top of that, that international dimension is being built. And 40% is the number which we put out there.
40% is the number. You know, we're still waiting for your results to be announced, which will be sometime in May. So you can't give us specifics, but the street is working with estimates as far as what profitability for you could look like. It's been 9 quarters on the trot, with the exception of 1 quarter of positive bottom line for you. At this point in time, given where crude prices are and have come up very, very sharply, as well as demand, you're looking at significant tailwinds, I would imagine, aren't you?
Well, I think in another configuration, one would call that a leading question. As you rightfully pointed out, we're in a silent period, so I cannot give any indication of guidance.
Don't talk to me about numbers. But
looking back to what we have done, and I'm very proud what the Indigo teams really have achieved. You know, in the middle of 22, we were exiting from COVID, and I remember joining at that point in time. We made a sort of small profit, but was very meaningful because it was actually, you know, the dark days of COVID were behind us, and we started to emerge from that. And ever since, we have been building not only our network, our customer proposition, our profiling, but actually creating the margins to start investing in the future of the company. You know, if you want to become a global airline, we should have a service, IT, digital tools, all centered around that.
So what does that mean in terms of investments over the next few years, whether it's on IT, whether, I mean, we know what it is going to cost you as far as the aircraft is concerned, but, you know, just building out the ecosystem to be able to deliver to the promise that you've just articulated, what will it mean in terms of investments?
Well, there's going to be serious investments, and obviously fleet is the largest part of it. Next to fleet, it's people. You know, this is the training center, and really very important part of Indigo is the people we have. It's also very much all our investments in digital. We start to invest heavily in AI. You know, we were a bit behind that, but if India is home, we should invest to that, and we should actually lead that. So we have our own sort of AI center now building and working.
Is there a number, you know, that you can share in terms of what you've invested so far on AI?
I don't have a number of crores, but it's multiple crores. Obviously, we're investing in that. And last but not least, it's not only our own investment, but also partnerships. So as recent as last week, we signed up a big partnership with Accor. So it's the first of its kind in India. And basically what we will be having now, that all our blue chip members can start using their points in staying in Accor hotels. And Accor members can using their points in flying Indigo. Accor is present in all our 40 international destinations. So what does it mean for an Indian consumer? You fly a lot domestic, you use your points to either fly with us international or have your hotel in Bangkok or Dubai or Singapore, wherever you go, and use the Accor hotel.
So, you know, Accor is one of the partners that you've signed up as far as the Blue Chip loyalty program is concerned. I just saw that you've announced a partnership with Swiggy today as well. So, you know, as you look at building out this partnership ecosystem, what should we look forward to next?
No, I think the philosophy here is we'll have a couple of leading partners in different spaces, and building an ecosystem is exactly what the word is. So it will have, Accor is clearly such a great global hotel brand that we sign up with that one, and then probably we have a couple of smaller ones. Swiggy is a very different notion, but also helping us to build that ecosystem, and especially in the high speed of India. The speed of having partners adding it, that I think Indigo is very well placed to participate in that boom.
Let's talk about Indigo Stretch, which is, of course, the business class offering and part of the premiumization strategy as far as Indigo is concerned. What's the response been like? I mean, you launched in November, so it's well over 6 months at this point in time. You've gone from Delhi now to Mumbai, Chennai, Bangalore. What can we expect in terms of Indigo Stretch?
Yeah. Maybe first to address one point. You said the premiumization strategy. I wouldn't call it the premiumization strategy. What we have is that very foundation. So we have a little short of 500 domestic routes. We'll have 10 out of those 500 having this stretch product. So we're basically adding a product on top of what we have. And then even on those 10 routes, if we take Delhi, Mumbai, there's 20 flights a day. There's a plane has 220 seats, 12 of them are premium and all the rest is economy. But it's very important for us because it starts to prepare for the next phase for international, start to prepare for our corporates. Delhi, Mumbai was the first route to start. That one has been received very, very well. The reviews we get on social media from customers, emails, whatever, is very, very positive. It's a tailor-made product.
Yeah.
It is very much geared to what we have. For example, we have now all these flights there and people just love it. So Delhi, Mumbai is doing well. It started, it's in full operation. Delhi, Bangalore is just recently completed its full 14 daily flights are now all being accommodated. We have Chennai launched and Hyderabad is the next one to be on the list.
Yeah, and so the planes that you're getting in, the one a week that comes in, all will have these 12 stretch seats.
Yes, Shireen. So we have taken a decision to have 45 of these aircraft with stretch. We started in November last year, each and every plane. So pretty much every Monday, a new plane comes in, sometimes on Friday. But, we have these planes coming in, and every new plane comes in, we put it on the route immediately. So the incubation period, if you want to call it like that, for us is like 12 months, and then all these routes should be in operation, which is incredible speed.
With speed and efficiency, and let's talk about efficiency and where you believe you can draw out more efficiency at this point in time to try and give you a further bump up as far as margins are concerned. I mean, you continue to be the market leader, well over 60% share at this point in time. What else do you believe that you can do to squeeze out more from the business, to juice it out even further?
I think Indigo has developed and optimized its processes in a formidable way. The 3-point disembarkation, the turnarounds of planes, the efficiency of the processes. In an environment where sometimes capacity constraints, airports in renovation, air traffic control. So it's the weather, it has a lot of challenges. Despite that, I think Indigo has optimized that. So that's where small innovations like adding a third ramp is helpful. I think the next breakthrough really is going to be in the field of digital, where a lot of information to our customers could be further digitized, could be further optimized. Self-rebooking tool, if there's bad weather, why should we rebook your flight? You may want to do it yourself. You choose yourself. So there's a lot of these processes in the works where we really believe that that's the next level of optimization.
Howard is a joke, teaches hate and stupidity and should no longer receive federal funds. These are the words of America's most powerful man, who's going after America's most prestigious, richest and the oldest university. And
let's talk about some of the regulatory challenges that perhaps could be on the anvil. We've once again seen the parliamentary panel recommend the possibility of looking at intervening in the market as far as prices are concerned. We've now got the government setting up a special cell where customers can actually talk about their complaints as far as pricing is concerned. Would you worry about the possibility of government intervention on pricing at this point in time?
Well, when there's a body where customers can complain about certain things, I think that's a good thing. There's always good for companies to have a body which keeps sort of things in balance and things. So I think in general to have a body like that is a good thing. Having said that, looking at the Indian market, it's one of the most, if not the most competitive market in the world. The average price levels are extremely competitive. There has been some recent reports which made a comparison. How did inflation go over the years and how did airfares go? And actually you could see that the inflation has gone much faster than the airfare. So we need to catch up in that in efficiency and sort of in order to keep the margins. Because in the long run, there must be a correlation between the cost of doing business and the price of airfares, right? Otherwise you'll be out of business. I think this is some part of the history of aviation in India. Last and very importantly, if we want to build global aviation giants in India, we should also look at what's the global dimension and global dynamics we're playing in and what type of airlines and size of airlines we need for that. So a good thing that the body is there. We fully support and we're fully transparent on that. When it comes to average prices, it is one of the most competitive markets in the world. Yes, there's peaks, but so is that in hotels. And let's look at it more from a global level rather than at the specific domestic route.
But has there been any conversation with the government on this issue?
You know, there's permanent conversations. If there's questions, there's conversations, right? And I don't.
I would imagine that you got a lot of calls during the Mahakumbh.
No, as an airline, we should never shy away from those conversations. And when there are certain prices which, you know, if there's one ticket which has, I don't know, 40,000 rupees on the route, that are occasions, you know, sometimes these systems push up the prices. I think the real discussion for the Mahakumbh is when it became clear that there was so much demand, we pretty much doubled the number of flights we had. If you've been to Prayagraj airport, it's not a very large airport. So I think the collaboration between the airport, the air traffic control, the authorities, ourselves, to put in all these additional flights, that worked out very, very well. And then, yes, there's a lot of chatter about, you know, there was someone booking a flight in the south of India, connecting over Delhi and Hyderabad. And but let's park that for a minute. Let's look what we have collectively achieved in making sure that all these people could travel there. I was one of them.
You were? How many people did you fly to the Mahakumbh?
You know, I think we operated close to 1,000 flights. There's 230 seats per flight. So that pretty much back and forth. So that's what, 5 lakh in and out together.
Yeah.
A very rough estimate.
But staying with possible regulatory challenges, I mean, there was a pushback from industry on the change as far as flying norms are concerned for pilots and the crew. Now the norms are expected to kick in July, the new FDTL norms. What will that mean? I mean, I don't know whether they will or won't. As of now, they're slated to come out in July. What will that mean in terms of operations and your turnaround times?
No. Safety for us is of paramount importance, and clearly it's important to continuously review all these rules which are related to that. What we also find important, let's take some of the best practices of other parts of the world as well, include these best practices in the discussion. Some other countries or continents have gone through a long phase of growth and development. India's aviation is actually taking off now, so I think it's a great opportunity really to incorporate some of these learnings. So the fact that the entire discussion on FDTL is starting and should be a very mature discussion, because there's no dispute on the importance of safety. Everyone fully subscribed to that. As it stands now, that 1st of July is there, and we're in the process of evaluating and detailing what exactly does it mean at what point in time.
Will you need to hire more? You know, July is not very far away. If those norms kick in, will you need to hire more?
July is not very far away, but still, again, we're reviewing what's going to be the precise impact, what possible ways of network alignment, and it has a lot of elements linked to night flying. What does it exactly mean? Should the network be changed? Should we stop some of the flights in the night? Could also be a consequence. So I think even there it's a holistic picture, and I think India at large has benefited a lot from the development of aviation. I think it's important that we sort of keep that momentum, and of course against the backdrop of safety first.
User development fee being hiked across majority of the major airports, whether it's Mumbai or Delhi. Do you believe that's likely to impact, travel demand? How do you see that affecting the sector?
Well, that's a fine balance. I think a lot of the investments which are taking place in airports today are great investments, and probably we're really up to those investments. And I think with that, some of the airports in India are now world-class airport facilities. And again, we need that. The country needs to have world-class airport facilities. If we want to be a global aviation hub, hubs are created by airlines, but can only be created in close collaboration and working together with airports. So that's what we need. Having said that, looking at the price sensitivity, a few hundred of rupees sometimes is enough to have people flying or not flying. So we should be mindful of looking how these user fees will eventually find their way into ticket prices. Because at the end of the day, there's a correlation between what is the price and the cost price of a product, and what is the price for the consumer eventually. So full support for all the changes. I think it's important that it's being done. But we should be mindful that, at the end of the day, the price of the ticket is based on different elements, and this aspect is an important part of that, and that should be in line with it.
Is it in line with what you believe is the kind of threshold, or do you believe it's tipped over?
I think at some points it runs the risk of tipping over. If you take the price of a ticket, the price of some of the UDFs should, in terms of percentage and correlation, should be not too much as the total price of the ticket, right? There's going to be fuel and flying and this and that and the other. So I think, again, full support for all the changes we're making, but we should be mindful of what would it do eventually for the total ticket prices.
You've also got new airports coming up. You've got the new airport coming up in Mumbai. Of course, you've had to move airports here in Delhi. There's Jewar expected, and that's on the anvil as well. In terms of the new airport infrastructure coming in, what does that mean as far as perhaps opportunities, but also adding to the complexity as far as an airline is concerned?
Well, I see it as a big opportunity, and all the large cities in the world, the mega cities in the world, are having 2, 3, or even sometimes more airports. London, Paris, New York, Shanghai, Tokyo, they all have multiple airport systems. India didn't have that system so far. Therefore, 25 is a big year for Indian aviation. So we welcome very much the opening here in Noida. We welcome the opening in Navi Mumbai. Indigo has committed very much to both new airports. We had the honor to do the sort of first test flights on both airports. They went very well. We will start building without decreasing on the existing airports. So I believe there's room for us to operate from both and not to decrease at the existing airports.
You pick up on this on social media. You pick up on this from customers who sometimes even reach out to us and so on and so forth. You are today the world's most valuable airline. But are you India's most loved airline is the question. And do you aspire to be India's most loved airline?
I would say, yes, we are. If I see what we do for the communities in terms of providing air connectivity, in terms of providing services, half of our routes are routes where others are not operating. So we're actually creating that opportunity. When I traveled to, not so long ago, I was in Durgapur and Deoghar. If you see what we are doing there in terms of creating that connectivity, so that's that much appreciated, recognized. So that is, if you want to call it, the hardware of the equation.
But what about the
software?
software?
When we look to the software, exactly, I was coming to that. When we look to the software and see what our staff is doing in often very difficult circumstances. If there's a flood at the Chennai airport last year, our people stand there and they deal with all the challenges which are there. It's outside anyone's control what's happening. and yet they deal with it. If I see the work we're doing, we now moved from the Delhi terminal 2, temporarily closed, everything had to go to terminal 1. That's a massive operation, and yet they do it. So be it on the ground, be it in the air, you know,
But the user experience, I mean, I'm sure you see the feedback as we do as well, whether it's the quality of seats, whether it's the fact that there's virtually no cushioning on some seats, whether it's food. I mean, how do you respond then to that feedback? Are you using that feedback to try and do something about the user experience?
It would be arrogant not to use it. So yes, we do. Yes, we do that. Looking at, and we monitor our net promoter score, and we monitor social media. So we do that, and we take that serious. You know, if we have 3.5 lakh customers a day, there's going to be complaints of those customers. And when seats are not correct, or when planes are, then of course we're addressing that. And even when staff behavior is not correct, we're addressing that. But by and large, and I think India has a system whereby customer complaints are all registered at the DGCA. It's all monitored very, very well. Our statistics look very, very, very strong there. Yes, there are still cases where people send, and all these complaints are being followed up. And if you put it even on a more international scale, our service stands out. So I think we have the hardware in place, we have the software in place, and with that together, the India's preferred airline is a subtitle we are proudly adding to the name Indigo.
Okay, well, Peter, I'm going to end by asking you to give me a sort of broad picture of what you're most excited about for 2025. We'll come back to the numbers when you can talk about them, but leave us with a broad picture of what you're most excited about for 2025.
2025 is exciting for the Indian aviation industry because we'll be hosting IATA, and finally we'll have a second airport in Delhi and Mumbai. That is for the industry. For Indigo specifically, we accelerate our internationalization. So we grow to more destinations. We got the wide bodies coming in. We got the XLR coming in. And that will basically be a very important step in the building of our global footprint. And from a customer perspective, we'll have the stretch domestic. We have a loyalty program, and we have a lot of new services on offer.
Well, it's always a pleasure, Peter. Many, many thanks for joining us, and we look forward to speaking with you after your earnings are out.
After the earnings, we do that. Thank you so much.
Thanks very much. Appreciate your time. With that, it is time for us to wrap up this CNBC TV18 special from me and the team on the show. Thanks very much for watching.
President Donald Trump. The US government has now threatened to ban Howard University from enrolling foreign students after the university said it will not surrender its independence. What does it mean? Let's understand the controversy in detail. Now, the US Department of Homeland Security, or DHS, has threatened to revoke Howard University's certification to enroll international students. This comes after the Trump administration decided to freeze over $2 billion in federal funding and cancel $2.7 million in DHS grants. Now, why is Trump going after Howard? Well, he has accused the university of allowing anti-Semitism and promoting ideological bias against Jewish students. Remember those protests that happened across most universities in the US last year in the wake of Israel's attack on Gaza last year? Now, many students protested at Howard.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty gained for the 5th straight session, the longest winning streak in a month. The Nifty reclaims 24,000. The Nifty Bank hits a record high. Gold continues to rally as prices hit another record. Weak dollar, ECB's rate cut, and President Trump ordering a probe on all critical mineral imports spark more safe haven buying. The price of 10 grams of gold in India now above 1 lakh rupees, including GST and making charges. US Vice President J.D. Vance and his family begin a 3-day India visit at the Akshardham Temple in Delhi. Prime Minister Modi will host a dinner later this evening. Vance will make an address in Jaipur tomorrow, where he's likely to make policy statements on the Indo-US ties.
Finance Minister Nirmala Sitharaman is hopeful of a trade deal with the US in the incoming months as she begins her 5-day visit to the US. India's team, led by the new chief trade negotiator Rajesh Agrawal, will hold talks with US counterparts to sort out pending issues. Both sides have finalized the terms of reference, covering 19 chapters of the proposed bilateral trade agreement. China warns countries against striking a trade deal with the US at the expense of Beijing. Chinese Commerce Ministry threatens countermeasures in a resolute and reciprocal manner. A bureaucratic reshuffle at the Finance Ministry amidst hectic trade negotiations. Arvind Srivastava, who was working with the Prime Minister's office, is appointed the new Revenue Secretary. Wum Lun Mangwal Nam moves from Civil Aviation to become the new Expenditure Secretary. Pope Francis dies at the age of 88 after a prolonged illness, the first person from Latin America to be anointed as the head of the Catholic Church. Pope Francis was known for his social justice advocacy, his calls for reforms within the Church and his environmental activism. Finance veteran KV Kamath says banks need to cut their operational cost to 1/4 of current levels just to survive. Kamath predicts banks will end up providing only retail loans in the long run, with the market providing corporate and infra financing. That's a money control exclusive. Rohit Sharma, Virat Kohli, Jasprit Bumrah and Ravindra Jadeja get contracts from the BCCI. Rishabh Pant promoted Shreyas Iyer and Ishan Kishan make a comeback as 34 players get new retainers. Well, let's start with the day's trading action. After a long weekend, Dalal Street came back to trading day with a bang, gaining for the 5th straight day. It's the longest winning streak in a month. The Nifty reclaiming the 24,000 marks, and banks led from the front, with the Nifty Bank hitting a record high. It's almost a 2% rally there on the Nifty Bank, a new record for that, 1% higher on the Nifty, reclaiming 24,000, and the Sensex up by about 855 points. Mid-caps did also outperform. Prashant standing by to wrap up the trading action. Prashant, looking strong as we start the trading session.
Well, a strong day once again as we start a full week of trading. I mean, last 2 weeks we've seen massive gains from the lows, of course. Nifty's added about 2,000 points. And today, if there's any indication, there's no signs of stopping. Bulls are back and back strongly, especially large caps. And of course, I mean, foreign buying at the margin is back as well, which has been very evident over the last 4-5 trading sessions now. So the Nifty past 24,100, the Nifty Bank making a new all-time high. Mid-caps and small caps, which lagged a little bit last week, participating very strongly today. I'll start with what was up in terms of the Nifty. Tech Mahindra was a big one, went up. And by the way, Infi was not a great number, but the Infosys stock itself was... it closed higher, but other IT stocks did much better. Of course, I mean, the Nifty IT index is down 25%, maybe a little less now after today's gains for the year so far. IndusInd Bank continues its journey. I mean, 15% last week, another 4% today. Trent was up 4%, Hero MotoCorp 4%, Power Grid 3.5%, Bajaj Finserv, Mahindra and Bajaj Auto were some of the other names which were up and about. Only 3 noticeable losers, Adani Ports, HDFC Life and HUL, which were down about 1% plus. In terms of broader market, lots of winners. And I'll just outline some. BSE was the big one, 6%. But the capital markets play, BSE, K Fintech, Novama, 361, Angel One. I mean, that entire pack was a buzz today, top performing sector. Tata Elxsi, 9% numbers again were poor. But I mean, of course, there was, I guess, a lot of covering and some buying as well. Just Dial, big one, 12% back by volume. Suzlon was up 10%. Atul Limited, about 4.5%. Sterling Wilson Solar continues its gains off the lows from last week. You had Vijaya Bank, Aavas Financiers, J&K Bank, Spandana Spurti, All Cargo Logistics up 6% and many more. So decent day, very decent day for the broader markets as well. In terms of what was down, Kirin Industries down 4%, Marico was down about 3%, and a name like Avanti Feed was down about 5% as well. But can't complain because, the repair and recovery over the last 2 weeks has continued as we begin, as I said, this new week. Back to you.
Thanks very much, Prashant. Repair and recovery there as far as the stock markets are concerned, but it continues to be a frenetic rally for gold. Gold rallying with the yellow metal hitting another record high. A faltering dollar and worries of a global economic slowdown have kept safe haven bullion in demand. Manisha standing by. Manisha, the gold gallop continues clearly.
Well, thank you for that. Those numbers on your screens are absolutely all-time highs for the global and the Indian markets as well. So we've done an all-time high of $3395 an ounce in the international markets. For the Indian markets, until now, it has been $96,850. So rupees per 10 grams. So, well, absolutely running, making newer highs in every time zone. Asia started higher, Europe has followed in. And if the US were to follow the same suit, you could be looking at much higher prices beyond $3,400 an ounce as well. Well, the support in gold prices comes in from the fact that you are looking at uncertainty in the global markets. Well, that actually is a calculation on what really you would be paying in sense of gold prices in India. These are the prices which are not inclusive of GST and making charges. Once you start adding all of that, we are almost at ₹1,10,000 per 10 grams for the Indian markets. If you were stepping out to buy gold today per 10 grams, whether it was a coin or jewelry, you'll be paying much higher than ₹1,00,000 per 10 grams already. And the expectation is that with the kind of scenario that we are working with in the international markets, whether it is about the dollar index, which is trading at a 3-year lows at or below 99 right now, is a supportive factor. And then apart from that, Trump ordering investigations on critical mineral imports, or whether it has been about a statement of not being very happy with the US Fed Chairman Powell and a statement also of firing him. So these uncertainties clearly are adding premium, and a safe haven buying is happening only in gold, and none of the other asset classes has been supportive for the gold prices as well. So $3,400 an ounce, almost done. The banks and brokerages are keeping on and reiterating their higher targets in sense of gold there. Deutsche Bank has talked about 3,700. Goldman Sachs upped their forecast to $37,000 and $4,000 an ounce as well in this year, if the current situation persists or there is more extremities coming in there. And then you have Bank of America, Citi, UBS also talking at levels of 3,350 to 3,500 on the higher side. Swiss Capital has talked about 3,500. SD Bullion has spoken about 3,500 in the month of April to May itself. So, well, very, very bullish cues continuing.
Yes, clearly the rally there continuing. Manisha, many thanks. And speaking of Trump, his deputy J.D. Vance, the Vice President of the United States, in Delhi for a 3-day India visit. Well, U.S. Vice President J.D. Vance starting his trip to India. He is the senior-most leader from the U.S. government to fly down to India since Donald Trump took oath as president this January. Now, Vance's visit comes on the backdrop of the tariff war and negotiations between both countries to seal a bilateral trade deal. Prime Minister Modi will host a dinner for the Vice President later this evening. Now, Vance will make an address in Jaipur tomorrow, where he's likely to make policy statements on current Indo-U.S. ties. The U.S. Vice President has been accompanied by his wife Usha and their 3 children, who were seen in traditional Indian attire. They were received by Union Minister Ashwini Vaishnav at the Palam Air Base in New Delhi. Later, J.D. Vance and family will have visited the Akshardham temple in the capital and spent nearly an hour there. Parikshit is standing by to take us through what is on the itinerary. Parikshit, J.D. Vance will call on the Prime Minister later this evening. What are some of the issues that are likely to be up for discussion?
Well, trade and tariffs could take centre stage when Prime Minister Modi meets J.D. Vance at his residence. This is going to be an official meeting, possibly will last for about 30 to 35 minutes. And we do believe that somewhere both sides will express an intent or a request to resolve all outstanding issues at the earliest. At this level, you don't expect the leaders to go into nitty-gritties, but somehow there would be discussions on how we can move beyond the differences on the trade front and have an interim trade deal at the earliest. Our understanding is, and we learned from sources privy to the trade talks, that the Indian side has agreed to reduce the average tariff rate from somewhere around 13.5% to 10% all across the product lines, but US is seeking zero tariffs. So will there be a compromise? That remains to be seen. Will India reduce barriers on agriculture and dairy? That remains to be seen as well. But both sides are expected to express their sensitivities and somehow say that let's move on and have a trade deal soon that can mutually benefit both nations. Having said that, discussions on immigration, discussions on defense acquisitions, energy, startups, space, these are some of the issues that are going to crop up in discussions. Russia-Ukraine war, the war in Gaza, definitely up for discussion, and India will also give its view on these subjects. China will be a big point of discussion. The US has imposed an almost 245% tariff on certain Chinese products, and Vance is expected to give his rationale on reciprocal tariffs to Prime Minister Narendra Modi, and both sides are likely to align foreign policy views on China as well. Thereafter, he will be going to Jaipur, where he'll visit Amer Fort. That's a personal visit with his family. In the afternoon, he gives a speech at the Rajasthan International Centre and goes to the Taj Mahal in Agra on day 3, following which he heads back to the United States. So it's an official trip in one sense, but there is a lot of personal element to the visit as well.
Well, Parikshit, many thanks for joining us. And let's stick with the official, because Finance Minister Nirmala Sitharaman is in the US on a 5-day visit. The Finance Minister addressed the Indian diaspora in San Francisco, where she expressed hope in being able to achieve a bilateral trade deal with the US in the coming months. Both sides have finalized the terms of reference covering 19 chapters of the proposed bilateral trade agreement. Here's the Finance Minister in San Francisco.
Keenness with which we are engaging with the US administration, even as I talk, I think the Vice President of the United States of America is in India. He will be engaging with the Prime Minister hopefully this evening or tomorrow. In between all this, the additional USTR had visited India to see the progress or to engage with the negotiating team who's dealing with the tariff-related negotiation and with the bilateral trade agreement that we want to sign. In fact, the progress of the agreement or the trade agreement that we are working on, at least a first tranche, is something which we hope to conclude by the fall this year.
Well, that is the Finance Minister in the US. As trade talks between India and the US progress, India has announced that IAS officer Rajesh Agrawal will take over as the next Commerce Secretary in October. He's currently the Additional Secretary in the Department of Commerce. A team led by Agrawal will hold negotiations in Washington this week to iron out differences in striking a bilateral trade agreement. Abhimanyu joins us now with more. Abhimanyu, what can we expect this week as talks restart?
India's negotiating team is set to visit the United States this week to sort out pending issues before launching negotiations for a bilateral trade agreement between both the countries. Led by Chief Negotiator Rajesh Agrawal, who's an Additional Secretary with the Department of Commerce, the team will speak to its American counterparts for 3 days starting 23rd April. Sources have told CNBC-TV18 that India and the US have finalized terms of reference covering 19 chapters for a proposed BTA covering issues of tariffs, goods, non-tariff barriers, customs facilitation, rules of origin and regulations. For a proposed FTA between India and the UK, the talks are moving towards final stages, with the sticking point being the issue of resolution of disputes between both the countries. Another full round of negotiations is unlikely as discussions are progressing at a fast pace between India and the UK. With the EU, India is discussing an early harvest agreement. The 11th round of India-EU FTA talks are slated to take place in New Delhi from the 12th to 16th of May. It remains to be seen how all these talks are going to pan out, even as the pause on reciprocal tariffs by the United States continues.
All right, Abhimanyu, many thanks for joining us. Amidst all the trade negotiations and tariff tensions, we now have a new team in North Block, which is the Finance Ministry. After a major bureaucratic reshuffle over the weekend, Timsy standing by to give us the details. Timsy, take us through what has changed in the Finance Ministry. Take us through the new team that Nirmala Sitharaman is going to work with.
Well, these changes have been awaited for a while. The Finance Ministry has a slew of new faces who will take charge of the government's many economic and developmental policies. Arvind Srivastava, a senior IAS officer from Karnataka cadre, has been named Revenue Secretary. He's an officer from 1994 batch and was serving in the PMO as Additional Secretary. V. Volnam, who has been serving as Civil Aviation Secretary, is new Expenditure Secretary. This 1992 batch Manipur cadre officer will take over from Manoj Govil, who will assume charge charge as Secretary Coordination at the Cabinet Secretariat. After a long gap, we now have a female secretary in the Finance Ministry too. Anuradha Thakur, an IAS officer from again 94 batch of Himachal Pradesh cadre, will move from the Ministry of Corporate Affairs, where she was serving as an officer in the additional secretary rank, and now she'll take over immediately as officer on special duty in Department of Economic Affairs. She will take over as DA secretary from current DA secretary Ajay Seth upon his superannuation on the 30th of June 2025. Department of Public Enterprises, that is DPE, will also get a new face. Moises Chailai, presently Secretary of Interstate Council Secretariat in the Ministry of Home Affairs, will take over from Arunish Chawla. Secretary Deepam Chawla was also holding additional charge in the Ministry of Culture and DPE. The Ministry of Commerce and Industry will also see a new bureaucrat later this year. Rajesh Agarwal, a Manipur cadre officer from 1994 batch, who is currently serving as Additional Secretary again in the Commerce Ministry, has been elevated to Special Secretary, and he will become the next Commerce Secretary when Sunil Barthwal, the current Secretary, superannuates on 30th September 2025. Important to note that Agarwal is also the chief negotiator for the ongoing India-US trade deal talks. The Central Board of Direct Taxes also has 4 new faces: Pankaj Kumar Mishra, Sanjay Bahadur, L. Rajashekar Reddy and G. Aparna Rao. All revenue service officers of the IT cadre from 1989 batch will join the board.
Timsy, many thanks. Now, President Trump is registering the worst economic approval numbers of his presidential career. According to a CNBC economic survey, 43% people polled approved of his handling of the economy, 55% disapproved. This is the first time in any CNBC poll that Trump's rating has been net negative on the economy, while President overall, 44% of the respondents approved of Trump's handling of the presidency so far, 51% disapproved. This is slightly better than the final reading of the CNBC survey when Trump left office in 2020. Now, China has warned it will retaliate against countries and negotiate trade deals with the U.S. at its expense. The Chinese Commerce Ministry, in a statement, has threatened countermeasures in a resolute and reciprocal manner. China has also accused the U.S. of abusing tariffs and bullying countries around the world. It promised to defend international fairness in trade and promised to strengthen solidarity with all parties. Pope Francis, the head of the Roman Catholic Church, passed away at the age of 88 after battling a severe respiratory illness. The first person from Latin America to be elected the head of the Catholic Church, Pope Francis was known for his social justice advocacy, his calls for reforms within the Church, and his environmental activism. Born as Jorge Mario Bergoglio, he was a hope of many firsts. The first from the Jesuit order, the first to take the name Francis, and the first in almost 6 centuries to become the Pope following the resignation of his predecessor, Pope Benedict. Crowds gathered at the Vatican Square to pay tribute to the Pope. Leaders from across the world have hailed Pope Francis's legacy. Prime Minister Modi, in a tweet, said that Pope Francis will always be remembered as a beacon of courage, humility, and spiritual courage by millions across the world. The papal conclave to elect the next Pope should be convened in the next 2 to 3 weeks. And other international news, Israeli forces have killed at least 39 people in Gaza over the last 24 hours, taking the death toll from 18 months of war to over 51,000. That's as per the Gaza Health Ministry. Meanwhile, the Israeli military has said that professional failures led to the killing of 15 Palestinian medics in Gaza last month. An inquiry into the incident by the Israeli Defense Forces found a series of failings, including an operational misunderstanding and breach of orders. The deputy commander of the unit involved has now been dismissed. Russia launched an attack in Ukraine just hours after President Vladimir Putin's one-day ceasefire came into an end. That was a ceasefire for Easter. As per the Ukrainian Air Force, Russia launched as many as 96 missiles and 3 drones in overnight attacks targeting 3 regions in Ukraine, including Kharkiv. Ukraine claimed its air defense unit shot down 42 Russian drones, while another 47 drones were redirected by electronic warfare. We will head into a break, but up next, finance veteran KV Kamath says banks need to cut their operational cost to 1/4 of the current levels just to be able to survive. An exclusive coming up.
What does Trump want? The White House has demanded that the oldest university in the US make changes to hiring, admissions and teaching practices, which it says will help fight anti-Semitism on the campus. The US Department of Homeland Security has demanded detailed records by April 30th, 2025 on visa-holding students' involvement in those protests, disciplinary action taken by the university, or any perceived threat to campus safety. Yes, that is the deadline. And what if Howard doesn't listen to the government? Well, then that would result in the loss of Howard University's Student in Exchange Visitor Program certification, which will effectively bar the university from admitting new international students. Howard is the first university in the US to push back against Trump's threat, and the consequences are for everyone to see. The American government has identified 60 universities for review. Last month, Columbia University agreed to many of the administration's demands in the wake of the protests after the government cut $400 million in funding. Let's look at some numbers here. International students make up more than 27% of Howard's enrollment this year. Overall, 6,000 students. How will it impact Indian students? Well, Indians constitute a significant portion of Howard's international cohort. In 2020, approximately 2,13,062 Indian students studied in the US, with 505 enrolled at Howard alone. Now, getting an admission is not easy there, but this move could further dent many students' aspirations. And what is happening in present is not good news for many Indian students. Reports indicate that Indian students across US universities are experiencing anxiety over sudden visa cancellations for minor offenses such as traffic violations or even social media posts. Foreign students in the US have faced sudden visa revocations, as I was talking about social media posts and other things, and this comes amid, the immigration crackdown by the government. Moreover, Indian students who often rely on F1 visas and post-graduation work permits like the H-1B visa fear that their academic and professional aspiration in the US could be jeopardized because of this.
Eversource Capital is set to be in advanced talks to acquire ride-hailing startup BlueSmart. Sources tell CNBC-TV18 the company has made a non-binding offer to acquire BlueSmart for 850 crore rupees. Sources add that BlueSmart's co-founders Anmol Jaggi and Puneet Singh Jaggi may be asked to step down from their role on the company's board as part of any potential deal. A final announcement could be made within the next 2 weeks. Remember, BlueSmart has already suspended operations in several cities. This comes at a time when the Jaggi brothers, who are promoters of Gensol Engineering, face a SEBI probe over alleged fund diversion. As per sources, the Ministry of Corporate Affairs has also launched a suo motu investigation into alleged irregularities at Gensol. It will examine the company's regulatory filings and accounts. On to a money control exclusive. Finance veteran KV Kamath says banks need to cut their operational cost to 1/4 of the current levels just to be able to survive. In a conversation with CNBC-TV18's Lata Venkatesh, Kamath predicted that banks would end up providing only retail loans in the long run, with the market providing corporate and infra financing.
Challenge that banks will face, are facing and will face, is cost-to-income ratio. So unless you disrupt that cost-to-income ratio to 1/4 of what it is today, you won't survive. 1/4. I'm saying if you cannot operate, you will have to be well below the 35-40% people are.
No, ICICI and HDFC
and some people are higher than that. Banks, I think, as they evolve, larger and larger part will be to the retail sector, because they are, as of now, best equipped, unless they're disrupted by a fintech. The corporates, large part of the corporate universe today, are cash positive. The cash flows are positive and can meet most of their growth needs. At the margin, they may have to borrow. Large part of infrastructure funding will come through a market process, which is outside the banking system. It's already happening.
That's KV Kamath. Now, the government has remained silent on MTNL's rising defaults, which now stand at 8,346 crore rupees. In fact, the firm's operations are being managed now by BSNL under a service arrangement. Sapna standing by with more. Sapna, take us through the details and where MTNL finds itself today.
Well, definitely, it has been a very long road, especially also for all those banks, because MTNL continues to be, pardon me, continues to be an NPA account, so to speak. So, if you look at the latest regulatory filing, well, the default amount has actually gone up by around 69 crores. So, it's around 8,346 crores is what MTNL basically owes to banks. And having said that, despite queries across the board, we have not got any suitable response from government officials as to what needs to be done regarding the NPA status of MTNL. However, what we have been given to understand, and this is through also conversations that we have had in the past with government officials, is the fact that there is no fiscal package as such that we can talk about in terms of rescuing MTNL, so to say. Sorry, pardon me. That's one. However, asset monetization is what the government has agreed upon. That's the second element. And third, very importantly, which you have pointed out, is basically BSNL taking over day-to-day operations of MTNL. I think that has already happened from Jan 1 onwards. So that is basically going to help the company stay afloat, so to speak. But the fact also remains that 8,346 crores worth of bad loans are still sticking out, and we'll have to wait and watch and see the space for more on MTNL.
All right, Sapna, appreciate you joining us. That's the latest there as far as MTNL is concerned. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment with more.
Hello and welcome to Startup Street Future Female Forward Special. I'm Shruti Mishra and with me as always is Arundhati Ramanan. On today's special edition, we put the focus on women founders that are shaping the startup ecosystem.
Absolutely, Shruti. In fact, according to a report by Traction, India's tech startup ecosystem ranks second after the US in terms of all-time funding raised by companies with women founders. But there's still a long way to go in bridging this gender gap.
And over the next 30 minutes, we speak to women founders to find out how they are driving India's growth story. Before that, here are today's headlines. Eversource Capital is in advanced talks to acquire electric ride-hailing platform Blue Smart. Sources tell CNBC-TV18 the investment firm has made a non-binding offer worth 850 crore rupees to acquire the mobility startup.
Skills and Talent Development Corporation NIIT acquires 70% stake in deep skilling technology training solutions provider iamneo for 61 crore rupees. Post-acquisition, iamneo will function as a subsidiary of NIIT and iamneo's founding leadership team will continue in their existing roles.
Brain Matter-backed Fitter turns profitable in FY25 after 3 years of losses, clocking 128 crore rupees in revenue and 11 crore rupees in profit before tax. The fitness startup with 50,000 daily users now plans healthcare expansion, including a Pune center and diagnostic facilities backed by additional funding.
Google faces a historic trial as US antitrust enforcers in Washington seek to force the tech giant to sell off its Chrome browser as part of a bid to restore competition to the market for online search engines. The US Department of Justice is heading into trial after two major legal victories against Google, having won a ruling in August with that Google monopolized search.
Huawei plans to begin mass shipments of its advanced 910C artificial intelligence chip to Chinese customers as early as next month. Reuters reported it achieves performance comparable to NVIDIA's B100 chips by combining two 910P processors into a single package through advanced integration techniques. Well, those were the headlines we've been tracking for you this evening. On what's brewing today, AI-powered smart cribs developed by baby tech company Cradlewise is now available in India. Recently endorsed by OpenAI CEO Sam Altman, who uses it for his own baby, Cradlewise is built to help babies and parents enjoy better sleep. Its advanced AI technology detects early wake-ups and gently soothes babies back to sleep before they even cry. After delivering nearly 30 million hours of restful sleep to families across the US and Canada, Cradlewise has now brought its technology to India. To discuss Cradlewise's journey and future roadmap, I'm now joined by co-founder and CEO Radhika Patil. Radhika, congratulations on launching Cradlewise in India. But before we talk operations, Sam Altman, CEO of OpenAI, like I mentioned earlier, recently endorsed Cradlewise and uses it for his own child. What was your reaction to that, and how has this level of global recognition impacted your brand?
Hello, good evening. Yes, it was an amazing call out by Sam Altman, and it was great to have Sam trusting us with his most precious creation. And it has definitely brought in a lot of visibility and trust with because you don't want to use a new product for your baby, and this definitely helps us propel our brand and trust across the ecosystem of parents.
Sure. Radhika, it's a full circle moment for you. You've brought Cradlewise back home. It began as a passion project in your own home in Bangalore. And today you claim to be one of the world's first AI-powered smart cribs. Tell us what makes Cradlewise truly smart and how the technology works.
Yeah. So Cradlewise has an integrated contactless baby monitor. It's the world's first crib to have a contactless monitor integrated with it. It can sense movements, opening of eyes, changes in breath rate, because when you're in light sleep, the breath rate is regular. When you're transitioning to when you're in a deep sleep, your breath rate is regular, and when you're transitioning to light sleep, it's irregular. So we can collate all these data points, and it helps us predict early wake up. We also look for the sleep patterns because every baby is unique and there's no one size fits all solution. Hence, AI and learning is a perfect application for baby sleep. We learn all these patterns and help the baby soothe just in time, because as if you're a parent and you know that timing is everything when it comes to to managing
Absolutely.
baby sleep. Yeah.
Sure. You know, Radhika, with a launch price of almost 1,60,000 rupees, how are you positioning Cradlewise in the Indian market? Are there plans to offer more accessible models in the future?
Yes, we are going to offer more accessible models for the Indian market.
Okay.
We just have this model as a startup, we have been lean. So we have the same model that we are offering globally right now for the Indian market, but we do have plans of offering more variants.
Okay. You've shifted manufacturing from China to Vietnam and now to Pune in India. What drove that decision and what kind of manufacturing capabilities are we now talking about?
Yeah, honestly, it's just this Make in India pull. I mean, it has been great. The acceptance of the vendor ecosystem to work with more startups and working around with the nitty-gritties of us of the fine balance that startups need to make. So this has been great. I mean, post-COVID, there has been an acceleration in the startup ecosystem, and more startups in robotics and space tech. I mean, this all has been great. It has been a strong pull for us to relocate the manufacturing, and especially Pune being an automobile hub, availability of skilled labor and the proximity to ports. All these have been factors for us to relocate the production, plus our team being there and having better operations control and scaling capability.
Sure, sure. Radhika, if you could take us through your current business growth numbers, what is the road to profitability looking like? And are there any new products or innovations in the pipeline or any new markets that you're looking at?
Yeah, so we are young compared to a lot of other startups. So yes, I mean, building the factory has been a crucial step towards our profitability. We are currently available in US, Canada, and India. We are expanding to Australia, the Middle East, and UK in the coming year. We are also working on the R&D for toddler beds and baby monitors separately. So yes, I mean, there has been a great pull for having a ecosystem of products, because sleep is a journey, and we are looking to capture the kids sleep space, because there has been a lot that we are doing for adult sleep, but for kids sleep space there has been a white space.
Sure. You know, Radhika, this is our Future Female Forward episode, and I have to ask you, in Indian households, women often balance family, careers, and cultural expectations. How do you see Cradlewise fitting into this ecosystem, and what kind of impact do you hope to create?
Yes, very true. I mean, I've gone through the same journey. So, in Indian households, it's very normal to have the primary caregiving responsibility with the mother herself. And with the crib, we have seen that parents, mothers are especially able to work from home, and it has reduced anxiety because they feel supported. You don't have to depend too much, because if your partner is traveling and busy with work, it also gives you that extra pair of helping hands when you need it the most, especially in the night, right? When you are also very tired and drowsy. So definitely it has helped with gaining more confidence for parents and moms, especially when, the primary caregiving is still the mother.
Absolutely. And one final question before I let you go. You and Bharat are not just co-founders, but also life partners. What's it like building a startup together as entrepreneurs, co-parents, and as a couple?
Oh, yes. It's been rewarding, and beautifully chaotic most of the times. It's very difficult to sometimes, switch off between the company and the family. But we do take, active roles in ensuring that we have separation between them. Wouldn't have done it any other way, honestly, because it's a deeply shared mission for us both.
Yes.
And it is born out of a parenting journey. So yes, I mean there are challenges, but sometimes our kids help us zone out, and we had gone
Yes.
hiking over the weekend. So these are the things that we actively do to ensure that we maintain the balance.
All right. On that note, it's time for me to wrap up our conversation. But Radhika, many thanks for joining us on Startup Street today, and wish you the very best for all your growth plans.
Thank you so much. Thank you so much for having me. Yeah.
Today's edition of Startup Street is all about the women making a difference in the entrepreneurial world. We now turn the spotlight on Vidita Kochar Jain, the co-founder of Jewel Box, a brand that's redefining luxury jewelry in India through sustainability and innovation. Jewel Box has also recently secured $3.2 million in a pre-Series A round led by V3 Ventures. The round also saw participation from several prominent investors, including Atrium Angels, Dexter Ventures, and JIIF. With revenues growing fourfold year over year and a bold plan to scale to 30 stores across Tier 1 and Tier 2 cities, the brand is poised to reshape how India experiences diamonds. Joining us now is Vidita Kochar Jain, the co-founder of Jewel Box. Vidita, thank you so much for taking time out and being here with us on our special edition of Startup Street. Jewel Box was started in 2022 and has emerged as a leading name in the lab-grown diamond space, right? If you could sort of take us through the inspiration behind starting the company and the opportunity that you see in this space.
Absolutely. Thanks for having me here. So Jewel Box was started in 2022 and it's roughly been 3 years. We're going to complete 3 years in May. And it's been a beautiful journey so far, and we're really overwhelmed with the growth trajectory of the brand. So the company started with a personal story. I got a lab-grown diamond ring as a proposal ring. And, that's when the story started. We did some research. We were so fascinated that exact substitutes of diamonds have been in existence since 2008, yet people did not know about the category at all. So we started doing some research. We found out that the market in the US had gone from 1% to 19% in just 4 years between 2017 to 2021. And we also found out that less than 6% of Indians today own diamond jewelry. That's a very abysmal number. But when I ask you to think of jewelry, more often than not, you think of diamond jewelry. So the aspirational value is so high, yet Indians have not been able to own diamond jewelry either because of the prohibitively high costs or because they don't think it is practical to spend so much on diamonds. And we thought that this category was a perfect fit for the Indian masses to actually be able to fulfill their aspirations and get access to sustainable fine diamond jewelry. And that's how Jewel Box was born.
So big opportunity here, and it all started out with you receiving that engagement ring of yours. But Vidita, as a woman founder in the luxury and tech-driven jewelry space, right? What have been some of the unique challenges or sort of advantages that you've experienced, and how has that shaped your journey with Jewel Box?
So I think the journey has been full of challenges, but it's also been a very great and steep learning curve so far, because my co-founder Nipun, who also happens to be my sibling, and we do not come from any gems and jewelry or diamond background. So we had to do a lot of learning, a lot of unlearning, and cracking the supply chain, cracking the retail model. All of these have been full of challenges. But I think what helped us was the fact that we were not bowed down by a set of stereotypes or any traditional thinking of how jewelers have been operating. We brought a lot of fresh perspective and thinking into everything that we've done. We've been extremely consumer focused, extremely consumer obsessed, and everything that has gone into the making of Jewel Box is today just because we thought how exactly as customers would we like to be treated by a jewelry brand, and that's exactly the kind of operations that we do here in the brand.
Right. So you came in with fresh eyes looking at this industry from a completely different perspective, right? Another thing that I wanted to just focus on was typically women-funded startups have always attracted lesser investment than those started by men, right? Although that is seeing some sort of a change, but there's a long way to go for that. Do you see that this trend is still continuing? How are you creating an equitable workspace?
So, of course, the topic of women entrepreneurship and women empowerment is something very close to my heart. Today, as we speak, less than 15% of the entrepreneurial landscape is comprised by women entrepreneurs, which is a very low number. And we really hope that we can sort of push this. For this, I am a part of certain sort of women entrepreneurial groups that help women with mentorship, access to capital, knowledge, industry connects, and things like that. In addition to that, when it comes to Jewelbox, the team today is about 130 people. And I feel extremely proud in sharing that at least 40 to 45% of the workforce in Jewelbox is comprised by women.
So 45% of your staff are women, which is great to hear. Coming to the business now, right? With the freshly raised through $3.2 million, how are you planning to split the pie? You're eyeing store expansion, marketing, and talent with these funds that you've raised, right?
Yes, exactly. So I think the major part of the fund raise is going to go towards expansion of physical stores across Tier 1 and Tier 2 cities in India. And we're going to be doing this through franchisee-owned as well as company-owned stores. And a major part of the fund raise is also going to be allocated towards team building and brand building.
Right. And, like you pointed out, you're very customer-centric and a lot of your designs are getting a lot of buzz. So how do you balance keeping things trendy while still holding on to that timeless jewelry appeal? And if you could also shed light on who is your customer? Are you seeing younger buyers driving the demand, or is the appeal cutting across all age groups?
So I think when we talk about the assortment at Jewelbox, it is very, very inclusive with respect to the design language that we choose. So the idea is whether you come to my store or somebody else like me or maybe a third person comes to the store, everyone should be able to find something or the other that they end up liking. So we're actually solving for the tastes and preferences of a wide variety of audience. That's with respect to the design language. It's a mix of both classics as well as new trends that keep coming up in the fashion industry. Coming to target audience, we're building a conscious luxury brand, which is mostly for the masses of India. Like I said, the vision that we have with the brand is to fulfill the aspirations of the people who find diamond jewelry prohibitively expensive or who don't find diamond jewelry to be a practical purchase. So solving for them, I think we majorly have the masses of India in our mind while we're building Jewelbox.
Right. And if you could quickly tell us, you've gone from 3 to 8 stores, but 30 is quite ambitious, right? So what's the game plan for scaling the business with both franchisee and company-owned stores in the mix? How are you sort of balancing growth and control at this point?
Absolutely. So I think we've taken a very sustainable path to growth. In fact, it's been 3 years and we are a profitable brand, and we built it in a very a very planned and structured manner. Till 2 years, till the end of 2 years, till last financial year, in fact, we had only 2 stores in one city, which was Kolkata. But this financial year, the year that we just completed, we expanded to 6 cities and with 8 stores. So the game plan had to be solid. We knew that we needed to get the SOPs and the operations and the retail play absolutely right, and we had to nail it before we moved out of our home city, Kolkata. So now, as we are in 6 cities, we feel well braced to actually take the number up to 30 by the end of the year.
So taking it up to 30, but if you could quickly tell us in 10 seconds, right? You said you were profitable. What is the revenue target for this year?
So we plan to end the financial year with an ARR of 180 crores.
All right, Vidita, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Thank you so much. It was a pleasure speaking to you.
All right, on that note, it's time for us to head into a short break. Coming up, from the big screen to angel investing, Samira Reddy is now eyeing India's lucrative startup ecosystem. A special conversation on the other side. Stay tuned.
Welcome back. You're still with us on Startup Street. Actor Sameera Reddy is now eyeing the startup space, looking to join cap tables in wellness and fitness-focused brands. In a chat with my colleague Aishwarya Anand, Reddy, known for her own inspiring fitness journey, emphasized on sustainable health over shortcuts and also shared her thoughts on buzzy trends like Ozempic and why real wellness is more than just a number on the scale. Take a look.
Are there plans of investing in a startup which is in the health and wellness space? Are you looking at taking the investor route and getting on the cap table?
You know, this has been going on for the last couple of years. A lot of people have come to me. I think it's very important to put your name on something which your followers really love. Like, they love you and they respect you. So as I said, I try to go into spaces that I really trust. And coming on an investor is a big thing. But yeah, I have been looking at places because I do believe somewhere when we're working this hard with brands and we're the ambassadors and we're going out there, we should slowly get into that space. I am looking for a few things because I believe that in my age group, there are definitely women who want certain products that I think I can think of. So things have been happening. It's very bizarre you asked me that because the last 6 months, a lot of chitter-chatters going on.
This is that moment where something clicks.
But I won't put my finger just because there's money.
There's
I've always had that, you know. Otherwise, trust me, my Insta would be flooded with ads.
So if health and fitness is one, what are some of the sectors that appeals to you a lot if you've been looking at this space, just in terms of sectors that excites you quite a bit?
I love workout gear. In terms of, for me right now, I'm loving using, you know, it's something as simple as like, massage ball or bands, or like, it's really silly, but I just love my bench towel. I just like to look cool with my sippy cup. So there are a couple of things that I am really loving throughout my fitness journey. So if I would do something, it would be really things that I love and things that make me feel good going to the gym.
Okay. There's been a lot of conversation around, pharmaceutical drugs like Ozempic, and I just want to understand which values do you align more towards? How do you see the whole controversy play out?
So this is really funny, but about last December, I actually put on weight again. I put on about 4 or 5 kilos post Diwali and post Christmas, as all of us do. And I remember that time somebody said, hey, why don't you just take Ozempic? And I was like, what? I was like, hold on. First of all, no judgment here, but it's a diabetic user's product. It's a pharmaceutical product. And I don't understand where it entered the weight loss game. I mean, I can't understand it, and I don't even want to understand it because I have my views on it, for myself at least. And for me, what I wanted was, you know, at the age of 46, I need to build my bone density. I need to build bone muscle. My muscle. I need to make sure that my next 20 to 30 years are going to be in the healthiest, strongest possible way that I can have with natural supplements, or supplements that will not, in my opinion, regress once I stop them. Now, I don't know much about these products. I have not read about it. But in my personal view, I prefer going the natural way, which is use, maybe having your vitamin C, your gut health, the right kind of foods. And it's harder.
Yeah.
It's hard, but guys, it is hard. And now we are in April, and I'm down 4 kgs. And I'm feeling good, and my swelling has gone because I've controlled the salt, and I'm controlling the sugar, and I'm on a diet plan. And yes, it's hard, but you can do it. You can do it. And there are products out there. It's like you will constantly be shown these things. But trust me, I feel we're living in an age where everything is just fast. Kal chahiye, aaj chahiye, and I'm like, that doesn't work like that. Have a 3-month plan, have a 6-month plan. Stick to the plan, train your brain. It's not that difficult. But yes, if you're suffering from actual diabetic issue and you need these medicines, then of course you have to take them. And for which, by the way, everybody needs to get checked, to check their hormones, to see where they're at, especially women.
And with that, it is a wrap on this special edition of Startup Street, Future Female Forward. More news and updates coming up on the other side. Stay tuned.
Hello and welcome to the Global Dialogue. I'm Shireen Bhan. 2024 was a breakout year for OpenAI's ChatGPT, and 2025 promises to be equally exciting. Joining us now to talk about the innovation pipeline, what we can expect as far as the AI war and the AI race is concerned, is Kevin Weil, the Chief Product Officer at OpenAI. Kevin, many thanks for joining us. I know it's late in the evening for you, and it's been a busy week, an exciting week with lots of launches lined up, including tonight, where you had the O3 and the O4 Mini. So let me start by asking you, Kevin, to give us a snapshot in very simple language. What does ChatGPT 4.1 mean for OpenAI and for consumers? And how do O3 and O4 Mini change the game?
Yeah, well, first of all, thank you for having me. I really appreciate it. Excited to be here with you. India is an incredibly important market for OpenAI and ChatGPT. It's our second largest market. It's our fastest growing market, and it's also the market where we saw our image generation just take off. But we had some great launches this week. You mentioned GPT 4.1. Which was a model for developers that is fantastic at coding and complex instruction following. And so, for that was a model that we released focused on developers, and we're seeing them. We have over 3 million developers on the OpenAI platform, and they're doing amazing things. That is one of our fastest growing models by usage ever. And then just this morning in the US, we launched O3 and O4 Mini, which are our frontier reasoning models. They're the smartest, fastest, safest models that we have ever launched. They're incredible at things like computer programming. So if you look at measures like on competitive coding benchmarks, these models would be better at competitive coding than all but about 200 people in the world. And they can answer hard PhD level science questions better than 80% of PhDs in their field across all fields simultaneously. So they're really very intelligent models, but you can also use them for, more mundane tasks, understanding, medical jargon, or looking at what's happening in the world, creating images, helping you with writing, translating languages. These models are so dynamic, and we're super excited to see what people can do with them.
Well, thanks very much for giving us that update. But, I want to link this back to comments that you've made previously, including a tweet that I saw from you about 10 hours ago, where you talk about the fact that these are the worst AI models that you'll ever use for the rest of your life. As the Chief Product Officer at OpenAI, with things changing so quickly, and in your words, you believe that these are the smartest models to date. How does that get you to kind of constantly reinvent yourself, constantly disrupt yourself? I mean, how concerned are you not just about competition, but about creating moats that continue to give you the advantage that you enjoy today?
Yeah, it's one of the most exciting things about this industry. These are simultaneously the most intelligent models in the world, the best that we've ever created, we believe the best in the world. And they're the worst that we will ever use, because the models are progressing and getting more intelligent, getting safer, getting smarter. Every few months, there's a new breakthrough, and all of a sudden, computers can do something that computers have never been able to do before. If you go back 2 years or so to when ChatGPT launched, if I asked you to use those models, at the time, they were amazing. They were mind-blowing. If I asked you to use those models now, you would be disappointed. And that's just because of the pace that everything is getting better. We've kind of whooshed past the Turing test, which used to be the high watermark for, is AI here? Yeah. And now that's in the distant past. Every AI model is passing the Turing test. So it's an exciting time. And the fact that ChatGPT has gone from 0 users a couple years ago to over 500 million active users today just shows how valuable these things are in people's lives.
I want to double down on this, Kevin, because you've also said that models are getting smarter, faster, cheaper, safer, more personalized, and more helpful. The future is bright. That's a lot to pack in. If I were to ask you what you prioritize today, when you look at how you develop and build the next line of products? Are you going to be prioritizing making this much more accessible, i.e. cheaper, given the kind of breakthroughs that we've just seen with DeepSeek? What do you prioritize in the attributes that you've outlined that models will need to focus on?
I think first and foremost, I care about making these models more broadly accessible and more useful to people. And that entails making them smarter and safer and things like that. But first and foremost, I want ChatGPT to help people live better lives, to help them accomplish their goals more quickly, to help them learn new languages, to help them learn new skills, to help them do the kinds of things they need to do for their family or their job faster so that they can spend more time on the stuff that they really care about. These models are, and ChatGPT helps me do this every day. As we think about building models for, developers, for programmers, for entrepreneurs who are running startups or working at companies, one of the things that we care a lot about is reducing the cost of our models, even as they get smarter. If you compare today to 2 years ago, again, when we launched, GPT-3, GPT-3 was more than 100x more expensive than are some of our models today. And our models today are smarter and faster. And so, I talked before about how rapidly this industry is progressing. You can do so much more today with an AI model than you could 2 years ago. And it's cheaper, and it's faster, and it's safer. And so it affords an incredible set of opportunities for people, for businesses, for developers all over the world. And we're very, proud and humbled to be able to help provide that.
But Kevin, how much cheaper can we expect things to get, in the near term? What are we talking about?
Well, so I said 2 years ago, our kind of flagship model was more than 100x what many of our models today cost. So you're talking about maybe 10x a year in price drop for sort of a constant level of intelligence. So the same level of intelligence in a model maybe gets 10x cheaper every year. And that's, Moore's law, which has transformed the world and powers our lives, and every little thing that we do every day has a transistor in it. Moore's law was about the number of transistors in a chip doubling every 18 months. And that changed the world. AI is on a trajectory of going down by a factor of maybe 10x in cost every year. So it's a much steeper exponential than Moore's law, which means I think we're going to see AI transform the world even faster. And that's exciting. I'm very optimistic about that.
You're talking about AI transforming the world, and I know previously you've spoken about the fact that you believe AI will surpass human coding, perhaps even by the end of this year. To parents and to kids who are looking at grad school, at people who are graduating from engineering colleges today, you talk about a bright future, but as they look at the expanse of what's going on and the disruption and transformation that's expected to happen, what would you tell them? Because it almost sounds like, you're writing the obituary in a way for coders.
I actually don't think so at all. Jobs evolve, they don't evaporate. If you go back and look at, I watched the movie Hidden Figures recently, which is about some of the rocket scientists from back in the 50s and 60s. They were doing longhand calculations on paper to calculate rocket trajectories. And today, that seems wild that you would have people doing it, right? Computers are just better than humans at doing hard calculations. And so, of course, computers do all of that for us. But that doesn't mean that there aren't rocket scientists today. And in fact, we've probably made far more progress if you look at things like SpaceX and also things like, the ISRO, the Indian Space Agency, which is, an incredible space agency, one of the premier rocket launching agencies in the world. I think we're far better off because we have computerized these things and computers do it better than humans do. I think that will be true of code as well, but that doesn't mean that it won't pay to be technical, that it won't pay to have a computer science degree. I think these skills will still be important. They're just going to evolve.
Well, speaking of evolution, let's talk about what you're seeing in India. You talked about how it is today your fastest growing market for ChatGPT. How many active users do you have in India? What surprised you about the adoption, the rate of adoption, the pace of adoption in India? Why do you believe you've seen this kind of an uptick here?
Yeah, I mean, our active users in India tripled, more than tripled in 2024. So it's been incredible to watch. We a few weeks ago we launched a new image generation tool using AI to generate incredibly images that you can control to a great degree, whether you want them to be vivid and lifelike or cartoony or following a particular style. We saw Prime Minister Modi tweeted using our image gen feature. We had cricketers like Sachin Tendulkar tweet images from ChatGPT, and it just took off. I mean, unlike anything I've ever seen. I've been fortunate to be at Twitter for many years. I led product at Instagram for a number of years. I mean, these companies were growing very quickly. I have never seen anything grow like ChatGPT was growing because people were having so much fun creating these images, sharing them with their friends, on WhatsApp and in other places. And it's just incredible to see. So we marshaled a whole lot of resources. We really tried to support it, especially in India. We released new features around our image gen, like image galleries that let you quickly view all of the images that you've created. There's just a huge amount of excitement in India for ChatGPT, and not just for this image gen feature, but also, ChatGPT speaks 100 languages. It can teach you any subject you want to learn. It can save you time at home and at work. And so, it's so broadly useful, and it's completely free. You don't have to pay us a dime. You can use it on an Android phone for free. So it's just, we deeply believe in bringing AI to the world and in the positive impacts that can make. And I can't think of a better example than, what's happening in India right now with ChatGPT.
Well, you talked about the Gibbalization of India, and we've seen that go viral, as you just explained to us. But I want to link this to the broader issues that are being debated at this point in time, issues related to copyright, issues related to data privacy. Is this a great way of data capture for OpenAI? That's the question that's being asked as well. And Sam Altman has said that he believes it's a net win for society, but there are negatives. I want to ask you this as the chief product officer. When you're developing and designing products, you do need to factor in his words, the negatives. As you look at where you are today in your innovation cycle, how much more of that is a focus area for you?
Oh, we think about it all the time. I was at Twitter in the early days. I was at Instagram. I think we know the promise of those platforms, and we also now know a lot better than we did 15 years ago some of the challenges inherent in broad scale platforms. OpenAI and ChatGPT, we spend more time and effort, and we put more thought into trying to understand both the positives and the negatives of how our work can be used. Far more than any company that I've worked at in the past. Doesn't mean we're going to get it right every time. I'm positive that we will make mistakes. We have made mistakes before, but we work very hard at trying to understand how this can be used. We also have a philosophy of iterative deployment. And when we say iterative deployment, what we mean is we want to get our products out to people early and often. We don't believe in developing something and keeping it in-house and then kind of launching it massively globally all at once to everybody. We believe in getting it out as soon as possible and in kind of co-evolving with society, learning as we go from how users are using the products, and where, if and when we make mistakes, we can fix quickly and continue to move forward. So there's this sort of humility to working to bring our products to people in an iterative fashion, listening, learning, making improvements, and then continuing to move forward. And I really appreciate that about OpenAI.
We are going to take a break here on the Global Dialogue and return with our conversation with Kevin Weil, the Chief Product Officer at OpenAI. Welcome back. You're watching the Global Dialogue. We're in conversation with the Chief Product Officer at OpenAI, Kevin Weil, on the big launch that they've announced last night. Launches, you have, of course, had a busy week, but ChatGPT 5, is there a pushback there? How much, what is the kind of delay that we should expect? And what should we be looking forward to now in terms of next steps? There's a lot of rumors and speculation around a Twitter kind of product. What can you share with us on that?
Yeah, well, we're very excited about GPT-5. There are teams working on it as we speak, and I think it's going to be a fantastic new model when we get there. But in general, this is the year that ChatGPT goes from answering questions for you to doing things for you in the real world. So, by that I mean we launched a product earlier this year called Operator that can browse the web like a human and do things for you. It can order food for you, through an online food ordering website. But it can also fill out forms. It can shop. It can do anything that you would do on the web, and of course you're in control the whole way. It's before it takes a sort of definitive action, it will pause and ask you if you want it to continue some action. But when I think about the time I spend on the web, I bet 30 or 40% of the time that I'm browsing the web, it's not because I want to be doing what I'm doing. It's because I have to get something done, and there's some series of pages and forms I have to fill out and other things. I would love an AI to do that for me. I would absolutely love for an AI to fill out those forms for me so that I can concentrate on, either getting more work done or spending more time with my family. And this is the year when AI begins to do more things like that for you. I'm very excited about that. It comes because of the advances that we're making with these reasoning models that are getting smarter and safer. And it comes with, integrations into the sites that you know and use every day. So that our models can understand them and can take action on your behalf.
You didn't respond to the rumors and the speculation around a likely Twitter-like product launch.
We'll see. We'll see.
Kevin, I know you don't sleep a lot, so let me end by asking you, what's keeping you up at night? I mean, is it Anthropic? Is it DeepSeek? What's keeping you up at night?
Honestly, we have so many fun things coming. What's keeping me up at night is much more trying to make sure that we deliver as fast as we can and deliver the best products that we can as fast as I know we can to all of the people around the world that rely on us. There's a lot of good stuff coming. I wish I could, take you through the entire roadmap here. But I'm very excited by it. The whole industry is moving fast. Our competitors are doing great things as well. But, I've never seen something grow the way that ChatGPT is growing globally and specifically in India. It's such an important market for us. So we've got a lot more great stuff coming, and I think people are really going to like it a lot.
I want to link this and end by asking you about the use cases, and education, I would imagine, is the big one. And I know that you've spoken about that previously as well, Kevin. Especially for a market like India, what can we expect? Is that going to perhaps be a focus area or priority that you would want to consider doubling down on?
Yeah, I think there are, people think about ChatGPT as you can make your job more efficient, you can write emails more quickly, things like that. But I think there are a handful of things that we can do, products that we can work on that will fundamentally make the world a better place. One of them is in the area of scientific discovery. These models are getting good enough that they are actually contributing to novel scientific research. They're advancing fundamental science. And, GDP and world advancement and human growth comes from advancing fundamental science. So, if these models can help scientists advance, if they can speed the pace of discovery 2x, 3x, 5x, 10x, that's an incredible impact in the world. If they can help people understand, my son went through a medical procedure not long ago, and we expected it was not going to be a big deal, but there was a small chance that it was a big deal. There was something wrong. I got a note later from the hospital that was full of, medical jargon that I didn't understand, but it sounded scary. And I couldn't get a hold of the doctor to ask. I uploaded the image to ChatGPT and said, "What is this? What's going on? Is this something to worry about?" And it said, "Oh, no. Here's what it is. You don't have to worry. This is totally benign." And that was 72 hours of worry and stress that I would have had that was gone because ChatGPT helped me understand something that I didn't have the background to understand. And that's our family with, we're fortunate to have great medical care and all of that. There are lots of people around the world who don't have access to that, where having the ability to talk to something like ChatGPT could be life-saving. And then, you asked about education. Every study I've ever seen says that when kids get individual tutoring, they get personalized education, their advancement rates are standard deviations better than kids that don't get personalized tutoring. And again, ChatGPT is free. It knows the curriculum for every class and every topic in the world and can give students personalized learning that evolves with them. Like I want to see every kid in the world have a personalized tutor that is helping them learn any topic they want to learn, whatever they're excited about, as fast as they want to go. The world will be a fundamentally better place when that exists. And I think we can be a part of making it happen, whether it's directly in ChatGPT, whether it's one of the developers and entrepreneurs using our APIs. I deeply want to see that happen because the world will be a better place. And, I would love to see that come from India.
Well, I'll end with India then, Kevin, because, on the back of the usage, the adoption, the acceptance that you have seen in India, is there anything specific that you've taken back in terms of learnings to iterate for the next wave of product launches that we could expect?
Yeah, I mean, we just had 10 or 12 people from the team in India doing a bunch of user research, talking to people in different, urban and rural parts of India. I was there a month ago with Sam Altman and meeting people, talking to users, talking to developers. The amazing thing is how broadly ChatGPT is used. You ask a room full of developers who uses ChatGPT, and they all raise their hands. It's really exciting to see. And they all have 100 things that they want to see us implement or do better, new features, new ideas. We know that one thing that's really going to be important for us is performance in low bandwidth environments. Not everybody has a great network connection. We really want ChatGPT to be broadly usable across the entire country, no matter what, cell phone, no matter what network connection you have. That's important. We're also thinking a lot about how we broaden our language support. So ChatGPT, I believe, is the best ranked model in the world for the top 11 Indian languages. But there are a lot more than 11 Indian languages, and we want ChatGPT to be great for everybody in India. And so we're thinking about broadening language support and making more of ChatGPT voice forward for those kinds of use cases. So we have a lot of ideas. They're going to benefit people in India, and they're going to benefit users all around the world, and we're very excited about it.
Well, Kevin, thanks so much. We look forward to seeing more of you here in India and appreciate you taking our time very late at night to be able to speak to us today. Thanks so much, and we wish you the very best. Look forward to seeing you soon.
Yeah, thank you. And by the way, when I was prepping for the interview, I told our new model, 03, that I was going to be meeting with the premier broadcast TV interview or broadcast Indian business-focused TV station in India. And I said, what station do you think it is? And it said, oh, clearly that's going to be CNBC-TV18. So 03 is a genius.
Clearly, 03 is a genius. But Kevin, what an absolute pleasure. Many thanks for joining us. And we look forward to having a deeper, longer conversation with you. Thanks so much for your time today. We are going to take a break here on the Global Dialogue, but there's a lot more coming up. Don't go anywhere. We're back in a moment with more. Hello and welcome to the Global Dialogue. I'm Shireen Bhan. 2024 was a breakout year for OpenAI's ChatGPT, and 2025 promises to be equally exciting. Joining us now to talk about the innovation pipeline, what we can expect as far as the AI war and the AI race is concerned, is Kevin Weil, the Chief Product Officer at OpenAI. Kevin, many thanks for joining us. I know it's late in the evening for you, and it's been a busy week, an exciting week with lots of launches lined up, including
tonight, where you had the O3 and the O4 Mini. So let me start by asking you, Kevin, to give us a snapshot in very simple language. What does ChatGPT 4.1 mean for OpenAI and for consumers? And how do O3 and O4 Mini change the game?
Yeah, well, first of all, thank you for having me. I really appreciate it. Excited to be here with you. India is an incredibly important market for OpenAI and ChatGPT. It's our second largest market, it's our fastest growing market, and it's also the market where we saw our image generation just take off. But we had some great launches this week. You mentioned GPT 4.1, which was a model for developers that is fantastic at coding and complex instruction following. And so, for that was a model that we released focused on developers. And we're seeing them, we have over 3 million developers on the OpenAI platform, and they're doing amazing things. That is one of our fastest growing models by usage ever. And then just this morning in the US, we launched O3 and O4 Mini, which are our frontier reasoning models. They're the smartest, fastest, safest models that we have ever launched. They're incredible at things like computer programming. So if you look at measures like on competitive coding benchmarks, these models would be better at competitive coding than all but about 200 people in the world. And they can answer hard PhD level science questions better than 80% of PhDs in their field across all fields simultaneously. So they're really very intelligent models, but you can also use them for, more mundane tasks, understanding, medical jargon, or looking at what's happening in the world, creating images, helping you with writing, translating languages. These models are so dynamic, and we're super excited to see what people can do with them.
Well, thanks very much for giving us that update. But, I want to link this back to comments that you've made previously, including a tweet that I saw from you about 10 hours ago, where you talk about the fact that these are the worst AI models that you'll ever use for the rest of your life. As the Chief Product Officer at OpenAI, with things changing so quickly, and in your words, you believe that these are the smartest models to date. How does that get you to kind of constantly reinvent yourself, constantly disrupt yourself? I mean, how concerned are you not just about competition, but about creating moats that continue to give you the advantage that you enjoy today?
Yeah, it's one of the most exciting things about this industry. These are simultaneously the most intelligent models in the world, the best that we've ever created, we believe the best in the world. And they're the worst that we will ever use, because the models are progressing and getting more intelligent, getting safer, getting smarter. Every few months, there's a new breakthrough, and all of a sudden, computers can do something that computers have never been able to do before. If you go back 2 years or so to when ChatGPT launched, if I asked you to use those models, at the time, they were amazing. They were mind-blowing. If I asked you to use those models now, you would be disappointed. And that's just because of the pace that everything is getting better. We've kind of whooshed past the Turing test, which used to be the high watermark for, is AI here? Yeah. And now that's in the distant past. Every AI model is passing the Turing test. So it's an exciting time. And the fact that ChatGPT has gone from 0 users a couple years ago to over 500 million active users today just shows how valuable these things are in people's lives.
I want to double down on this, Kevin, because you've also said that models are getting smarter, faster, cheaper, safer, more personalized, and more helpful. The future is bright. That's a lot to pack in. If I were to ask you what you prioritize today when you look at how you develop and build the next line of products, are you going to be prioritizing making this much more accessible, i.e. cheaper, given the kind of breakthroughs that we've just seen with DeepSeek? What do you prioritize in the attributes that you've outlined that models will need to focus on?
I think first and foremost, I care about making these models more broadly accessible and more useful to people. And that entails making them smarter and safer and things like that. But first and foremost, I want ChatGPT to help people live better lives, to help them accomplish their goals more quickly, to help them learn new languages, to help them learn new skills, to help them do the kinds of things they need to do for their family or their job faster so that they can spend more time on the stuff that they really care about. These models are, and ChatGPT helps me do this every day. As we think about building models for, developers, for programmers, for entrepreneurs who are running startups or working at companies, one of the things that we care a lot about is reducing the cost of our models, even as they get smarter. If you compare today to 2 years ago, again, when we launched, GPT-3, GPT-3 was more than 100x more expensive than are some of our models today. And our models today are smarter and faster. And so, I talked before about how rapidly this industry is progressing. You can do so much more today with an AI model than you could 2 years ago. And it's cheaper, and it's faster, and it's safer. And so that it affords an incredible set of opportunities for people, for businesses, for developers all over the world. And we're very, proud and humbled to be able to help provide that.
But Kevin, how much cheaper can we expect things to get? In the near term, what are we talking about?
Well, so I said 2 years ago, our kind of flagship model was more than 100x what many of our models today cost. So you're talking about maybe 10x a year in price drop for sort of a constant level of intelligence. So the same level of intelligence in a model maybe gets 10x cheaper every year. And that's, Moore's law, which has transformed the world and powers our lives, and every little thing that we do every day has a transistor in it. Moore's law was about the number of transistors in a chip doubling every 18 months. And that changed the world. AI is on a
Hello and welcome to this special show. No, you're not fine the way you are. That's how the latest book by Dutch historian Rutger Bregman urges people to think outside their comfort zone. The book, titled Moral Ambition, shows you a path to make a difference to the world rather than just watch from the sidelines. The author argues that a 40-year full-time career consists of around 80,000 hours, 10,000 work days or 2,000 work weeks. But how you spend that time is the most important moral decision of your life. What should be the main ingredients of moral ambition? Where to start in terms of identifying the world's problems? And do money and idealism go together? Those are some questions that the book addresses. Joining us right now is the author, Rutger Bregman himself. Bregman had made headlines in 2019 in Davos for calling out billionaires for tax avoidance and flying in private jets to talk about climate change.
This is my first time at Davos, and I find it quite a bewildering experience, to be honest. I mean, 1,500 private jets have flown in here to hear Sir David Attenborough speak about, how we're wrecking the planet. And I mean, I hear people talk in the language of participation and justice and equality and transparency. But then, I mean, almost no one raises the real issue of tax avoidance, right? And of the rich just not paying their fair share. I mean, it feels like I'm at a firefighters conference and no one's allowed to speak about water, right? there was only one panel, actually.
Well, we've had two. You're the second of our panelists.
There was only one panel.
Let's go there.
One panel hidden away in the media center that was actually about tax avoidance. Yeah. I was one of the 15 participants. So something needs to change here.
Rutger, thank you so much for joining us on the program today to speak about your latest book, Moral Ambition. One of the lines that the book begins with is no, you're not fine just the way you are. People may spend their whole lives climbing up the ladder of success only to find, once they reach the top, that the ladder is leaning against the wrong wall. Why did you feel it is important to shake up your readers and their thinking and their approach towards work and professional life?
Yeah, well, my reasoning is pretty simple. In the first place, we have a lot of very big global problems. So 15,000 kids die from easily preventable diseases every day. 85% of the world population is below the poverty line of the country in which I live, the Netherlands. We have the threat of the next pandemic that may be just around the corner. There's war, there's democratic backsliding. You know, there are a lot of things we got to do something about. But then the second thing is that a lot of people are currently stuck in jobs that don't really add all that much of value. And I'm not talking about teachers or nurses or care workers. No, I'm talking about people who often went to great universities, who have beautiful resumes, who may be a marketeer or a banker or a corporate lawyer or whatever. And still, at the end of the day, they have the feeling that they don't really contribute all that much. There's one big study that showed that around 25% of people in developed economies even think that their own job is socially meaningless. So there's a huge waste of talent going on. And my book is basically a call to arms. It says that if you are very talented, if you have a little bit of ambition, then you should use that to make the world a wildly better place. And I call that moral ambition. It's the combination of the activism or the idealism of an activist and the ambition of an entrepreneur. When those two things come together, something really magical starts to happen.
Right. But at what stage and at what point should people start thinking about this? Because the common line that we hear when someone talks about changing the world or launching a political party or working towards a social cause is that you can't change the world, or it's better to stick to the beaten path, you know, have a work life balance, earn a good enough amount of money for your family, for your holidays, so that you can retire well and early. Nothing wrong with it, but perhaps, according to your book, one wouldn't be very satisfied with this way of living. But how does one come to the conclusion that you're cut out for making a difference to the world, for leaving an impact? And where do you really start off?
Well, history is littered with examples of small groups of really thoughtful, committed citizens who made a massive difference in the fight against some of the greatest problems we face as a species. In the book, I talk, for example, about the abolitionists, those who took up the fight against the slave trade and against slavery. And you got to remember that in the 18th century, in a country like the United Kingdom, for example, this was really, really unpopular. The United Kingdom was making an enormous amount of money on the slave trade and on slavery and on having this whole system of colonies. But then there was a small group of mostly entrepreneurs and businessmen who said, this is the greatest moral atrocity of our time. We should kickstart a movement against this. So it is really small groups of really committed people that can make a difference. History shows us this. And I've tried to write sort of a self-help book, a guide that people can use if they also want to follow that path. Now, I got to say, if you want to read a book that will make you more relaxed or more mindful or happy or whatever, then you should probably not read my book. There are thousands of self-help books that will teach you, how to do less. But this is a book about how you can do much more and how you can really leave your mark on history.
Right. Now, speaking about leaving your mark on history, you speak about what startup founders, young entrepreneurs can also do. you know, your book also argues, and you've said this, that a lot of times we are launching companies or launching solutions to the problems we never really know we had, or it's probably too simplistic. So what is the kind of mindset or moral ambition that young entrepreneurs need to have?
Yeah. So we got to realize that ambition, it's just raw energy. You know, it can fuel a rocket that goes to Mars, but it can also fuel a bulldozer that, you know, waltzes over a rainforest. So it's just energy. And what really matters is how you use it. What I currently see is that there are a lot of young entrepreneurs starting new companies that, you know, create these products that are perhaps in the best scenario, okay, but in the worst scenario are actively harmful. So there's a famous quote from someone who worked at Facebook a long time, and who said that the best minds of my generation are thinking about how to make people click on ads. And that is pretty sad, isn't it? That you have all these really smart people who could technically do an enormous amount of good. You know, in a country like India in particular, if you know, would take up the fight against some of the greatest health problems, just imagine how many lives you could save. It's honestly extraordinary. So it's always a little bit sad to me when those very, very talented people, spend so many hours on something that doesn't actually matter all that much. Maybe you can make a lot of money with it, but in the end, you know, what are you going to think about when you lie on your deathbed? About all the PowerPoints from colleagues that you didn't see, about all the long meetings that you didn't attend, or about the actual impact you made. That's I think what really counts in the end.
Right. You know, how would you define moral ambition today? Of course, when you hear the term, you immediately think about doing something good for society. But according to you, what would be the 4 main ingredients of moral ambition that youngsters, that entrepreneurs, industry veterans, CEOs can keep in mind?
So I co-founded an organization called the School for Moral Ambition that helps as many talented people as possible to pivot their career and to use their resources, whether it's their talent or their capital or their network, to make the biggest possible difference. And we use a simple framework to help people focus on those biggest problems. It's called the SSS framework. So we focus on problems that are really sizable, they're very big, they're solvable. You got to have some plan of, you know, what to do about them. And most importantly, they're also sorely neglected. You know, if you go and work on the issues that everyone else is already working on, then you're not going to make the biggest impact. So, for example, I'm someone who grew up in a rich country, in the Netherlands, in Northern Europe. If I want to, you know, help as many people as possible and to improve their health, then, you know, probably focusing just on the Netherlands, where we already spend a huge amount of healthcare, is not going to make the biggest possible difference. If I would shift my focus and focus on something like malaria, for example, 600,000 people die from malaria every single year, mostly kids under 5, well, then I can suddenly do much more good, right? Because it is so neglected. So if you're really morally ambitious, you gotta dare to go where others don't go. You gotta be able and be willing to do the unpopular or the unsexy things.
Right. And does this mean, you know, because when we hear about working for a social cause, working for the betterment of society or world, you often hear that you need to lead an austere life. Can one have a day job where you're working as somebody in the corporate sector, have the ambition of rising up the corporate ladder, yet be an idealist? Can money-making, idealism all go hand in hand together?
Well, I think that money is pretty important if you want to make a big difference. The former UK Prime Minister, Margaret Thatcher, she once said that the Good Samaritan, you know, from the Bible, he didn't just have good intentions, he also had money. So yeah, if you want to make a biggest possible difference, you got to find some way to attract capital. And here, I think philanthropists or brave philanthropists can make an important difference. If you study these great movements of the past, I mean, I already mentioned the abolitionists. They weren't financed by governments. You know, government was not giving subsidies to these people who fought the slave trade because the government was making an enormous amount of money. facilitating the slave trade. The same was true for businesses. They were certainly not giving money. So there you need very brave individuals who are willing to go against what is fashionable, against what is popular. And look, I also realize that there are a lot of young people who are like, well, how am I going to buy my own house? You know, how can I make my own career if I don't climb this corporate ladder? And I do understand that. I just think that there's more to life, probably. And for a lot of these talented, privileged people, my message is, look, you can only drive one car at a time, right? At some point, it's okay. And then other things become much more important. And it would be a shame if you lie on your deathbed and you're like, oh, as you said, I've been climbing the wrong ladder my whole life.
Right. You know, you've spoken about how awareness is the best starting point, while for many it has become the end goal. What do you think we need to do in order to become a more satisfied individual, make a difference? And what is the problem, according to you, with the kind of activism that we see?
You know, the reason I wanted to write this book is that, honestly, I became a little bit fed up with myself. I'm a writer. I spent 10 years of my career providing my opinions from the sidelines. Indeed, as you mentioned, shouting things like taxes, taxes, taxes when I was invited to Davos. And that can be very satisfying, but it's also quite easy. Here I was, you know, on the sidelines, watching the people who are doing the real work, who are in the arena, you know, with the sweat on their faces. And I started experiencing this emotion that I like to describe as moral envy. I was just jealous of the people who have some skin in the game, who do the real work. And I indeed realized that awareness is vastly overrated. I had spent 10 years in the awareness industry, providing my opinions. But very often, people don't do much with what they know. To give you one simple example, most people know that billions of animals are terribly tortured in what we call factory farms. Or we can know about that at least, but most of us just choose to ignore that. So the real challenge is in bridging the gap from awareness to action, to actually do something. And so I wanted to write a book that would be a big kick in the butt for myself, that would force myself to make a difference. And hopefully it's helpful for others as well. You know, as I said, I've co-founded this organization now, completely changed my life, turned into a social entrepreneur. And that has taught me many lessons, and also, caused me to believe that it might be possible for others as well.
All right, just stay with that thought, Rutger. We have to take a short break, but don't go anywhere. When we return, this conversation with Rutger Bregman, the Dutch historian, will continue on his book, Moral Ambition. We'll get you much more after this break.
Whatever impact we have seen in terms of F&O order, on month-on-month basis, I am seeing a growth of around 6 to 7% now for this past 2 months. So that gives a broad sense that, okay, retail are coming back. See, for retail, there was no reason for them to come back because markets were depressed. They did not see any opportunity, and they were not in a hurry to really jump and decide that what kind of an instrument they...
Welcome back. You're watching CNBC-TV18, and we are in conversation with the Dutch historian Rutger Bregman on his latest book, Moral Ambition. I just want to go back to that Davos moment of 2019 when you called out billionaires for tax avoidance, for using, for burning aviation fuel to fly down to Davos in private jets as well. How was that moment in your career as a historian, as an author? Were you invited to Davos again after that incident? And what was the kind of feedback you received?
So for some reason, they never invited me back. I guess it was something I said that they didn't particularly like. But I have been wondering, obviously, after those years, like, how can we make more progress in the fight against tax avoidance and tax evasion. Because wherever you go, whether it's the United Kingdom or India, the United States or the Netherlands, everywhere billionaires have lower effective tax rates than working class people. And that seems to me utterly unreasonable and utterly unfair. Now, you can just shout that and say that and go viral for it, but wouldn't it be much more effective to build a SWAT team, a very dedicated cohort of people who want to dedicate their career to fighting for tax avoidance and tax justice? So that's what we're doing right now. We are starting a campaign on Wall Street in New York. We are recruiting the best wealth managers, the best bankers, the best fiscal lawyers, and we are convincing them to pivot their career, basically saying, look, you're now working on the wrong side. You can leave your job and work for us. It's only going to be for the best of the best, so it's very hard to get into one of our fellowships, as we call them. But that's what we're going to do.